Against the rest of the board. So we'll see if that persuades any other shareholders to do the same. And after Nike's numbers guy, we will certainly watch Adidas, Puma and JD Sports.
There's a lot to fold into the market this morning. Sneakers, we've got those factored in. We've got defense stocks we need to be talking about. The US shutdown obviously is a big story as well for these markets. I'm just going to kind of talk over this very quickly and then hand things back. We have some stocks to watch and we have some markets that are open. There we go. We found the markets. Stock 600 is flat at the moment. The FTSE 100 giving back early gains. We are likely to see a number of factors folding into that market as well. The defense story will be significant. The banks, though, are really interesting in the Spanish space and more broadly across the European space. The IBEX is giving back a little bit of ground. But look at that. The FTSE 100 is the standout story this morning on the upside, despite everybody else softening up. The FTSE 100 looks like it's having a fairly good day, which is interesting in the light of what else is going on around the world. Is this going to be, could this be, given the valuations, a safe haven space in terms of the global equity market picture? Kriti, what are you seeing on the sector front?
Well, healthcare seems to be the leader this morning. That might explain the outperformance you're seeing in the FTSE 100. I'm just looking at the stock 600 and your biggest index contributors. AstraZeneca, Roche, Novo Nordisk, Novartis, Sanofi, GSK. Those are your top 7 tickers this morning in terms of contributing to the upside. So, Anna, it really speaks to this idea that that's where the gains are. But again, it's coming a bit of backdrop of red.
Right, yes. And it's interesting, the drug sector. So on the one hand, you know, if markets are broadly weaker and we're worried about shutdown, then maybe there's some haven status to pharma. But more specifically, JP Morgan giving us a sense of why this is happening. So Pfizer's Trump deal. So remember, after hours European time, Pfizer did a deal with the Trump administration, or at least it came to light, that would mean that they're not going to be so subject to these tariffs. And JP Morgan saying that this could act as a bellwether for the sector. It could reassure investors over a broadly manageable impact for the pharmaceutical sector. And so if that is the sentiment that is writ large with investors here in Europe, then that seems, you know, plausibly to be pushing these pharma stocks a little bit higher, even on a day when some new tariffs are being introduced by the United States.
Yeah, as you say, the logic is defensive and also de-risking. So 2 factors which obviously maybe play in to that narrative. It's interesting that tech is on the back foot this morning. So ASML, SAP, both the biggest drags on this market this morning. But third in terms of the movement that we are seeing is Rheinmetall.
Yeah.
So it's interesting that we are seeing some of the defense stocks maybe weakening up. Are we refocusing our attention away from hardware, armored personnel carriers, that kinds of kit, which Europe is going to need a lot of, maybe towards the drone space? Maybe you see some movement there. I don't know. But it's interesting that we are seeing maybe some ground being given back. Some of the banks are a little bit weaker, but Rolls, Airbus, both giving back some ground. Safran also giving back some ground as well. So, yeah, a little bit of a rotation towards the pharma space, away from tech and away from defense. 2 of the big themes that have driven this market recently.
I wonder if today is kind of a new start to a new month, new start to a new
That's
quarter.
Also a factor.
Take into the valuations piece. Of course, we are seeing that underperformance in the tech space in the broader U.S. stock market as well. In the futures picture, that feels to be maybe a little bit of a reset you're seeing in those valuation-heavy pieces of the market on this side of the Atlantic. Let's get a little bit more analysis here. Fiona Bowl, Managing Director and Global Head of Equities over S&P Dow Jones Indices, joins us around the table. Pleasure to have you. Thank you so much for your time this morning. We're kind of thinking about how we're positioning for this new quarter. For you, what is top of mind in Q4?
Look, I think the S&P 500's had a great run so far this year, up 15%. We know valuations are, I don't want to say high, stretched, maybe, but the market seems to still like US equities. I think we'll be definitely watching that. We have seen some flows move into the European market. Maybe the shutdown is a catalyst for that to continue. But we would, think that with earnings and revenue still looking pretty good for US companies, that the focus will remain on the US market.
What is driving the equity story? I mean, 3 months ago, we were talking about margin compression. We were talking about consumer demand falling off a cliff. It feels like the tariff impact, some of which, as Anna mentioned, are kicking in literally today, is kind of being brushed off as something that can be absorbed by consumers, but then also by companies. But by that logic, shouldn't the stock market have taken a bigger hit if you're trading on margin compression?
I think we've definitely seen a bit of a wait and see, and while we're waiting and seeing, we're still seeing money move into the US equity market. So, let's see, as you said, some of those tariffs come in today. Let's see how long those companies can hold or how much of a margin compression they're willing to take. And let's see how the consumer reacts. I think, again, we haven't really seen too much impact on the consumer just yet.
Yeah, Fiona, I mean, you run some of these indexes that we're watching go to these really elevated levels, all-time highs. So you mentioned the S&P 500. I wonder what you take away from the fact, though, that investors are clearly demanding other ways of looking at the S&P. So the fact that they're looking at equal weight, or they're looking at things that downplay the tech and upplay some of the other stuff. I mean, what does that tell you about tech valuations and where we are on that journey?
I think it basically tells you that investors are being much more nuanced in their approach. Traditionally, you just bought the S&P 500, but now if you're looking at tilting your US exposure, so you're either like diving straight into the mega caps and looking at the S&P 500 top 20, or as you said, you're looking to downplay that mega cap exposure and look at an equal weight or a capped index. So I think it's more telling me that investors are being much more deliberate about how they express the US equity
Because a lot of active managers sit in that seat, Fiona, and they tell us that this is the kind of news environment, political environment, where you really need active management because there's so much politics. A lot of it's unpredictable. There's devils in a lot of the detail, and so you've really got to know these companies bottom up. Does that chime with what you're seeing?
Well, it chimes in the fact that the allocation is what is active. So again, investors are looking at using passive strategies, but their allocations are changing around, do they want to be highly involved in mega cap or do they want to tilt away from that? Our latest SPIVA report, which looks at active versus passive, would say that active managers are in a green period, that if they're going to outperform the index, as you said, this is the time they're going to do it. But again, over long periods of time, it doesn't work out that well for them.
How are you thinking about the dollar? How are you thinking about non-US investors in the US market? I keep bringing this up. The S&P is flat on the year if you're a euro-based investor. How do I think about that? How do I hedge my risk in terms of the currency factor, which is playing a much bigger role right now?
Yeah. Certainly last year we saw our European clients saying that they wanted to have US exposure in US dollars, and that they've switched that around in the last, I would say in the last 6 months. So you were getting like a double bang for your buck, right? You were owning the 500 and you were long the dollar.
It's reversed.
It's reversed. And we've definitely seen that in flows. So we've seen the change in the way that you're allocating to the US. And as I said before, we're also seeing a lot of European and other non-US investors just tick up slightly that global equity exposure.
Okay, so let's talk about that global equity exposure. The dollar goes down even more. I'm going to whisper this. The emerging markets, there's signs of life. If the dollar continues to go down, does that spark become something a little bit cosser?
I was in Mexico a few weeks ago, and it was really interesting to talk to investors there about what they're seeing, and they're falling back in love with their own markets.
Wow, okay. It's been a bumpy ride.
And it's been a bumpy ride. And you look at Mexico, you look more broadly at Latin America, it's been very strong. The banks, the industrials, somewhat different to what you've seen in terms of the sector performance in the US. So, that may be something that continues, but you're right, you're just seeing those signs of life.
Just to jump in again, if the US market were to go down, does it drag everybody else down with them? How big a diversifier is that EM play potentially?
I think it's not just an EM play, I think it's just a non-US play.
Right, okay.
Well, you're talking about emerging markets. This is the perfect time. Bloomberg put out a story yesterday, and I'm a little obsessed with this headline. London falls out of top 20 IPO markets as fundraising slumps 69%, falling short of Mexico and Singapore, which are, I got to say, are two countries I would not have thought would have trumped London in terms of an IPO market. When it comes to whether there is that desire for kind of fresh investments in the public markets versus the private, are you seeing that divergence widen, even though there is this kind of more business-friendly stance, I would say, from world leaders?
I think we're seeing companies be very deliberate about whether they want to be in the public or the private market. And maybe that's always, been the case. Maybe it's just more out in the open today. But again, we track the public markets. We're moving into trying to track the private markets. But we think there's still, huge value in being able to benchmark and track very liquid, transparent public markets.
I think as this goes on, Chrissy, I wonder if London's going to start telling a different story, which is about, look what we're doing in private markets.
Yeah,
look how well we're
absolutely.
doing that. That might be a story that gets surfaced a little more. While we've got you, Fiona, let me just ask you about the shutdown and how that impacts on the people you're talking to. I mean, typically we talk about the length of this, and, it matters very much whether this lasts a few hours or it lasts more than a month. We've seen it last more than a month. Are you sensing that investors you speak to think this is going to be on the longer side of shutdowns and it's going to have, therefore, a material impact?
I think the really interesting stat is if you look at the last 20 shutdowns and you look at the average move in the S&P 500, it was zero. It was nothing.
Yeah.
And so I'm not sure that, investors are really being that worried for now. As you said, it's much more about the longevity of the shutdown. It's about the data drought. How long do we have to live without key data? And is this time different because, there are threats of redundancies as opposed to just furloughs? So I think it's a wait-and-see approach.
Big picture, where are we? We started this conversation talking about risk. How risky is this equity market for fresh capital right now? How are you thinking about the picture kind of more broadly in relation to other asset classes? Are there better places to diversify and hang out? Kind of just, what's that kind of first thought when you think about equity markets at the moment?
My first thought is that if you look at ETF flows, there are still very strong flows into equity markets, both US and Europe. And Europe's actually seeing some more flows.
So it's a liquidity market at the moment?
It's a liquidity market. I have to go back to my old favourite commodity markets, gold. Yeah. It has
that tells me a different story. Why gold and equity markets don't seem, both at records. Does that not strike you as odd?
It does strike me as odd, but the way I think about it is I really think gold has become a backstop. You are heavily invested in equities. That means you're heavily invested.
Right. You're going to talk to me about barbells in a moment.
I am going to, if I thought that way, yeah. But I do think it's become even maybe more than it used to be. This backstop asset that that investors think they have to own.
Okay, that's interesting. Yeah, the barbelling conversation is one that I have with a lot of people right now. It seems to be a common theme, but an interesting one in terms of how people are playing it, maybe slightly differently. Anyway, Fiona, lovely to see you. Thank you so much for coming and seeing us once again. Fiona Bolt, Managing Director and Global Head of Equities at S&P Dow Jones Indices. Let's talk about the Core 6 story and what is happening and what we are watching this morning. It's interesting, the defence stocks are soft this morning. Tech is soft this morning. The market has a more defensive feel to it. The pharma sector is having a better day. Sam Fazeli is going to be joining us in just a moment to talk about that. Let's get a conversation going about some of the moves that we're watching in more detail. Pharma is the first place we stop with Chloe Melly.
Good morning, guys. Yeah, let's start with some positive movement across that pharmaceutical sector this morning. We've got a wall of green across Novo Nordisk, AstraZeneca, Roche, and Novartis on the back of Pfizer's deal with the Trump administration over drug pricing. So JP Morgan said that this could act as a bellwether for the sector. It could reassure investors that some of those European pharma companies could be striking similar deals and therefore avoiding the worst of that impact. And therefore, this is really driving the shares, with Roche in particular up almost 5% this morning. Moving on to the defense sector, where we have seen a little bit of a downward movement on the reverse there, with downward movements across Rheinmetall, Saab, Leonardo and BAE Systems ahead of a meeting of EU leaders in Copenhagen today to discuss the drone incursions that we've seen over the EU's airspace recently. So there's no detail yet, and we have, but ahead of that potential news flow that we're going to get today, the sentiment seems to be down across that defense sector. Moving on to the sportswear industry, where we have seen some movement across Puma and Adidas. So that is on the back of Nike's earnings last night. Nike reported good earnings. Their B estimate said that its running segment was doing particularly well. That could have been a headwind for those two companies, given that they also operate their own running operations, of course. But it seems to be that the market is reacting to that kind of consumer enthusiasm here and momentum for that running sportswear segment, and that is driving the shares in Puma in particular, which is up 1.3%. And finally, let's talk about Ambu, a medical device company that increased its long-term targets this morning, and it is up 9% on the back of that.
Chloe, thank you, Chloe Nelly, with those movers. I'll throw another into the mix. We've seen a sugar rush in the Greggs share price this morning, which seems appropriate. It was up by 13% out of the gates. Q3 trading update going down well with investors, but that hasn't lasted, and it's not up quite as much as it was. And perhaps the Bloomberg Intelligence notes has something to do with that. They're talking about the relief that investors see on costs and on volumes, risks being short-lived.
So that tells me a lot about what Anna buys in Greggs when she goes into Greggs. Sugar rush is not the first thing that springs to mind.
I was just trying to fit it with the news flow. See? That's why my heart.
So this is not a donuts kind of conversation. This is because I think sausage rolls and bacon bass.
Yeah, that's what I was going to ask. I was like, isn't that what Greggs is known for? But
all of the above, I'm told. I've never been. Right, coming up on the program. Nike sales suggest its turnaround plan is bearing fruit. We will keep an eye on those European stocks. In that sector, those sportswear makers, Chloe was taking us through the impact that the Nike shares are having on some of those European players. We'll get back to that conversation. We are also, of course, going to continue coverage from the Women, Money and Power conference taking place right here at Bloomberg today, here in London. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
The most multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the Opening Trade. We are 18, nearly 19 minutes into today's equity market session. Actually, all things considered, from a European perspective, it all looks all right out there. The DAX is a little bit of a laggard this morning. You are seeing names like Rheinmetall under a little bit of pressure, so that's one factor you need to fold in to the narrative there. So defence stocks, which have been a big powerhouse for the German market, are rolling over a little bit. You've also got to pay attention to what is happening in terms of the sneaker market. I always find it a struggle to talk about sneakers, but apparently that's what we're going to do now. Not the kind of the products themselves, just the word sneaker. Nike shares have jumped in extended trading in New York on signs that its turnaround effort is starting to pay off. The company reported better than expected first quarter sales, helped by gains in wholesale and running shoes, which had previously been weak spots. We have a new CEO. Well, he's an old CEO, but he's kind of an old Nike hand coming in as CEO, reconditioning this business, and it's starting to work. Our global business reporter, Jennifer Creary, joins us now. So we're getting two steps back, but they're warning that we're getting two steps forward. But the company's warning there could be kind of one step back. It's going to be an uneven road going forward from here, which sounds perfect for a running shoe. What are the big takeaways that we need to be thinking about here?
Yeah, so Elliott Hill did say yesterday that progress won't be linear, but it's going to take some time. So the key takeaways really were sales and revenue beat analyst estimates. So sales fell 1% on a currency neutral basis in the first quarter. So that was better than what analysts were expecting. So certainly there are tentative signs that the turnaround is starting to bear fruit. Of course, Elliott Hill coming back last October out of retirement. So certainly a vote of confidence in him. There are a couple of reasons for that you mentioned already. So particularly, redesigning some of its new shoe ranges, including its running franchises, and that really drove 20% growth in the category. So that's a real driver for Nike at the moment.
Nike is an international company that is exposed to kind of everywhere, but specifically China as well. What happened to the tariff narrative that hit its stock so hard?
Yeah, so the key headline here is that it's increasing its estimate for the hit from tariffs from $1 billion US dollars to $1.5 billion. So that's obviously going to be bad news kind of across the board, given that Nike, like a lot of these sneaker companies, manufacture the majority of their shoes in the likes of China, Vietnam. Nike has previously said that it's looking to have, quote, surgical price increases and also shifting some of its supply chain away from China. Currently manufactures about 16% of its shoes from in China. It wants to bring that number down to the high single digits. So moving its supply chain to kind of manage some of those tariffs better.
So Jennifer, in the answer to the question, where does the pain fall? It sounds like it falls on the margins and on the consumer. A bit of both. Is that how Nike is playing this? The pain from tariffs, the negatives hit both those places.
Yeah, I mean, it will hit the consumer undoubtedly, but also the kind of broader narrative is, what is happening with inflation? How is that going to affect consumer sentiment? Are consumers going to pull back on their discretionary spend? So that is a key headwind that Nike is facing.
If it's doing better, are Adidas and Puma doing worse? How does it work in terms of the relative relationships between these businesses?
Yeah, listen, I mean, across the board, that all these companies have to manage tariffs because the majority of their shoes are manufactured in Vietnam and China. But listen, they're all very different companies. Like Nike is trying to increase its ranges, its sportswear ranges, particularly its running shoe ranges. So it's certainly trying to find growth in other categories. But, tariffs are a problem that all these companies are going to have to manage.
All right, Bloomberg's global business reporter Jennifer Creary walking us through the sportswear story. We thank you so much. Let's go from sportswear to pharma stocks. European pharma stocks broadly higher today as Donald Trump's 100% import tariffs on patented drugs take effect. That's not why the stock's rallying, though. This, of course, comes as the U.S. drug maker Pfizer secured a reprieve from those levies after agreeing to slash some drug prices and invest $70 billion in the States. Massive move in the U.S. yesterday, certainly a catch-up trade in Europe today. Sam Fazeli's all over this, the Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst. That is a juicy title, Sam.
Yeah,
I've got to say.
I can add a few more bits to it if you want.
Yeah, I mean, more
just
words.
To make it harder.
More words. Just to really round it out. Speaking of rounding it out, talk to us a little bit about what we heard from Pfizer yesterday. Is it ultimately a roadmap for other pharmaceutical companies?
Yeah, absolutely. I mean, the administration, President Trump clearly said during the just over 1 hour conversation that next week we're expecting Eli Lilly. Whether they'll do the same show. I don't know, but I think President Trump likes those because it really brings the point home. But it sounded like that there's going to be a whole host of these. And frankly, the pharma companies have been preparing for this. They've been denouncing their investments in the U.S. and the billions of dollars, et cetera, over X number of years. So that is what we're expecting. And I think we've got here what I'm using 3 phrases: win, win, lose. So we're going to unpack that if you want.
Win, win. Okay, so who's winning, who's losing?
Okay, so the pharma companies are winning because we're not getting any type of tariffs except for this thing that supposedly kicks in today, which I'd be surprised if it actually happens because we already have, the 100%, 1st of October, right? But I don't know which companies will be impacted in my world. So the win is for the pharma companies because it takes away, as you can see from the share prices, this worry about how it's going to be implemented. Is it going to be draconian in terms of pricing, etc.? That's the win. The US gets a win. Extent of it, we'll have to wait and see. How much extra investment are they going to get in the US? Make everything you sell in the US in the US. That's a win, right? Who loses? Rest of the world, i.e. Europe, will have to either pay more and keep treating the same number of patients, or pay more and try and manage its budgets and treat fewer patients. Whether that more is 10% or 20%, it's going to be a hit.
Wow.
So that's the loss.
That's going to go down well.
Yeah.
It's not going to go down well, right?
Right, okay, so that's where how the geography comes in. Tell us more about so it's is it the Section 232 tariffs that are supposed to come in today?
No.
Sam, no, but whatever they are, you don't think they're going to
No, Europe's got its tariffs, and they said, well, we're not impacted by that. I think China's got its tariffs. I think they're not impacted by that. Japan has their tariffs. They're not impacted. So who does that leave? Maybe India? I don't know exactly. Or Korea? South Korea? Not sure. But in the broader world, the impact is not going to come in with 100%.
Trump RX.
Yes. Is it? Because I think the people who mentioned it said...
So this is, just to explain, this is the new portal which US consumers are going to be able to use to buy drugs from the government at kind of lower prices.
Yeah. Some pharma companies set up their own. Lilly was the first one. I can't remember exactly when. I think it was Q1 they announced it. They've got their own platform they're selling it. This is a good thing that the government's doing. Trump RX or not, .gov, whatever it is, it's going to allow people who don't have insurance, who are able to at least get now access to pharmaceuticals. So yet another little win for pharma companies, right? I don't know what the margins of those drugs that they sell on that basis will be, but it's a plus, and it gives yet another venue for companies to sell their drugs direct to consumer.
Sam, thank you very much. Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst. Yeah, when we saw the move in Pfizer, it wasn't entirely instantly apparent that this was going to have such a big impact on European stocks this morning, but some of these European pharma stocks up by more than 5% this morning, so certainly a sector worth keeping an eye on, and by far the best performing sector this morning. Coming up on the programme, we'll speak to another voice taking part in today's Women, Money and Power event. Catherine Mann will be with us, external member of the Bank of England's Rate Setting Committee. She's been talking a lot about inflation already this week. We'll probe into her views a little more around that, how restrictive policy is or should be for the UK economy right now. All of that conversation coming up. That's next. This is Bloomberg.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Will Obey. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
What shutdown? If you look at the equity markets here in Europe, everything's fine. A real stark change from what you're seeing over in the States, where futures are declining and declining fast. Over in the States, or over here in Europe, green on the screen, not necessarily in the DAX, where you are seeing some pain in the tech stocks. You are seeing SAP, Rheinmetall, for example, weigh it down. But pharma stocks are on a roll. And that would explain the outperformance you're seeing in the FTSE 100 and the Swiss market, Guy.
Absolutely. We're 30 minutes into the session. There's some decent rotation going on out there within these markets. At a headline level, we look reasonably balanced. 268, 325, 324 in terms of the ups and downs. But volume is high, which speaks to maybe some of that rotation that we are seeing. Drug stocks are definitely the focus of attention this morning after what we've seen in the United States. And you're seeing UCB, Tub, which is basically the holding company for that. GlaxoSmithKline. We're going to speak to Emma Walmsley a little bit later on as a part of Women, Money and Power. So pay attention to that conversation a little bit later. GSK is up by 1.62%. So pharma is where we are seeing the big gains coming through. 152-week low that's worth paying attention to. Anna was talking about sugar highs a little earlier on. I know that they don't do this anymore, but it's not going to spoil my my gag. 1 year, the stock is down by 40%. The stock is getting hit hard this morning on the back of a negative outlook from this company. The big drag is coming through as a result of what they're seeing in markets like ethanol, feedstocks for animals, all that kind of space is where we're seeing some weakness coming through. Tate & Lyle is down by 40% on a 1 year basis and is a real standout 52-week low this morning. Anna.
Let's get an update on some of our big stories then this morning. Kritty was just talking about the shutdown, the impact it's having on markets. Well, the US government has shut down for the first time in nearly 7 years. This after Congress blew past a midnight funding deadline. President Trump has suggested his administration will use this shutdown to conduct mass layoffs of federal workers. EU leaders are meeting in Copenhagen today. They're expected to discuss a possible drone wall after repeated Russian incursions into NATO airspace. Financial support for Ukraine is also expected to be high on the agenda. And Jaguar Land Rover is to reopen its factories today after a cyber attack crippled its operations. Assembly lines at the firm have stood still for 4 weeks, triggering financial concerns. The FT reports that parent company Tata Motors had secured £2 billion emergency credit lines separate to the £1.5 billion loan guarantee from the British government. Guy.
Let's stay in the UK and talk about what is happening with monetary policy and what is going on over the road from here at the Bank of England. The latest data seems to suggest that UK inflation is high and sticky. Let's talk to Catherine Mann, external member of the Monetary Policy Committee over at the Bank of England, joining us as part of our Women, Money and Power gathering here in London today. Good morning.
Good morning. Delighted to be with you.
It's fantastic to see you. UK inflation is high and sticky.
Yes.
Was it a mistake to cut rates?
So I think we always have to balance what we're seeing in the inflation side of things against the activity side of things. Now, you know, of course, I have voted to hold rates.
Yep.
I think what we're seeing in the Monetary Policy Committee is a range of views. on the balance between prospects for activity and prospects for inflation. My view is that inflation, the scenario that we painted earlier this year of the high risk of inflation being persisting for longer, I believe that scenario is playing out. Now, I am aware of the risks on the downside, and so I put some weight on that, but I put much more weight on the inflation scenario and inflation persisting.
In your personal view, therefore, and I'm just your view, not the committee's view, was it a mistake to cut rates? Have we already loosened policy too much?
I do think that a policy is relatively loose compared to what the balance of inflation prospects is relative to activity. So I voted to hold rates. And so I think in some sense...
Think rates should be higher?
No. I think rates are on hold. I think rates being on hold is appropriate for the current period. I would not see that tighter rates is appropriate, in part because if they tighten more, then we have to loosen later. And more than a year ago, I talked about that being a policy boogie.
Yep.
And I thought that's not a good thing for monetary policymakers to do. So I think a hold is appropriate at this point.
Okay, yeah, we'll avoid dancing at all costs.
Avoid dancing, right.
Let me ask you about inflation expectations then in the UK, because you seem to put quite a lot of emphasis.
Yes, I do.
We heard from Sarah Breeden yesterday, who puts less emphasis on this uptick that we're seeing in household expectations of inflation. What is your thinking, Catherine, about where that's coming from? Is it all because food prices have been on the rise and that has a sort of outsized effect on expectations?
It's a combination of things. Certainly food is very important. Food is very salient for the consumer. They go shopping every week or so. But it is also the case that we have been above a empirically estimated threshold of CPI. We've empirically estimated the threshold of about 3.5% as making consumers very conscious of all types of inflation. When they go shopping to the grocery store, when they go shopping for shoes, when they go to a restaurant. So very conscious of inflation. And what that implies is that sensitivity to changes in inflation increases. And that makes them pass through that sensitivity into inflation expectations. And we do see that in the data. There is drift in inflation expectations, and that's a very important ingredient in my thinking about the persistence of the inflation process.
And that's why you focus on it. So thinking about the headline inflation or core inflation or however you want to look at it, we do have a persistent inflation problem, I suppose, is that the word, in the UK compared to the rest of the G7. Now, growth not doing too badly, actually, for what it's worth, against the G7. But inflation, we seem to have more trouble with this. What would you put that down to? I'm sure there's a thesis to answer that, but just briefly.
So I think there's a number of things. As I say, there's a threshold. We've been above this threshold for a very long time. Our oil shock or the energy shock was higher to begin with than in certainly than the U.S. and in Europe as well. So there are a number of different factors. Plus, the supply side of the economy continues to be trouble facing the UK in general and monetary policymakers in particular.
When we look at some of the forecasts, you mentioned the U.S. there, look at some of the economic forecasts in the States, compare them to what you're seeing on continental Europe with the ECB as well. There's an expectation that if not the fourth quarter of this year, which I guess we're in now, I'm just realizing, but in the first quarter of next year, it basically, the growth and the inflation projections go down before they go up very sharply. Is the UK an outlier when it comes to that? Are we waiting for that second round of inflation to show up?
From the U.S.?
Or Europe.
Or from Europe. So,
but just import it, basically.
Right. So spillovers are very important when we think about how the financial markets behave and how we have to be, as a monetary policymaker, I have to be conscious of those spillovers coming from our two neighbors, our two very big neighbors, and they do play a very important role in the decision-making process. There are times when the financial market spillovers are large enough to dominate what is the appropriate, in my view, the appropriate stance for monetary policy for the UK. So we're very conscious of those spillovers.
Is there a tariff effect that we're still waiting for?
There are a couple of different ways in which a tariff effect can come through. One way it would be to, uptick to inflation associated with tariff on products. The other way, of course, is that there are products that are tariffed outside the UK, and so those products will be rerouted to the UK markets, and that would put some downward pressure. We don't see either one of those really playing out yet, and I think the reason why is that the tariff landscape continues to be shifting. So for firms to really kind of identify what they should be doing to tariffs or with tariffs, whether it's how it's a cost structure, how much they pass through to consumers or other parts of the business supply chain, that's still uncertain for them, and so it's going to take some time for that thing to settle.
Well, when might we have clarity on that? Is that the next 3 months? Is that a 6-month piece where it starts to show up in the data? What's the timeline?
So it is starting to show up in the U.S. data. It's not really showing up in the U.K. data, partly because it's not really showing up in global prices. But there is another factor in the U.K. that I think is very important, and that is whatever happens kind of coming in on the dock, there still has to make it to the shelf in the U.K. And that gets us back to the domestic foundations for the inflation pressures in the U.K. And so that's still, even whatever is happening with tariffs abroad, it still is the domestic component is the more important issue that I need to face.
Can I just quickly ask you about what is happening with fiscal policy? Not what you think is going to happen, but the effect that there will be on monetary policy.
Right.
If taxes go up, how do you think about that in relation to kind of rate hikes? Is that what effect does it have on inflation? What effect do you think it's going to have on growth? How are you thinking about the possibility, which looks like an almost racing certainty now, that the taxes are going to go higher? What effect will that have? Will it reduce some of the pressure you think that maybe exists on the inflationary front within the UK?
So, of course, I can't comment on whatever might be happening
the derivative effects.
Right. So, but I can comment on what we observe from our agent reports and from our decision maker panel with regard to the accumulation of national living wage increases as well as the national insurance increases that have already that are already part of the landscape that firms face. And we are finding with the, as I say, these survey indicators that more of that is being incorporated into the cost structure of firms and is being passed through, particularly firms. This is from the decision maker panel, and this is something that is available on the website, so nothing proprietary here, that the firms that are most exposed to the national living wage and to the national insurance contributions are passing through those prices to a greater degree and have higher inflation now and are expected to have higher prices next year.
Been great to catch up with you. Thanks for stopping by to see us. I'm looking forward to all the commentary we're going to get a little bit later on as well. Catherine, always a pleasure.
Thank you very
much indeed. Catherine Mack, Bank of England external MPC member. Catherine's going to be on a panel at 11 a.m. Remember, you can catch that as part of the Women, Money and Power event that is taking place here at Bloomberg. There's the live shot. We're about to kick things off. You can find it. There's a top live running. There is live go that you're going to be able to follow it on your Bloomberg terminal as well. You can stream it online. Pay attention. There's some fantastic people appearing on this panel a little bit later on. Coming up, how are the world's wealthiest investors putting their money to work? Morgan Stanley's head of global client coverage is going to be joining us shortly. Elizabeth Dennis next. This is Bloomberg.
Do you know what to tell people about what the tariffs are going to do on the United States economy and the investment environment, or is it not clear yet?
If you look at the impact of the tariffs, they were much more significant and broad than I think the market expected. Looks closer to 19% on balance versus 2 and change last year. So effectively, it's a 20% increase on 10% of household goods that are imported into this country.
And do you think it's going to lead to a recession?
Well, we think that it's going to impact both inflation and the economic growth scenario. So we were coming into yesterday expecting the real economy to grow at 2%. And inflation to be closer to 2.8%. If you just go through the math, it would suggest there's probably 1 to 2 points upward increase on inflation and a similar amount on economic growth. So it could put us in a position where we're teetering.
So the tariffs will likely depress the GDP growth rate and increase inflation. So what's the advantage of tariffs?
From our standpoint, we have a hard time seeing the benefits of tariffs. They do tend to be inflationary in the short term. As you're pointing out, the longer term impact on economies is probably the greater downside.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to the opening trade. We are 44 minutes into our European session, and this is the picture for US futures. So the European session weighed down a little by what is happening stateside. So we're slightly negative in Europe, more so in the United States, down around 1% on NASDAQ futures. Now let's think about that further, because Congress has blown past the midnight funding deadline, triggering the first US government shutdown in nearly 7 years, and the third under President Donald Trump. With markets juggling record highs, volatility and tariffs, our next guest offers a unique perspective on how investors are positioning. Let's talk now to Liz Dennis, Head of Global Credit Coverage at Morgan Stanley. Liz, nice to speak to you. Thank you very much for coming
having me
to speak to us. And you are able to take the pulse of ultra-high net worth and wealthy investors and tell us a little about how they see the world. Do you think the shutdown, I mean, a lot will depend how long it lasts, I guess, but what impact will this have on your customer base?
We think our client base will view this as a fairly muted response to the government shutdown. We have been through this before, and our clients are actually much more focused on big macro themes that are driving long-term value creation. So you take themes like longevity, biotech, genomics, and the theme really of all themes clearly is artificial intelligence. So our thematic research believes that we'll see just for the S&P 500 potentially 13 to 16 trillion in long-term value creation based on AI adopters and AI enablers. And that's where our clients say, we want to be involved on both the institutional and the individual side in funding data centers and being part of the energy infrastructure, the real estate boom that's coming with that artificial intelligence boom.
Well, Liz, it feels like the investment case for the U.S. and the investment case for AI are going hand in hand and are almost kind of interchangeable at the end of the day. Where does Europe play into all of this? With the clients that you're speaking with globally, is there still a sense of the Sell America trade that we saw 6 months ago?
I think we're having a healthy debate about American exceptionalism. Clearly, there is concentration in the tech names and the Mag 7. We've put out a lot of research on this topic, and it's an area where we want to make sure that we give our clients global access and global perspectives. But at the end of the day, we also know that this AI trend and the tech trend and innovation in that space is going to continue to be a driver of long-term value.
How are they feeling about these markets at the moment? Equity markets are trading at pretty punchy multiples. Credit spreads are tight. The Journal's got a piece talking about cracks in the luxury housing market beginning to open up this morning. How are they feeling? Is this a nervous market right now?
I would not define the market as a nervous market. I would say that our clients are very engaged. They're engaged both in the private markets and in the public markets. And what you're seeing is this expansion and growth in the private markets that's enabling clients to stay and companies to stay private for longer. And what that really means is that there's a whole ecosystem from private to public that's allowing a healthy dynamic across high yield, investment grade credit, levered loans, all the way into the private credit space as well.
And so you're seeing an embrace then of private markets. As that offering, the private markets offering, gets out to more and more customers, do you have to think differently about risks and transparency and all of that? How do you manage the risks on that side?
Our clients are mostly focused on getting access to those private companies. And so what that means is they're going to, in many cases, leverage the best-in-class asset managers that are on our platform. So Morgan Stanley is the largest distribution platform for alternatives, as an example. And we've seen that space grow tremendously. So the private markets are now at $13 trillion in size, but the individual investor is a very small percentage of that. And so their question is, do I go through funds? Do I think about more liquid structures, a huge demand for evergreen structures that are on our platform? But increasingly also, how do I get access, if I'm a higher net worth or family office individual, into a co-investment directly into a company? And what that means is that for names like Stoke Space, most recently, CoreWeave, MedSpa, these are companies that we're giving access to our clients to directly, and we can access a lot of different sources of that. We can do a tender offer for a private company on our platform, providing liquidity for those private employees, but also access to our ultra-high net worth demand. We can go to our investment bankers, we can go to our financial advisors, and really the largest source of our deal flow for co-investments is from our asset manager partners.
All right, Liz Dennis, Head of Global Client Coverage over at Morgan Stanley. We thank you so much for your time. She'll, of course, be a part of the Women, Money, and Power Summit later today. Let's talk about what else we've got going on throughout the rest of the day when it comes to these markets. Golden Week does kick off today. Of course, it's going to affect the Chinese markets. We're going to keep an eye on gold in terms of the reaction there. Of course, in Copenhagen, we have the informal EU summit. We'll get some reporting there in just a moment. Plenty of data, though, on both sides of the Atlantic. Euro area CPI hitting in just over about 60 minutes' time. ADP employment data coming in at about 1:15 p.m. UK time, plus the ISM manufacturing data just about 90, let me do my math right, 105 minutes later. 3 p.m. is what you need to know for that data set.
Not a lot of public data coming out, though. That's going to be the story of the next couple of days, the dearth of data that we're going to see stateside, private sector data very much in focus. Let's talk about what is happening in Copenhagen today. European leaders are meeting there for what's apparently an unofficial conference between them sides. They're going to be talking about, obviously, what is happening on the defence front after the Russian incursions into NATO airspace that we've seen so much of over the last few days. They're also going to discuss continued support for Ukraine. Let's talk to our Chief Europe correspondent, Oliver Crook, who is there. What do we know about the plans that are going to be talked about today in terms of providing Ukraine with additional funding? Walk us through what we're going to be seeing.
Yeah, so guys, this informal meeting basically lays the groundwork for basically a decision to be made at the end of the month at the formal meeting in Brussels on a number of different issues. It's going to be a focus on defense, a roadmap to being battle ready for 2030. But one of the main issues, and this is something that has now been increasingly spearheaded by Friedrich Merz, the German chancellor, is basically finding a way to monetize those 140 billion euros worth of assets that are still sitting over in Belgium. And you'll remember the debate over this for a number of years now. You'll remember the Biden administration had been pushing the Europeans to try to start touching those underlying assets for a number of years. They always said it was a little bit too complicated, that there wasn't the legal footing to do it. Now that there is massive fiscal strain in Germany and France and a number of these countries, then the funding for Ukraine is not as assured, and the United States has basically stopped writing checks under Donald Trump. They are now finding a way to monetize those assets, and now the Germans are spearheading that process. So that is what is going to be discussed today among the leaders. There's got to be a lot of different sort of issues that need to be worked out legally about how to make that sound so it's not actually stealing property. As you can see here, we're still setting up and awaiting the leaders' arrival here in a couple of hours' time. Forgive the sound, but that will be one of the main focuses. And of course, the next will be how Europe actually makes itself battle ready in the next 5 years. And that is going to be the other part of the plan that they'll be discussing today to try to ratify by the end of this month.
Yeah, Oliver, so that's certainly getting a lot of attention. You mentioned certain projects that Berlin is trying to spearhead. Does that take us into territory of perhaps some ground opening up between Berlin and Brussels? We've seen this in a number of fields recently. Is that going to have an impact on the conversations about how Europe makes defence and spending decisions?
Absolutely, because what they're now going to be presenting, we got the sort of white paper, the earlier structure of basically this 2030 roadmap of how the Europeans will actually build out their defense budget. What you need to do is start putting out milestones, start assigning certain tasks to certain nations and cluster coalitions of different countries. And there's going to be a big debate about basically who should be spearheading that. As we know, Ursula von der Leyen and the EU will basically try to get that power centralized in Brussels. The member states have a different view about that, right? And Friedrich Merz in particular And we should say that despite any light that exists between him and Ursula von der Leyen in wanting to retain control in Berlin, he's very sort of pro-European. He used to be an MEP, but the problem is domestically he's dealing with forces like the AfD, who basically are allergic to basically surrendering any more power to the EU. So you've seen that on the question of regulation. The Germans want to cut regulation domestically, but also at the EU level. You see it at the car ban, for example. Merz now is very openly pushing back against the combustion engine vehicle ban that is slated to come into place in 2035. And you're going to see that around the question of defense without a question. And of course, the question of troops in Ukraine, something that that Frederick Merz himself has pushed back, doesn't want to have any German troops active in those security guarantees. So those will be some of the issues that will be reflected today. And we'll see basically how this sort of this debate continues to unfurl, because we should say this is at the very heart of Europe. On the one hand, the Europeans are conscious they need to work as a bigger bloc. They need to compete against the United States and China. At the same time, national level, there's a lot of demands to have less Europe. So that is going to be sort of the large debate that is going to sort of be the architecture of this new commission over the next 5 years. How do you unlock the scale without creating more Europe?
Bloomberg's Oliver Crook live for us in Copenhagen. We thank you so much walking us through the dynamics ahead of that EU summit. We've got another event, of course, here, a little bit more local. Bloomberg's Women, Money and Power special event just about to begin here at our EMEA headquarters. Our very own Danny Berger is on the scene now and joins us from the event. Danny, it looks really exciting. What can we expect from the event?
Yeah, just a little more local, but Kriti, it is such an important time, not just here in London, but globally. It comes on the heels of an American government shutdown, the biggest leverage buyout, changing geopolitics, and a changing business environment. And that and many more are going to be the topics that we're going to be discussing here with world business leaders at the Women, Money and Power Summit. You can see things just starting to get kicking off behind me. It's going to kick off in about 20 minutes time. Francine Lockwell will be leading us at the panel, a really great one with the State Street and Franklin Templeton CEO. So questions about how you conduct business with some of the oldest and storied institutions at a time when things are changing, especially for those American businesses trying to get workers over as questions remain about H-1B visas and otherwise. So you can see some of that fantastic lineup there. I also personally will be hosting a panel on real estate after coming from a nadir of 3-4 months of a slog of that market itself. We'll also be speaking with the co-founder of New Bank, a Brazilian fintech bank that is expanding beyond and just applied for a U.S. business license charter. So much is changing, some big conversations to be had for. So again, that kicks off in roughly about 10 minutes time. Conversations will take place throughout the day, ones you do not want to miss.
Danny, thank you very much for being very brief anchor. Of course, Danny Berger here in London, here for this event, Women, Money and Power, and it seems that people are gathering for that event right now. In terms of European stocks, then, we're very much focused on the drug sector, aren't we? That is by far and away the biggest story, it would seem, in European stocks this morning as we wait for the shutdown to really kick in stateside.
Absolutely. Drug stocks are having a very good day. Just some uncertainty removed around the space, which has been plagued by uncertainty.
Or some hope added, maybe even if not full uncertainty removed.
Yeah. Even at the margin, take some off. That is the kind of share price reaction that you are going to see. But I think, as you say, that kind of how the shutdown plays out, I think is the narrative for the rest of the day now. In the absence of all this data that we were expecting and are now not going to be getting.
Well, that's all the equity market. The bond market feels stable, but is that the calm before the storm? Do we see a little bit of, as this shutdown looms large, if we get to that 35 days, do we see a more volatile reaction in the 415 that we're seeing on the U.S. 10-year? That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi Zahran, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The US government shuts down for the first time in almost 7 years as Congress blows past a midnight funding deadline. Stocks fall while gold climbs as the shutdown threatens to delay key economic data. Plus, EU leaders meet in Copenhagen as they weigh mounting security threats and more support for Ukraine. And we'll hear more from some of the most influential voices in global finance at Bloomberg's Women, Money and Power event. You can also watch that event on LiveGo or follow along with the T Live blog. Meanwhile, here on markets, let's have a look at what's happening across a host of markets for you. S&P futures are negative, and this really does reflect the shutdown story. How long it lasts might dictate how much impact we see, but certainly for the moment, US futures are weaker. Stocks Europe 600 is trading higher, and a lot of this has to do with the healthcare sector. So managing to look through that weakness stateside and go higher in Europe because healthcare stocks see something to be cheerful about in that Pfizer deal between Pfizer and President Trump. And as a result, we see quite a lot of strength in the healthcare sector this morning. Meanwhile, the euro 117.52 as we see general weakness in USD. Let's get things started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Good morning and welcome to The Pulse. I'm Anna Edwards in London, in for Francine Lacroix this morning. Now, Congress blew past a midnight funding deadline, triggering the US government's first shutdown in nearly 7 years, and the third under President Donald Trump. He has suggested his administration will use this shutdown to conduct mass layoffs of federal workers.
How many federal workers do you plan to lay off?
Well, we made you a lot, and that's only because of the Democrats. And as you know, they wanted to be able to take care of people that have come into our country illegally, and no system can handle that.
If you want an indication of how serious Republicans are about keeping the government open, who wants the shutdown? There's no better proof than the fact that Speaker Johnson sent everybody home this week, ensuring a shutdown no matter what the Senate did.
We're joined now by Bloomberg's Miles Miller, who can take us through some of the political impact of this and what we're likely to see in Washington. Miles, very good morning to you. Nice to have you here in London. You cover Washington for us over in the States. So very good to have your expertise here. So tell us a bit about the impact here, and in particular, layoffs. We're used to hearing about furlough and temporary layoffs when it comes to shutdowns. But here, President Trump is talking about permanent layoffs. I wonder how much that can endure.
And the shocking thing about it is kind of how jovial he is about these layoffs to government employees. We're talking about 750,000 government employees who are being furloughed, and then a portion of them who are likely to be laid off and for good. Usually when we have shutdowns like this, what happens is these government employees are furloughed and they get back pay. We know now that the president has said that some of these people can be working in programs that will be permanently unfunded, permanently eliminated. But when you get down to the brass tacks of it, what is so important to focus on is the fact that the very important economic data will not be coming out when we expect it. The Friday jobs number that so many parts of industry rely on, the same thing with GDP and inflation as well. You know, it's essential to the ECB. It's essential to how the Fed sets rates. And without that kind of data coming out in a timely fashion because of the shutdown, you know, it could really throw markets in for a tailspin.
Yeah, absolutely. So if we don't get that data, maybe more emphasis on some of the data, the private sector data that we do get. Miles, thank you very much. Thank you for joining us. Miles Miller here at Bloomberg, taking us through some of the latest news flow surrounding the shutdown. Joining us now, Ursula Marchioni, Head of EMEA Investment and Portfolio Solutions at BlackRock. Ursula, very good morning to you. So let's get your big picture take on shutdowns. I was looking at some data about what stocks do in shutdowns, and what's really interesting is over the last, the last ones we have on the Bloomberg terminal at least, they're all of varying lengths, different backstories that come in before them. It doesn't really tell you anything about which way stocks will go, for example, because they've done everything. They've gone up, they've gone down, they've gone sideways, and net, it adds out to pretty much no information at all. So what kind of thinking do you do going into this shutdown?
Good morning, Anna. Thanks for having me. So, yes, I agree that typically markets tend to look through the noise of the shutdown. So, to your point, if we look at the last few occasions where we've seen this playing out, actually the S&P rose throughout that period. And so you can see different elements playing into that. But the effect wasn't necessarily that negative. But this one is different, I agree with Miles, in terms of the importance of having more hard data coming through at present with respect to the US economy is extremely high, because we have two dissonant narratives about the US out there. One about soft landing, which really consolidated around the last Fed meeting, the CAT, Chair Powell referring to downside risk in the employment market. And then another one where we've seen a very strong Q2 GDP figure. And so again, where are we? The fact that we are extremely unlikely now to get payrolls on Friday, but potentially the last shutdown, to your point, lasted 35 days. So we could get into something that hits the 15th of October when we're due to see CPI, and then towards the end of the month, the Fed. I think this is important. And so for me, from an investment perspective, it goes back to two key themes that we've seen playing out this year with investors, and that 100% will continue. One is the volatility in the long part of the curve, and so duration not playing as a diversifier in portfolios as it used to, and so the need to find other diversifiers. Diversify our diversifiers is my tagline. And then the second one is the role of US assets in portfolios, particularly for European domiciled investors.
Okay, so as we look to diversify the diversifiers, where do we look?
So we've seen obviously a lot happening in gold. So if I take a step back, plus 46% performance year to date, and still, over 50 billion in flows just through ETFs, or ETPs rather. That trend, despite, the run having been spectacular, is set to continue, because we need more alternatives to that cushioning that duration doesn't give us anymore. Other areas, private markets, potentially new asset classes, small allocations to bitcoins to be considered. And then I think more in the classic space, systematic strategies, hedge funds and long shorts, also great ideas.
There's so many emerging trends in asset management right now. Private markets is one big one, I suppose. As we think about that diversification theme, how much structurally do you think this sort of landscape of assets that people pick from is really shifting right now, and people are increasingly looking for those alternatives?
I feel it's shifting significantly. I've been on the road this year, last week, as a last example. And again, the conversation around strategic asset allocation changes to benchmark is top of mind for all large distributors on the continent in the UK. And I think the element that you refer to, private markets, as a manifestation of new diversifiers is one element. The other big element is, again, what do we do with US assets? What do we do with the US when, if you talk to a German investor, we've seen about 20% increase in the DAX year to date, and yet the S&P, while up 14% in dollar terms, is flattish in euro terms. And so we've seen this decoupling in dollar weakening and strength of the US equity markets. And so what to do there, where we observe loads of portfolios having equity sleeves allocated to MSCI World, which has 73% exposure to the US. That is a huge theme. And so again, I'm seeing clients and I'm thinking about the way forward as one where we need to be selective and discerning. So in the US, I think there's very much a quality theme around, AI continuing to play out, but also healthcare or banks being attractive sectors. In Europe, it's more of a value tilt. So if we think about banks, good profitability, yet still cheap, or more domestically tilted sectors such as defense, industrial. So again, either sectorial plays or partnership with active managers that can select, I think will be a good way forward.
And do you see data or talk to investors and get the impression that investors internationally are pulling out of the United States, or they're still happy to be in the US, they just want to hedge those positions in a way that maybe they weren't previously?
I think that's a brilliant question. So if I look just as exchange traded products, and again, we should look at active funds as well, but to give you a sense, we've seen 71 billion flowing into European equities this year, vis-a-vis last year, 7. So there's a 10 factor, an order of magnitude of difference. So it's clearly coming, and the repatriation trade is in flux. Since August, we've seen some return of interest from European investors towards US equities, but as you pointed out, it's more towards hedge share classes or areas where the FX element is less pronounced. So I think this theme will continue to play out and will make big changes in portfolios.
So that hedging dimension is really important. We're looking ahead. We're already in the fourth quarter, believe it or not. So this year seems to have gone just incredibly fast. We talked about growth then a little bit, where you might search for some of that, even in a careful way, maybe in the United States. What about income investors? Is that one of the themes that you're looking at for the fourth quarter?
100%, and I think that's the other side of that duration element that we mentioned. So we've seen a lot of interest for short duration, and we still like short duration and the belly of the curve, both in the US and in Europe, and then locking in income, which is still a generational high opportunity. We like European investment grade, but we also continue to like emerging market debt, particularly in local currency, where we've seen a lot of flows returning this year, and we think there's more to go.
Yeah, we had an interesting conversation in the last hour of program, actually, about emerging markets and about the effect of that weaker dollar. And so often when if we've seen negativity around the United States, admitting that stocks are at near records, so it's not very negative, the overall story in the US. But when we've seen people turn a little more negative on US assets, that doesn't necessarily bode well for emerging markets. But here, with the dollar weaker, and a lot of people are asking, what does this mean for EM, and what opportunities might there be in EM if we're relative to each other rethinking political risk in these geographies?
Yeah, I think you're right. It's always a relative trade. And so again, in this logic of loving the US equity market, but having to take care of the FX element in a different manner, and therefore diversification into other markets. Emerging markets have seen inflows, and there as well, I think the stars are aligned in terms of the weaker dollar going forward. We think about the next 5 years at BlackRock, we expect as a central scenario further weakening of about 8%. That is coupled, stars are aligning, with emerging market central banks broadly being on a easing path. And so again, you can see the two converging together and more opportunities going forward. Again, I think selectivity is important. We've discussed a lot around this big block of emerging markets, potentially needs redefining. There's a lot of different things in there. And so China, India continue to be for us the areas to focus our attention on.
We're going to listen to a conversation about the world's best bets right now, Ursula. Is it AI and that technology and all the excitement around it? Is that still, do you think, the favourite in terms of topics to invest around?
Look, it's difficult to see how it will derail. Also looking at the last earnings season that we just wrapped up and how, 12% EPS growth in the S&P 500 year on year, and within that, communication services, information technology being the leaders. So yes, I believe it will continue. It's a generational opportunity, a structural change, but that element of discerning and selectivity is important because, to your point, we are at record heights.
And so if it is a structural change, does that mean we accept it's different this time? Is that what we say when it comes to valuations, that if valuations look stretched, maybe that's okay?
It is okay, in our view, because, again, the cash flow that you see coming through and the earnings that we have seen being reported still sustain that. Of course, should that change, that will be a signpost that will make investors reflect. But for now, we continue to like it.
Okay, thank you very much. Thank you, Ursula, for joining us. Ursula Marchioni, Head of EMEA Investment and Portfolio at BlackRock. Now let's take you live to Bloomberg's Women, Money and Power event, taking place here in London as the financial world experiences a massive reallocation of capital and profound technological change, some of which we were just discussing. What are those great opportunities and biggest risks facing global markets? Let's speak now, or hear now, from Bloomberg's Francine Lacroix. She's hosting a discussion with the CEOs of State Street Investment Management and Franklin Templeton.
We're calling for a soft landing in the U.S. We think the ECB has done a really good job. We're obviously a little bit concerned with China and some of the structural issues that are necessary. And we're also working our way through all the tariff negotiations. And I suppose maybe that's the piece of it, which is realizing that we've been in a period of time where we've had ultra low interest rates, a lot of fiscal stimulus, this ongoing globalization. This chapter is coming to a close. Clearly, America is focused on America first. And so that notion of just buy the S&P 500, if you own that for the last couple of years, you would have been just fine. It's all about making sure that portfolios are very diversified because it is difficult to price in the uncertainty and volatility. And so I don't have necessarily a risk that we don't think the market is thinking about, but from the perspective of investing, holding gold, holding cash, holding private markets, being deliberate about all of that is in a very important way forward.
Jenny, is there something you worry about, valuations?
No, I agree with you, Shannon, on the point she's made. I would just add, I think the market may be a little bit optimistic on the number of rate cuts. I think that inflation is probably going to be, more difficult than to come in and maybe even, we might even see, obviously the tariffs are going to come through. You look at U.S. employment and, on the one hand, the 900,000 jobs that, suddenly didn't exist, people say, well, is that a weak labor market? And yet you had wages go up 4%, in some cases 5%. And so, immigration had gone from like 3 million people coming in to now 1 million and even less. So that's absorbed. At some point, there's going to be continued wage inflation if you have less immigration in, right? And some of it's been offset probably by productivity gains in companies and some of those things. But I just think that inflation is a potentially bigger problem. And so you're not going to get the rate cuts that the market thinks it's going to get.
Because it's stickier.
It's stickier. And by the way, remember the big, beautiful bill, those, I do call it tax extensions because there were more tax extensions in it. But some of that was front loaded. So that's going to be a stimulus for next year. All those things are kind of inflationary.
Yeah. Do you worry about inflation or the labor market in the U.S.?
Well, I'm going to disagree with you, Jen.
Okay. All right, good. That makes a better panel.
So from our perspective, we do think the inflation hawks have it wrong. We've been worried about the labor side, and obviously the Fed has a dual mandate. And from our perspective, yes, we've seen some goods inflation, but the services side is showing deflationary pressures. And when you think about housing and rentals, we see that really coming down. And so inflation, in our view, 3% last year. We think it's 2.8% this year, 2.6% next year. And wage growth is slowing. Unemployment is ticking up. It hasn't impacted the consumer yet, and that's one of the reasons why we're optimistic about the U.S. equity market. But we think it's critically important that the Fed continue on its path of easing. We're calling for another 50 basis points this year, 50 basis points first half of next year to really get to a neutral rate closer to 3%, which we think is more sustainable relative to the growth of the economy.
I mean, I know the Fed drives everything, but are you sometimes amazed at, given everything that's going on, geopolitics, China, there's multiple wars on multiple fronts, the debt concern, the U.S. government shutdown that we're experiencing, that, the markets are a little bit too focused just on interest rates?
Well, the consumer's still doing great in the U.S. I mean, they're still spending, and actually, if you look at the market, I mean, earnings are pretty good. You still have pretty good earnings growth. I think there are segments that some of the policies are really hurting. I think like agriculture, hospitality, some of those things. But in general, the market's still, and the economy's still really strong. So I'm put on the side of saying that we're going to have good markets here, and again, that's why I think we'll have a little bit more inflation than the Fed. So I would put it at the 25 basis points one time this year.
Do you look through the U.S. government shutdown?
If you look back in history, 20-plus shutdowns, they tend to last 1 to 2 weeks. I'm not going to say I'm projecting that is going to be the case here. But there are clear policy compromises that can be made here. There's an exogram that's available. And typically when you see a shutdown, it's modest impact to economic growth. But once there's a resolution, you gain that back. In so many regards, I would say the market tends to look through these episodes.
2018, the shutdown, the market, initially for other reasons, the market dropped, and then it actually went up and bounced back. So we seem to get through them.
I mean, there's not a single day that goes on without us talking about private credit, private markets. Is there anything that we're underestimating, actually, with the very rapid growth of private credit?
Look, I always say with private credit, you got to remember that banks used to be the lenders. Capital requirements were such that it changed it, so now that's shifted into the private markets. I think the key is, but this is consistent with any credit. With credit, you always have to find where the opportunity is, right? So right now, you look at the high yield market and even the private credit market, some portions of it are priced for perfection, right? Like you want to know people are optimistic about the economy, look at the fixed income markets. So you have to find where there's opportunity. And the key, I think, is to remember that private credit is illiquid, and therefore you have to get a premium. You should get a premium for that, so kind of demand that. Am I worried about private credit? Not yet. What I've said, one thing that is a concerning trend is as you get into these perpetual products from drawdown, it's always a bit riskier when you have to deploy capital in the case of credit, because sometimes you're better off saying, well, you're not getting the risk-adjusted returns that you should for it. So I think that's just a trend that we should keep our eye open on.
But Jenny, Franklin Templeton has really expanded, quite a lot into private credit.
Yep.
The integration, I imagine, hasn't been without tension, because if you're a traditional asset manager, it's quite different to private credit investing. So how do you navigate the two in terms of leadership?
I actually honestly don't think it has been. I actually think there's tremendous respect from both parties, and actually they view it as there's an advantage. Matter of fact, if you're just a traditional fixed income manager and you don't have access to talking to people in private credit, it's like you're managing with half the information. So we ensure that our teams are talking to each other to understand how it's evolving. And as a matter of fact, I think we're all doing is trying to figure out appropriate products where you can incorporate private assets into, combining with your traditional fixed income.
Yeah, you're also going into just much more alternatives. Is there a strategic challenge in trying to build scale in some of these projects?
Look, I think that I first want to agree with Jenny in this case. I see, tremendous value creation happening in the private marketplace. The liquidity and capital are available to private companies. The bank regulatory environment not likely to change dramatically, that we're going to see increased private credit. So, the view that these are exposures that large institutions, ultra high net worth individuals have had access to for a very long time, yet individual investors have not, has really been a big focus for us at State Street, and partnering with other firms that have these capabilities, in this case, Blackstone and Apollo, and bringing some of these exposures. In the Apollo case, we're really focused on the U.S. investment grade core plus segment. Many managers will have emerging markets debt or high yield within the plus component. We're talking about private investment grade with that premium that's available. And so I think very innovative, creative structures are coming to market that are really with that intent of helping, whether it's retirees and target date funds get exposure to private markets, or in our case, ETFs. We think it makes a lot of sense.
Do you see the need for a cultural shift? Because some of the, this space maybe is more relationship driven, it's faster paced.
In many respects, I think that all of our worlds are sort of merging together, right? Institutional versus wealth. I think there are very sophisticated firms that are advising clients, that are incorporating private markets inside of portfolios. Likewise, if you invest in a target date fund that has, say, 10% allocation, that's already built for you, right? That's a glide path. And so I think that in general, maybe some of the behaviors that we have seen from individual investors in decades past, I think is a very different situation today.
How will it change the financial industry in 3, 4, 5 years? How much do you think longer term actually about you and your competitors, Jenny?
Well, look, there's a reason why there's this massive proliferation in alternatives and private assets, right? So in the case of private credit, we already talked about it. A lot of the bank lending rules and capital requirements, I think, has pushed post the financial crisis into the private credit. And I think in private equity, companies are waiting longer to go public. You just saw yesterday, I think it was yesterday, Electronic Arts just went private at a $50 billion valuation. Right? You can't imagine in the past that there was enough private capital for that. Well, why? Because a lot of the rules around public companies and quarterly earnings and things force CEOs in a time of great technological innovation there's a fear that to meet those quarterly earnings are not making the investments that they need to make to ensure that the company's positioned for the future. There's pressure on compensation. There's a lot of pressures on, and the cost of the regulatory compliance to be public. So companies are choosing to not go public and going private from being public. So I don't think that trend changes. And if anything, in this time with the technological advances, as I said, I actually think there's even a greater reason to stay private.
Feel free also to send questions. There is a QR code. Go for it. It's anonymous. No, I'm kidding. It is anonymous. Do you see a big change in
I think a lot of the trends that we've been seeing, sort of barbelling of portfolios, index for large market exposures and alternatives growing, I see that continuing. I do think a lot of investors and wealth platforms are increasingly wanting to do business with fewer providers. And so this trend of the larger firms, whether it's on the public market side, private market side, getting bigger and bigger, I think is a theme that continues. The desire by investors for a really strong value proposition, which in turn has put pressure on our top line. But that at the same time has come where there's so much technology that's available for all of our firms to really think about how do we streamline our entire process, deliver a really strong client experience. And I think the other exciting thing that we're seeing is just the ability to leverage technology at scale and customize, personalize at scale. And so, we've partnered, for example, with a firm in the US called Ethic that provides, this automated, tax-optimized solution for clients. And I think it is beginning to make certain markets, when you think about India, for example, payment systems are much more robust. Ability to transact is a lot less costly. And so we're seeing new investors coming into the market. And I think that's an exciting space.
I mean, I know there's a couple of ideas being floated around, get rid of quarterly earnings. We're not sure whether that sticks or would be regulated, but does it also change the public markets, or will, public markets want to change?
I don't think, if you go to changing to reporting every 6 months, I don't think that's enough to change and people say, oh, now I want to stay public. I don't think that's going to be dramatic enough. I think there's a lot of fundamental issues around being a public company. And we need it. Like, we need the liquidity. We need a lot of public companies because most people, it's the best way for them to get investments. They need to have that liquidity. And so we have to, I think, be honest with ourselves about why it is that people are choosing to stay private.
You mentioned technology. Do you feel like that, at the moment, the financial industry could be disrupted? So how much time, in your working day do you spend thinking about disruption, AI technology, or acquisitions?
A tremendous amount, because I think the world is changing quickly. And I say that every year, and I feel like the following year it is even changing faster. And so I think all of us in our industry have to look beyond, what we're doing in our financial services realm, but look broadly. And so the technology, how it can be used to create greater efficiencies and productivity, I think we're all doing that. Looking at opportunities to get greater insights, whether that's in the investment process or delivering for our clients. I think in many respects, we're still early innings. These are questions that we get from our clients all the time, like winners and losers with blockchain, with AI, with quantum computing. And frankly, I don't know if we have all the answers. But what I think is exciting from an investment perspective is the ability to take advantage of these greater macro themes. And to ensure that there's that allocation, because we know these spaces are really, they have the potential to disrupt. Exactly what the outcome is, I think, is still to be played out.
Will we see more deals like you did with Apollo? Is that like a blueprint of things to come?
We're very much oriented around partnership. I would say if there's one theme that runs through State Street, it is that. We know what we're really good at. And ETFs is a big part of our business, and so partnering with what we consider best-in-class firms to bring their capabilities to market, Apollo, Blackstone, Bridgewater, all of those are partners. So I think the answer is yes.
Jenny, how do you see, again, how do you see your firm actually changing over the next 4 to 5 years, and what do you spend most of your time thinking about?
Well, I mean, so, we got big in private assets, so we're about $260 billion at Franklin Templeton Private Assets. We just announced a partnership. We had wanted to do more in the infrastructure space. We think that's really important. Infrastructure is a great asset for particularly people who are retirees, want some source of income, but also get some upside. And we ended up partnering with 3 firms to pull together, and then we're going to, package it and basically leverage our distribution capabilities. One thing that I think is really important to understand the differences as you talk about these various firms, as you move from these alternative managers who have historically just sold into institutional clients, where the client knows exactly in a pension fund what their cash flows are, to being able to talk to financial advisors of individual clients, the education that's required is really significant, and the investment in education is really important. And we spent a lot of time on that component of it to make sure that suitability is appropriate. And I think that all of these things, as we're coming together, it is really important. The financial advisor is critical because they're the tip of the spear in figuring out whether it's appropriate and suitable for an individual client.
In terms of the leadership, Jenny, you just added a new co-president, Daniel Gamba, to the firm. What does that mean for succession planning? Are you planning to step down?
It's so funny. Somebody asked me that question. I was like, what are you talking about? I'm just getting started. No, I couldn't be happier about Daniel coming. He was actually a CEO or president over a $1.3 trillion asset manager, and I had to convince him why. And, you should talk about it. I think that the bigger getting bigger in asset management, and the reason why is you have to have full breadth of capabilities, and I genuinely believe that if you don't have scale, your ability to train your AI models, you're going to be left behind. And data is very expensive. We know because we buy it from places like Bloomberg. But so, yeah. So honestly, to be able to attract Daniel and also to recognize two other folks who are on my team and the good work that they do, we created a model. We actually have 3 co-presidents under me. So I gave up the president title, and I'm still the CEO. So I always thought it was kind of silly to be both president and CEO anyway.
What are you like as a leader? I mean, in these, when you look at what you've bought and it's big and you're trying to get bigger, is it really culture fits that you have to work on, and how
100%.
difficult is it to pass it
That
down
is
from
the
top?
biggest thing that happens in this, right? It's easy to buy a company. What's hard is making sure you're integrating and that it ends up being more than just the firm being added to your firm. And so we spent a lot of time getting our CIOs to know each other and talk to each other. And I'll tell you, to me, it was like a breakthrough when this was what our growth equity CIO was having a heated debate with our deep value CIO on whether NVIDIA was overpriced or underpriced. And both just fundamentally believed it. And it takes time for that to build that kind of trust to be able to do that. And then, we came out with a real estate debt fund, and actually it came out between our real estate private credit team, or actually our private credit team post-COVID was saying, gosh, if we have to foreclose on a property on this real estate debt that we have, we're just going to have to sell it in the market. We've never managed properties. Let's talk to the real estate clearing partners. So they started doing these calls every 2 weeks to just talk about kind of what the market looked like. And it was the clearing partners who said, hey, all the regional banks were the lenders. They've retreated post-Silicon Valley. We should step into the space. And so we launched a real estate debt fund, and our multi-asset team actually was the one that seeded it with $500 million to give it scale right out of the gate. So to me, having 3 CIOs, all of this came out of our CIOs. It didn't come out of product development. And to me, that's a sign of success by being able to get them to spend enough time together. They value each other's insights and have those conversations. And so I view it as that's kind of my job, is making sure the team is actually playing like a team.
Yeah, and this is also something that, leadership fundamentally boils down to making sure that, the culture fits, the culture works as you want it to be.
That's right. And to me, I think in this position, it's really 3 key things that are critical. One is strategy, which you talked about, asked us about, the right direction for the firm, recognizing your strengths, your ability to deliver value and punch above your weight. 2 is having the right people in the organization. Jenny spoke about that with her co-presidents. And lastly, culture. And I think culture matters a lot. We're an organization that's very collaborative. We work very closely with our clients and partners. Our mission is really to be the world's leading partner and provider of innovative investment exposures and tailored solutions for our clients. We need to be really listening carefully to our clients, connecting the dots, moving with agility, moving with speed, but also with a focus on the heritage of the firm, which is very much about democratizing investing. When we essentially gave birth to the U.S. listed ETF industry some 32 years ago. So that is a theme that cuts through. And so culture is one of these things where it's just about the values you hold dear and reinforcing that at every part of the organization.
Do you hire differently now than you did 5 years ago because of AI or because of the value sets or the tools at your disposal?
There's some things that you just never change. I always, when people ask about culture and acquisitions, I always say, in acquisitions, the investment banker will tell you why it's a good price and a good strategic fit, but they'll never talk about culture. And so we always say we look for 3 C's, firms that focus on the client. And you can tell in due diligence how quickly are they talking about the client. Are they collaborative? Does the management team like each other? We actually invested in a company where after 6 months, I met the management team, and I was like, you guys understand they don't like each other, right? And guess what? It didn't work out, right? Collaboration is really important. And then finally, this mindset of continuous improvement, right? Are they people who are curious, who want to, continue to do better? You always have to hire for those things, right? And then it becomes the skill sets around what are you looking for? And I think, it's going to be interesting. We were talking about it earlier, just even with our kids, as they're leveraging tools. I mean, I'm so old that when I did math, they didn't let you have your calculator in the class, right? Because you had to learn how to use math, right? And so they're trying to figure out, how do we deal with all these AI tools in school? And I don't know that any of us really understand what that is. But you want people who are willing to try these new things.
But Jenny, when you say you can tell very quickly after a conversation whether they put client at the forefront, what do you mean?
You can, I mean, you and I just had a conversation about an event that we had where somebody made a comment that we were shocked that it actually, I said, that must have been an internal voice. I don't know how it came out externally about how they were thinking about clients. You can tell. You can tell whether people genuinely are there. I mean, at Franklin Templeton, we talk about, and I tell the story about how, you know, saying to my kids, will anybody follow me in my career? And my daughter goes, no, Mom, I want to do something that helps people. And I was like, are you kidding me? Like, and I genuinely, I get excited about what we do because it is so important in helping people. And, you know, I think you can feel whether that's a genuine passion about whether people feel that or not in our industry.
How do you hire?
Look, I think I'm with Jenny. I mean, there are lots of tools now that help us, but at the end of the day, we are in a business of delivering for people. And so that desire to be curious, to learn, to be entrepreneurial, you know, a lot of the skills that are being taught these days in college, I think in 3-5 years' time, it's going to be something else. And so it's that core desire to stay current, to understand, to learn from others, to bring others along with you as you seek solutions. I think those are some of the qualities that I think are very persistent over time.
Can you tell in the first meeting whether it's going to work out if you meet someone that you want to hire?
I think there is a desire to come to a conclusion very quickly, but I do think it takes some time to really watch and observe and try to understand, you know, the motivations around decisions that they've made in the past. What are those key sort of value trade-offs that they've made? I think some of that essence, I think, is quite important.
I'd say if we haven't all admitted that we've hired the wrong person for a certain job, we're lying to ourselves. It's hard. You try to do it. I think that one of the key things is you also have to then make a decision to make a change if it doesn't fit.
And you learn from that.
And you learn from it, right?
That's right.
Jenny Johnson, Yishin Hu, thank you so much for joining us. Thank you.
Thank you.
Please welcome to the stage Anu Iyengar, Global Head of Advisory and M&A at JP Morgan.
Francine Lacroix there in conversation with the CEOs of State Street Investment Management and Franklin Templeton. Quick check on the markets before we get back to the Bloomberg Women, Money and Power event. European stocks a little bit weaker this morning. Looking at US stocks and US futures looking a little bit weaker. So we continue to monitor those markets and think about US shutdown. But let's head back to the Women, Money and Power event. I can see my colleague Jumana Besetcha has taken to the stage to bring us the next panel conversation. Let's listen in.
I feel like we started off the year, and I was sitting having a conversation like this in Davos at the World Economic Forum right at the beginning of the year, and everyone was feeling really bulled up about the prospects for deal making, for M&A, for IPO activity in the US. And then you fast forward a couple of months, and obviously you had the tariff announcements, you had this massive wave of uncertainty unleashed. I think, you know, there was concern about what this all meant. We were entering into this new regime. And yet, in the last couple of months, what we have seen is public markets, US stock markets, all-time record high after all-time record high. And some mega deals have been closing. I mean, only yesterday, we're speaking about EA Sports. That is the largest LBO in history. We're talking about $55 billion here. So something has happened in the last couple of months, and we're going to get to the bottom of it. Anu, I want to start with you and just sort of, you know, your description, your characterization of what has gone down in 2025 and why all of a sudden we're seeing these mega deals come to the forefront.
It's been a roller coaster ride.
Yeah.
Many of it unexpected. And now I think people getting comfortable with dealing with the unexpected. Every day you wake up and you're like, okay, what's the headline today? And how do you navigate it? And you can be at one level maybe concerned about that, but at a markets level, I think it's a good thing too, because the resilience that the markets have shown to absorb what each of these events that you could have viewed as a big shock and just kind of work through that. So I'll break it up into three buckets, right? First, M&A deal making, $3.4 trillion in the last 9 months. And historical average has been about $4 trillion. So even if you have $1 trillion, we are looking at 10% higher, but it's probably right now we are tracking to about 30% higher year over year. And this is after having a pause for about 4 weeks or so when it looked like, deal making was going to look very different. You talked about record highs in S&P and NASDAQ, but yet, Jenny just talked about it, the importance of scale, which is driving companies to do larger and larger deals. 49 mega deals, larger than 10 billion. 49, just in 9 months, contributing to about $1 trillion of volume, because the correlation between valuation and scale is at an all-time high. And so you see every strategic who's saying, yeah, if I want to do an M&A deal, how do I do a bigger and bigger deal? But yet, at the same time, there's about 20% of the S&P 500, which is trading at a discount, and a meaningful discount to their 52-week highs. So there's plenty of opportunities as well, which is why you see deals like these LBO deals happen.
Speaking about headline news, we walk in this morning, there's a U.S. shutdown. Could that derail IPO activity? I mean, SEC is going to get impacted. Filings for IPOs are going to get impacted.
I think we could find, just among the four of us, 50 headlines this year, each of which in isolation you would have said should bring things to a grinding halt, because we are still in the middle of geopolitical tensions across the globe, each of which you could consider as a significant event that has an impact on many things in the economy. But yet, people have figured out a way to navigate it. So whether you want to call it uncomfortably comfortable, comfortable with uncertainty.
Numb.
Not numb. I think there's various versions of that. But no, I don't think it brings things to a grinding halt. I think the innovation, creativity, and most importantly, the need for scale, the need for supply chain solution, the need for technology, need for AI, the need to find solutions to labor. There's a lot of drivers such that companies don't have a choice but to navigate.
Okay, so let's pick up on that word scale. You are in the interest, Christina, of providing capital. The deals are getting bigger. I referenced EA Sports, but there are a whole bunch of other deals also. You talk about Anglo Tech, the railroads in the U.S. also. These are huge deals that are going through. How easy is it to get the capital that is needed to finance those deals? And how big can you go? I mean, $55 billion is a huge sum.
So the very good news is the credit markets across non-investment grade and investment grade are very strong, and we can talk about all-time tights, but importantly, supply-demand is still in a very good technical position, which means there's not a tremendous amount of supply yet of large transactions. Obviously, the deal you mentioned on Monday is a big one. And we've also had great innovation in the capital markets, and a lot of that happens in the U.S. around the private credit markets. And the thing that's exciting for us at Goldman Sachs is the convergence of those two markets are creating even more pools of capital. And so when we created the Capital Solutions Group at the firm, that's what we saw. We saw private credit expanding. It started out in a non-investment grade sponsor-related market, and now it's grown into the investment grade market. This is trillions of dollars of capital that are forming to support these companies, these sponsors, these sovereign wealth funds, these large capital investments. The need for AI investing in data centers and compute and also energy transition, people quote $100 trillion by 2040. So we're quite confident that the markets will support that. Back to the question about how big can we go? Right before that transaction announced, we held an internal session with our merger bankers, and we talked about the art of the possible for what would be a single BLBO, which is what that is, raising $20+ billion of debt, funding a large equity check. And I think it's really the equity there that is super exciting, which I know maybe we'll talk about. If you were going to expand that horizon to maybe a double B type credit rating, I think, you know, you're talking 60, 65, $70 billion of transaction value could get done with strong credit markets across private and public. And then, of course, we have the equity to raise. But we're very, very optimistic about the return of large M&A, and we're starting to see signs of it. And we see it in the CEO boardrooms of confidence. And yes, the blip for the shutdown last night, I agree with Anu. Hopefully it's a blip. We've seen many of them in the past. They tend to be short-lived. I think the average is 8.5 days. That would be nice. But if it does drag on, I think ultimately you might see an impact.
Yeah. So, May, I want to draw on your Middle East expertise. You've been in the region for a really long time. And does
that mean she's old?
I've been in the region for, I guess, a long time, too. So we're all in this together. But, you know, not a day goes by where I'm not reporting on my show out in Dubai about a Middle East sovereign wealth fund that's taken a very large stake, a strategic stake, in a U.S. company, whether it's in AI, whether it's, you know, QIA investing in Anthropic, whether it's MGX and Intel, the EA Sports deal, PIF, obviously a huge equity chunk. So talk to us about the role you think Mideast money plays in getting these deals over the line and how they are thinking about the investment opportunity with these strategic choices.
So I think if you go back historically, you'll see that the sovereign wealth funds used to be a passive investor. And passive investors in public securities or a passive investor in private equities, and they would not ever be on the forefront. If you look at just the past decade alone, past 5 years more specifically, but the past decade, that's evolved, that's changed. The sovereign wealth funds have realized that they have substantial amount of petrodollars that's coming into their coffers. And they have at the same time decided to diversify more meaningfully away from oil and gas domestically. So a lot of what you're seeing them do is really taking action for their own agenda and their own strategic agenda. So even if you look at EA as an example, and that transaction where there's a meaningful check, equity check that came out of PIF, that's part and parcel with their broader strategic plans of diversification, and sports and esports is a big part of that. Savvy was the subsidiary that was set up by PIF to focus on that. They've done an acquisition previously, Pokemon, and that was a $3.5 billion acquisition. And they continue to look at that as a means for them to diversify into what they want to be relevant in, which is sports, entertainment, e-gaming, etc. And a lot of what you're seeing them do is part and parcel with that mega strategy that they have. That's both in Saudi, which is a huge plan for them to go from what used to be a very focus on one center of gravity of productivity, which is the oil and gas, and now into a substantial amount of differentiation, which takes a lot of investment, and the investment can't be alone. So what they're doing is they're leaning in on partners. So even in EA, they had partners with them, partners that are trusting partners for them. They've done these types of investments for them to then, and we will see, I'm pretty sure, that there'll be a lot more of the development of these games happening back in Saudi as well.
But the Middle East capital is a slice of overall private capital, right? Because over the last decade, you've just seen the number of companies which stay private for longer and the number of public companies decline, right? So in that mix, I think this is the latest set of investors who have kind of grown in a meaningful way, but private capital itself has become a big part, whether that's private equity or private credit. That private capital continues to grow, and the number of companies who are staying private or going private and company formation in the private land is also increasing.
So you bring up an interesting point, which is specific to the PE industry, right? And the fact that, you know, monetization opportunities are less. They're just happening with less frequency. Many of these deals were done when interest rates were lower. There was abundant liquidity, you know, back in 2021. It's a challenging time for the PE industry. How does that affect what you do?
So there's more creativity required for private equity to monetize.
Yeah.
And you start with the company wants to sell to a strategic, right? And the strategics are also looking at every portfolio company of every sponsor to try to find opportunities, because sometimes that may be an easier way for you to get something done. Plus, every flavor. It's no longer I take the company public or I sell the company. There is myriad variations of what you can do in between, partially own and partially monetize. and there's every color of the rainbow flavor in between. And that's what we are all doing, frankly. We set up a group to look at strategic financing solutions, which just means how do you look at the asset that you own and find a way to partially monetize and partially own. And why continue to do that? Because the multiples at which people enter these assets are still high, despite where the market is. That's one. And second, the scale that you need in order to go public. So I know here we are in London, but if you want to think about the S&P 500 inclusion, in 2008, the size of a company was $3 billion to be included. In 2024, $18 billion. That's a pretty dramatic change in scale that is needed, which means you need to get your company big enough before you become relevant in the market for index inclusion.
Yeah. I also think of functioning IPO market's a very important dynamic we should talk about, because that is, for a sponsor, an important element, particularly looking at these large transactions. When you're making this type of a bet on that size equity, are you committed to your IC to say, for sure, I will sell it to a private buyer 5 years forward, or do I need to make the commitment that I can take this company public again? And so, coming out of the gates of September, we had the best start in the equity capital markets since 2010. The ECM volumes now are up 18% year over year. Sponsor volumes are up. And importantly, the month of September was very active for sponsor IPOs, and they're all working and they're all trading well. And we actually at Goldman have 17 IPOs on the launch pad. So I do think, again, functioning markets across private and public are super important to support these transactions. And, that will be an important element for sponsors going forward. Continue to be. A lot of them will stay private for longer, but there are some very large pending IPOs that sponsors are going to bring back to the public markets. So public market investors will have an opportunity to invest.
Well, I want to say also, May, I know you wanted to jump in, but capital markets also in the Middle East region have picked up significantly. We have seen a huge explosion on the IPO front. How is that also translating down the capital structure in terms of opportunities and PE interest in the region?
Absolutely. Can I just first maybe just address the one point, which is the other thing that we're seeing globally is the emergence of secondaries as another alternative to exits for private equity firms. And I think that is a wave that will continue for a while to come. And I think there's a lot of participants ever growing into that. So just
the continuation funds, I think,
entirely. That's been the biggest and something we're quite active in. But just going back to your question about the IPO markets and the capital markets in general, I have to say that in our region, the capital markets have been a little bit sleepy for a while, and then they woke up. And they woke up with a vengeance. And the way that they woke up with a vengeance is through the governments of, in particular, UAE and Saudi Arabia, because I think these are the sort of more prominent of the capital markets. They figured out that the best way for them to support their capital markets is by privatizing their own companies, which are typically very well run, cash generative, dividend paying, et cetera. And I think they got to the realization that IPOing doesn't mean losing control. It just means monetizing and taking those funds so that you can actually invest them in other things that you need to, that are relevant to you, important to you, that you would have otherwise not necessarily been able to capitalize. So that's what's happened for the most part in UAE, in Abu Dhabi, in Dubai, in Saudi Arabia. And that really generated a lot of global interest in those capital markets. If you look at in the UAE alone, the markets are up 165% over the past few years. They've outperformed most other, if not all other markets recently. Tadawul has actually performed relatively well, maybe not as
not so much this year.
Sorry?
Not so much this year, Tadawul.
Not so much this year, but Bloomberg wrote that perhaps there's going to be an easing off of foreign restrictions on trading. I think that's a technicality that once that actually does materialize, I think we'll see those markets performing a lot better. And I also think that people are looking for ways to invest that are outside of the core markets of the U.S., which some people think is a bit toppy. So this becomes a good alternative as well.
I know, I want to bring it back to, I guess, the number one theme that's going to come up on every single one of these panels, and that's just the amount of excitement there is around artificial intelligence and the investment opportunities there. But it's not just excitement, it's actual Hundreds of billions of dollars of capex spending is going into building out these data centers. Loads of deals are going through. Should we be nervous about valuations in this space?
There is not a single boardroom, not a single C-suite, not a single investment committee where AI is not discussed. Not one. Every company you can...
That's Bloomberg's Jemana Besetcha, of course, hosting a panel on deal-making at our Women, Money and Power event. A lot of conversations there about M&A, about the role that private markets are playing, of course, in that. You can continue to follow the event. You can watch that panel and all that come after it. LiveGo and TLIV are the functions to use on the Bloomberg terminal to do just that. We'll be hearing from the GSK CEO, Emma Walmsley, a little bit later in the programming on that stage. Bank of England external MPC member Catherine Mann joined us on TV earlier, but she'll be appearing on the stage at the Women, Money and Power event a little bit later. And stay tuned to Bloomberg TV for many of those interviews and panels from the event. Up next, Bloomberg Brief. This is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
NYK sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japanese agency. And also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the petroleum fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, and the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next, 10 years, we try to increase the number of the vessels powered by the ammonia.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. The U.S. government is shut down. It is the third under President Donald Trump. Agencies told not to start carrying out plans for a funding lapse. Market disruption, stocks and bonds falling as the shutdown threatens a temporary blackout in economic data. And we'll have live coverage of Bloomberg's Women, Money and Power event in London, featuring the most influential female voices in finance from around the world. So once again, we're 5 hours into a government shutdown. The Fed stays open. Commerce Department badly affected, so is the BLS. Likely no employment data from the government on Friday. No non-farm payrolls. We will get ADP. We did get JOLTS. But I love what the economist of UBS, Paul Donovan, said today. Private data is like viewing the economy through a keyhole. Very clear, but a very narrow field of vision. So that'll give you an idea of what the Fed is trying to deal with and what markets will be trying to deal with when it comes to trying to perceive what the monetary policy path forward is going to be. As you can see, traders have turned risk off. S&P futures down, NASDAQ 100 futures down, Russell 2000 futures down. For small businesses, they're not going to be able to get loans until this thing turns itself around because that whole situation has shut down. Let's look at yields. For the moment, we're not seeing too much movement in yields. We're about where we were yesterday with the 30-year at 4.74, the 2-year crucially at 3.60.23. It's important to note that coupon payments won't be affected, debt servicing won't be affected as of yet. We do have to wait and see if rating agencies are going to have a say on all of this, though. I do want to also mention that some perceived haven assets are rising. Gold, for example, hit a record earlier. It's actually peaking towards $3,900 an ounce. And interestingly, crypto has taken a turn up in the last hour or so. Bitcoin, Ether, and some of those tokens are on a tear. But let's get to some individual stock movers now. Over to London and Kriti Gupta. Kriti.
Bonnie, thank you so much. Let's kick it off with Nike here this morning, soaring higher by 3.7% in the pre-market. This one's a little bit of a head scratcher, Vonnie, because you're seeing two very different dynamics. Nike, of course, the maker of sportswear, of athleisure, of sports equipment, you name it, has a lot of international exposure. So when you have that sort of tariff impact, Nike is one of the first stocks that get hit, especially when it comes to China. Except here's where it gets really interesting. They actually came out with their earnings last night. Fabulous earnings, strong across the board, but they increased the amount that they're going to hit on their bottom line when it comes to tariffs. $1.5 billion, that is higher from the $1 billion forecast they gave in the last quarter. Really crucial because you would think that the higher hit would actually mean the stock maybe trades a little bit lower in the pre-market. The opposite is happening this morning, Vonnie. You are actually seeing it raise higher, and it might just be this idea that clarity remains king when it comes to some of these American stocks and the tariff impact. That is the Nike story. Let's talk about the Novo Nordisk story here. I kind of want to use this stock as emblematic of what you're seeing in the pharma sector around the world. I woke up this morning to futures trading lower. I am now talking to you as the pharma sector is really pushing around not just the FTSE 100 to some grain on the screen this morning, but also the Swiss index. This comes after the news from Pfizer and the Trump administration yesterday that there can actually be an agreement to alleviate some of the pressure on tariffs. So you saw Pfizer higher in yesterday's session, a little bit of a catch-up trade in Europe, despite the fact that technically today is the day that pharmaceutical tariffs on Europe actually kick in. Nevertheless, Novo Nordisk and the entire sector higher to the tune of about 2% this morning. I want to end on Occidental. This is a stock that we have our eye on when it comes to the deal space. Still maybe getting a little bit of the Buffett bid, higher by 1.3%. OXY is your ticker, trading about $48 a share. Crucial here because Warren Buffett, who's been very active when it comes to Occidental, is in active talks to talk about the OxyChem business, a $10 billion deal if it does, in fact, come true. So Occidental Petroleum getting a little bit of a bid this morning, Vonnie.
All right, Kriti, thank you so much. That is Kriti Gupta there in London. I do want to break some euro area CPI data for you all. Coming in as anticipated, the preliminary September consumer prices data show a rise of 2.2% as expected. Core CPI in the euro area up 2.3% year over year, and that also matches estimates. As for the euro, it is trading stronger today at 117.52 right now, although it has to be said that the dollar index is weaker for obvious reasons. Well, in just moments, we're going to hear from outgoing GSK CEO Emma Walmsley. And later in the show, State Street CEO Yeshen Hung speaks to Danny Berger before an interview with Christina Minnis of Goldman Sachs. A massive show for you today. Bloomberg's Women, Money and Power event is currently underway in London. So let's go straight there. Let's go to a panel discussion with GSK CEO Emma Walmsley.
You know, it was 9 years ago in September that I was asked to take on the great privilege of leading GSK, and it was 9 years ago in December 2016, that I first started talking to Luke Miles about joining me on the great adventure of transforming the trajectory of the company. And, you know, when you decide to leave a job that you love, you hope for two things. One, that you've put a company in a much stronger position than you found it, and also that you manage to support the smoothest possible transition. And we've all seen examples of where it doesn't look quite like that. And, you know, I feel really good to have been able to do both. It's a very different company in structure and strategy and momentum and prospects, and most importantly, pipeline. And a lot of that I've built with Luke. But it really does feel like 26, and it did feel the right time to plan for a transition, because, you know, we did this period and we continue to upgrade our outlooks from 21 to 26. We're going to over-deliver on that. And it's 26 when, frankly, I believe the CEO who's going to deliver the decade ahead should be given the time and space to define it and its building blocks, and frankly deliver and over-deliver on our long-term outlooks, which I'm really confident Luke will do. So in that sense, the time is right for GSK, it's also right for me, and the most important thing that I can do in the few months ahead is really set him up, and I know he's going to do an outstanding job with a good team, but to set him up for the strongest possible momentum he can. And, you know, then after that, I'll start thinking about what I'm going to do next. And, you know, there's zero chance of any retirements, but it's all about setting him up now. Well, oh, by the way, and getting 2 more drugs approved by the end of the year. We've already had 3 important medicines and vaccines approved, and I'm hoping for another, you know, really significant multiple myeloma approval, and then by the end of the year, the world's first 6-monthly asthma treatment that reduces the kind of attacks that cause hospitalization by over 70%. So not stopping till the last day.
And so if you look at the horizon for the company, where are you seeing the next big breakthrough, the big drug breakthrough?
Well, honestly, in our industry, which has a lot of commentary and a lot of noise and is very busy and matters in every country in the world, because it's such a huge allocation of government capital, and every individual cares about it too. But the only point of it is to innovate. Remember, we are an industry, one of the few industries that has to reinvent itself every decade because of the IP model. And it's probably been the most important move that I've made, you know, with the team, which was releasing Haleon to set up the balance sheet to be able to invest in innovation. We doubled the spend on R&D, and we now have 15 drugs, medicines and vaccines in our pipeline that should be launching, all material, all with potential peak year sales over £2 billion, should be launching by 2030. And I think 80–90% of them in the next 3 years. And they are in cancer, in respiratory disease, so whether it's asthma or COPD. In HIV, we've long been, you know, really leading pioneers in innovation. We're the first to bring long-acting drugs and solutions to both for prevention and for treatment to HIV. And remember, you know, when I first started work, that was a terrible death sentence, and it's now something we can live with as a chronic disease. And I hope we'll be able to bring a twice-a-year treatment for HIV. And then, of course, we continue to be committed to a vaccines business. You know, a bit of volatility in that market in one country in the world more recently, but there is no better, this is really serious, there is no better return on investment than stopping disease before it starts. And we shouldn't have short memories, whether it be about what happened in the pandemic just a few years ago, or frankly, it wasn't many decades ago when our children were, you know, dying of measles and, you know, the tremendous burden of polio or whooping cough and these things, and we're excited about the science that's coming through there too.
Yeah, I mean, you know, and I also want to ask, as a pharma CEO, but also as a mother of 4, what do you make of some of the rhetoric coming out from the US? For instance, pregnant women should not take Tylenol, as we know is paracetamol here, or that there is no need for vaccines, and how are you dealing with that?
Well, I'm not going to comment on the Tylenol business, but I would say what we seek to do in the US always is engage constructively, grounded in science, and answer questions with total, you know, transparency. I think, I mean, you said as a mum of 4, you know, I have given birth twice in New York, once in London and once in Paris, and they all seem to give different recommendations, and the pediatric experience. I mean, this is the thing that people have to understand, that health systems are very different in different countries in the world. And so, you know, history shows that when vaccination rates drop, diseases tend to surge, and then vaccination rates come back up. So I think our job is to make sure we partner with governments and, you know, bring facts and science and keep calm. And, you know, our vaccines is actually the smallest business at GSK, our biggest business. And Frankly, where the majority of our pipeline is coming through is in specialty medicines. So that's in oncology and respiratory and immunology. And so that's why, even though it's been a bit bumpy, I would say, and we're a bit cautious in the near term, we've continually been able to deliver upgrades, whether it's in our annual outlooks or, frankly, our long-term outlooks too, because the pipeline keeps progressing.
And you spoke of constructively engaging in the U.S. Many of your peers are seeing constructive engagement as lowering drug prices in exchange for a reprieve on tariffs. We saw Pfizer's announcement yesterday. Two questions, one, are you considering something similar? Two, are there any new drugs that you would consider launching in the US and UK at the same price?
Well, first of all, there are multi-dimensional pressures or news flow. In fact, every day you wake up to some new flow for our industry. For the reason I said before, which is every government cares about it. It's a huge allocation of capital. It's, whether it's the NHS here or what's going on in the US, it's always a top topic. And if you look at yesterday's news specifically, I think that's a step forward, and it's progress. And you've seen the markets see that as well, because it's about constructive dialogue between the government and industry. And make no mistake, the US is by far the biggest priority market for our industry, because it's the best country in the world to discover and develop innovation. So far, by the way, there are others that are coming up very fast, but it's also the best place to, for some people to be able to access that innovation early. And if we want to lower the cost of healthcare, we have to continue to encourage innovation, but at a cost that is sustainable for payers, affordable for patients when they're paying to a certain degree out of pocket, but also sustainable for us, because we have to cover the cost of failure in a pipeline, because most things don't work. And absolutely, GSK is engaging constructively. In the state visit just, I can't remember if it was last week or 2 weeks ago, we were very present, and I made the announcement of that we were committed to invest $30 billion over the next 5 years in R&D and advanced manufacturing. We're very confident and committed in betting big on the US, and that includes having these kind of constructive dialogues around pricing and access. I'm not going to get ahead of whatever we're going to do next, but I'm confident that, and I'm optimistic that the industry and government can navigate through this together to make sure that we continue to support what matters most, which is bringing down the cost of healthcare by keeping people out of hospital with innovation. And the burden of disease and unmet needs is still so huge. 1 in 2 of us will still be fighting cancer. 1 in 3 of us, not most, people don't think about it yet, but the neurodegeneration is a huge burden. And so we've got to keep working to incent innovation first. And I think we saw some balance in that commentary yesterday too.
And in the UK, other pharmaceutical companies have been quite vocal about the government not doing enough both on drug pricing.
Yeah, this is an important point.
To encourage investment. What would you like to see the UK government do differently? And what would you like to see to ensure that your presence in the UK stays the way it is?
Well, let me first be clear. We are committed to the UK. It's our home. It's our HQ, it's our listing. We invest heavily here. I mean, we invest more than $1.5 billion a year in R&D. We invest in manufacturing here. And there are many things about this country, whether it's some of the best universities in the world, the eternal promise of the data in the NHS, but we've seen some recent moves on that in terms of translational opportunities and the clinical trials. And I think that is critical. But I mean, a bit to your earlier question specifically, which I didn't answer on the pricing. It is, and I've been really consistent on this, you cannot have life sciences as a leading industry for your country, whether it's here or in Europe, if you don't support a competitive commercial environment, i.e. if you don't recognize the value of innovation. And that is critical. And actually, you know, again, I believe deeply in the value of constructive engagement. And actually, I think, you know, we're seeing some movement with the government, and I think some recognition of the value that our industry can bring. And I think that's the most crucial thing that we need to get fixed to be able to move ahead together and keep this industry as a leading one for the UK. But, you know, the UK is 2% of my sales. The US is 52% of my sales. So it's about getting FDI here. But, you know, I'm not being distracted by all the listing questions that everyone gets overexcited about, I think.
That's my next question.
Okay, well, let's move on.
Don't scoop me on the question.
Okay, I didn't know, but, you know, I perhaps could have anticipated it. I won't comment for other people.
But
there are companies that are well valued here, and I just think we should focus on what.
But in terms of liquidity, which is a perma pain point, it seems, we're seeing how the London market is doing. Would it be a consideration to do, for instance, what AstraZeneca did, or to move your listing to the US? Because, as you said, the US is such a big focus market.
As I said, we have no plans there. We have an ADR there. It doesn't. Our listing location doesn't distract from where we allocate our capital in terms of investments, and there's no plans on that.
Okay. The other, while we are on a roll here, the one thing that we are seeing is national governments protecting or trying to protect key industries, sovereignty, and whether that's in defense or in pharmaceuticals or in tech. In what scenario would it make sense for GSK to combine with another UK pharma company to create a national champion?
Well, GSK has great prospects as we stand today. It's been fantastic to have this chance to lead the organization through a step change in terms of operational performance and growth, and a real shift in terms of our pipeline prospects. So, I find it a bit hard to imagine all the scenario plans that could possibly be, but there's zero engagement on that kind of question at the moment.
So merger with AstraZeneca is not imminently on the cards. Okay.
Not sure where that came from, but good.
It's, anytime there's a change in leadership, there is always the question about an activist investor or a merger.
Oh, well, I've had experience of that, and I can tell you that what matters in our industry, and it's what I said in answer to your first question, the only thing that matters is the pipeline of innovation, because that is what sustains our growth, and that is the point of the industry. That's the value we deliver to society, and it's hard. It takes a long time. Fortunately, technology, and this is that's why healthcare is the ultimate use case for everything to do with AI and tech, and I think it's going to become a more productive industry, and the returns will get better over the decade ahead. But that's what we need to focus on, more than financial engineering. And don't forget, there's nothing more disruptive to an R&D organization. And I've done global mergers. I know what they take in consumer goods, but in pharma, there is nothing more disruptive to an R&D organization than, aggressive extraction of synergies.
Yeah, and so,
And it's not like the scale play is a question for many of us.
And, in that vein, before I get to my final question, do you still stand by your move to spin off Haleon instead of take that $50 billion takeover offer?
Of course. I mean, zero doubt on that. When I started, we had a completely locked up balance sheet. We had declining investment in R&D. We weren't doing any BD. And, half the pipeline of the industry comes from outside the core research of the main company.
Yeah.
So that was the moment to unlock the capacity of the company to invest in the reason it exists. And frankly, that's why we've delivered a step change in growth and a step change in margins over the last 5 years since we've been an independent company. And quite frankly, as someone who grew up in consumer goods, and I led that consumer business inside GSK, I built the 2 global mergers with Novartis portfolio and then the Pfizer one, I don't think I had a single question at a quarterly results about the consumer business. And when I took over as CEO, I think a lot of people had that question because of my background about whether I'd want to hold on to it. It was the opposite. It's like the consumer business is never going to be given the capital to invest in its own independent growth because the priority had to be the pipeline. So that's a 100% answer.
And finally, you know, Emma, when you step down, the tally of female CEOs of FTSE 100 companies falls to less than 10%. When you took over in 2017, did you envisage that this would be the scenario in 2025? And, you know, this is a place where we're trying to be optimistic. So what is your message to the future generation of female leaders, or just leaders?
Well, first of all, you said, what did I, you know, did I envisage this? I've tried never to define my career by my gender. And it's always annoyed me a bit when you get the sort of the female CEO tag to everything you do. But at the same time, I deeply recognize, and maybe more so now than when I started.
Less than 10%.
Yeah, I deeply recognize the responsibility we have as role models. And nobody can debate. It's a serious problem when 10% of our leaders, whether it's in business and industry or in government or in the judiciary or in education, it's a serious problem when we are not more appropriately represented. And it's no coincidence that GSK has had a step change in operating performance whilst I have moved to a position where 50% of my direct reports are women, including the CFO, the head of digital and technology, you know, the head of our US business. Remember, I said 52% of the company is a woman. So, you know, and actually we're up to, it's not just about the top table, but it's the next generation coming through. I meet regularly with the top 30 of the company because I believe one of our most important jobs is to drive succession. And half of them are women, and that's really the generation that's going to come through. And what do I say? I say, Ruth, go for CEO. I say to...
Are my bosses in the room?
Yeah, well, why not? I say to women, have big, brave dreams, and don't let other people talk you out of them.
That is
ask for help when you need it, work hard, learn from brilliant people who will help you stand up on the difficult days. And you got one life, don't waste it.
Thank you so much, Emma.
All right.
That was a pleasure.
And that was GSK CEO Emma Walmsley speaking to Ruth David, Bloomberg London Bureau Chief. Meanwhile, in the States, Congress blew past a midnight funding deadline, triggering the U.S. government's first shutdown in nearly 7 years, the third under President Donald Trump. For more, I'm joined by Bloomberg senior reporter Miles Miller. Miles, President Trump has signaled that he'll use the shutdown to also lay off federal workers, not just furlough. What exactly is he planning?
Yeah, this is a very different shutdown than the shutdown of the first Trump administration. What we know is that the president, and by extension his budget office, has asked for cuts to programs that should be eliminated. And what we know is that usually during these shutdowns, the 750,000 employees in the federal government who are usually furloughed then get back pay. But in this situation, it appears as though there is a significant amount of people who work in programs that the president does not feel are central to the mission of the federal government, who probably won't be returning to their offices. And, you know, this is all in an effort to shrink government. It's something that the president said that was a lot of good could come out of the shutdown. But if you really want to talk about it, it's about the impact of the shutdown and really the impact it'll have on global markets. The immediate global impact is economic. Jobs, inflation, and GDP reports won't be released in a timely fashion. And of course, that leaves the Fed with issues because what can they rely on if that jobs data, if that GDP data is not timely?
All right, Miles Miller, thank you so much. We'll chat to you again later. That is Bloomberg senior reporter Miles Miller there for us in London. I want to remind you, you can watch more of Bloomberg's Women, Money, Power event by going to Live Go on your Bloomberg terminal. But let's just take a quick look at how markets are faring now as the government is 5 hours, 26 minutes into a shutdown. We have futures pointed lower, risk off across the board. The dollar index down about 0.1%. Dollar yen weaker by 0.5%. The yen at 147.12. This is Bloomberg.
Let's talk about this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. The U.S. government is in shutdown. It's the third under President Trump. Agencies told to start carrying out plans for a funding lapse. Market disruption, stocks and bonds fall as the situation threatens a temporary blackout in economic data. Elsewhere, we have live coverage of Bloomberg's Women, Money and Power event in London with the most influential female voices in finance from around the world. I do want to bring you some market action, though, on this first day of a U.S. government shutdown. As you can see, futures are pointed lower. They're off their lows of the session, though, as we approach the open. The shutdown won't end until enough Democrats accede to a short-term funding bill. Who knows when that could happen, but there's likely going to be no NFP report Friday, possibly even no inflation data October 15th. Paul Donovan of UBS saying private data is like viewing the economy through a keyhole, clear, but with a narrow field of vision. In other words, it's only somewhat useful that we can depend on ADP data. We really need that government data to know what the Fed's path for monetary policy could be. That said, we're not seeing too much movement in bonds just yet. It's not going to affect interest payments or coupon payments, anything like that. We do see the 2-year yield down about a basis point. The 30-year yield trading below 4.75. We'll be watching that closely. The VIX elevated, but just still under 17. Let's get to some individual stocks to watch now for the session. Here's Kriti Gupta. Kriti.
Bonnie, thank you. We'll start with Nike this morning, higher by about 3%. NKE is your ticker. So a double whammy here, because on the one hand, they did talk about reporting earnings that were strong across the board, a real turnaround story when it comes to not only their internal organization, but how they're dealing with the tariff threat. They also provided some clarity on what that hit could actually look like, talking about a hit to the tune of about $1.5 billion. That is up for about $1 billion in their previous outcome. Looks like those earnings overshadowing the tariff compromise. Another stock we're watching very closely, especially here in Europe, is Novo Nordisk. I think emblematic of the pharma rally you are seeing around the world, really taking its cue from the Pfizer story yesterday, the idea that a negotiation with the Trump administration can alleviate some of the pressures when it comes not only pharma tariffs that have kicked off as of today, but also how it looks in terms of building the investment and the infrastructure in the States down the pike. So pharma rallying around the world following the Pfizer lead. I want to end with some deal news, or potential deal news, I should say. Occidental very much in focus. We'll call this the Buffett bid, higher by about 1.4%, as Warren Buffett yet again thinks about, or I should say considers, according to reports, taking over OxyChem, which is part of the Occidental business, to the tune of about $10 billion. Those shares rallying this morning as well, Bonnie.
All right, Kriti, thank you so much. Kriti Gupta there. Bloomberg's Women, Money and Power event is underway in London. Bloomberg Open Interest co-anchor Danny Berger is standing by now with State Street Investment CEO Yi-Shin Hung, who just wrapped her panel. Danny.
Vonnie, thank you so much. That's right. I am here with the State Street Investment Management CEO, Yi-Shin Hung. Really excited for this conversation, Yi-Shin. Thank you so much for joining, and great to see your panel earlier this morning, too.
It's great to be here with you, Danny.
So this is your third year as CEO of State Street, one of the oldest banks in America, a storied institution, and it's been, let's call it a volatile business environment for 2025. We're talking just after a government shutdown, policy changes coming thick and fast. How do you judge 2025 so far?
Well, it has been a very dynamic year, let's say. But at the same time, you know, we feel very good about the U.S. economy. Our base case is for a soft landing. We think that the Fed is making the right moves by starting with a 25 basis point cut. We're looking for another 50 basis points this year, 50 basis points first half of next year. Corporate earnings are incredibly strong. Right, the EPS estimates are supposed to be 11% this year, 13% next year. And so despite a lot of action and policy making, at the same time, we feel like the fundamentals are actually quite strong.
How does some of it change how you run State Street specifically? And part of what I think about is talent, for example. Changes to H-1B visas, tensions at financial and academic institutions in Boston where you're based. Has that changed at all, how you think about bringing talent into the bank?
Well, look, I mean, we're examining all of those and thinking about the implications for our long-term talent strategy. What's important to keep in mind is State Street is a global firm. State Street Investment Management is also. We're in 30 locations around the world, 12 of which we manage money out of. And so we have so many locations in which we can attract talent.
Does it change at all how and what geographies you want to attract talent? Are you looking, for example, expanding more abroad versus the U.S.?
We're looking everywhere in all the major markets. Of course, we see tremendous growth as you think about the Asia-Pacific region, Middle East. But there's a lot of dynamics in every market, whether there's increased pension consolidation that we see in the UK, Ireland, the Netherlands, and then the tremendous growth in just wealth. And the ways in which individual investors are accessing investments is evolving by virtue of technology and personalization and scale and all of that. So there's so many opportunities. At the same time, we can focus on some of the challenges in the marketplace, but I tend to look at these longer-term trends and see a real role for us as a global, very significant firm being able to bring insights to investors.
State Street always investing in technology, and of course, we're in the middle of a technological revolution, you could call it. How are you thinking about not just AI as an investment, but implementing AI within State Street?
There's so much promise across AI, just in automating basic tasks, but leveraging tremendous amount of data that we have. State Street is the second largest custodian bank in the world, And so a good 10 to 15% of all transactions we see. So there's enormous information that we gather that we can then turn into insights. And that's one of the wonderful applications of AI and machine learning.
Yeah, HSBC says that they've cracked the nut of quantum computing. Is that something that State Street's looking at using?
We are definitely looking at it. But I would say a lot of this is still early days. And it will play out over time. And to your point, investors are increasingly asking us about the implications of quantum computing, the digital currency environment, AI, blockchain. Unfortunately, there are a number of ways that investors can play those themes today.
Do you think ultimately it leads to just a more productive workforce, or does it also lead to a slimmer workforce too?
I think the evolution of roles will change. You know, first and foremost, we really want our people focused on the areas they add most value and take out, you know, those activities that tend to be more manual, more administrative. And if we can leverage technology, I think that's all the better. But also, I think from the investing standpoint, there's more insights to be gained. And then clearly, as we're interacting with more and more investors and understand what's on their minds, we can be in a better position to tailor solutions for them.
One of the other evolutions is the inclusion of private assets, private capital, for more wealth and retail-oriented investors. You've really been at the forefront with this. You've launched your second ETF with Apollo. What's next?
We're really excited about this arena. We see ETFs as sort of the vehicle of choice around the world. This year is likely to be another record year in terms of ETF flows. And for us, because we're such a significant ETF player, we're in a good position to partner with the likes of Apollo and Blackstone and Bridgewater to bring these great strategies that institutional investors have had access to for a long time and make that available to everyday investors. So we're constantly looking for what are those types of innovative investment exposures we can deliver.
And for the most part, it really has centered around credit. Maybe it's a little bit more liquid. Do you think all types of private capital make sense in an ETF wrapper? For example, real estate, private equity, VC, does all of that make sense? Or do you think it will remain just being credit that fits the ETF wrapper?
Yeah, look, I mean, ETFs, it's important that there's underlying liquidity. And, you know, we've seen that develop in the fixed income market. With our ETF, Apollo is providing firm bids. We're seeing interest from the street. So we want to make sure that that exists because that's critical. The nice part about the ETF structure, though, is that 90% of the liquidity is typically in the secondary market. So you're not solely reliant on the underlying to provide that liquidity. And so I think we have to be very careful as we evolve. And then ultimately, there's this promise of tokenization, right? That could also be another way in which some of these more illiquid assets can then be available to people.
There has been this, again, this desire for these private assets, and part of it is just because there are less public companies. We have half the amount of publicly listed companies that we did in the late 90s. Other changes too, companies being taken private. We had EA last week, which was massive. At the same time, you have a administration that maybe will allow companies to report just twice a year instead of quarterly. One could view it as a move for these public markets to be less transparent. Obviously, State Street, you're very much so in these public markets. Do you think that is an issue? Is this a world moving where investment just looks less transparent as it once did?
We think it's actually going in the other direction because we see a lot of private markets firms really bringing different types of vehicles. You talked about what we are doing. We're also doing this in the retirement arena. We're the first to introduce private markets within our target date fund series. All of that requires sort of increased transparency, increased information. And with that, we think markets will begin to develop around sort of this private market space, even if the number of public companies doesn't grow dramatically.
All right, Ishan, we're going to have to leave it there. Thank you so much for joining this morning.
Thank you,
Fantastic to see you. And Vonnie, that is, of course, Ishan Hung of State Street. Lots of changes at the firm, whether it be diving into private market ETFs or looking at how AI is changing the future of finance.
Absolutely, Danny. Fantastic interview, and we'll be looking forward to more of those later from you. That is Danny Berger there in London, and you can continue following the panels at Bloomberg's Women, Money and Power event in London by typing LiveGo on your terminals. Now to other top stories trending on the terminal this morning. Euro area inflation accelerated in September, cementing the ECB's plans to keep interest rates steady for now. Consumer prices rose 2.2% from a year ago. The ECB's key deposit rate is likely to remain at 2% at their next meeting, October 30th. Taiwan has pushed back on a U.S. request to move chip production stateside to cover half of America's demand. Its vice premier says Taiwan never made a commitment to have the U.S. produce 50% of the semiconductors it needs. The latest comments underscore the tensions complicating trade talks between the two sides. Warren Buffett's Berkshire Hathaway is nearing a deal to buy Occidental Petroleum's petrochemicals business for about $10 billion. That's according to sources familiar with the talks. If successful, it would be Berkshire's largest deal since buying reinsurance company Allegheny in 2022. Coming up, the U.S. government has shut down. More on what to expect next. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
We published a story recently about the explosion of robotic companies and innovation in China. I think we said there's something like 50 or 60 robotic startups in China. Are we behind, and should we be concerned about that?
I think as far as the state of innovation, no. Most of those robots aren't built for work, for the things that, which is the entry point for these robots today. They can do some interesting things. A lot of times it's backflips or making coffee or something, but not really useful work. These robots can pick up to 50 pounds on our next generation. So they're great for the education of robotics, getting people interested. But as far as humanoids, they've got to check that safety box before they can come into any of the facilities here. And that's a big bar that we haven't seen much of out of the Chinese robots.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Federal workers do you plan to lay off?
Well, we may do a lot, and that's only because of the Democrats. And as you know, they want to be able to take care of people that have come into our country illegally, and no system can handle that.
If you want an indication of how serious Republicans are about keeping the government open, who wants the shutdown? There's no better proof than the fact that Speaker Johnson sent everybody home this week, ensuring a shutdown no matter what the Senate did.
That's President Trump and then Senate Minority Leader Chuck Schumer speaking to reporters before the U.S. government shutdown. This is the third shutdown under President Donald Trump. For more, Bloomberg Washington editor John Harney joins us now. So, John, Trump has signaled that he'll use this shutdown not just to furlough some federal workers, but to actually lay off workers. What is he planning?
Well, that has been a suggestion, a threat, as this closure of the government was approaching and as it unfolds. Now, the plans for furloughs and for what agencies are supposed to do during this period do not, as of yet, include layoffs, dismissals, that sort of thing. But it's certainly on the minds of federal workers and their families and others, of course, and people who may depend on these agencies.
Yes, and we know that certain agencies will remain open. I mean, the mail is going to continue, for example, TSA and so on, but national parks, that's going to be affected. The Congressional Budget Office estimates about 750,000 employees will be furloughed and a cost per day of $400 million in lost compensation. Curious as well as to what else is going on around government. So the White House has now pulled its nomination to lead the BLS. What's behind that move?
Well, the BLS, it's interesting, the BLS will shut down. And of course, any nominations or any of that sort of thing will have to be put off. And the jobs report this week will not be will be delayed at best.
There you go. That is E.J. Antoni, who had been the pick for the BLS. That pick now scrapped. Also, the CFTC pick scrapped. Bloomberg Washington editor John Harney, thank you so much for joining us this morning. We want to go back now to London for Bloomberg's Women, Money and Power event. Open Interest co-anchor Danny Berger is standing by with Christina Minnis of Goldman Sachs. Danny.
Vonnie, thank you so much. And indeed, I am here with Christina. Thank you so much for joining this morning. Wonderful to see you. And look, you obviously oversee a lot of these credit markets at Goldman Sachs and acquisition finance. And what a year it has been, especially recently with these big tech AI players coming in to look for this market for financing. The statistic is they've raised 70%, the tech giants, from what they issued in the same period last year. How does that change the contours of credit markets to have these tech titans such large participants?
Well, the good news is the investor appetite is very strong as well. And so when you look at investments in this infrastructure, which is what this is around, obviously AI, most investors have an allocation of desire of like 8 to 9%. And if you look at where they are, they're only in the single digits. So number one, you have an investor base that is very open to want to invest here. Number two, you have great formation of capital in the private markets and in the public markets to support this need. And we've all talked about large numbers, 100 trillion by 2040, to support all the needs across AI, infrastructure, and compute. And the good news is, over that period of time, our capital markets are there to support this demand.
Are there some areas where we've gone too far? And I just think of the Oracle debt issuance, for example, that we had a few weeks ago, where you have them issuing 40-year debt. And the spread is something like 1.37 above treasuries. It's very, very tight for a time period that is essentially, who knows what the world's going to look like then. Right. Does all of that make sense?
I think you have to focus on supply demand as a technical, right? And I think that's a big element of why the markets continue to be so supportive. There's a lot of liquidity in the system, and they need to stay invested. We did a transaction last week for a BB company, and it came at a negative new issue concession, and it's the largest senior unsecured note that's come in the last decade. A negative new issue concession. It just shows you markets are positioned to invest.
Does that mean, though, that risks in some cases aren't appropriately priced?
I think there's been a lot of discussion about what the appropriate risk premium is. One of the things that we're excited about around credit in general is the macro backdrop so far is set up what we almost call a Goldilocks scenario, which is the economy is showing some of the macro factors that would suggest easing is in store, which is good for credit and good for companies and good for cost of capital, but it's also not so weak that people are concerned about growth. I think the U.S. economy has been remarkably resilient. We've spent a lot of time with our European clients. They're seeing signs of growth, also in Japan. So there is a macro setup that would suggest credit has still room to run.
And again, you put on top of that the demand, which you've been talking about. I mean, is there going to ever be a scenario that you can foresee where spreads widen materially and stay there? For example, April 2nd has spreads widen, they immediately snap back. Are we just in tight spreads for the foreseeable future?
I would say you probably get some vol periodically, like April. And again, what could really change the spread widening is real macro weakness, but also tremendous amount of supply of new money. And so we probably should talk about some of the large deals that are getting announced.
Can we?
Yes.
I mean, last
Kind
week,
of
and I know there's some specifics you can't exactly talk about because
Right.
you've been involved some of them. Speaking of which, the $55 billion largest LBO with EA. One of the interesting things about that, though, was that it was entirely financed by JP Morgan. Is that a win for banking to say that banking is participating in this and not private credit?
Look, I think in that scenario, because we were the sole exclusive sell-side advisor, confidentiality was very important. If you noticed, the deal didn't leak until the very end.
Yes, well done.
A large part of that is driven by sole financing provider, sole sell-side advisor,
Right.
which we speak a lot about at our firm. So I think it's a very good sign in a situation like that where the board wants certainty and speed and confidentiality. And also, I suspect, knowing how that deal will likely be received in the markets, it's been public about the size of the financing. It's $20 billion. I think my chair is sliding down here.
Come back over.
Sliding down. I don't know why it's moving. But $20 billion for an LBO seems large, but we've worked with our colleagues to say that's very doable, imminently financeable, and it will go very well. And while private credit, I'm sure, could have stepped in there and supported the deal, I suspect the pricing of that debt, when it comes into the market and we run a full auction for that paper, will come inside what private credit would have been able to do.
And just quickly, Christina, because we're almost out of time, but I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours then, just given the benefits that you're talking about?
Yes, I think we're going to see the return of large transactions. We're already up. The $10 billion size transaction year to date is already up meaningfully. And with sponsors, the number's up 80%. And I think they're going to avail themselves of both private credit options and public options. And we're, as you know, at Goldman Sachs, we have one of the largest private players in the world, plus our agency, we're agnostic.
Well, Christina, we're very excited to hear what else you all are going to be up to this year. Won't ask you to break confidentiality, but it's an exciting year to come. And Bonnie, with that, I will toss it back to you. That's, of course, Christina Minnis of Goldman Sachs on already an active year and more activity to come.
Danny, thank you so much. Danny Berger there. And you can continue following the panels at Bloomberg's Women Money Power event in London by typing LiveGo on your terminals. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Now a look at what's ahead today. European Union leaders begin an informal meeting in Copenhagen to discuss support for Ukraine. Then, all hail private data. It might be all we get for a while, given that we're in shutdown. 8:15 a.m. we'll get ADP employment data, and at 9:45 a.m. the S&P manufacturing PMIs for September. So to that end, let's take a look at the macro picture as we are 6 hours now into a government shutdown. As you can imagine, S&P futures lower, though we're off our session lows. Not too much movement for yields, down a basis point on the 2-year, a weaker dollar. That's it for Bloomberg Brief. Surveillance continues the conversation.
NYK sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japanese agency. And also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the parity fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
Both parties want their little demonstration. My instinct is this probably goes on for about a week.
Refusing to release the BLS data is going to be a problem for the markets.
Probably this report is not coming out on Friday.
If we still have a shutdown, it could impact the Fed meeting, and that might be reason for people to pull back.
Even with the long shutdowns, you still have markets outperforming.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg surveillance starts right now. Coming into Wednesday, entering a government shutdown. Congress blowing past the midnight funding deadline, putting some of this week's key economic reports on hold and leaving some investors focused on alternative jobs data. ADP is coming up later.
Yeah, look, this is Make ADP Great Again. This is the week where all of a sudden the alternative data sources take on a disproportionate amount of information, a disproportionate amount of clout in markets. Expect pretty significant trading ranges where you get both ADP as well as ISM Manufacturing later this morning. They may be the last clean reads because tomorrow we're not getting jobless claims, and on Friday we're probably not getting non-farm payrolls report heading into what will be a very fraught Fed meeting at the end of this month.
We did this back in 2013. We had a non-farm payrolls report that was delayed by a couple of weeks, and depending on how long this goes on for, we might be doing it all over again.
We are doing all over again. The question now is how long will this shutdown last? We are in a government shutdown, so you're going to see a number of workers that are going to be furloughed. The reason why this morning I am waking up with a little bit more of optimism that potentially this is going to be a short shutdown is we already see some Democrats caving. Overnight, you had 3 Democrats decide to vote for the clean continuing resolution the Republicans put on the floor. They need to just flip 5 more. When this starts to hit the D.C. metro area, do you think the senators of Virginia and Maryland are just going to sit back? Or are they going to say, no, you know what? Our constituents do not have work right now. They are not being paid. They can't go out, pay for their bills. We are going to vote to keep the government open.
It's quite a start to Q4. Let's talk about Q3. The final month of Q3, markets don't care about any of this. The strongest September for equities going back 15 years. The biggest month for debt issuance, the biggest September, I think, on record for corporate debt supply. And we closed out the month with the biggest leverage buyout ever in the history of financial markets. That is quite a September.
It sounds very risk-on. At the same time, you had the biggest rally for the month when it comes to gold for the month of September, going back to 2011. So definitely a different tone to all of this, but the market's wide open with the expectation that the economy will chug along and the Fed will keep easing into a vacuum, except it will not be a vacuum. And this is going to be really important at a time where the government's shut down and we're not getting those official metrics. How much more important will some of the earnings reports be, especially as they start trickling out with Delta and then JP Morgan and the rest? All of a sudden, that might be the most important kind of information that we get for setting the tone into the rest of the year.
I can't believe we're doing ADP guesses, but we are. So median estimate is 51K, highs 80, lows 25. This is the real deal. 8:15 Eastern time. It's ADP day this Wednesday. From New York City, welcome to the program. Coming up this hour, George Concavas of MUFG as we kick off Q4 with a government shutdown. John Lieber of Eurasia Group on why it's likely to resolve within 2 weeks. And Evan Spiegelman of BMO Capital Markets as the White House inks a deal with Big Pharma. We begin this hour with our top story. The U.S. government shutting down for the first time in nearly 7 years. Bloomberg's Laura Davison joins us now from the nation's capital. Laura, welcome to the program. What happened and how long is this going to go on for?
So at midnight, the government shut down. This means that, there will be almost no one working at the Bureau of Labor Statistics, no jobs report. There are some agencies that will stay open and keep operating with minimal staffing, things like the National Park Service. The White House has wide latitude on what they keep open, what they shut down. So it's very much a political calculus of sort of who do they want to pinch and where the pain points are going to be. In terms of how long this lasts, it's not clear yet. It looks like at least a couple of days. Senators are set to leave town for the Yom Kippur holiday. The House isn't even in town, and right now it's still Democratic leaders and Trump, sniping at each other on social media. Once we get into the weekend, though, and into next week, it's possible we could see some daylight. We saw a couple Democrats join with Republicans last night to vote for opening the government. That if did not pass, they need at least 8 Democrats to join with them, but they've already got 3, getting 5 more. As the pain really sets in, as people aren't getting paid, as key services are delayed, that could start changing the minds of lots of senators.
Laura Davison with the latest down in Washington, D.C. Laura, thank you. More from Laura later on this morning, tracking this story. This is how it usually plays out. Goes on for a little while. Public gets sick of it, blames both parties, and someone caves.
Exactly. And right now, what you have at the moment is no party is fully blinking, but that is going to change because this is just going to drag on. And as I said, you have senators from Virginia and Maryland where their constituents are going to be directly impacted today, immediately, and that might flip some votes.
Which is why typically the market looks through it. So is it different this time? Here's the view on Wall Street. George Concalves of MUFG writing the following: if a shutdown lingers, it will end up delaying upcoming economic data releases and likely dampen risk-taking. George joins us now for more. George, good morning.
Good morning.
I want to get to the final point there. Why will it dampen risk-taking? Do you sense that this is somehow somewhat different?
Look, so this is a year full of disruptions, contradictions. You guys opened up with how markets have been risk-on, climbing the wall of worry. Nothing really phases these markets. But there's always that moment in time where you kind of compressing towards the end of the year, good gains. Maybe you use this as an excuse. It's a catalyst to say, you know what, take some chips off the table. It's been a good year. If this were to linger, it could be disruptive.
So it's just the theory that there's something potentially that could disrupt things, so you might as well sell. Does that actually fly for you? What would you actually sell if you're going to de-risk?
Well, look, I mean, you're already seeing the weakness in the dollar. It's your traditional macro products. It's going to be about a relative value play. Equities have had a great run. Let's not kid ourselves, right? So I do think that there's, again, let's see if this lingers. If it does, and it goes on to the weekend, I think it will matter.
I feel like every single month people are saying there is something that will matter because I'm nervous about valuations. Does that sort of work anymore, given the fact that the underpinnings of this have been proven out in the earnings, have been proven out in some of the investments, particularly from the tech giants?
Look, I mean, I think we can't conflate all that stuff. I think, again, as my point earlier, it's the time of the year. You have a lot of gains. This is where you could get defensive if you wanted to.
Do you think if the market takes a downturn, that'll be enough to maybe push Congress to actually act?
That's a great point.
The way the bond market pushed Trump to act in April?
That's a great point. So, I mean, I think risk markets here matter more. The dollar matters a lot, too. But, I mean, it only matters if it really changes the foreign flow, which has been largely coming in as a hedged flow. But if the dollar were to change, I think that would matter. And I think if equities take a turn.
How much does it matter to the market that we're not going to get Friday's jobs report as of now?
I mean, look, you guys were kind of poking fun at ADP, but ADP is, it has been proven to be a better predictor of what's really been happening to the jobs market. So maybe we might have a sigh of relief because NFP has been so wrong for so long.
Just to be clear here, that is a sport that a lot of people have enjoyed for a long, long time.
This is very true.
I was going to say, just to be
not
fair,
unique to any of us.
I don't think that we were poking fun at it. I think that in fairness, we are saying make ADP great because people are actually going to care about it. But carry on.
Look, but ADP has been a better predictor of what the true underlying weakness in the jobs market.
George says it's
Yeah,
great already.
exactly.
The confidence numbers from consumers aren't great. Jobs data hasn't been great either. Just in the last 24 hours, the quits rate, the lowest this year, consumer confidence, 5-month low. The share of individuals saying jobs were plentiful, the lowest since 2021. We've got a high confidence investor and a low confidence consumer. What's the credible argument for that dichotomy to persist?
I mean, it doesn't persist. I mean, unless you start to really place a greater emphasis on productivity and that the consumer doesn't matter in an economy that's a consumer-based economy, that means you think that you're changing how this economy operates. And maybe that's happening with AI and all the investments, but that's a little bit a bridge too far for me at this stage. I mean, it takes time to implement all these sort of new technologies, and we've put a lot of money into it. The consumer's still relevant, so if you kind of cut off the consumer here, I think that jobs market for me.
Do you think we're reaching the limits of looking through weak data here?
I do, because again, time of the year and the fact that we've been very nonchalant, complacent, there's lazy longs in a lot of different asset classes.
How about lazy longs in bonds? You didn't mention going into bonds necessarily. You talked about a potential weaker dollar. You talked about lightning risk. Are bonds the same kind of trade as they have been in the past during government shutdowns?
I think it depends on how long it lasts. I mean, I think past is not prologue, so we can't go back, and we haven't really had a long enough shutdown, and we'll see how long this one persists. But I do think the changing nature of flight to quality of the bond market has been with us for the last 18, 24 months, right? So I think this one would probably prove in the same direction, that the reach for treasuries probably won't be as strong as in the past. Because you have alternatives now. You could just sit in cash for longer. You could buy T-bills. So duration probably won't trade that well if this were to last, because it highlights the potential dysfunction that is concerning on the fiscal outlook, right? So I think that's all part and parcel. Again, it depends on how long this lasts. Maybe it's a nothing burger, and we're gone by the weekend or before the weekend. But if this goes into the weekend, I think it's risk off, or and bonds could potentially be under pressure too, the long end of the curve.
When was the last time you had this much or this little conviction?
Well, look, I mean, I think in general, investors are just, have been, and forecasters have been just going with the flow, right? And just operating with how markets, provide, short-term trading opportunities and being very tactical. I would say that this is, this is the new world we live in, I think.
Well, do you push back against that, against the flow? Is this the time to start pushing back against what has been a winning trade, which is stocks go up, brr?
Everything goes up. Yeah, no, I think we're in that sort of stage where I think it does make sense to be more discerning. I think it makes sense. Like, you've had an amazing year, and you mentioned gold. Like, all of these different asset classes cannot be right. They're all going up for different reasons.
What else do you need to see to get to this point? The title of your note, it's still a reach for Goldilocks outcome.
Because we haven't really seen it broaden out, right? It's been so concentrated, and like the sort of capex, the sort of performance that's been so concentrated in tech, it masks the reality. And John was mentioning it before. The consumer cannot be this pessimistic, and somehow we're going to have like the start of a robust cycle. That means that we're still on the tail end of the consumer side, and tech operates in its own planet.
I just want the sound effect again. That's all I want. You're having quite a week, aren't you? What was that one? Burr. Is that the money printer?
Yeah, money printer go burr.
Right, okay.
I mean, that's just essentially.
Right.
But yeah, you think it's got like a very kind of Latino, like a brr.
Yeah, George agrees.
Yes, you do.
For me, all I can say is that's what I think about every day when people have this lack of conviction, and it's just buy stocks.
That's what gold thinks too, right?
Yeah. Brr.
I know we get comfortable around this table sometimes. Just to remind you, we are live. George, it's good to see you.
Thank you.
Can't redo this. George Goncalves of MUFG, thank you very much. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, Vonnie. Yes, thank you, John. Good morning. Well, as you guys have been discussing, Congress blew past a midnight funding deadline, triggering the first government shutdown in nearly 7 years. The White House's budget office ordered agencies to begin executing their plans for a funding lapse. The shutdown will disrupt hundreds of thousands of jobs, upend many public services, and lead to delays in key economic data. The White House has pulled the nomination of E.J. Antoni to lead the Bureau of Labor Statistics. His nomination showed signs of faltering due to criticism from senators and economists. A White House official said the administration looks forward to nominating a new candidate soon. Bank of England Deputy Governor Sarah Breeden warned of the threat to the economy posed by leaving interest rates higher for too long. Breeden said that efforts to stamp out a fresh spike in inflation by holding borrowing costs in restrictive territory come with risks in the other direction. And that is your Bloomberg brief. John.
Vonnie, thank you. Thank you very much. More from Vonnie in about 30 minutes' time. Sticking with the Bank of England, Catherine Mann, a member of the Monetary Policy Committee, speaking at Bloomberg's Women, Money and Power event over in the City of London. Bloomberg subscribers can tune in to the interview on Live Go on the Bloomberg terminal. Up next on this programme, we're playing the blame game.
Republicans are plunging America into a shutdown.
We're doing well as a country, so the last thing we want to do is shut it down, but a lot of good can come down from shutdowns.
A conversation up next with John Lieber of Eurasia Group, live from New York City this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Shutdown, day one. Some economic data might be compromised by this. I'm sure you're familiar with the story. So this is the week ahead for the economic data. We will get ADP later this morning at 8:15 Eastern Time. Look out for the PMIs at 9:45. The ISM as well. Super, super important. Big question mark around jobless claims and around payrolls. Jobless claims and payrolls are super, super important for this Federal Reserve. Just where is this labor market at a time when FOMC officials at the moment are super divided on what to do next?
Yeah, and as you were mentioning earlier, the JOLTS data that we got yesterday, the job openings data, which is the last official data point that the Fed may get before their meeting at the end of this week, showed the same kind of inconclusive market that we've been talking about. The idea that the actual number of job openings came in higher than expected, actually rose, but when it came to the quits rate, it tied with the lowest rate going back to 2020. This is not a dynamic market. This is a stagnant labor market, and it has a lot of concerns and red flags around it.
Got a low confidence consumer. Pair that with a high confidence investor. There's something got to give in Q4. Equity futures to kick off Q4 look like this. We're negative by 0.5% on the S&P 500. On the NASDAQ, we're down by 0.6, following a 3-day winning streak on a benchmark closing out Q3. In the bond market, 2-year, 10-year, 30-year. Focus on the front end of the curve just for a moment. 360 on twos. We just closed out the quarter. The 2-year bond yield down for 3 consecutive quarters for the first time, believe it or not, since 2020. That story, though, has started to stabilize. I think people coming to realize just how divided this committee is on how far they're willing to take things and how quickly they're willing to cut again.
On one side, you've got Governor Myron, you have Mickey Bowman, you have Chris Waller, although he's been really quiet, which is notable to me. Then you have a mounting number of other Fed officials, and yesterday, adding to the rolls, Lori Logan of the Dallas Fed coming out and really putting the emphasis back on inflation, saying the combination of persistent inflation, resilient demand, and modest labor market slack indicates to me that policy is likely only modestly restrictive. There may be little room to make additional rate cuts. This flies in the face of getting down to 2% in quick order, which is possibly the reason why you're seeing that stagnation in the 2-year.
That's next meeting for the Federal Reserve at the end of October, the end of this month, October. Unreal. Under surveillance this morning, we're playing the blame game.
Republicans are plunging America into a shutdown, rejecting bipartisan talks, pushing a partisan bill, and risking America's health care.
We're doing well as a country, so the last thing we want to do is shut it down, but a lot of good can come down from shutdowns. We can get rid of a lot of things that we didn't want.
So here's the latest this morning. The Senate failing to reach a deal to extend funding, plunging the U.S. government into a shutdown, putting a slew of economic data in jeopardy. John Lieber of Eurasia Group writing the following: even a macroeconomically insignificant shutdown could have knock-on effects that delay data releases for the next several months as federal workers get up to speed. John joins us now for more. John, welcome to the program. I want to pick up on the language of the president there, that last line. We can get rid of a lot of things we didn't want. Is this going to be a different kind of shutdown?
Yeah, absolutely. I mean, I think the fact is that Trump is playing a different game by a different set of rules than I think the Democrats on Capitol Hill are playing right now. And he's been playing that all year, and he's been playing that for his entire political career. And I think that there's a lot of unpredictable effects that are going to come out of this shutdown that we haven't seen before. If you look at the pattern this year, it's that Congress's authority has been usurped or even eliminated in many cases when it comes to decisions about what the federal government's doing, who they're funding, whether or not they're laying off workers or even closing entire divisions, and Congress has been helpless to stop it. So part of the reason the Democrats are behind this shutdown, are rallying behind the shutdown, is because they want to force the power of the purse back over to Congress. But I don't think Trump cares. And again, he's playing a different game. He now has the power to choose who's essential, who isn't. He's going to take that opportunity in a way I don't think we've ever seen in the United States before, and deem the functions that he prioritizes as essential and then cut off the ones that he doesn't. So this is a very different type of shutdown than we've seen before. Even the one that Trump oversaw in 2018 and 2019, the government was partially funded then. So you had the core defense functions and other security functions had an authorization from Congress to keep spending money. Right now, nobody does. So Trump's in charge, and he will be in charge until the Congress agrees to reopen the government.
Does this administration try to make furloughs actually permanent?
It could try. I mean, I think that's a decision that's up to the courts. I mean, one of the interesting phenomenon so far this year is that the courts are awfully slow, and the Trump administration could be pretty quick. So they could use this as an excuse to try to furlough more workers. You know, there's been some resistance to those furloughs, even within the cabinet agencies that are run by Trump appointees, because they want the people to do the work they're supposed to do. But now they suddenly have an excuse, and clearly the White House sees a political advantage in forcing more of these layoffs in order to bring Democrats back to the table, and I expect that they're going to use it.
Well, John, 3 Democrats already back at the table last night in the sense that they voted for the Republican clean CR. They only need to get 5 more Democrats to then reopen the government and keep it funding to the end of November. Do you think that Schumer is losing the moderate wing and potentially this is going to be a short shutdown?
It could be. I mean, you know, your base rate here, your expectation should be that this is a relatively short shutdown, you know, because of these political pressures on members of Congress who don't want to see this happen. And the only thing you need is exactly what you said. You need 7 Democrats to say, we've had enough. We already know the universe of those 7 Democrats. They're the ones that voted to keep the government open this spring. And you mentioned Schumer. He's the one who's under the most pressure because he took just withering criticism for his decision to keep the government open. But the fact, and he's under a lot of pressure from the Democratic base to regain leverage over President Trump, leverage that simply doesn't exist through Congress right now. And so I think that he's in a really tough spot. Those other Democrats, I think this is an easier calculation. People like John Fetterman from Pennsylvania see that this is a tough thing for the Democrats to win. And over the next week or so, I expect those numbers are going to grow. And you know, that will help to end the shutdown probably sooner rather than later.
That actually is exactly where I wanted to go, John. This idea of in March, what happened to Chuck Schumer when a lot of people, Democrats in particular, said caved to the Republican demands to keep the government open. Is this just performative to avoid that, to placate a certain side of the Democratic base? Is that how it's being read, at least in polls?
Yeah, I mean, I think he's in a tough spot, and you know, I feel bad for the guy. There's no way to win this thing. Like, he's got to keep his eye on the Democratic members who elected him to be leader. He's got to keep his eye on the Democratic voters who elected him to his Senate seat. And the fundamental problem for the Democrats right now is they don't have a strategy to push back on Trump. That they've been unable to land any punches, and they've been unable to draw any blood. His popularity is reasonably high for President Trump. He's hovering around the mid to low 40s, which is much better than he was doing in the entirety of his first term. And he's doing all kinds of controversial stuff that the Democrats hate, and they can't articulate the case against him. And until they figure out how to do that, Schumer and the other leadership are going to be looking for things like this that allow them to kind of shore up their base on the left and placate them a little bit and try to land these punches that so far they've been unable to do. I think this is a prime example of that.
John, the markets largely don't care. Do voters care? Has there been anything in the voting or the polling that shows that this is swaying the needle in any capacity?
I suspect at some point the chaos will be enough and people will say, you know what, we don't like either of these jerks that are causing all these big problems. That's kind of where I think this ends up in the polling. I don't think it necessarily falls on the Republicans or Donald Trump. I don't think it necessarily falls on the Democrats. Maybe the president takes more responsibility because he's the executive. But, you know, if you look at the elections, there's no evidence that these shutdowns, as we talked about last week, there's no evidence that these shutdowns make any difference in the elections whatsoever. In 2013, the Republicans were solely responsible for, at the time, a very long shutdown over Obamacare. And in 2014, they won back a majority in the Senate. So there's just no evidence that this has lasting political effects. I think it could be a drag on the overall approval rating of lawmakers in Washington, but I don't think either side's going to win or stands a lot to lose here.
John, do you think it's time for new leadership in the Democratic Party?
Probably. I mean, I don't think there's anything. You know, I think that being a leader is a tough job. I think it's a hard thing to do. They have a new leader in the House, and he's doing his best. I think in the Senate, you know, I wouldn't cast aspersions on these guys. I used to work for the minority leader in the Senate and for the Republicans, and it's a tough job. It's a tough job keeping everybody happy. But you know, again, the Democrats are not articulating the case against Trump, and their leadership is not helping them do that. So I think looking to Congress for your leadership right now is a mistake. And if I were the Democrats thinking about the next leader of the party who's going to be running for president, I'd be looking out to the states, to the governors, to people that aren't currently playing on the national stage in the way Schumer is. You know, Schumer's got to do his own tough job managing his own caucus and playing the inside Washington game. And then these governors that are out in the states are the ones who I think will be the more effective messengers against Trump eventually.
John Lieber of Eurasia Group. John, thank you, sir. Appreciate it. Such a strong final point about the future of leadership of that party.
And there's a lot of swirls around about Chuck Schumer's, not just his leadership, but his seat in New York. Point blank yesterday, Alexandria Ocasio-Cortez was asked, are you going to primary challenge him? And she said, look, a lot of Republicans think the shutdown is because I might go after his seat. They should come talk to me directly. Come to my office, she said.
If you're just joining us, welcome to the program. Welcome to our office. Futures negative by 0.5%. Up next, Amy Falls of Northwestern University, managing one of the nation's most valuable endowments. That conversation just around the corner.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Goodbye Q3, hello Q4. Equity futures on the S&P 500 negative by 0.5% following a three-day winning streak. On the Nasdaq, we're down by 0.6. What a run through September. For the third quarter, the S&P up by 7.8%. The Nasdaq 100 up by 8.8%. The Russell over the 3 months. The bulk of the move came in August. But for the third quarter, the Russell up 12%. In the bond market, 2-year, 10-year, 30-year, Lisa and I were talking about what was happening at the front end of the curve, 360. We've had 3 consecutive quarters where 2-year bond yields have been falling. Again, the bulk of that move actually came in August following that really weak July jobs report. But that move in the bond market just unleashed another leg higher for gold. Gold, 4-day winning streak into Wednesday. Make it day 5. Up again this morning by close to 0.75%. We're staring down the barrel of 4K on gold. Gold on the quarter had a 17% rally. Gold on the month was up 12%. That is the best monthly gain going back to 2011 for the yellow metal.
Last night I was listening to a podcast about gold because I was so inspired and about why Spaniards loved gold back in the 1400s. I know you're rolling your eyes at me, but it was because it was physical and they could actually take it with them. And there is this idea that you cannot take the hopes and dreams of the economic progress of a nation with you in the same kind of way that you used to. The dollar, well, guess what's happening down in DC? The euro, well, check out France. And so this is the reason why gold keeps climbing, even in the face of people saying, it's just a rock.
But just for the record, I wasn't eye rolling. Someone else around the table was. You know, just in case. You know, just in case. You do a great eye roll. Mine not so much. 3 hours away from the opening bell. Let's get you some morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. We start with the Lithium Americas. Shares are surging 33% in the pre-market after Energy Secretary Chris Wright confirmed here on our network that the U.S. will take a 5% stake in this company and a 5% stake in its Nevada mining project, home to the largest lithium deposit in the U.S. It, of course, marks the latest example of the Trump administration making investments in critical areas of the economy as it seeks to boost domestic production and cut its reliance on China. And moving on to the power company AES, shares also moving sharply to the upside, up 13%, as we report here at Bloomberg that BlackRock Global Infrastructure Partners is in advanced talks to buy the company. AES is valued at $38 billion, including debt, but it has lagged its peers in the utility space, making it right for a buyer betting that AI will continue to drive electricity demand. We're reporting that an agreement could be reached as soon as this week. And Nike, finally, its comeback bid is finally gaining traction. Shares are up 3.5% after sales came in much higher than analysts were expecting. That's because some of its initiatives, like focusing on performance and running and re-engaging with some of its retail partners, are finally starting to take hold. But there are still hurdles, with Nike saying it expects a hit of $1.5 billion due to tariffs this year. That's much more than the $1 billion it was previously projecting. John?
Yahara, thank you. More from Yahara in the next hour. We'll catch up with Adrian Yee as well in about an hour from now to talk about the latest with Nike. Nice beat from them. Nice move in the pre-market. On our radar this morning, the U.S. government shutting down. Congress failing to meet a midnight funding deadline, halting non-essential services. This is the third shutdown under President Donald Trump. Elsewhere, Taiwan rejecting a U.S. proposal to move chip production stateside in order to cover half of America's demand. The Taiwanese vice premier saying the idea came from D.C. and his country will not agree to the conditions. And finally, the White House withdrawing the nomination of E.J. Antoni to lead the BLS. President Donald Trump named Antoni for the role after firing the commissioner. Officials saying they will nominate a new candidate very soon.
So his nomination was on the ropes because before you get to the Senate floor, before you get to a hearing, you have to get through a committee. And we already had Senator Lisa Murkowski a couple of weeks ago say the committee expressed, quote, extreme reservations about him. So already that was happening at the committee level, and you can't lose the Republicans at the committee level because you for sure know you're going to lose the Democrats. So his nomination on the Hill was already on the ropes. And this comes after economists on both sides of the aisle, even conservative economists saying actually, we don't have faith in this individual. We don't think he's the right person to lead the BLS.
So this story's kind of slipped under the radar, but I think it's more important. Important not just for the BLS, but also for the process underway to select the new Fed chair. There is a history of Republicans pushing when it comes to the new Fed chair. There is a history of Republicans pushing back on the president when it comes to the Federal Reserve. We talked about Stephen Moore in his first term, nominated for a seat on the Fed board, had to be pulled. This happened here with the BLS. I think keep that in mind if you're really worried about the independence of the Federal Reserve and who might be appointed, nominated by the president and the Treasury Secretary through this process. This is another example that Congress will flex its muscles now and again.
And this is another example of how the market has an upper hand in pricing out some of the political risk that pundits talk about, because markets never were that concerned about E.J. Anthony. They were talking about the likelihood that he wasn't going to get through because of a slew of issues that were really coming from both sides. As a result, they didn't see this as a real problem. And they are looking through the sort of questions around independence with the Fed for the same reason. So maybe point for markets.
The market gets a vote. And on this time, it didn't even have to vote on this particular issue. We'll see what happens with the Federal Reserve later this year. Let's turn to investing. Demand for private markets rising as investors seek a slice of the booming $13 trillion asset landscape. Northwestern University among the institutions navigating the shifts in asset allocation, with one of the nation's most valuable endowments topping $14 billion just last year. Joining us now is Amy Forbes, the Chief Investment Officer at Northwestern, from Bloomberg's Women, Money and Power event in the City of London. Amy, welcome to the program. It's great to get some time with you. Typically, we wouldn't begin a conversation with you by talking about cash, your cash allocation and liquidity needs, but I think we have to start there, Amy. What are your cash allocation looking like now? What does it look like, and how's that changed compared to years gone by?
Yeah, it's a little higher. We have about 7% of the portfolio in cash or very short-term treasuries, and that's higher than normal, and also the duration of the treasuries is shorter, reflecting a lot of the operating uncertainty that we want to be prepared for.
Amy, when did that start? When did you start stockpiling or adding to your cash holdings? Was there a trigger that really prompted that shift?
I think it's a combination of things. We started around December of last year. There was a moment where I was thinking about redeploying, and that would have been around Liberation Day. But I think the combination of operating uncertainty and at that time relatively fully valued markets, similar combination to at this moment where I think markets are pretty fairly valued and there's a lot of uncertainty in the economy and there's operating uncertainty at the university, it just makes sense to have a little bit more dry powder, and the risk of not being in the market seems less extreme, and of course it helps to have relatively high rates on short-term treasuries. So all three things are supportive, I think, of having a little bit more money in your back pocket.
Amy, you talk about some of the moments where you flirted with getting back into the market. I wonder how much you were influenced by some of your peers at other universities who had huge allocations to private markets that they couldn't quickly liquidate in when they needed some cash. If that sort of encouraged you to hold on to more liquidity as well, whether that encouraged you to stay away from some of that aspect in terms of redeployment.
I think it's really important. Seth Klarman used to talk about the option value of cash, and I mean, I think it's harder to measure, but it is very important to have enough liquidity to redeploy into opportunity. We do have a big private equity allocation, and we've actually been growing it over time, but I think a barbell can be quite helpful in that you want to be opportunistic, and then you also want the long-term benefits of extremely long horizon investing, which I think private equity still represents.
What does the rest of the year look like given the cuts of federal funding from the Trump administration to universities like Northwestern?
We are looking hard at how to respond to a changing funding environment. I think there's many aspects to that. From an investment standpoint, we do have to continue to work on generating high returns. We are 25% of the university's budget. I don't see that going down anytime soon. And so we are stuck in a hard place of wanting liquidity, but also wanting high returns. So we are definitely barbelling in terms of how we respond in the investment.
Federal grants remain frozen as well by the Trump administration. Is there active outreach between the university and U.S. officials?
Yeah, I am probably not the best person to comment. I believe there is conversation.
Amy, just to build on this barballing, though, I think this is really interesting. How you balance the move into alternative strategies with the increased liquidity needs because of the operational environment. How are you and the team confronting this moment? Does it make it difficult to lean into those strategies, or do you have to remove money from, say, your public market allocation to fund those needs?
Yeah, I think you have to have margin. I think the important thing is to be really clear why you're giving up liquidity and where, and you have to believe you're going to get the higher returns. One thing that we have been doing is looking further down the market capitalization of private equity as we see the probability of more money through retail and other products coming in at the high end of private equity. We think the better returns may be migrating down to middle and lower middle market private equity. So we just want to be sure that we're getting paid to give up liquidity because it is valuable both for rebalancing and for meeting the needs of the university. I think there are areas of the market like large cap US stocks where it may be less important. You can probably use an ETF, and we've done a little bit more of that, where we believe you can use options or ETFs to put that exposure on. You don't need to lock up capital as much.
Amy, you talked about getting to the lower end of the private equity sphere, lower and middle market companies. I'm just wondering if you still see private equity as a source of returns over, say, private credit, where there's been so much interest, so much money, the discussions around the golden age of income.
Yeah, private credit is a very viable asset class. I think we have a 5% spend rate, so something with a 9, 10, 11% expected return is good. I think you have to think about returns net of defaults, and we haven't really seen a default cycle. So, I don't think you put all your eggs in the private credit basket. I do believe in ultimately earnings growth does drive returns over the long term. So what we want to invest in is companies that can generate good earnings growth and capital that will seek companies and make sure that the management teams are rewarded for investing in high ROIC projects. So I think there is real opportunity with smaller and middle-sized companies to generate earnings growth with the right capitalization, the right management, and the right investment partners. So we believe in both, and I think we are exposed to both. Right now, we're probably a little more focused on deploying new capital into middle market private equity, but there's nothing negative about private credit. I think it's just the spreads are probably pretty fully priced right now.
Amy Falls. Amy, appreciate your time. It's great to do this, and hopefully we can do this around a table in New York sometime soon.
Thank you so much.
Of Northwestern University. Amy, thank you very much. When you're 25% of the university budget, and it's a real risk you might become a bigger proportion of the university budget, you've got to account for that. Amy's in a tremendously difficult position. A lot of people running endowments right now are. You've got to have that bar that she talked about. You want to shift into alternative strategies, but if you give up that liquidity, you need the returns. At the same time, you need liquidity, so you're sitting at the front end of the curve. Problem you've got from here is that the interest rates are going to start to come down. So you've got a decision to make. What do you do with that position? Do you have to extend duration? Do you have to think about doing other things? They're going to get squeezed more and more potentially by both the regulation and what's happening with interest rates.
Yeah, and the policy uncertainty, because they don't know exactly what's going to come down the pike, what grants are or are not going to come through, what strings are going to be attached, sort of what we saw with Harvard and the $500 million pact that they seem to have agreed with President Trump to provide a lot of training to trade organizations, trade schools. There's a question here. How do you remain liquid at a time where so much of your investment has been seeking for yield and illiquidity? And we have already seen that with forced sales of private credit, private equity from the likes of some big universities already. So a really interesting moment. Fascinating she's betting on middle market private equity at a time where there are a lot of questions around the economic growth of this country.
Amy Force of Northwestern University. Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you so much. Dallas Fed President Lori Logan said the central bank should be cautious about cutting rates further. Logan supported the Fed's rate cut at its meeting last month, but said the central bank should be cautious in considering additional cuts while inflation remains above target and the labour market relatively balanced. President Donald Trump says his administration is close to finalizing a deal with Harvard University. Trump initially accused Harvard of failing to tackle anti-Semitism on campus, but later broadened that to include allegations of political bias. Warren Buffett's Berkshire Hathaway nearing a deal to buy Occidental Petroleum's petrochemicals business. The Wall Street Journal reporting Berkshire would pay $10 billion, including debt. If successful, it would be Berkshire's largest deal since buying reinsurance company Allegheny in 2022. And that's your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. I'm next on the program, the art of the deal.
Today, Pfizer is committing to offer all of their prescription medications to Medicaid, and it will be at the most favored nation's prices. Pfizer will invest $70 billion to reshore domestic manufacturing facilities. They're all coming in over the next week. We're making deals with all of them.
Up next, Evan Siegerman of BMO Capital Markets. He's going to explain just what is Trump RX. That conversation up next from New York City. You're watching Bloomberg TV.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Will Obey. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Asia is at the forefront of some of the world's biggest stories. I'm Sherry Yan in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Kicking off October on a low, we're down by 0.6% on the S&P, down by 0.7% on the Nasdaq 100. Under surveillance this morning, the art of the deal.
Today, Pfizer is committing to offer all of their prescription medications to Medicaid, and it will be at the most favored nation's prices. Pfizer will invest $70 billion to reshore domestic manufacturing facilities. They're all coming in over the next week. We're making deals with all of them. And I said, if we don't make a deal, then we're going to tariff them an extra 5, 6, 7, 8%, whatever the difference is, and we'll take it that way.
So here's the latest this morning. Pfizer striking a deal with President Donald Trump to sell some drugs directly to Americans at a discount. Evan Siegerman of BMO has an outperform rating and a $30 price target on shares of Pfizer. He writes the following: the announcement serves as a positive to the biopharma sector. The deal seems to set a path for other pharmaceutical players to follow, allowing for headline pricing concessions and a Trump win. Evan joins us now for more. Evan, welcome to the program, sir. So I'm going to challenge you with this. The direct-to-consumer effort, Trump RX. Evan, can you explain how this is going to work and how effective it might be?
Well, it's still TBD as to what this actually will be. Apparently, it's a website that's launching next year that allows, direct-to-consumer sales of many pharmaceutical products. There's no website yet. I don't think, there might be a Trump RX website if you go to, but it's probably just a landing page. We have seen some DTC efforts, mainly with the GLP-1s, like with Lilly Direct. So there is a model, but expanding it beyond that is a bit of an unknown. It is a bit reminiscent of me when the government was trying to do the Affordable Care Act marketplace exchanges, and that really didn't work out well. So we will see what happens here.
Evan, when they go direct to consumer, can you just help people understand what happens with margins when they drop prices? Are margins maintained? What happens?
So a great question. So margins are actually maintained, and a lot of the drugs that they were discussing with Pfizer are drugs that are not significant to their, top line or are declining in terms of revenue contribution. So you say you have a drug with a list price of $1,000. No one actually pays that. PBMs don't pay that. So if you're giving a discount of 30, 40%, and you're passing that through to just a consumer on a direct-to-consumer basis, nothing really happens to margins. You're unlikely to see the big ticket oncology products in a DTC market, right? You're not going to get a $200,000 per year cancer drug that's given at a hospital via this channel. It's more for the tablets, like with Lilly Direct for GLP-1s, for inflammation, for, more primary care conditions.
So is this essentially just cutting out the middleman, getting rid of, say, the Caremarks, the CVSs? Should this hit that entity much harder than the actual pharmaceutical companies?
I would say so. And if you hear commentary from Dave Ricks, actually, he highlighted, I believe, on the second quarter earnings call, his concern and frustration with the middlemen and how they inflate prices and really just make it very challenging for patients and consumers to get access to these products. Because if you think about it this way, you have a drug, again, for $1,000. The middleman gets that rebate and discount of $500. That savings doesn't necessarily go to the end user. It's absorbed by the system. So I think a Trump RX or DTC platform wants to get that discount right to the patient so they're not paying a ton out of pocket. The issue is we all have, insurance plans, and if we're not going through the PBMs, we don't get our deductibles and out-of-pocket maxes, so you're kind of not getting the full benefit of your health insurance. That's a different debate for a different day, but probably something you can think about as well.
Well, but is that part of this debate, right? I mean, this is essentially a question of why can't we just have a simpler system where things cost less? I mean, it's a pretty basic argument. Why haven't we done this sooner? And it comes down to, sure, the OEMs, and it has to do with the middleman, but it also has to do with the insurance structures and how we get premiums and all those forms that everyone hates filling out. So is this a first step to that, or is this essentially a nice prophylactic move that doesn't actually move the needle because of all of these other complications?
Unfortunately, I think it's the latter, because in reality, if you want to change the system, you need true PBM reform. You need to really look at the rebate and discount structures, because while this is a nice headline and there's going to be some drugs available online, it's not going to be the entire pharmaceutical kind of ecosystem. And I think you really need to understand what's driving cost increases in healthcare, insurance, for example. And I'm not a managed care analyst, but I've been reading headlines about how, health insurance premiums are set to rise 10% in the commercial space, 70% in the ACA kind of marketplace spaces. So that's a real problem. And I think that's going to hit folks next year. So if you want sustainable kind of, accessibility and dealing with costs, you got to look at the PBMs and the insurance companies.
Pfizer also agreed to spend $70 billion in domestic manufacturing facilities. Is this the blueprint for other pharmaceutical companies if they want to avoid Trump tariffs?
For sure. And, I think it's important to note, all of the companies that I cover, including Novo Nordisk, have significant U.S. manufacturing operations. So they're constantly investing both manufacturing and R&D in the United States. So it's not necessarily it might be a new headline announcement, but they were probably planning on doing it anyways. I don't just see them coming out one day and saying we're going to invest an additional $70 billion without having thought about it previously.
So is there even a risk anymore of tariffs in the pharmaceutical sector?
I never thought there was a real risk of tariffs outside of the 15% bilateral kind of trade agreement that the U.S. and Europe has on some products. When we saw the 100% tariff kind of headline from Truth Social last week, I said that was more bark than bite because, again, all these companies have significant manufacturing presence here. I think that there could be some tiny bit of, some tariffs on, imported API, which would be 15% on a portion of cost of goods sold, which really would be inconsequential when you're looking at the cost of a pharmaceutical product.
Evan, can I just narrow you down on a number just quickly? When Anne-Marie talked about that, was it 70 billion?
Mm-hmm.
70 billion investment promise. How much of that was already going to be allocated?
Well, I have to go back and check my notes. Probably pretty much all of that, because you're not going to come out one day and just say we're spending 70 billion. This is long-term planning, and they were probably able to think about it over the past years. They're doing their budgets and then come out and say, hey, we're doing this for you.
Thanks for clarity on that, Evan. It's important. Evan Siegerman there.
Very important, of course.
BMO Capital Markets. Evan, thank you. Thank you very much.
Yeah, this is sort of the story with a lot of the companies, right?
Yeah.
I mean, they can't just announce $500 billion investing plans overnight without already having some of this allocated.
But they have to add to it. Apple already had, I believe, $500 billion, and they added $100 billion to go stand alongside the president in the Oval Office and say, we're adding more manufacturing and adding more money and investment into the United States.
Unless you're Jensen, of course. Jensen apparently can just pull that money out of thin air and make big promises.
But then he also can go out and make deals overseas, and he can dance to his own music. I mean, this is sort of the single-handed agent around the world. I want to see a biopic about Jensen Huang. Please, let's get on it.
Oh, like a movie?
Yes, absolutely.
Okay.
Like a movie about how
I'd
he
be down with
regained
that
the...
too.
I think that would be
Who's
fascinating.
going to play him? You got an idea?
Ooh.
Take some time.
I will.
You ever think about that?
Thank you.
Share it in the next hour. That's your big tease. Okay. Coming up alongside that, of course, we'll have some guests. Michelle Weaver of Morgan Stanley is going to join us alongside George Pollack of Signum Global, the former White House trade official, Kate Kalukowicz, and Adrian Yee of Barclays. Adrian talking about the latest with Nike. Decent numbers from them. The stock is higher in the pre-market. The broader market to kick off the month of October and the final month of 2025. Hello Q4. Equity futures negative by 0.6% from New York City. The second hour of Bloomberg Surveillance is up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Used to be, one would say,
What's that got to do with the price of tea in China when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The amount of euphoric behavior in the equity markets is extremely high right now.
There is still so much liquidity in this market.
The earnings situation we think is excellent.
Our businesses are having very strong years. With a little more certainty, they'd be leaning in more.
Long equities and long gold has worked very well for us, and we think that will continue to work.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 pulling back from a 3-day winning streak. We're down by 0.6%, closing out a 5-month winning run. On the Nasdaq, we're down by 0.7. In the bond market, the 2-year stabilizing around 360. 3 consecutive quarters of falling yields at the front end of the curve. That story stabilizes going into the next Fed meeting. We might be light on economic data, at least for this week. Payrolls is due to come on Friday. Claims is due to come on Thursday. We're in a government shutdown. We might not get those numbers.
So what we will get is ADP, ISM manufacturing, and that will come today. So today actually might be the most important day of data that we're going to get this week. And right now, what's interesting to me is that it is a Rorschach test. You can look at this market, you can look at this economy and see weakness. You can look at this economy and look at this market and see great strength. And you have Fed officials on one side seeing one thing, Fed officials on the other side seeing the other thing. And it is unclear where they are going to come out because we've heard a lot of Fed speak and it shows a lot of division on a Fed looking at the data very differently from one another.
And yesterday, Lori Logan talking about how there's still a lot of this concern about inflation. We might not get the next CPI print. That's October 15th. The issue we have with this shutdown is we don't really know the timing of it. Is it going to persist through the weekend? Is it going to be a 2-week shutdown? Is it going to be 35 days, which you saw in 2018, 2019? I woke up optimistic, as I said in the last hour, because 3 Democrats decided last night to vote with Republicans on the CR. They just need to flip a few more. And what do you do with the senators in Virginia, in Maryland? All 4 of them are Democrats when their constituents are furloughed and they want to get paid and they're not working. They're going to have to say, all right, we're signing up for this. It's over. The fight's over. We capitulate.
Financial markets are already optimistic. The September we've just had has been absolutely historic. We've had record highs across the board on the S&P, the Nasdaq, on the Russell. We've had record debt issuance for the month of September for corporate credit. We've seen the tightest credit spreads on investment grade in multiple decades for high yield near the tights of the year. We've just seen headline after headline that speaks to a market on fire, and yet we've having this conversation about a Federal Reserve that's cut interest rates once. It is about to do so again, and maybe again and again.
This is a confusing moment, and I keep thinking about what Peter Scheer said with the I-shaped economy, where you have the bulk of the economy, and then you have this little eye that is so bright, and a little dot is so excited, and that is AI, and that's all these big companies that can profit from wealthy individuals who can keep on spending. And it raises the question, the Fed has one tool, it has the rate instrument, it has the balance sheet, it has a couple tools, but they address the same issues, and they're trying to solve for something that is fundamental to this question of how do young people get jobs with AI? How do you retrain people? How do you get people into the labor market? Things that are difficult for them to address by lowering rates, and yet they're seeing weakness in those areas areas. It is a confusing moment, and the data is reflecting
This year's flying by, isn't it?
It is.
October. 3 more months to go. Equity futures negative by 0.5% this morning. Coming up this hour, Michelle Weaver of Morgan Stanley, with Wall Street closing out a strong September. George Pollack of Signum Global as a government shutdown begins. And Adrian Yee of Barclays with a surprise beat for Nike. We begin this hour with stocks sliding as investors weigh the impact of a data delay. Michelle Weaver of Morgan Stanley sees tension growing between the Fed and markets, writing last year the Fed cut 50 basis points when it was concerned about a weakening labour market. Yet today, the data is even weaker. Michelle joins us now for more. Michelle, good morning. Good to see you.
Good morning. Thank you for having me.
You and a team have written about the need for speed. Is that the risk now, that this Fed doesn't respond quickly enough?
Yeah, absolutely. I think the market is now really anticipating these rate cuts. Our economists expect us to get another 125 basis points total between this year and next year. And I think if with the shutdown, with some of the government data delay, I don't think that the Fed is going to just, totally go on pause because of that. The data is the data, whether it comes out or not. I think, though, that really is the key risk, is what does the Fed react if we don't have the data? But overall, I would say the market is in a very strong place. I think with the policy risk side, it's really taken policy risks in stride post-Liberation Day. That was the peak for fear for corporates. That was the peak for fear for investors. So even with this government shutdown, if it's a matter of weeks, not a matter of months, I think the market will be able to take it in stride.
Is it a sort of contradiction in terms for the Fed to be cutting in the face of these robust earnings and what we're seeing in markets?
So the Fed is reacting to the labor market data. The Fed is not reacting to the earnings data. So I think if you're an equity investor, what you care about is, of course, the earnings, and you also want an accommodative Fed that's able to lower rates, able to spur growth. The Fed, though, they're not particularly paying attention to the earnings data to make their decisions. Of course, they look at it, but that's not what their mandate is about.
At the same time, in the past, asset bubbles and extreme valuations in asset markets has been something that the Fed has paid attention to. At what point does it matter? This is something that John was asking a couple of days ago. Does it feel like they're concerned about not addressing the fundamental problem in the labor market as much as they are inflating an asset price bubble and potentially inflation?
No, I really don't think that we're currently in a bubble state. I assume you're referring to AI with that bubble question.
Maybe.
And I want to unpack a couple different things. I would call it more of a boom than a bubble, a different B word there. But there's kind of three different prongs to the AI story. There's the underlying technology itself, which we're very, very bullish on. There are the AI enablers. They're the ones laying the ground, building the infrastructure to allow this technology to exist. Yes, valuations are very rich there. There's no two ways about that. It's a tough time to justify adding risk, but we do think the demand for compute is there. And then there's the AI adopters side of the story, and what companies are going to be able to do with this new technology. As you were mentioning before around earnings, we think that over the next 2-year period, that's where you're really going to start to see some of those efficiency gains, some of those benefits from AI adoption.
You think it's a boom? At some point, does it bust?
I would not say a bust. Maybe you get some correction valuations, maybe you get a modest reset, but I don't think that, it's 2000. I think that's the comparison that everyone has been trying to make, and okay, great, is this just the dot-com bubble all over again? I would not say that that's on the table.
When you say you think that we're finally going to see earning strength from AI, where exactly? Like outside NVIDIA, actually downstream companies that are supporting this industry?
Yes, so I would say more companies are now putting AI products live into production. We had the ChatGPT moment in 2022 when it sort of burst onto the scene, became a part of everyone's consciousness. There was a lot of excitement around it, but there wasn't a lot of actual corporate adoption yet. Our tech team runs a great CIO survey, and they estimate that around 60% of companies are going to have some sort of AI product in production by the end of this year. So now we're starting to move past the testing phase into the actual use case phase. And I think what's really exciting for investors around the AI adoption story is that it's not just one industry, it's not just one sector. A lot of the enabler story has been so concentrated, but this is really about technology diffusion. This is about different types of companies being able to adopt this, being able to increase their operational efficiency and improve some of their cost structure. So this is really a broader story.
Can we lean on your framework for Morgan Stanley for how you think about the equity market more broadly? This rolling recovery versus rolling recession. This is something you and the team have done for a number of years. I think back to the work coming out of the pandemic, it was a similar theme. Where are we in that process now?
Yes, yeah. So we think we're now exiting a rolling recession and in the early innings of a rolling recovery. What do I mean by rolling recession? So we, of course, haven't had a traditional economic economic recession. We have seen overall equity market earnings hold up. But if you look under the surface, if you're not just thinking about what's going on at the index level for earnings, you've seen the average stock in the market have negative earnings for much of the last 3 years. And it's really been happening in different phases. It's been rolling. So post-pandemic, you had a lot of weakness in the consumer goods areas, in the consumer tech areas, things that were really overconsumed during the pandemic. Then you had it kind of hit housing, then it hit manufacturing. So it's been happening in stages, which is why you haven't had that big index level earnings drawdown. But for the average company in the market, it's been a much tougher setup. We think now you're transitioning, though, into a rolling recovery phase that bottomed post-Liberation Day. You've had a really sharp V-shaped recovery in earnings revisions breadth. So analysts broadly are becoming more constructive on the earnings picture within the market. And we think that that is a pretty good sign that we're now entering that recovery phase.
I had a bunch of teens at my dinner table last night, and they were debating. I know that's explains a lot. Well, it explains why I make sound effects this morning. I'm just wondering whether they were going to get jobs. That's what they were debating. Can this be a jobless recovery? You start talking about the earnings breadth widening out. A lot of these smaller companies are adopting AI, algorithmic learning, making it difficult for some of these kids when they graduate from college to possibly get jobs.
Yeah.
Is that possible?
It's largely been a low hire, low fire market on the labor side, but to your point specifically around AI, I think you're starting to see the impacts of AI on select pockets of the labor market. I want to be really clear. We are not calling for mass job loss due to AI. But when you look at things that are highly automatable from the AI adoption front, so particularly computer programming and customer service roles, so for example, you just type into a chatbot instead of speaking live with a customer service rep, you're starting to see an impact on the hiring for those jobs. For 22 to 25-year-olds in those industries, you've seen a decline in the number of roles, whereas it's broadened out for those who are older within those job roles.
Michelle, this was great. It's good to see you. Thanks for dropping by.
Thank you.
Appreciate your time. Thank you very much. Michelle Weaver there of Morgan Stanley on a rolling recovery that they're starting to see.
They all want to be plumbers, the teens, because that's where they see the money. Well, I mean, they all want to go into finance, but
it's a story like 20 plus years ago in the UK. It was the same thing. We didn't have enough plumbers.
Well,
then everyone went to what? To college to become a plumber.
Yeah, well,
and then we had too many plumbers.
Well, we don't have that yet. So the plumbers still are earning a lot of money. So people are actually looking at plumbing. But this is the point, actually. The sort of trade occupations are the ones that actually are the profitable ones right now versus, say, white collar, unless you're at the very top. And how do you get in if the entry-level jobs? This was the discussion last night.
Still the humanoids start to do that work too.
You think so?
Maybe. Who knows?
Think the humanoid?
I've got absolutely no idea. I don't know what's wrong with you this morning. Where are these impersonations coming from?
I had teenagers at my table last night.
And they were doing robot impressions?
No, that's younger.
They need to work on their impressions, so then you come in with better impressions.
What's in the coffee this morning? TK special?
Yeah.
That what's going on here? All right, let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Bonnie Quinn. Hey, Bonnie.
Hey, John. Thank you so much. The U.S. government shutting down then after a midnight funding deadline passed without an agreement on a funding bill. Democrats refused to sign on unless the bill included healthcare spending. President Donald Trump blamed, quote, crazed Democrats. The shutdown will disrupt hundreds of thousands of jobs, upend many public services, and lead to delays in key economic data. Pfizer won a reprieve from President Trump's threatened tariffs on Big Pharma. The company agreed to slash some of its drug prices by up to 85% and sell directly to the American public. Pfizer said it will make sure Americans receive comparable prices to those offered in other countries. Other drug makers are expected to make similar agreements. Nike reporting first quarter sales and profit that beat expectations as its turnaround efforts started to pay off. CEO Elliott Hill has pushed to reset the athletic apparel maker by clearing out old inventory and reorganizing the corporate structure, including replacing many top executives. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the program, entering a government shutdown.
Republicans are plunging America into a shutdown.
We're doing well as a country, so the last thing we want to do is shut it down, but a lot of good can come down from shutdowns.
Up next, George Pollack of Signum Global, live from New York City this morning. Good morning.
key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
60 minutes away from the ADP report, taking on additional significance this week, given the fact we might not get payrolls on Friday. The estimate, the median in our survey, we do a survey for this. The median is 51K, the high is 80, the low is 25.
Look, we're kind of poking fun because it used to be who trades off the ADP report, and then it became maybe the ADP report is actually more accurate than non-farm payrolls. And now it's we only get the ADP report, so you better trade off of it, and that's where we are.
It's fairly decent data.
It is.
You'd call it second or third tier economic data, I get that, but for a good reason. Vonnie was talking about this earlier this morning, the way UBS sees this moment, that it's like looking through the keyhole with the alternative data. It's clear, but it's narrow. You're not getting that broad look at the bigger economy.
If ADP doesn't necessarily look at government jobs, they look at private payrolls, so they can get a good read on some of the industries, some of the sectors. Looking through a keyhole is a really good way of putting it. People are going to be looking through every keyhole they possibly can find without anything more broad.
We'll cover it extensively at 8:15 Eastern Time. The market will too. Equity futures right now in the S&P, negative by 0.5 on the Nasdaq 100, also down by 0.5%. The equity market a little bit softer this morning, following some major gains for Q3 and the month of September. For Q3, the S&P 500 up almost 8%. The Russell up by around 12%.
And this comes with the idea that the Fed is going to be cutting rates, and not just what we saw last month, but there will be consecutive moves, including at the end of this month. That's the rub. What happens if you get more Fed officials coming out like Lori Logan, like Austin Goolsbee, like some of the others who say we don't want to front load this stuff? This is actually a concern to us given the fact that inflation is still real. All of a sudden, do you ever risk some of those trades, or is this, you know, money printer go, whatever?
Is Goolsbee starting to sound a little bit political?
He's been, yes.
Yeah?
I mean,
do you think he gets the same kind of opportunity that Governor Myron does, or rather lack thereof, at the moment to voice his opinion on things? It's kind of odd to see Goolsbee have a certain view on things right now compared to where he was 12 months ago, depending on who's in the White House at any given time.
I think that there are two Fed members that I could say this about. I think that probably Austin Goolsbee is one of them and Mickey Bowman is the other, who's made a complete flip-flop depending on who's in the White House. And so you can see that in pretty cold relief. So to say that the Fed has never been politicized or that economics doesn't have a political bent to it is probably incorrect. The question is the battle of the viewpoints and the ideologies coming together with a lot of people who are just trying to parse the data and everyone just trying to do the right thing. And I think that that's the mess in the Federal Reserve.
It's an interesting way of framing things. We'll try and pass the data later on this morning. Under surveillance this morning, entering a government shutdown.
Republicans are plunging America into a shutdown, rejecting bipartisan talks, pushing a partisan bill, and risking America's health care.
We're doing well as a country, so the last thing we want to do is shut it down, but a lot of good can come down from shutdowns. We can get rid of a lot of things that we didn't want.
It's the latest this morning. Congress blowing past the midnight funding deadline, pushing the U.S. government into a shutdown, the third under President Donald Trump. Bloomberg's Laura Davison joins us now for more. Laura, I just want to pick up on that language again from the President of the United States. A lot of good can come from shutdowns. What kind of good can come from this?
Trump has floated a lot of ideas that Republicans could use this shutdown to their advantage. They could enact large layoffs of federal workers. He talked about cutting spending of programs that Democrats like. Trump and the White House have a wide latitude to do a lot of things during a shutdown. Some of these things, like we saw with DOJ, might not totally stand up to the law, but you do them, and then, when the courts are shut down, they move a little bit slower, and you don't actually litigate those things for several weeks. The question here, and that both sides are weighing very carefully, is who is going to win the messaging war? for. That is the risk that both sides have, that this could dog them in the midterms. Democrats are hoping that as soon as some of these notices start going out to people who are on the healthcare exchanges, that their premiums are going to rise, that the public will come to their side. That is a little bit of a gambit because the public does not like shutdowns. And right now, people view the Democrats as being the one who are sort of pushing the shutdown. This is a different position for them. Generally, it's the Republicans who found themselves with the blame.
The blame game will continue through today and maybe into the weekend. Laura, thank you. To extend the conversation, joining us now is George Pollack of Signum Global. George, welcome to the program. Let's play the blame game. Who's winning right now? Who's winning in the court of public opinion?
I think for right now, it has to be considered that the Republicans are winning in the court of opinion. They get the headline. Republicans funded government. Democrats said no. And I think that's a difficult headline to defeat. And Democrats are still continuing to be disjointed in their messaging. We've seen talks about healthcare. We've seen talks about rescissions. We've seen talks about congressional power of the purse. And we've seen talks about immigration. So it's kind of been disjointed from the Democrats.
How long do you think it's going to last, George?
I think right now our view is that this will last around 5 to 10 days. Because the reality is Democrats don't like shutdowns. While they are coming into this shutdown because they fear their base, that fear only takes them so far, and as we already saw with Cortez Masto and Angus King voting for the GOP funding bill, this isn't a thing where it's going to be a long-term shutdown.
When the president says we can do a lot, get rid of a lot of things, was he talking about getting rid of institutions, individuals that are going to be furloughed permanently? Is he talking about permanent changes?
So it seems what he's trying to say is, look, once we furlough these employees, it's going to be politically easier for us to actually operate reduction in forces and remove them. The issue is the civil service protections still exist. So they're going to still have to go through a notice period. They're going to still have to go through an administrative period, and it's not going to be right away. And as your reporter was saying, it's going to be subject to additional legal challenges.
George, are you expecting travel disruptions? And I say this with the TSA agents that are considered critical workers, but last time around just walked off the job or called in sick because they weren't getting paid.
Well, that's the big question. And I think what the TSA agents and similar people in that positions have learned is we do have power. So last time was 35 days when they started to do the walk off the job. I think this time we should expect that if it gets that far to be triggered much, much earlier and for them to be unwilling to really portend a long shutdown.
George, you said the Democrats are catering to their base. Who is the Democratic base right now?
I think the Democratic base is generally people who are frustrated with the president, who are concerned that Democrats were saying he's going to govern like a dictator, he's going to govern like a fascist during the campaign in 2020. And by and large, to the president's credit, he's governed as he campaigned. And for these people, they can't understand why Democrats are treating him so normally. For example, when the administration recently deployed some troops, Hakeem Jeffries made the comment, well, you can either focus on that or you can focus on doing health care with us. And for the Democratic base, they're saying, but wait, he's deploying troops to American cities. Why are you so focused on such relatively minute issues like healthcare?
George, with that in mind, where's the leadership going to come from going into the midterms, one, and going into the next general, which is something they've got to think about already?
I think that's the biggest question. And the issue is Chuck Schumer, Hakeem Jeffries, while they serve as leaders in the Congress, they don't have much buy-in with the base. When they speak, I think the base feels that they're largely ignoring them and they're not the vocal advocates they want. Right now, the man who's probably the most effective leader of the Democratic Party, and I can't say politically good or bad, is Gavin Newsom, because he's actually implementing a fight back and arguing that we can't continue to treat this as normal.
So, George, are you saying when it comes to Democratic leadership, it all needs to come from outside the bubble of Washington, D.C.?
I think that's where we're going to see it being mostly come from, because the reality is Jeffries and Schumer have put themselves in a position, be it in March 2025 or with their messaging since March 2025 in the last funding bill, that they feel that the base believes to them to be out of sorts with their priorities. And Gavin Newsom, with his Twitter profile, with his policies, with his executive action, seems to be the one truly leading a substantive pushback against the president.
And his hair and his Hollywood smile and all of that, George, of
course.
You know, if he wasn't good looking, would we pay this much attention to him?
Isn't that an evergreen statement about everything in life? I mean, honestly, at a certain point, to be a politician now, you kind of have to work social media and be something of a pop star one way or another.
All of that, but isn't California like the poster child for all the things that Republicans have beat them on in the last general?
This is the reason why some people are wondering whether this is viable. They're looking at Gretchen Whitmer, they're looking at other places, but ultimately it comes down to what George was talking about there, this idea of the base being people who are opposed to the president. That's a pretty disparate base with a lot of different agenda items, and who's going to bring them together and then face that withering criticism that you were talking about.
I'm not jealous of the hair. Maybe a bit. George, thank you. George Pollack of Signum Global.
Tell us more, John.
Thank you so much.
You really?
Just having a conversation with myself. I actually wanted to get to this. Torsten Slok of Apollo this morning. What a no from him. We in the economics profession need to look ourselves in the mirror. Goes on to say the consensus has been wrong since January. The forecast for the past 9 months has been the US economy would slow down. The reality is that simply has not happened. The US economy remains remarkably resilient. Bottom line, is becoming increasingly difficult to argue that we are still waiting for the delayed negative effects of something that happened 6 months ago, Liberation Day. For investors, this means that the upside risks to inflation are growing, particularly if the Fed continues to cut interest rates.
This is what Max Kettner was talking about, that this may be a policy mistake if the Fed cuts rates, but that doesn't matter if you're an investor. You get long because ultimately they are underwriting risk. This is essentially what Torsten's been arguing, though, all year. So in one level, yes, it's sort of saying economists have gotten this wrong, but then he's arguing that they've been getting it right, and for the most part, they have.
I feel like I'm having deja vu to June when Torsten put out a note about how Trump has outsmarted everyone when it comes to tariffs. And this is another note that might land in the inboxes of individuals working at the NEC, and you're going to hear Caroline Leavitt talk about it at the podium, I'm sure.
Without a doubt. I imagine that could happen in the next few days. Coming up on the program, we'll catch up with the former White House trade official Kate Kalukowicz with steep new tariffs in effect. Plus, Yahara has your morning movers. Nike shares rising on the back of their latest earnings report. That stock is up by 3.9%. And in London, happening right now, Bloomberg's Women, Money and Power event is underway. The editor-in-chief of The Economist among today's guests. Bloomberg subscribers can watch on Live Go on the Bloomberg terminal. Live from New York City, you're watching Bloomberg TV.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Right, okay.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Stocks are softer. We're down by 0.5% on the S&P. We're down on the Nasdaq too. We've been up and away through Q3 and through September. What a move we saw in the third quarter, particularly through September for the stock market. Through Q3, the S&P up by almost 8%, the Nasdaq up by close to 9%, the Russell up by 12%, and so much of that move for the Russell came in the month of August when we had this massive repricing of interest rates, particularly the front end. That was true in the bond market too. 2-year bond yields down for the third quarter, down for 3 consecutive quarters, but that move really came through August. Through September, that started to stabilize around 360. And that's because this big debate is coming together with the Federal Reserve. In early August, you're sitting there thinking, okay, really weak jobs report, Fed's got to move. Here we are in early October thinking, okay, how many more times has the Fed got to move? Governor Myron wants to go down maybe another 100 basis points. I can point to 1, 2, 3 people on the committee that are struggling to get to 1 or 2 for the next 6 months.
In August, it was obvious. You had non-farm payrolls that spooked everybody. You had revisions that just added to that. And then you had a Fed that said, okay, we're throwing in the towel. We're going to be cutting rates at Jackson Hole. And then all of a sudden, the data starts getting a lot better. And this looks like a lot like what we saw last year around the same time, the head fake over the summer. And Fed officials are reflecting that, and they're reflecting the changes. They are only as good as the rest of us, and they only see what the rest of us see.
And that's where the market's living, in this wonderful place called 2026, where growth is better and profits are healthy, and the AI boom continues. Think about the September we've just had for credit, for equities, for deal making, for the biggest leverage buyout ever. And the Federal Reserve came out and said, don't care about that. I'm worried about this. I'm cutting interest rates. And that's what's making the bulls right now so bullish into year end.
Especially because ultimately you can make an economic case for it. If the Fed is watching the labor market isn't really doing much. I mean, what we saw yesterday from JOLTS data, which really is probably the last economic data that we're going to get from the government, it's kind of the stagnant market. So you could say, okay, maybe it needs it. Do we get a jobless recovery in the market profits, even with maybe the rest of the economy still lagging behind?
Low confidence consumer, high confidence investor, and that dichotomy has persisted over the last several months and may well continue to do so into next year. Equity futures right now in the S&P 500 negative by 0.4%. Let's get you some morning movers. Here's Yahira with more. Hey, Yahira.
Hi, John. We start with a big mover. Lithium America's soaring 33% in the pre-market after Energy Secretary Chris Wright confirmed on our network that the U.S. is taking a 5% stake in this company and a 5% stake in its Nevada mining project, home to the largest lithium deposit in the U.S. It marks the latest example, of course, of the Trump administration making investments in critical areas of the economy. And moving on to Nike, whose comeback bid is gaining traction. Shares are up 4% after sales came in surprisingly better than expected, but there are still hurdles, with the company saying that it expects to take a hit of $1.5 billion this year due to tariffs. That is more than the $1 billion it previously projected. And we end on Delta. It is rising nearly 1% in the pre-market after Jefferies upgraded the airline to a buy, with the analyst Sheila Kuyuglu saying that stronger third quarter revenue guidance gives her confidence that margins will expand. Her new price target is $70, about a 22% upside from here. John?
Yahira, thank you. Appreciate it. Bramo, you talk to the airlines. They're living in a similar world to the markets, it seems. Looking forward to about a few months ahead for economic activity.
It's a world in which Delta and United do very well because they cater to the upper income consumer as well as the business class. It's a world in which Frontier and Spirit are going to continue to struggle. And this is the dichotomy that we see in the economy, and this is the dichotomy that we see in the airlines.
Delta. Delta is so popular right now. I was looking at a Delta flight the other day. I won't tell you the route.
I know what you're
so
looking
American
at.
now.
Yeah.
Okay. I won't tell you
Transatlantic. It's fine. Okay.
the route.
Yes.
Okay. I'll get through this moment.
I hope so.
It was so expensive,
Yeah.
and it was months away.
That's exactly what I complained about to the United CEO. I said, listen, Scott Kirby, Scott, it's so expensive. If you want to go anywhere in December, we're driving. And he's like, well, you know, tough. This is what happens. Don't go to such popular places or take time off another time.
I would tell that to management.
Yeah.
It was a work trip.
Yeah, exactly.
So I'll inform them. Yeah,
Oh,
I will
please do.
inform them. All
I'll
right.
go another time.
Maybe next year, the year after. On our radar this morning, a partisan impasse over spending and healthcare triggering a government shutdown. The shutdown potentially spiking the unemployment rate and delaying key economic data. Elsewhere, Lithium Americas rising as the US agrees to take a 5% stake in the company and a 5% stake in its Nevada mining project. The move aiming to speed up development of a domestic supply chain to counter China's dominance over rare earths. That stock is absolutely surging. Elsewhere, the US Trade Representative Jamieson Greer saying he expects President Donald Trump to sign more trade deals with countries in Southeast Asia during a trip later this year. Several nations still negotiating lower tariff rates.
So here's my question when it comes to what U.S. Trade Representative Jamieson Greer was talking about. Are these the frameworks this administration has gotten with Japan, South Korea, and then they want to actually nail some of the final details, sign them, and have these big ceremonies? Or is he talking about other deals? Basically, maybe a bigger trade deal with China, because the president already said he's going to be seeing Xi Jinping on the sidelines of the APEC summit. So I think there's a lot to take from this one statement. What exactly are we getting from this trip? Is this just a sign on the dotted line from those frameworks? Or are we going to get something substantial when it comes to the two biggest economies in the world?
We've talked about this before. Now, typically, any statesman, any leader, head of state would go into a meeting with 99% of the work already done, and then you go and sign a deal. That doesn't seem to be the way President Donald Trump approaches this kind of thing. It seems to be deal-making in the moment, which raises a lot of questions about this moment. If you think about the objectives they'd like to achieve with other nations' economies in Southeast Asia, you'd imagine it would sound like this. Okay, we'll sort out a nice tariff deal for everybody, but what we'd like is for you to do something about the transshipping, the goods coming from China into the rest of the world. At the same time, you're going to come to an agreement with China on everything else. I'm not sure how you can do one and achieve the other.
Nothing exemplifies that more than Taiwan. And you mentioned this earlier, the idea that Taiwan is coming out and saying we didn't agree to what the U.S. is saying, which is that 50% of the production comes from the U.S. And this goes to the question of how much will Taiwan be a bargaining chip in that grand détente between the U.S. and China, at the same time that Taiwan is instrumental in a key component in everything that we use every day here in the United States. This highlights the complexity of a simple transactional type of relationship that we've been trying to parse out without really a greater framework.
Let's stay on the trade story. The president's steep tariffs on pharmaceuticals, heavy trucks and furniture going into effect today. Joining us now, the former White House trade official, Kate Kalukowicz. Kate, welcome back to the program. Let's think about this series of meetings that take place in Asia over the next month or so. How are you thinking about what can be achieved on that trip?
Well, when I listen to the predictions of Ambassador Greer, the U.S. Trade Representative, I think I have to go on the side of these are deals with other Asian economies, probably not China. And I think if you remember back to Liberation Day, some of the highest tariffs were handed out to economies in Asia. And I think those countries, particularly the ones that have not gotten framework agreements yet, are still very anxious to hammer out some sort of deal.
Kate, does the U.S. need to present some sort of larger framework for its relationship with China as part of these trade deals with, in particular, Southeast Asia?
Well, it's an interesting question. I mean, I think what we've seen, of course, is the agreements the Trump administration has struck so far have included provisions directed at China. So some sort of framework, a global framework, if you will, around shared objectives toward China, higher tariffs, provisions that try to cut down on transshipment, economic security. This is the language they use when encouraging trading partners to adopt similar measures to China. Now, what that means for the bilateral with China remains a bit, unseen.
At this point, though, Kate, do you get some sort of cohesive sense of the relationship that the U.S. wants both with China as well as with Southeast Asia, which makes a lot of goods for the United States and is, frankly, the basis of a lot of the fast fashion and other retail brands in particular?
Well, the reality for most of those economies, of course, is that the United States wants us to buy less from those economies. So fast fashion, furniture, we saw some moves this week on furniture. This is very impactful for that region. The president has been very clear about what he wants, and that is more production in the United States. So I think these agreements around the edges will be on items we can't make here. Critical minerals will be a focus, of course, with Taiwan trying to incentivize more moves on semiconductors. The question about what he wants with China, I think, remains really questionable. We don't know. He wants a deal with China, of course, but another comment that Ambassador Greer made yesterday seemed to signal, a bit of a heightened posture, a threat that tariffs could go back up after November 10th if we don't continue to make progress. So I don't know that we're getting closer to a bilateral deal with China.
So what's going to come out of this meeting between President Trump and Xi Jinping? Because Trump says they're meeting.
Yeah. Well, look, a meeting is not, they're not going to want to have that meeting result in heightened postures that take us away from a deal in the future. President Trump has been very clear. He wants a deal with China. So I think that both sides will find a way to maintain the status quo. Both sides, though, frankly, have been increasing pressure. The Chinese themselves this week added new provisions that will impact goods going to America. The United States added lists that impact the way we sanction and address foreign companies buying from China. So they're adding, this is what we've seen, I think. They add leverage, and then they potentially negotiate that leverage away to keep the status quo.
It's a great point. With all the tariffs coming out, a lot was missed in terms of the U.S. expanding the export blacklist, the entity list when it comes to China. So do you expect more moves things like that before Trump sits down with Xi?
Well, I think this is this repeat that we have found ourselves in this relationship. Until and unless we can articulate a grand vision for the trade relationship between the United States and China, I think we are going to create these false pieces of leverage that can then be negotiated back. So these are important moves that are being made. The United States as well in a few weeks will implement new tariff fees on ships from China. This will be very dramatic. So these are all new things that can be negotiated in advance of a November 10th deal while we retain everything else that's on the table.
Kate, just to give this more context, is that what you think the H-20 chip reversal was about, getting leverage to then just unwind it?
Well, I have to imagine that was part of it because the Chinese made, a seemingly big deal about getting access to that chip. They got access to the chip, and then they turned around and said, we don't want it. And by the way, we're going to take action against NVIDIA. It all seemed sort of a false construct to me. So perhaps that was their intention all along.
Kate, appreciate your view, as always. Kate Kalukowicz there, the former White House trade official, on what we could see over the next month. When's this meeting?
End of October, early November, yeah.
What do you think we can achieve?
Well, this is the problem. I think the Chinese delegation want to go in knowing exactly what's going to come out of it. To your point, 99% of the deal done, and then at the presidential level, you just sign off. Trump is happy, I think, to have basically the start of the negotiation almost in person, but then he did say he would go to China next year. So potentially this is going to be a two-part scenario. He sees with Xi, they come out with something, maybe soybeans, I think right now that is critical to his base in rural America. And then the bigger grand bargain potentially happens next year.
You've said this a number of times. When this kicked off in the middle of 2018, this took 18 months to sort out before we secured these purchase agreements going into the pandemic. Pandemic hit, everyone forgot about them, but it took 18 months.
And that was just purchasing agreements. Now it's everything. Export controls, TikTok, purchasing agreements, rare earths. This is going to be incredibly difficult. Fentanyl, are they doing enough on fentanyl? If not, those tariffs are staying.
This is a super heavy lift for the administration to address, and it's a big, big issue that's been building for a long, long time. Equity futures on the S&P negative here by 0.4% with an update on stories worldwide. With your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Taiwan pushing back on a U.S. request to move chip production stateside to cover half of America's demand. Taiwan's vice premier says the country never made a commitment to have the U.S. produce 50% of the semiconductors it needs. U.S. Commerce Secretary Howard Lutnick said the U.S. has held discussions with Taipei about the proposal as a way to reduce the risks of over-reliance on overseas chip making. The The FTC blocking a partnership between Zillow and Redfin. The deal would have made Zillow the exclusive information provider on rentals offered by Redfin. The FTC said the partnership would cut the number of websites offering apartment listings, leaving consumers with fewer choices and driving up prices for buildings that want to advertise. In sports, the MLB postseason is underway. The Detroit Tigers and Boston Red Sox are off to a strong start in the wildcard round after each winning Game 1 on the road. In the National League, the home teams fared better, with the Chicago Cubs beating the San Diego Padres and the LA Dodgers beating the Cincinnati Reds with 2 home runs from superstar Shohei Ohtani. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate it. Anything to add, Bramo?
Yeah, just want to point out that the Red Sox are moving on and, against somebody else. Just saying. I mean, look, honestly, I'm pro New York because here I am. At the same time,
Here I am. Thanks, Lisa.
Anytime.
Did Bramo just get the eyes?
Yeah.
Did Bramo just get the eyes?
Yeah, it was a rough night. I was feeling so optimistic when I first put the game on, and then got the
went out for you.
Okay. All right. Should we move on? You done? You're playing the violin for her? All right.
Yeah. Big violin.
Up next on the program, passing on higher prices.
Our members are eventually going to pass on the price increases to our consumers, and that's starting. We're seeing that in earnest, and our consumers, 75% of which in a recent survey that we conducted said we're seeing those price increases in footwear in particular.
That conversation up next with Adrian Yee of Barclays.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Live from New York City, welcome to the program. Under surveillance this morning, passing on higher prices.
Now that those reciprocal tariffs have hit and are in place, it's inevitable. Our members are eventually going to pass on the price increases to our consumers, and that's starting. We're seeing that in earnest, and our consumers, 75% of which in a recent survey that we conducted said we're seeing those price increases in footwear in particular. But we'll have to see how much price flexibility or elasticity our members have in response to what consumers are saying they need to make a purchase.
So here's the latest this morning. Nike's turnaround efforts taking shape with better than expected sales. Tariffs weighing on the company's comeback somewhat as it raises some consumer prices. Adrienne Yee of Barclays raising her price target on Nike to 70. Adrienne joins us now for more. Adrienne, welcome to the program. Always good to catch up. Let's just talk about Elliot Hill and what he's doing and the kind of turnaround that he's already delivering. How effective is it? I was thinking about inventories and how aggressive he's been on that front too. Are you starting to see some real results?
Inventories are the beginning of any turnaround, right? It stabilizes the margins. And so what I would say here is there are typically 3 years in kind of a branded recovery. The first year is basically the reset year, which was FY25, where he came in and he cleaned up the marketplace and he cleaned up the inventory and created innovation, right? An innovation pipeline that we're starting to see right now bear fruit. The year 2, which is what we are in right now, is typically the year of inventory cleansing and finding a firm kind of terra firma on margins. And then year 3 is profitable growth, and we're expecting that to come in FY27. So we are clinically going through the classic steps of the turnaround. And I would say the key data point that you should be looking at coming out of this print, not just the beat on the quarter, we know they ended up lowering the out quarter, but it's really that sales to inventory growth inflection. For the first time in many quarters, we're seeing sales grow at 1% and inventory down about 2%, low single digit. So we like that positive spread. Kind of, it's a harbinger of margin stabilization to come over the next couple of quarters.
So that's the year 1, year 2 story. I think we should sit on year 3. Adrienne, what's the secret sauce? Are there reasons to be hopeful?
There are reasons to be hopeful. As we know, they've taken about 30% of these big 3 classics, the Air Force One, the Air Jordan 1, and the Dunk. They still have work to do on the Dunk, meaning that they want to bring that exposure, how much is in the marketplace, down. They really want to move toward a pull model. So you're never going to see those 3 classics take so much of their, sales volume. And what they're doing is they're replenishing the pipeline, starting with performance. So starting in Run, Vomero 18, Pegasus, and Structure. And then as we're going into next year, you're going to start to see a lot more of what they call sportswear, which was previously named lifestyle, right? But they're calling it sportswear. It's the non-performance side of it. That product is going to start to flow in probably more so in calendar 26 and then into the back half of next year. So definitely some hope on the product.
So essentially, the cool stuff that people can resell on some of those sneaker platforms isn't going to come until 2026, 2027. They're now going to focus on actual sportswear and competing with the likes of On Brands or On Holdings or other potential running brands, Hoka, that have really gained steam. Is that right?
Yeah, the On Running and Hoka, together are almost $5 billion of the performance run category. And they weren't there previously, like in the, 5-10 years ago, right? It was Nike dominating that performance run. So they're coming back to kind of the win now strategy, which is really focused in athletics and athletic endeavors. And then from there, when they rebase and kind of get back that brand equity, Nike is about winning and is about sports, then they'll take that and then halo that on to kind of the more sportswear or the lifestyle, what I like to call lifestyle type product. But they're starting to bring that to market. And you're definitely going to see the infill. Remember last year in February, they'd started to pull all that. Actually, now they'd started to pull all that product out of the marketplace, and you'll see some incremental infill. Now, when you take a big chunk out and you put kind of newness in, there's always the demand uncertainty of, is it the right stuff? And we're doing that in a tough macro environment.
When you talk about the macro, Elliot Hill said that challenges remain, particularly when it comes to places like the Greater China region. Can Nike continue to recover with China as a part of their business, or do they need to make a decision whether they're in or whether they're out?
Yeah, China kind of pre-pandemic was sort of in the mid-teen range. It was supposed to have grown over that horizon, right, to about a quarter of the business. Today, it's about 12 or 13% of the business. So it's actually shrunk, and the profitability has shrunk along with it. I would say that a fully expressed turnaround of Nike cannot be done without its growth regions, and China is the growth region, along with APLA, which was also, Asia Pacific, Latin America, which was also under some stress. So those two regions, they talk about being staged. Traffic got worse in China. And so they're kind of what I call chasing the ball downhill. You think you're someplace, you go to it, and it goes a little bit further down. But I do think that as you get kind of the global, particularly North America, stabilized, you'll create some of that global brand heat. And the other two will come along eventually, particularly as they're doing this inventory purging.
When it comes to Nike, 16% of their manufacturing is in China. Can they get that below 10% at some point?
So there's two reasons, really, maybe three reasons why you're going to be in China. Number one is volume. So you'll see the bigger manufacturers having a tougher time sort of getting out of that China region. Number two, you do it for quality, right? So if you higher quality control, and then number three, you would do it if you have a lot of kids business, just because of that you want to make sure that you have that kind of all the regulatory environment. So what I would say for them is they can get there. Probably they can make a lot of headway on their footwear, which is primarily done in Vietnam. And then they can probably get that to a low double-digit number. I'm not sure that you ever, for them being that large, that they ever can get the economies of scale that they do in the China region as they move to smaller markets with, less kind of infrastructure for somebody as big as Nike. Smaller players can definitely do it. Big players, $46 billion footprint type players, harder to do.
Adrian, you're one of the best, always a clinic. Always walk away from these conversations with a clearer picture of things. Thanks for being with us. Adrian Yee there of Barclays on Nike this morning. Year one, year two, year three. We're in year two. You talked about Hoka and On Brands. They were getting killed by them, and they're fighting back.
Yeah, they're saying, look, we're not just a shoe to wear to school and then resell when you don't decide to walk normally for a while. But I do think now that they're focused more on running, the question is how big is this market? How much can they gain territory? And how much does their model depend on imports from Southeast Asia in particular?
I can't believe people do that.
They do.
They're like getting the Nikes and trying not to walk properly because they don't want to crease them.
Yeah.
You had this at home?
I did have this at home. And I was like, listen, it's not worth it. And then, just the walking
just
like an avatar. It's like wearing platforms. Maybe just get shoes that you can wear.
I agree. Anyway.
Personal.
Anyway. Coming up, Abby Yoder of JP Morgan, Greg Dacko of EY, Tiffany Wilder of PIMCO, and Vivek Arya of Bank of America Securities.
Do you know what to tell people about what the tariffs are going to do on the United States economy and the investment environment, or is it not clear yet?
If you look at the impact of the tariffs, they were much more significant and broad than I think the market expected. Looks closer to 19% on balance versus 2 and change last year. So effectively, it's a 20% increase on 10% of household goods that are imported into this country.
And do you think it's going to lead to a recession?
Well, we think that it's going to impact both inflation and the economic growth scenario. So we were coming into yesterday expecting the real economy to grow at 2%. And inflation to be closer to 2.8%. If you just go through the math, it would suggest there's probably 1 to 2 points upward increase on inflation and a similar amount on economic growth. So it could put us in a position where we're teetering.
So the tariffs will likely depress the GDP growth rate and increase inflation. So what's the advantage of tariffs?
From our standpoint, we have a hard time seeing the benefits of tariffs. They do tend to be inflationary in the short term. As you're pointing out, the longer term impact on economies is probably the greater downside.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We published a story recently about the explosion of robotic companies and innovation in China. I think we said there's something like 50 or 60 robotic startups in China. Are we behind, and should we be concerned about that?
I think as far as the state of innovation, no. Most of those robots aren't built for work, for the things that, which is the entry point for these robots today. They can do some interesting things. A lot of times it's backflips or making coffee or something, but not really useful work. These robots can pick up to 50 pounds on our next generation. So they're great for the education of robotics, getting people interested. But as far as humanoids, they've got to check that safety box before they can come into any of the facilities here. And that's a big bar that we haven't seen much of out of the Chinese robots.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Both parties want their little demonstration. My instinct is this probably goes on for about a week.
Refusing to release the BLS data is going to be a problem for the markets.
Probably this report is not coming out on Friday.
If we still have a shutdown, it could impact the Fed meeting, and that might be reason for people to pull back.
Even with the long shutdowns, you still have markets outperforming.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500, negative this morning. Down across the board, we're off by 1/3% on the S&P. On the Nasdaq, we're down by 0.4 after delivering a monster Q3 for the S&P, for the Nasdaq, the Russell. Over the previous 3 months, up around 12%. In the bond market, 2-year, 10-year, 30-year bond yields look like this. Your 2-year down by 1 basis point, your 10-year down by 2, 413.48. Heading into this mess. No jobless claims, no payrolls. In about 14 minutes' time, the headline data point of the week, ADP employment.
I was going to say, heading into this, the moment of the week coming up in now less than 14 minutes, which is the ADP report, the expectation for 51,000 jobs, coming down from 54,000 the previous month. This is what we're going to be really ramping up, and potentially the market will really be responding to, because this and then ISM manufacturing that we get later this morning might be the last read that we get for quite a while in our keyhole of economic data that is getting narrower because of perhaps the government shutdown.
ADP Wednesday doesn't quite have the same ring to it, does it?
Do we get to take off Thursday and Friday now? Because, usually it's jobs and then weekend.
No reason for us to be here.
Why are we going to be here?
Take the long weekend.
Wait for the government to open, get the data. Exactly.
I feel like we're kind of essential. Let's run with that. All right, that's kind of important.
Okay. I'm taking off Friday.
Let's get paid at the end of the month. Coming up on the program, super essential. Abby Yoder of JP Morgan Private Bank as stocks pull back from all-time highs. Greg Decker of EY as we break down the latest ADP employment numbers, and Tiffany Wilding of PIMCO with future data in jeopardy following the government shutdown. We begin this hour with stocks pulling back following the strongest September in 15 years. Abby Yoder of JP Morgan Private Bank writing, we're still constructive on the market despite a strong year-to-date rally. Abby joins us now for more. Abby, good morning.
Good morning.
Is ADP the new NFP?
I mean, I guess so, right? This is quite unique, but I also think the market doesn't seem to really be paying attention to what's happening from, the government shutdown perspective. It's really focusing on the fact that the strength in both the economy and earnings this year have been underestimated, perennially, basically. Starting in April, it's just been a complete underestimation in terms of the strength, the ability for companies to be able to navigate through what is very turbulent, geopolitical scenarios. So I think, we'll get this last data point. Who knows how long this government shutdown will last? Historically, it doesn't have a huge effect on financial markets. GDP can maybe be affected, and then you see a bounce back. But right now, we just need to see how long this is actually going to be going on.
Torsten Slok of Apollo said something similar to you. We've underestimated the economy. He said the economics profession needs to look ourselves in the mirror. Concluded with this line, and I wonder if you agree with this too. This means that upside risks to inflation are growing, particularly if the Fed continues to cut rates. Do you share that view too?
Look, we don't share that view. We don't see signs of, the services side of inflation, picking up, which is what would, be concerning to us, particularly on the wage front. I think it's very hard right now for economists to think about, what is there are all these different things that are happening at the same time, particularly on the immigration side, that I think make it just very difficult to kind of parse through the data and think about where we are from a break-even standpoint. But again, just thinking about it, we had, 2Q GDP come in, over 3%. We're having 3Q GDP looking in that direction as well. This economy can withstand some slowdown, right? It's on a very, very solid footing.
So why is it that the Fed could cut rates even though there's an incredibly solid footing in the economy and not see the inflation that Torsten Slok is talking about?
Because what's going on in the labor market, right? Because it's kind of this no hire, no fire labor market. So I think this is a unique position where the economy is growing, pretty healthily, and the labor market is kind of this odd one out where it's just got a lot of things happening that make it very difficult to understand where this, is it strong or is it, weaker at the margin? And what's causing that? Is it, the visa picture, right? Is it immigration or is it AI? It's very hard to disentangle what's going on from a fundamental perspective. But right now, the economy's strong, profits are strong, but the labor market is kind of the one thing that stands out as being relatively weak, and that has implications for wages.
The longer that continues, how much does it make it difficult for you to argue in the broadening out? The idea, not necessarily in the other 493 and the S&P 500, but the Russell 2000 and some of the smaller companies that might be more susceptible to that dynamic in the labor market, considering that they're more leveraged to consumer spending and consumer appetites?
Yeah, well, I think what that will depend on, right? Because basically what you're getting at is what happens with margins, right? And small companies obviously have a lot less bandwidth in terms of the margin story. I think that'll be really, what will be important in that discussion is what happens with technology and what happens with AI. Is that being implemented and therefore offsetting what is a weaker labor market and adding to the productivity picture, right? I think that's going to be very interesting. And your point on small companies is interesting because when you look at a lot of the data and the surveys that have been done in terms of adoption from an enterprise standpoint, it's mostly on the large side, right? It's really not on the small side. So because of that dynamic where you're seeing, because they rely so much on the labor side and have those thinner margins, they should be probably more at the forefront of adopting, this technology, but they're not. So we're not of the camp right now that you see this broad widening out necessarily, particularly because you just need to see more reprieve on the interest rate side.
There's a large gap between your bear and bull case for mid-2026. What would it take to hit that bear case?
It would be a traditional recession. So the way we're thinking about that is that average 25% drawdown from our, let's call our base case, right? So that would be where we're getting to that. And that would just be a market deterioration in the labor market beyond what we're expecting at the moment.
So beyond the basically stasis we're seeing. Mm-hmm. When you look at all the AI growth in the market, can you decipher any of this and how it's hitting the labor market, even though it's sky high on the equity markets?
Well, I think the argument is out there that it's affecting, the entry-level workers, right? And that's why you're seeing their unemployment rate move higher. I think, again, going back to this very muddied picture from the labor market perspective, I don't think that, necessarily you're not seeing younger workers hired because of AI. It could have been the immigration surge, right? There was, the administration coming out with this H-1B visa policy, I think is trying to tackle that exactly, right? Why do we have this youth unemployment rate moving higher and these large cap companies hiring so many people from outside the U.S.? Why don't we focus more on the pool of talent that we have here? So I think that's something that's top of mind in terms of.
We're 2 weeks away from earnings season now. Banks are going to kick things off. What are you looking for? Starts with the banks, then we'll move on to other themes and other industries. But what are you looking for and how high is the bar for corporate America?
I mean, the bar isn't that high. Like, we've had 3 consecutive quarters of double-digit earnings growth starting in, Q4, and expectations for Q3 are, 7 to 8%, so relatively low. And there's been a dichotomy, right? Like, you've seen revisions for the full year move higher, but it's really being primarily driven by AI and the Mag 7, and the rest of the market is still seeing some weakness in terms of their revisions. So I think the bar isn't that high. It feels like a somewhat similar setup to 2Q in that we think, we're probably going to exit the quarter with another double-digit earnings growth picture. Just because, again, when we're thinking about the economic backdrop, this was like another quarter, just like 2Q, where everyone's saying we're going to see the effects of tariffs. It's going to come through, and it just hasn't happened, right? To Torsten's
I'm hearing
point.
it again.
Yeah.
I'm hearing it again from other banks. Citi, Nathan Sheet saying it's going to bite. Other economists are waiting for it to bite too. Are you saying it's not going to bite?
Not in 3Q. We're not seeing signs of it, really. And so I think again, going back to what we were talking about at the very onset, like the fact that companies have been able to mitigate and really work through this situation in this ever-changing scenario has been extremely impressive in terms of what we heard from 2Q. And I just don't see 3Q being any different.
Abby, it's good to see you.
You too.
Thanks for dropping by. Abby Yoder there of JP Morgan Private Bank. Got to go a little bit earlier to prepare for the big one. The jobs report dropping in about 6 minutes' time. The ADP report just around the corner.
I can't wait. I'm so excited. I think it's going to be a big deal.
You're not alone. It might be the only deal of the week.
I think that's the reason why it's the big deal. And I just wonder where the market is more potentially caught off sides. Is it an upside surprise or is it a downside surprise?
Let's give you an update on stories elsewhere before we get to that. With your Bloomberg brief, let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The White House has pulled the nomination of E.J. Antoni to lead the Bureau of Labor Statistics. His nomination shows signs of faltering due to criticism from senators and economists. A White House official said the administration looks forward to nominating a new candidate soon. The brief relief for homebuyers is officially over. U.S. mortgage rates climbed for the first time in 5 weeks, putting a halt to the recent recovery in housing demand. According to data released by the Mortgage Bankers Association, the contract rate on a 30-year fixed mortgage jumped 12 basis points to 6.46% last week. Peloton has overhauled its hardware lineup and raised prices in an attempt to lift the company out of its multi-year slump. The new products include updated versions of its bike, treadmill, and rowing machine. The fitness technology company is also rolling out Peloton IQ, a new artificial intelligence system to power the personalization. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the programme, ADP employment data set to cross. Mike McKee's going to break that down. Greg Dacko of EY will join us to go through the numbers and react. From New York City this morning, good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Astonishing day for US technology.
It's shaky
region's technology ecosystem.
Asia's biggest tech news and innovation.
With the shutdown, with some of the government data delay, I don't think that the Fed is going to just, totally go on pause because of that. The data is the data, whether it comes out or not. I think, though, that really is the key risk, is what does the Fed react if we don't have the data. But overall, I would say the market is in a very strong place.
That was Michelle Weaver of Morgan Stanley. That's not just the key risk, that's the key question going into Friday. Will we or won't we get that payrolls report? At the moment, it looks unlikely, so this is all we've got. An ADP report about 90 seconds away. The estimate is 51K. The previous number is 54. What kind of limitations are there around that number? What kind of read do you get on the US economy? And what on earth does it mean for the Federal Reserve when they meet at the end of this month? Going into that number, the scores look like this. Equity futures on the S&P 500 negative by 0.4%. On the NASDAQ down by 0.5%. In the bond market, your scores shaping up as follows. 2s, 10s, and 30s. Your 2-year around 360. Bramo, this is it. We've got nothing else.
In fairness, you could say that ADP has been more consistent than the non-farm payrolls report, where we've gotten massive revisions. So arguably, this is actually really high-quality data that can give us a sense of just whether it's still on the stasis or whether it's falling off a cliff. Why are you both laughing?
Because it feels like someone from ADP just shot you an email.
Exactly. It's like an
In a
ADP
commercial
pill.
break.
It's not just ADP. Actually, they didn't send me a message. Full disclosure.
ADP pill was given to Lisa this morning.
Well, I think
not the Lisa
the
of last year.
ADP pill has been given to all of us because we don't have anything else.
We've got ISM as well.
That's true.
I think that's going to be important too.
I agree.
If you're pricing in that reacceleration in equities and in credit too, you need to see some evidence of that now going into the fourth quarter.
ADP collects the receipts. They process all of the payments. So they are seeing something on the ground, and it's the keyhole we're looking through this morning.
It's nice to have you on board. All right. So the data looks like this. The estimate is 51K, the high is 80, the low is 25, with the actual number is Mike McKee.
Well, we are waiting for the number to drop here. It is going to come any second, we hope. We're counting on ADP because we're not probably going to get the non-farm payrolls number, and it hasn't hit yet. So that's not good news for ADP or for anybody in the markets. But we will say that you go to war with the army that you have, not the army that you want. So it is ADP that everybody is going to be focused on, along with a little bit later the ISM manufacturing numbers and the ISM in a couple of days, the ISM services numbers, get some sort of read on what people are saying about the overall labor market. Now, right now, we still haven't seen the ADP numbers pop up. So.
Mike, they had one job. This was their big moment. This was it. ADP. It's what everyone wanted to see. There it is, Mike. Give it to me. It's not nice. It's not good.
Contraction, not good. Negative 32,000 is the headline number for ADP, which is obviously the worst in quite some time. Goods producing jobs down by 3,000 within that category. Construction off by 5,000. People have been waiting for that. Manufacturing down by 2,000. 28,000 service industry jobs, ADP says, were lost. 19,000 in leisure and hospitality, and professional and business services down 13,000. The only real positive category is education and health services, which is always the big hiring place, 33,000 on the month. As far as pay insights, median change in annual pay for job stayers was up 4.5%. If you change jobs, you got a 6.5% raise, they said. So this is where we are. And last month, by the way, revised down to a 3,000 negative job print instead of 54,000. If we had these numbers and then we're getting non-farm payrolls on Friday, you'd see a lot of people maybe starting to change their forecasts for Friday and lower them, because this is not a good number. And we have seen ADP, as Lisa was saying, get a little bit closer to the overall numbers on a month-by-month release basis than the BLS until those revisions come in.
Mike, you're a pro, as always. Appreciate the breakdown and the tap dance. Mike McKee there with a job number. That's a big downside surprise. That's a disappointing number, and you're seeing the bond market respond to it. We're down by 5 or 6 basis points at the front end of the curve. 2's back to 355. 10's down by 4.1%. That's a big disappointment. And if you were concerned about the step down in payrolls growth, I think that's more fuel for concern off the back of that report.
Yeah, at this point, we're looking at a 95% chance that the Fed is going to cut rates at the October 29th meeting in Washington, D.C. on the backs of this report. You also just saw the lowest reading on this ADP print going back to March of 2023. So definitely signaling some weakness. And essentially this gives ammunition to those who are saying the risk management tool here is catering to the labor market, not necessarily trying to tackle inflation.
Greg Dacko of EY is with us around the table. Greg, good morning. Good morning. This is all we've got. How useful is this number, and what are the limitations around it?
Well, I think it's useful in the sense that we don't have anything else. I would push back a little bit on the notion that the ADP is necessarily the best gauge of BLS reports when it comes to employment, because it's just focused on the private sector. It also does not include all the details that we get out of the employment report. So it is a good reading in terms of having a perspective on the labor market, but it excludes some important parts of the labor market, including the public sector, where we're anticipating some further losses, both at the federal level, but also at the state and local level as we start the new year with less funding for many state and local governments. So I think the weakness is apparent in terms of labor demand in the labor market more broadly, whether you look at continuing claims for unemployment, whether you look at yesterday's data on job flows, the JOLTS report showing the hiring rate and the quits rate at a 10-year low, not just a few months low, but a 10-year low, showing there's very little flow in the labor market. There is underlying softness in the labor demand components. And the labor supply, of course, has been tremendously affected by the reduction in immigration. So it's a combo, but I think labor demand is weaker than labor supply at this juncture.
Are you saying that we've been sort of in this stasis, low hire, low fire range for a while, and now we're actually seeing the labor market break to the downside?
I think there are certainly risks to that. The low hire, low fire environment is not sustainable. It's an uncomfortable balance. You rarely stay in that balance for a prolonged period of time because either one of two things happens. Either you see employers starting to hire more, that's the good story, that's a positive story, or you see more layoffs because essentially there's a desire to manage costs. And let's not forget, we are still in the midst of an environment where there are a number of supply shocks affecting the economy. Too many people are still reading the economy as if it were guided by demand shocks. This is not the case. Supply shocks are increasingly important, whether it's tariffs and trade disruptions, immigration disruptions, energy disruptions, capital disruptions. All of those factors are affecting economic trends in a way that we haven't seen before. Think of technological shifts as well. AI, a big shock to the economy. We're not reading the economy in the proper way, and that's why many people are confused about the economic signals. The mixed signals are the reflection of an economy that is impacted by a significant number of supply shocks.
Yeah, and essentially, this is an economy in dramatic transformation. I just wonder how you square the idea of profits growing across Wall Street, across a lot of corporate America, at the same time that we see this low hire, low fire dynamic potentially breaking to the downside.
Because everybody's thinking about the consumer, about the market, about the business environment. It's not like that. There is a tremendous degree of polarization across businesses, across consumers, across the economy when it comes to how these shocks are affecting different actors in the economy. Take tariffs. Tariffs are not affecting everyone in the same way. Those that are very price sensitive are seeing the prices at grocery stores rising, and they're pulling back on demand. They're seeing retail costs also rising. They're pulling back. Those that are at the higher end of the income spectrum, they're less concerned about an increase for a price ticket to go somewhere, to fly somewhere on vacation, but they're also gradually being more cautious. And the same applies to businesses. Not all businesses, not all sectors are created equal in the face of the supply shock. If you're more heavily leaning towards the tech sector, then you're going to be benefiting from this AI boost. If you're a big corporation that is investing in AI, you're also going to be investing more in CapEx. We're seeing that in the GDP data. So it really depends on where you lie on the spectrum of the economy and how exposed you are to these shocks.
Greg, what if we get a prolonged government shutdown and this is all the Fed has to go off of?
Unfortunately, this is not the best time to have a government shutdown. Of course, there is the immediate effect of essentially 800,000 federal workers not being paid and being put on furlough. That can have a notable impact on the economy. We estimate a drag of about 1/10 of GDP growth for every week of government shutdown. But importantly, for business leaders, policymakers, and economists, this means we're flying blind in a highly foggy environment, and this is very risky.
Can we get a shutdown-induced recession in some pockets of the U.S. economy?
Perhaps in some pockets of the economy, but not necessarily broadly speaking. This is not significant enough to really bring the economy to its knees when it comes to a potential recession. But we are seeing some sectors that are seeing outsized declines in terms of economic activity. You look at the housing sector, for instance, a sector that is also hit by insufficient supply, but increasingly by the drag of demand from a low affordability environment. If you start to see more segments of the economy affected negatively by government shutdown, think about the area around DC, think about contractors that depend on federal funding, then that could put further downward pressure on a housing market that is already struggling. So regionally and sectorally, you could have these pressures that are outsized and that weigh on economic activity. Not a broad-based recession, but a more pronounced slowdown and potentially a contraction in some sectors, some regions of the country.
If you are just joining us, welcome to the program. Just moments ago, the ADP report, of course, taking on additional importance this week because we might not get the payrolls report this Friday, came in at negative 32K. Negative 32K. We were looking for 51,000 in our survey. That was the median estimate. A revision to the previous month as well. That was 54. It's now negative 3. Greg, just got this question from a Bloomberg subscriber. They said the cycle is always stop spending, stop hiring, then start firing. And the question they've got is the natural progression always the same in a slowdown? Is it any different this time?
I think it's very different this time around because we're affected by supply shocks. Supply side dynamics are very different this time around than they've been any time over the past few decades. And I think that's why you're seeing these unusual evolutions when it comes to the different sectors of the economy. We have rarely seen a low fire, or even no hire, no fire type of environment. That is not a comfortable balance. Again, I think we are likely to see further weakness on the labor demand side. That's going to weigh on economic momentum. One key indicator that I watch, I know it's a lagging indicator, but it's income growth. If you look at real disposable income growth, it's only been growing at a 2% pace. Consumer spending still growing close to 3%. At one point, the dip into savings is not going to be sufficient to sustain spending, and the minority of people that are still doing most of the spending cannot do so forever. The higher income individuals are also gradually being impacted by higher prices and importantly by higher interest rates. If there starts to be some volatility in the equity market because of a government shutdown or because of other developments, then that could weigh on these individuals' desires and potentially means to spend.
Greg, it's good to see you. Thank you, sir.
Always a pleasure.
Greg Dacko there of EY. Mike McKee still with us. Mike, I've got about 30 on the clock. I know you wanted to jump back in.
Yeah, we've got an important note from ADP here that you remember when the BLS revised down its job creation numbers for the last year, ADP did the same thing, and they say the September number is 32,000, but a loss of 32,000 jobs, but the overall reduction from the revision was 43,000 jobs. So now it's even more confusing.
Mike, you can bring some clarity and maybe settle down some nerves in about 5 minutes' time. We'll be back in a second. Coming up on the program, Tiffany Wilding of PIMCO with future economic data in jeopardy following that government shutdown. That conversation up next.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The opening bout is about 60 minutes away. Moments ago, 15 minutes ago, we had the ADP report, a downside surprise, negative 32K. The estimate was 51. The revision to the previous month, not great either. The stock market's down about 0.4% on the S&P. That's largely where we were. In the bond market, though, an additional bid, a rally, particularly at the front end of the curve. Yields down by more than 5 basis points. The 2-year at 3.55. So that's the cross-asset picture, stocks and bonds. Let's get you some single names, some morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. We start with the power company AES. Shares are surging 11%. Honor reporting that BlackRock Global Infrastructure Partners is in advanced talks to buy the company. AES is valued at about $38 billion, including debt, but it has lagged its peers, making it right for a buyer that believes AI will continue to drive demand for electricity. Meanwhile, moving on to Peloton, those shares are up 3% after it just made its first major moves under new management, which as they try to lift the company out of a slump that has lasted for years. So they raised prices and also introduced updates to its bikes and other workout machines, while also rolling out Peloton IQ, which is an AI system for personalized coaching. And after that workout, you're gonna need some protein, which leads me to my next stock, Cal-Maine Foods. This is the largest egg producer in the U.S. Shares are plunging down 10%, even after the company reported its strongest first quarter ever, but they fell short of analyst estimates. Still, egg sales were strong, driven by higher prices and higher volumes, and the company says that's all thanks to soaring demand for protein. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Some of the movers going into the opening bout about 59 minutes away. Moments ago, we got that economic data, ADP coming in softer than expected. Mike McKee mentioned this. I think this is an important note, what it could mean for payrolls, what any of this would mean for payrolls on Friday. If you're interested in what the estimate actually is for payrolls on Friday, Lisa is still 52,000. The median estimate, the high is 129, the low is minus 20. You'd imagine all of that would shift lower after a number like the one we just got.
Especially given what Greg was talking about, this is private payrolls. If private payrolls shows this kind of weakness, and Kevin Gordon over at Charles Schwab points out that construction jobs declining by 5,000 is the lowest going back to 2020. If you're seeing that in the private sector, throw on top of it the public sector where there are a bunch of cuts going on, and it probably would be even worse. So it raises a question of, is it really potentially pointing to even more downside over for non-farm payrolls?
Let's get to Mike McKee now for more. Mike, welcome back. You've had a second and a third look at this number. Help us understand what's behind this all.
I wish I could. I said you go to war with the army that you have rather than the one that you want, but what if you can't count the army correctly? That seems to be the case here. ADP has said as part of this report that they use the QCEW, the quarterly census of employment from the BLS that is done to incorporate unemployment insurance claims so that it's more accurate. You remember 900,000 jobs were taken away in the past year from the NFP numbers, but the government doesn't apportion those by month until January. ADP has done it now. And so while they're saying there was a negative 32,000 jobs created, they also say they subtracted 43,000 jobs from the month because of the revision. It also had an impact on August as well, which is now a negative 3,000. The chart I was just showing there was how the non-farm payrolls, private numbers, and the ADP numbers, how much they missed by. And you can see they'd gotten a lot better, but I suspect this month is going to be kind of difficult to figure out if we get an NFP report because of this revision by ADP. You had a chart, showed what we'll miss. Construction spending gets the honor of being the first report that probably doesn't come out. Tomorrow, jobless claims. Reuters reporting that we will not get jobless claims. We're going to keep an eye on that. The Labor Department hasn't put out a release on it yet. Factory orders, then the jobs report, and then, of course, CPI and the third quarter GDP numbers, two big numbers coming up that we won't get. And the longer-term threat of all this is that there are going to be things that can't be measured if this goes on long enough, get past the week that includes the 12th, and you won't get data collected for October jobs. And if you go maybe another week longer, you won't get enough data for the October CPI. So there are some real issues here with the government shutdown and data. We can hope it's short and that they can get all this stuff out very quickly.
We can only hope. Mike, thank you. Thanks for explaining all of that. Mike McKee with the latest. Tiffany Wildiger, PIMCO, joined us now for more. Tiffany, welcome to the programme. Let's say this is all we've got, and there's a lot still to play for in October. It's only just started. I've got no idea how long the shutdown goes on for, but let's say this is all we've got. Is there anything in here that would stop this Federal Reserve from just cutting interest rates again at the end of the month?
No, I mean, so I think clearly this ADP report was weak, and I think digging through the details of it, you know, I think there's an interesting bifurcation in large versus small and medium business sizes. This has been something we've been very focused on because we think that this economy is basically creating winners and losers. The tariffs, the technology improvements that we're seeing, the various tax cuts, all of that we think is benefiting somewhat more larger companies, and it's a really challenging environment for those small and mid-sized businesses, and that's where you saw the some more of the weakness. I think that in terms of the ADP report, the fact that it contracted, if you adjust the payroll survey, the government survey for the overestimation in that survey over recent years, you can get to numbers that look like they were contractionary over the last 3 months as well. So I think these surveys are given a consistent signal that we are seeing some more concerning weakness in the labor market.
And so right now you're seeing priced into the market a 101% chance of a 25 basis point rate cut at the October 29th press conference and meeting. And then in December, again, almost a 100% chance, 88% chance of another cut. I just wonder, Tiffany, is that the solution to what essentially is the K-shaped economy that's getting to be an even bigger K?
Yeah, I mean, so I think that's right. There is, I think interest rate cuts as a result of the fact that the shock that we're going through right now is both a demand and supply side shock. Tariffs and both immigration will have supply side effects as well. And of course, central bank policy is not well suited to deal with supply shocks, but nevertheless, policy is in restrictive territory. And, I think when you're in an economy that is going through this type of transition, given the policy U-turns, arguing that it's closer to neutral is certainly very reasonable. And I think the interesting thing that we're seeing, since the implementation of tariffs is that the adjustment that the economy is making to tariffs is not primarily through price adjustments, but it actually looks like it's happening through the labor market as well, as companies are trying to cut labor and other costs. So that just means, we think that means the Federal Reserve has room to cut interest rates here. They still have rates that are above neutral. Getting back to that is very reasonable in our minds, given the weakness of the labor market we're seeing.
This is really a strange moment where you're seeing companies adapt and adjust to the tariffs by potentially cutting workers. That's what you're saying, not just raising prices, and yet continuing to report really good earnings, continuing to really deliver and highlight the strength of the consumer. Can you square that circle? I mean, how does that make sense? The fact that the consumer is strong, layoffs are happening because that's the way the companies are dealing with this, and so the companies are profiting. At some point, does that flywheel stop going?
Yeah, well, I mean, I think it gets back to your point on the K-shaped economy. So we see it on the business side as well. I think the largest businesses, that primarily make up the S&P index, for example, I think they're the relative beneficiaries of these various policies. So you have pretty large tax cuts that were also passed in the One Big Beautiful Bill that that will benefit companies that are relatively capital intensive. They do a lot of CapEx. They'll get upfront expensing for all of that. And if those companies, can offset those tax cuts, offset the tariffs that they now have to pay, they're in a pretty good position. The smaller and mid-sized companies that maybe have less CapEx will be in a worse off position. So, I think those are the companies right now that are facing the most pressure. The broader indices of smaller companies like the Russell, for example, it's not done as well. Those equities have not done as well this year. I think very reflective of that theme. And I think the real question for the broader economy is how, I would actually argue we're not seeing a huge amount of layoffs yet. What we've seen instead is that the gross hiring rates have declined, very tremendously. So the question in our minds is, how these struggling businesses, how much will they lay off labor over the coming months, and will that cool off the broader economy?
So Tiffany, can you see Fed officials arguing that instead of tariff-induced inflation, we can have labor market weakness that's tariff-induced? And shouldn't those that are concerned about the tariffs actually be on board with now wanting to cut rates?
Yeah, I mean, I certainly think that's the argument that we're making, and I think that as you get more data, that you will see more and more Federal Reserve officials coming around to that argument as well. I think Mary Daly in recent public comments has made that data. Of course, Christopher Waller, Governor Waller, has also come out with some pretty big concerns about the labor market. So I think that, yeah, certainly as we get more information and you have more certainty within the FOMC, we think they cut interest rates a couple of more times this year. As a result of that, now, of course, the government shutdown, the fact that we aren't going to get, potentially aren't going to get data releases, or the data quality could be poorer over the next couple of months before we go into the November meeting, could be problematic. But again, of course, the ADP data that we've gotten, some of the other private sources of data will be more important, and that's what they'll be using.
Besides the fact that we're not going to get economic releases, how concerned are you about the government shutdown?
Well, I mean, traditionally, government shutdowns have just a temporary effect on the economy. The workers that are furloughed or that aren't paid, ultimately, when the government opens, will get back pay. So this is usually just a temporary effect. It's possible that we could have a longer shutdown. We would argue that the effects start to get nonlinear after you get workers, contract workers and government workers that start to miss a couple of paychecks. I think one paycheck probably okay, but as you get more that are missed, then that's when you start to see a bigger impact on consumption. The other thing is that there could be permitting delays. The government does give out permits for investment, and the longer that those kinds of services are shut down, you could see some delays in investment as well. So, ultimately this can get larger as time goes on. I think the largest government shutdown historically has been, maybe a couple of weeks. We hope that's the case again. But, and as of now, we think this is a temporary issue, but certainly we're monitoring the situation.
That sigh resonated with us all. Tiffany, thank you. Tiffany Wilding of PIMCO. Tiffany, thank you so much. I think it resonated with most people in this market. If you're just joining us, welcome to this program. So we've got a government shutdown. We don't know how long it's going to go on for. There's a big question mark now over the release of jobless claims on Thursday, a big question mark over the release of payrolls on Friday. So this is what we've got to work with. ADP and a big downside surprise, negative 32K against a median estimate of 51.
Look, it sounds like it's all confusing, but what it is clear, and I think that Greg Daco put it really well, and I think that Tiffany Wilding put it really well, which is that on the margins, companies aren't hiring, and to the extent that they are laying people off on the margins, that's showing up because the whole pool of workers isn't as big. I'm just struggling with, yes, we're all exhausted, but there's a very real issue here. The Fed has a hammer. It sees something, it has to be a nail. But ultimately, the K-shaped economy is not going to go away with rate cuts. What it's going to do is it's going to increase the asset price inflation that we've already seen, even if it doesn't increase the inflation in the underlying economy. How do people grapple with that? Well, Max Kettner's buying into stocks, and if you can, that's what people are doing.
And he's not alone.
Exactly.
And they're buying gold. Gold in the S&P. gold and the S&P. Yeah, and that's worked well so far this year.
At some point, this breaks down, though, because at some point, what are the limits of that K-shape, whether it is a political response or whether it ends up being something that has to come from legislation?
5 years in the making. At least over the pandemic and post-pandemic, but some might say it's decades in the making. Well, post-GFC and the central bank response to that.
And how much does the AI transition accelerate that, given the fact that companies are finding, oh, hey, guess what? I don't need a secretary to do that for me. I don't need an entry-level person to do that for me. Hey, ChatGPT, what should I wear today?
Some of that's going on. Have you asked that question, have you?
No, never, ever, absolutely not.
Sure,
I don't believe it.
I don't believe you now at all. Bond yield to lower this morning by 6 basis points, the 2-year at 3.54. 10's down 5 at 4.1%. Let's get you an update on stories worldwide with your Bloomberg brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Well, let's recap the data. Private payrolls unexpectedly dropping in September. ADP data showed private sector payrolls down by 32,000 last month. Economists surveyed by Bloomberg were calling for an increase of 51,000 jobs. Goods-producing jobs fell by 3,000. Service-producing jobs were down 28,000. Walmart is planning to remove synthetic dyes from its store-banned food products in the U.S. The world's largest retailer will also eliminate 30 other ingredients, including some artificial sweeteners, fat substitutes, and preservatives. Excuse me, which will apply to all store-brand food and beverages. The changes go into effect by January of 2027. And that's your Bloomberg Brief, John.
Appreciate it, Vonnie. Thank you so much. Vonnie Quinn there with the latest. Up next on the programme, we'll set you up for the day ahead. Plus, Vivek Arya of Bank of America Securities as big tech's AI spending spree continues. That conversation up next.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Push back a little bit on the notion that the ADP is necessarily the best gauge of BLS reports when it comes to employment, because it's just focused on the private sector. The weakness is apparent in terms of labor demand in the labor market more broadly. The low hire, low fire environment is not sustainable.
That was Greg Deco of EY following this number, negative 32,000 on ADP. The estimate in our survey, 51K. Some negative revisions in there too. Stocks were softer going into it. Stocks look like this now. We're down by 0.4% on the S&P, but there was a turn in the bond market. Yields just took another leg lower. If you look at the front end of the curve, two's down by 6 now. The 2-year at 354.70. Typically, you might not see a move like this off the back of data like that from ADP. But this takes on additional importance because we don't know if we'll get the payrolls report this coming Friday. This is what it looks like for the week ahead. The trading diary is shaping up as follows. So we will get the PMIs. We will get ISM. Look out for that a little bit later this morning. We might not get jobless claims Thursday morning. So big question mark around that. And a big question mark around the big one. Will we? Won't we? Maybe. The payrolls report coming Friday morning at 8:30. Eastern time.
Yeah, so this is what we've got, and right now it looks pretty bad. Andrew from Alliance Bernstein, Andrew Brenner, came out and said that this is the biggest 2-month decline that we've seen in ADP going back to 2020. A lot of 2020 comparisons, given how good the labor market has been until then. And it raises the question, why is bad news in the labor market not bad news for an equity market, or not worse news for an equity market that has been, to use Tom Keene's word, ascendant for the better half of 2025?
Because the Fed is driven by this story in the labor market, and the equity market is driven by this. In the stock market, NVIDIA, a market cap surpassing a record $4.5 trillion after a slew of recent deals. Vivek Arya of Bank of America Securities reiterating its buy rating following NVIDIA's $100 billion investment in OpenAI, predicting the investment could generate $300 to $500 billion in revenue. Vivek joins us now for more. Vivek, welcome to the program. It's always good to get your perspective. You've heard the complaints, financial engineering, circular finance. How are you framing these announcements of the last month?
Sure, John, I think that, we are incredibly positive on the AI infrastructure deployment cycle. I think we are just in the first, few years of what could be a 10 to 15-year cycle of essentially remaking the world's infrastructure from traditional to accelerated computing, and then generating a ton of insights from all the data that is just sitting out there. And semiconductor companies are extremely well positioned to benefit from the early part of that deployment. And I think NVIDIA is the best of the bunch because it has the best turnkey model to benefit from this infrastructure deployment. Now, in terms of the complaints about investing in their customers, I do think the optics are questionable, no doubt about that. But then if you step back and say that if the overall deployment is going to be multiple 100 gigawatts over the next several years, what NVIDIA is investing in is maybe 10 gigawatts, so less than 5% of that overall deployment. And the second point to consider is that it's not like they're just handing over free GPUs to OpenAI. For every GPU that they will, for every investment that they will do in OpenAI, or $10 billion of investment, OpenAI will have to go and raise another $30 to $50 billion to complete that installation. So that's why I think you have to look at the bigger picture, that this is a way for NVIDIA to push what is probably the most disruptive force in AI deployments. And I think it has a force multiplier effect on the overall infrastructure deployment cycle.
I think the thing that concerns people, Vivek, is that a lot of people are looking at the big picture. They're looking out 10 years, they're looking out 20 years, they're getting incredibly excited, and they're saying, let's all price it in now. How much of the entire story for 10 years has been priced in without necessarily seeing the percolation into the rest of the industries throughout the S&P 500, Russell 2000, et cetera?
Sure. No, I think it is true that, the market capitalizations of many of these companies have increased considerably in a short period of time. But we also have to consider that the amount of capital spending has also increased commensurately. If you look at this in terms of traditional valuation metrics, NVIDIA today is trading at maybe about the same multiple as the day ChatGPT was launched in 2022. So it was trading at about 30 times forward earnings that day. and it is still trading at about 30 times forward earnings, despite the tremendous amount of growth potential ahead. If we think of this in terms of price to earnings growth, right, the S&P 500 is trading at 2 times its earnings growth. NVIDIA is trading at less than 1 times its earnings growth. So I think based on traditional valuation measures, we think that the stock is still incredibly cheap, and not just NVIDIA. I think there are a number of other companies in the semiconductor sector that are trading at about 1 times earnings growth, well below where many of the large cap growth companies are trading at, or where the S&P 500 is trading at. It's really about what is going to be the pace of CapEx deployments. And our view is that as long as there is this disruptive force such as OpenAI that is able to impact the social, the cloud computing, the consumer, the enterprise models, it is going to keep the pressure on every other hyperscaler to invest. And we think these semiconductor companies benefit tremendously from that.
Vivek, just real quick here, what would you see that could potentially raise the red flag that there is something that seems a little overly exuberant or frothy or bubblicious about this sector?
Absolutely. I think it starts and ends with capital spending. I think that's what we pay the most attention to. It is not the daily headlines around China. It is not the headlines around this model is better or that model is better. Follow capital spending. And when you look at the commentary from the largest companies on the planet, which are the US hyperscalers, every move that they are making in capital spending is up and to the right. That's what we focus on. And as long as those companies are able to justify the amount of capital spending, as long as they are able to see whether it is the competitive forces that are pushing them to do so, whether it is the ability to generate new sources of revenue growth that are pushing them to do so, it doesn't matter. As long as their capital spending tap is on, I think the companies that we follow are extremely well positioned. Of course, not every capital spending cycle is always a straight line. There are going to be invariably periods of digestion. It's just hard to know when those periods of digestion happen. So follow the line of capital spending, follow the moves of these hyperscalers in terms of, asking for more computing capacity, more data center capacity, access to power. I think those things matter a lot more than, as I mentioned, the daily noise around, large language models or talks of bubble, etc. Follow capital spending. That's the most important thing.
Vivek, appreciate your statement. Your perspective, as always. Thank you, sir. Vivek Arya there of Bank of America Securities. I remember not so long ago being on $1 trillion watch. And here we are at 4.5 trillion. NVIDIA, Microsoft 3.85, Apple 3.8, Amazon 2.3, Meta close to 2, Broadcom above $1 trillion. You've got Alphabet close to 3. The numbers just go on, and they're getting bigger and bigger.
When you compare them to the GDP of entire nations, it starts to look like it's their world. We're just living in it.
It's pretty crazy, isn't it? Coming up tomorrow, Kelsey Barrow of JP Morgan, Sarah Hunt of Empire Saxon Woods, Mike Pyle of BlackRock, Biggie Chada of Deutsche Bank.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Let's talk about this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Will Obey. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
All right, stocks are down after the first government shutdown in 7 years. 30 minutes until the start of trading. I'm Matt Miller. Danny Berger is on assignment, but we will be getting to her throughout the program. Bloomberg Open Interest starts right now. Coming up, the U.S. government shuts down for the first time in nearly 7 years, and the third time under the presidency of Donald Trump. Democrats and Republicans showing no signs yet of compromise. Meanwhile, on the data front, a big miss for ADP. Private sector payrolls unexpectedly fall by 32,000 in the last month. And as the risks to the economy rise, stocks kick off the fourth quarter in the red, while gold climbs to yet another record high. In terms of the single stocks that we're watching, Nike is one of them after the company beat expectations, but it did warn that its turnaround will be bumpy as margins remain under pressure. Still, the shares, you can see, up 4.5% in the pre-market. The U.S. government agreed to acquire a 5% stake in Lithium Americas to help counter China's control of the lithium market. This had been previously reported, but still provides the confirmation, a lift of 32%. Now, it is a very small stock, so keep that in mind. And Meta Platforms moving to the downside. The owner of Facebook is going to start using interactions with its AI chatbot to more effectively tailor the content and advertising on its platform. So Meta will be listening to you, and you won't be able to opt out. Now, the main story, of course, President Trump and Democratic leaders pointing the blame on each other as the government shutdown begins, both sides trying to define their priorities ahead of next year's midterm elections.
How many federal workers do you plan to lay off?
Well, we made you a lot, and that's only because of the Democrats. And as you know, they wanted to be able to take care of people that have come into our country illegally, and no system can handle that.
If you want an indication of how serious Republicans are about keeping the government open, who wants the shutdown? There's no better proof than the fact that Speaker Johnson sent everybody home this week, ensuring a shutdown no matter what the Senate did.
For the latest on the shutdown, we're joined by Washington correspondent Tyler Kendall. So, Tyler, what, in terms of actual services, are we going to see right away? What over the longer run, and how long until this gets solved?
Well, that's a really loaded question, Matt, because at this point, we haven't seen any of the sides really move towards an agreement after government funding lapsed early this morning. Now, in terms of what's going to happen, we're going to start to see government services really slowed down. But keep in mind, any of those functions deemed essential will continue to open, such as healthcare agencies, things like that people really do depend on. But importantly, things like the Small Business Administration, for example, that will shutter. National parks are going going to close. Permits are going to be slowed, and ultimately 750,000 federal workers are expected to be furloughed, though expected to get back pay once the government does reopen. But that means that they're going to be without work and without paychecks until that happens. Now, as you well know, at the heart of this is that Democrats are demanding that some policy changes are made now instead of down the road. They're asking for changes related to health care provisions, including extending or making permanent those expiring Obamacare tax credits set to end at the end of this year. Republicans, though, Matt, are pushing forward with what's known as a clean CR, a continuing resolution that would fund the government through mid-November. No other provisions attached. Republicans ultimately need 7 Democrats to get on board with their plan, really 8 if you think about it, because we're not expecting Republican Senator Rand Paul to ultimately vote on any bill that keeps government funding levels where they're at. Last night we saw 3 Democrats get on board, so Matt, that means 5 more need to come over.
All right, Tyler, thanks very much. Tyler Kendall there out of Washington. Now, payrolls at U.S. companies unexpectedly dropped in September, the fall due in part to issues with data analysis. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now to talk first about the ADP numbers, Mike, but also how this shutdown could affect jobs in general.
Yeah, overall, it's going to be a pain for people on Wall Street and for people at the Fed. The problem we have here with ADP is it's normally not considered a reliable indicator to what we get for payrolls, but since we're not getting payrolls on Friday, it looks like, then you have to go with ADP. But ADP says it had a sort of problem this month, shall we say. As you mentioned at the top of the show, ADP saw 32,000 jobs, private sector jobs, lost in September, and 3,000 in August, revised down from a gain of 54,000. But they re-benchmarked their numbers to the quarterly census of employment that the BLS puts out, which is the number. Remember, we got the last non-farm payrolls report, 900,000 jobs were lower than in the year before. Well, the government doesn't re-benchmark those until January, but ADP re-benchmarked it this month, and they said it subtracted 43,000 jobs. So you might have had a total of 11,000 if not for that. BLS doesn't re-benchmark by month until January, as I said, so the numbers probably wouldn't be very comparable anyway, and that's a problem for people trying to figure out what all this means in the absence of the payroll numbers. We do have some substitutes you can look at, Matt, and I'm sure you will love this. If you go to WSL ALTE on the Bloomberg terminal, you can get a whole long list of other jobs numbers and indexes put out by various private and government sectors. So just a few of them there. ISM Manufacturing and Services, we're going to get that manufacturing number at the top of the hour, and that'll get a lot of additional scrutiny as well. You also mentioned the table of things that we're going to miss. We're going to miss a lot, not a lot this week. Jobless claims may be the worst of it, but besides payrolls. But long term, if we don't get this done by, say, October 18th, the week that includes the payrolls number on the 12th, you might not get an October jobs report at all. And the same thing might be true of CPI if it goes on for too long. So that would really throw some monkey wrenches into the Fed's ability to tell what's going on with the economy and for the market's ability to bet on what the Fed is going to think.
Yeah, Mike, I see everybody pushing out from a trader buddy of mine, Anthony Santos Stefano, to Torsten Slok, pushing out this Bloomberg function, WSL space ALTE, go, to get alternative sources, which is fascinating. We'll talk to you again at 10 o'clock because, as you mentioned, ISM is coming out, construction spending coming out as well. Michael McKee is our international policy and economics correspondent. Let's bring in Terry Haynes now, founder of Pangea Policy. And Terry, just to help me understand exactly what's really happening, to hopefully take some of the political spin away. The Republicans say that they want just to pass a clean CR to keep the government open, and that the Democrats want to add $1.5 trillion of health care funding. Who is holding America hostage here?
Everyone is, Matt. And good morning. Everyone is, because at root, you've got a Congress that hasn't been able to approve full-year spending bills for well over a year now. We've been running on temporary authority for since before the beginning of the Trump presidency. So what you got here is a situation where there's not a lot of leadership going on both sides. What Republicans have the better of the argument right now, though, and I'm not saying this in a partisan way, but it's an easier argument. All the Republicans saying, look, I mean, if you want to negotiate on some stuff, let's just keep the government open and we'll negotiate. But Democrats have a higher bar. Schumer's trying to navigate kind of the money and the energy in the party that are demanding some resistance to the bad orange man, and at the same time, they decided only a couple of weeks ago that they wanted the hill they wanted to die on in this negotiation was health care and really readdressing the cuts that Republicans made in July in the tax bill. So they want to do that, but there's no chance right now that Republicans are going to cave to the Democrats wholesale. But Schumer has also got a win in front of him, which, if he wants it, which is to announce the restart of negotiations and bring the government back in.
I thought it was interesting. I looked back at some of Schumer's comments from 2013 and 2018, 2019 from those shutdowns, and he was saying, like, we can never hold America hostage again. And yet he essentially is holding back most of his party from voting for this CR. On the other hand, President Trump has said that he wants to fire large numbers of workers, almost, it seems like he's saying, as retribution to the Democrats for forcing this shutdown. I thought that was part of the whole plan, shrinking the federal government. Why don't the Republicans take advantage of this and actually do it?
Consistency is the hobgoblin of little minds, Matt. Emerson said that, and he was right as usual. On the federal workers, it's a moving target, and Trump's intentionally making it so. The original was, we're going to fire mass quantities of people. Now they're not talking about firing; they're talking about furloughing, which is even a little fuzzier. But they don't, for a couple of reasons. One, they've got to keep the government open, but secondly, it is a pressure point on Democrats. The public employees are mostly unionized, and they are vastly pro-Democrat. So what you've got now is a situation where, to go back to Tyler's point, you got 52 Republicans, you got 3 Democrats that are already voting with the Republicans to reopen the government. That's 55. You need 5 more Democrats. 4 of them happen to be from Maryland and Virginia, which are 2 states that have large number of public employees. The last thing those 4 senators are going to want to see is kind of mass layoffs or furloughs or firings. So there's going to be increasing pressure on Schumer within his own caucus to bring this to an end sooner rather than later, because now you're at 59 and you need 1 more after that.
All right, Terry, really appreciate your time this morning. You're definitely someone who's going to have to work even more as the government shuts down. Terry Haynes there of Pangea Policy. Joining me here at the desk now is Citi's head of U.S. equity trading strategy, Stuart Kaiser. And Stuart, great to have you here. The assumption is that equities don't typically care too much about a government shutdown either way. Is that correct?
Yeah, I think that's our working assumption. As Terry kind of alluded to, approval ratings of the U.S. Congress are pretty low to begin with, so I don't think this is really going to surprise a lot of people. From our perspective, for this to be really impactful for equity markets, you're going to need to see it last for a while. You're going to see pretty large layoffs, or you're going to need to see something happen in the bond market to kind of spill over into the equity market. None of those are base case, but I think those are the required type of things you'll need to do to really impact equities.
Is Wall Street sort of operating on the assumption that this only lasts about a week? I mean, as Terry said, you've already got 3 or 4 defectors from the Democratic Party, and it seems like probably more to come.
Yeah, I think that would be, probably weeks, not days, but I don't think we'd expect it to last. Like in 2018, you lasted almost 5 weeks. I don't think the market's expecting it to last that long, but the fact is, the Democrats were under pressure back in the springtime for not pushing back harder and potentially shutting down the government then. So it does kind of put them under pressure to, I think, not only shut the government down, but kind of let it last a little bit. So it does look like they're resisting, the kind of Trump policy push.
All right, Stuart, you're going to stick with us. My guest co-host for the hour, Stuart Kaiser from Citi. Coming up, Nike earnings aren't as bad as expected. The company realigns the business around specific sports like running and basketball, and we'll dig in to those results ahead. Happening right now in London is Bloomberg's Women, Money, and Power Conference. The event brings together the most influential female voices in global finance to discuss critical themes facing the future of business. That's why my co-host Danny Berger is there, and you can follow along anytime on your terminal. Just type LIVE GO. This is Bloomberg.
What's the level of a social space that I firmly believe in it. I think it's everybody's responsibility to.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Let's get now to high interest. Look what's making headlines around the world. PIMCO says it's time to grab bonds while the yields are still juicy. With central banks chopping rates and cash returns set to sink, the bond giant argues fixed income can beat cash and deliver 5 to 7% portfolio yields. The firm is overweight duration, cautious on corporate credit, and warns that tariffs could chill growth. But bottom line, bonds look like the safer bet than sitting in cash, at least according to PIMCO. Meta is about to mine its chatbot chats to fine-tune what you see on Facebook and Instagram, sites that it owns. Starting December 16th, users may begin to see recommended posts or ads about topics they discuss with the Meta AI chatbot, if they don't already. There's no opt-out, though the company calls it just one more signal in the mix. The move shows how Zuckerberg's AI push is being folded back into Meta's ad machine, which drives nearly all of its revenue. And Peloton is cranking out pricier products to try and revive its ride. The new bikes, treadmills, and rowing machines will have swivel screens, faster chips, built-in fans, and voice control. The company is also rolling out a new AI system for personalized coaching guidance. Peloton CEO Peter Stern joins Bloomberg Television today at 12:30 New York time to talk about that new offering and how it could help the bottom line and the stock. Speaking of those two things, front and center with Nike, the shares are climbing this morning. Results came in slightly ahead of expectations, though the company warned its recovery will be anything but smooth. Let's discuss the company's turnaround plans with Kim Basin. He is a senior reporter for Bloomberg News. City's Stuart Kaiser, my guest co-host for the hour, sitting with us here on set. Kim, talk to me first about the comeback. This is something that we talk about seemingly every quarter now for Nike. Is it really finally here?
Yeah, Nike had one of its worst years ever last year, and these are the first signs that the new CEO's comeback is starting to work, right? So he set the stage last quarter. He said that would be the bottom for Nike. Like, this is finally the inflection point. This is the time where Nike will begin its comeback. And right now, it looks like there's some hope here.
And from like a fundamental perspective, what are we seeing from Nike today that would give us confidence that that's actually happening?
Yeah, so sales weren't as bad as expected. They expected them to be down mid-single digits, but now it was down about 1%. But there's one crucial category for Nike that it lost a lot of hold of over the past 5 years or so with rivals like On and Hoka. It's the running category. And Elliott Hill, the CEO, said running is up 20% this quarter, and they've refreshed all three of their biggest running lines. And that's just such a crucial category for Nike and what it was built on once upon a time.
I'd note the stock's down over the last 5 years like 41%. But the PE, the forward PE is more than NVIDIA. They're trading at like 43 times forward earnings. Is this a stock that the street likes? Because, I mean, for running, you got to figure this is the OG, right?
Yeah, it feels like a stock that the street wants to like, right?
Yeah.
And it's Nike's one of these old school American brands that everyone's kind of rooting for. And you can see it in their marketing right now, too. They've been spending more marketing this year, spending more on marketing this year. You saw them have a Super Bowl ad. Well, one of the big things with this new CEO is refocusing on sport. He felt that Nike had gone too far away from their sports ethos into lifestyle sneakers and all this fashion stuff. So running is part of that. So is basketball. So is global football, training. All these things are what Nike wants to focus on.
Can I just ask about, we think about Super Bowl ads, and I, look down Fifth Avenue to see what shoes people are wearing. But it's not just about the United States, right? China has to be a huge market for a brand like Nike. How are they doing there?
It is a huge market for a brand like Nike, and China is lagging far behind North America right now. Nike has hit several speed bumps there over the last 5 years, and the recovery there will take longer, and their executives have admitted it will take longer in China to fix things. They have thousands of like mono-brand stores, which means like Nike stores with the swoosh on it, and stores that it works with, franchises. It's just going to be a tougher effort for them out in China than it will be in Europe and the U.S. and other markets.
Stuart, the consumer always front and center here. Obviously, that's that kind of spending is 70% of our economy. How does the consumer look to you in terms of ability to spend, what is it, $100 or $150 on a pair of trainers?
I think if you took out the labor market, the consumer looks pretty good, right? Retail sales actually came in stronger than expected. If you're thinking about Nike, you got a couple Olympic years ahead of us, which I'm sure they're going to lean into hard. The ADP report, obviously today, a little troubling, and the negative momentum in jobs market kind of concerns you a bit. So our view is U.S. consumer has kind of been the white knight of the U.S. economy now for a long period of time, and that's why the employment market is so important to us, because spending has been robust, but you are seeing some kind of cracks under the surface on the labor market, which kind of makes you worry about the forward a little bit.
By the way, Kim, how about the effect of tariffs on Nike? I mean, has the CEO, Elliott Hill, tried to get closer to Donald Trump, tell him how good he looks, tell him how great he is,
Might as well give it a shot, right?
Yeah.
Nike expected $1 billion in tariff impact and extra costs. They've just said it's 1.5 now as tariff costs increase.
So worse than expected.
So even worse than expected, and that just came in this last earnings report.
So that adds to the kind of volatility, the bumps in the road that we're expecting. Kim Basin, thanks so much for joining us. Stuart Kaiser is going to stay with us as we get these markets open. Just about 8 minutes to go. Coming up in the next hour, we're going to talk to an analyst about Nike. Christina Fernandez covers the brand from the Telsey Group. She's going to talk about her view on the firm's turnaround plan and new product lines like Skims. Oh, we didn't get to Skims. We'll get there eventually. Ford, the motor company, just released third quarter sales. Overall sales rose 8%, and EV sales jumped 30% as the tax credit expires. consumers rushing in to get those deals. We'll talk about the auto sector as well. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
A check on futures ahead of the opening bell. We're looking at red arrows to kick off the month after the government shutdown at midnight. S&P futures down about 0.4%. NASDAQ and Russell futures also right there. Still with me is Citi's head of U.S. equity trading strategy, Stuart Kaiser. And Stuart, okay, we've got red arrows for today, but in general, it feels like we've had more and more IPOs. As I get closer to the bell, that's what I think about. And yesterday, Jefferies said M&A is back. So are you optimistic?
We're optimistic, fingers crossed a bit. I mean, M&A at the beginning of the year was such a popular, kind of investment theme. You could argue that corporate America and a lot of the capital markets kind of got shut down for 3 or 4 months, just given the tariff uncertainty around the tax and spending bill, and even immigration to some extent. So we've kind of put it out there as the sneaky bull case would be that corporate America begins to re-engage in the fourth quarter after kind of hibernating for 3 or 4 months. And that would be reflected in M&A and IPOs, but also potentially hiring and CapEx spending. As you know, a lot of these budgets are set at the end of the year. So, some of that headcount and that CapEx might need to be done as well. So, yeah, we're optimistic. And I think if you want to be bullish equity markets, you almost have to rely on the idea that corporate America is going to kind of come back a little bit here into year end.
All right, Stuart, we're going to keep you with us through the opening bell. Stuart Kaiser from Citi is staying with me. Futures are down after a government shutdown, now in place for 9.5 hours. This is Bloomberg.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are shut down, and as a result, we're looking at red arrows across the board. S&P futures down 0.5%, NASDAQ futures and Russell futures as well. Still ringing the opening bell at the New York Stock Exchange. You've got Neptune. It says NP listed, NYSE. I don't think NP is the ticker, but if you think I'm wrong, shoot me an email, mtmiller@bloomberg.net. Down on the NASDAQ, Hologic is ringing the opening bell. Their stock over the last 5 years is unchanged. I mean, it's only up 1 or 2%, but if they're doing more to fight breast cancer, it's worth it. And this is the start of Breast Cancer Awareness Month. For all of October, you'll see a lot more pink ribbons out there. In terms of your stocks to watch today, Nike is one of the big ones. We just talked about this with Kim Basin. The shares are up more than 5% in the cash trade as the company shows a comeback is underway, although they say it's going to be a bumpy ride and tariffs are going to cost $1.5 billion. That's 50% more than they had previously estimated. Lithium America is right now up 26%. You've already seen a huge run up in this stock as there were reports the U.S. would take a stake. Now that has been confirmed, and the stock, although it's very small, up on that confirmation. And then Meta Platforms right now down 2%. Not sure if it's connected, but Meta says it's going to use your interactions with its chatbots. For example, it's going to listen to your conversations with Llama and then give you targeted ads on Instagram and Facebook. If you want that, it doesn't really matter because you can't opt out. Let me get back to the desk right now. I'm going to bring in Citi Head of U.S. Equity Trading, Stuart Kaiser. And just to talk quickly about the shutdown, Stuart, again, you know, we're only 9.5 hours in, and it does look like the markets are down. I'm not sure if that's a reflection of the shutdown or of the gains that we saw in September. How much does it matter?
I mean, it matters. I think this morning, a little bit of the shutdown, the ADP number was weak. And, you know, again, ADP probably, to Mike McKee's point earlier, not tier one employment data, but it's the only thing we have. So the market has to trade it a little bit. And yeah, look, we had one of the strongest Septembers we've seen in a number of years. You know, markets are pretty high. You're adding in kind of some uncertainty around the government. So I think all of those things kind of conspiring to give you a modest down day. But again, we don't think the shutdown, unless it is really extended, is going to be that meaningful for equity markets.
It's a great time, I think, to reflect on what has been a pretty amazing run for stocks. I mean, the S&P is up 13%, and not after a couple of bad years, after some bangers, right? especially considering the fact that we have these massive tariffs compared to where we were before. And economists all over the street were telling us that was going to gum up the economy. It doesn't look like that's happened so far.
It doesn't seem like it. I mean, definitely there's some risk on the labor side, but the rest of the economy seems to be functioning pretty well. I think, you know, coming in, people were thinking, well, in the previous Trump administration, he did the good stuff the good stuff first and the bad stuff second, like if you did the ordering. This time the theory was, well, he's doing all the tariffs and stuff ahead of time. That's going to create a negative impulse, and then we'll get the positive news after. The fact is the tariffs have not really disrupted the economy yet.
Or the mass deportations.
Or the mass deportations. And then you also have, you know, frankly, you're getting positive momentum on the regulatory and tax side that are going to help you. So, yeah, I agree. Surprisingly, obviously positive year so far for the S&P 500, very driven by the AI theme. I mean, we took our AI CapEx spending numbers up 25% yesterday. The previous estimate was only made a month ago. So that gives you a sense of, A, how powerful that theme has been, and also how rapidly it's accelerating. So it's really hard to ignore that as a chief driver.
I mean, that's, I saw some data a couple of days ago about foreign investors increasing their U.S. equity holdings, and I thought, wow, they're not shunning us. In fact, they're putting more money into U.S. stocks, and I guess that is all because of the AI play, right?
Yeah, you cannot own the AI theme without being in U.S. equities. And look, at the beginning of the year, there was a lot of money, seemed like it was destined for Europe. And frankly, I think the biggest problem with that trade was that the U.S. equity market sold off 20 or 25%. And I think some of that money that was on its way to Europe kind of U-turned over the Atlantic and came back into the U.S. because, wait, I can buy the U.S. market now at a 20% discount and have full exposure to that AI theme. So yeah, it's without a doubt what's the key driver of the market. AI power generation as well, one of our favorite themes, and we're still very positive on that.
The power gen is crazy. We had an amazing story the other day on how much it's driven up electricity prices, but that just shows the huge demand.
I agree, and if you look at the gubernatorial race in New Jersey, this has become a key topic. Kathy Hochul in the U.S. New York working with Trump to get natural gas. You look at out in California, they're now negotiating with these oil prices. I mean, when those big blue states start really focusing on energy costs, A, it's going to be a huge political issue, but B, you also know it's a serious challenge kind of facing.
If I look at commodities, I mean, GLCO is the way to pull up the big page on the Bloomberg terminal. Gold at another record high right now, 38.74, and obviously with the dollar weakening, that makes a little bit more sense. But do you, as an equities strategist, do you advise your clients also to hold a little bit of this, or even the producers of gold?
Well, it's funny you mentioned the producers of gold. I think that GDX is up almost 100% year to date. So you've gotten gold prices to a level where the operating leverage in the gold miners is now playing into it. To your point on the dollar, I think earlier in the year, people wanted to be short the dollar because of tariffs. There weren't any other currencies that necessarily wanted to be long, so they ended up in gold. The only thing that worries me a little bit about gold right now is no matter what scenario I put out there to someone who's bullish gold, they tell me gold is going up in that scenario. So it does seem like sentiment is really there. But
kind of like crypto people, right?
Exactly. There's no bad news.
You're right about the GDX. It's actually up 128% year to date. So it's done incredibly well. Outside of this ETF, or outside of the AI and even the energy play, is there anything else that you like? I mean, do you have faith in the S&P 493 to be able to boost earnings as much as the Mag 7?
I mean, we really hope so, because if you look at how the market has been performing lately, it's S&P 500 up quite a bit, Russell 2000 catching up, but the S&P 493 or S&P equal weight has actually lagged both of them. So it's very interesting. The belly of the market has kind of been really underperforming. And yeah, to your point, what you need there is a broadening out of EPS growth. We've seen little hints of that, here and there, but look, at this quarter and next quarter, we're really going to need to see that happening for that to work. Otherwise, look, at Mag 7 equally weighted, it was up almost 800 basis points, 8% last month. So we would love that trade to work, because I think that means earnings is broadening and the economy is very solid. It just hasn't happened, and I think it's a show me story right now.
Stuart, great having you with us. Really appreciate the time you spent with us today. Stuart Kaiser is the head U.S. equity strategist over at Citi. Let's get a check right now on how the market is doing. Just a few minutes into the open, we're looking at losses, but only about 0.25% on the S&P. This is the move screen, which I think is the most dynamic way to look at the S&P 500. We got it arranged by points, so you're going to see on either end of the barbell really the biggest companies in the market. Apple is the biggest gainer right now, adding 7 points. And you've got then Eli Lilly, Visa, and Thermo Fisher Scientific. You're going to see some of these, Merck, for example, and Lilly, AbbVie, some of these companies coming up with Pfizer after the announcement that they made yesterday in the talk with President Trump. NVIDIA is the biggest loser in terms of point reductions, taking 4 points off of the index. You see Facebook there as well, Meta Platforms with Microsoft, JP Morgan, Broadcom, and Google holding the market down as well. In terms of the sectors that are moving right now, and it's still obviously very early in the session, but you see healthcare the biggest gainer. And that's what I'm talking about with Pfizer, with Lilly, with Merck, all of these drug makers doing better, rallying on the news that we got yesterday in the press conference with the president. Utilities are also doing well, real estate and consumer discretionary. These are really defensive. Actually, all 4 of them really are defensive sectors. So when these lead, that's not really bullish. And you do see the market obviously weighed down by communication services. These are the big hyperscalers, financials, the big banks, industrials, and consumer staples. Now, coming up, the Fed lowering the stress capital requirements on Morgan Stanley. We're going to take a look at their decision, plus more on the government shutdown next. This is Bloomberg Open Interest.
We have 2 crises, 2 essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachian Zahran, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Quick check on stocks. Just about 12 minutes into the session, we are looking at losses that aren't quite as severe as futures had indicated. Right now, the S&P 500 trading at 66.77 is down less than 0.2%. And September was a fantastic month. We were up more than 3% on the S&P 500 in a month that, at least over the last 30 years, has been one of the worst of the year. Let's get to our top calls right now. Some of the analysts' action and focus this morning. First up, AT&T is getting downgraded over at Barclays. The analyst says tailwinds are beginning to moderate and sees limited upside for the share price. Telephone is up nearly 25% so far this year. It's done well, and maybe it's time to take profits. Next up, Carvana is getting upgraded to a buy at Jefferies. The analyst sees the online car retailer delivering elevated growth. He says it's best positioned to benefit from a nascent shift to digital in the $800 billion used car market, and I can't imagine buying a car any other way at this point. Finally, chipmaker Marvell Technology is getting cut at TD Cowen. The analyst cites limited visibility and cautions that its custom chip business could stagnate or decline next year as the competition heats up. Marvell Technologies down in the cash trade more than 2%. Let's turn back, though, to this morning's top story, and that is, of course, the shutdown. Bloomberg Intelligence senior policy analyst Nathan Dean writing in a note ahead of this event that, quote, the most likely scenario is a short-term stoppage with reopening feasible as soon as the October 4th weekend. We look for policy implications of the shutdown, and for that we go to Nathan Dean. He joins us now, America's dad, without the vest. Nathan, what are the implications in terms of, for example, an effect on the economy? I think the 2018-2019 shutdown erased $11 billion, but we got 8 of that back. So at the end, we only lost about $3 billion of GDP.
Yeah, so I think there's really 3 impacts that we've been telling our clients. And the first is, when it comes to the markets in particular, the 2018-2019 shutdown showed a dramatic drop in the S&P 500. And based off of today's data, we haven't really been seeing that. So a lot of it could be headline risk. And I think folks are more accustomed to a partisan Washington than they were before. The second is data. Obviously the Bureau of Labor Statistics is not working, and there's a lot of data out there that our clients are using, whether it's jobs data, commodity data, et cetera, and the data is not going to be there. And then finally, the economic question, like you mentioned, 750,000 government workers are furloughed right now, and they're not going to get paid. The next major paycheck comes in next Friday. So if you're trying to game this out, obviously the next 2 to 3 weeks are going to be important. If this shutdown goes further, that's when you're going to start to see the economic impact of that, primarily here in the Washington, D.C. region to start, but then I think it just trickles throughout the rest of the United States.
I just want to point out a function on the Bloomberg a lot of people have mentioned today, Nathan. WSL space ALTE shows alternative data sources that you can use while the government is, while the federal workers are on furlough here. How many firings do you expect, and how many are going to come back? Because the Trump administration, one of its main goals has been to shrink the size of the federal employee base. This is an opportunity for them to do it. President Trump says it's likely, and he can blame the Democrats for it. Is he really going to go through with it?
So right now, I think we're at the point where it's still political posturing, and I don't think there's actually a plan yet. I mean, I take that back. The Office of Management and Budget and Director Russ Vought certainly has a plan, but it's not up to him. It's up to President Trump. And I think what happens here is you're going to see negotiations take place later this weekend, and then that's when the decision will be made. Should we move forward with this or not? Because, look, if the president decides that he wants to just lay off a lot of these workers, look, there are court cases that are mostly going to come, but they can move forward with this progress. But I would point out is that the Virginia, Maryland senators in particular could stave a lot of this off so that if the threats do come forth, then you could have those 2 Virginians and 2 Marylanders come forth and say, look, I'm going to support to reopen the government, because if they do that, then you stave off and you can get ahead of the OMB.
Can you clear up something that I've heard the president say and a number of Republicans, that the Democrats want to give illegal aliens free health care? Is that really the case? I know the Republicans wanted to pass a clean CR, and the Democrats want to add about $1.5 trillion in health care and other funding. But is part of that somehow going to allow undocumented immigrants access to free health care?
You know, this is one of those talking points where both sides are right and both sides are wrong, and they're really just pointing at the portions that they think play politically advantageous to them. And that's where the problem is with the shutdown at the moment, is because both sides go into a shutdown thinking that they are the ones that have the best political positions. The Republicans offered this clean CR through November 20th. You know, they think that they have the moral high ground. The Democrats, on the other hand, say, look, we want to be seen fighting President Trump, and we also want to fight for these Obamacare subsidies that expire at the end of the year. And I don't think they're going to get that while the government is shut down, but this is where I think this solution potentially could be found, is that if the Democrats later this week or beginning more likely next week come to figure it out that they can actually achieve their goal of fighting President Trump with maybe a gentleman's agreement or an unofficial handshake that they will deal with the Obamacare subsidies later, because I think that's something that President Trump wants. The rest of his party may not, but I think President Trump certainly wants to take care of these Obamacare subsidies before the November 2026 midterms. That's where the solution will be found, and ultimately I think the government stoppage can end.
Nathan, we have obviously a large portion of our viewers are working at banks, probably many of them at Morgan Stanley, and now they have diminished regulation to deal with. This is one of the promises of the Trump presidency, right? We have the Federal Reserve, not that they're working in lockstep with the administration, lowering the capital requirement, the buffer requirement to 4.3% from an initial 5.1%. Are we going to see continued moves like this?
I think so, because this is an easy win for the Federal Reserve. This doesn't have to go through a rulemaking. What happened here is that Morgan Stanley petitioned the Federal Reserve as part of their stress testing process to lower their what's known as stress capital buffer from 5.3% to just north of 4%. And the Fed looked at it and said, you know what, you're right. Now, it doesn't have to go through a rulemaking, and so it's an immediate change. This takes effective today, and so now Morgan Stanley is a little bit better situation because, in their view, they've been overpaying for this. Now, the deregulation argument when it comes to banks in particular is still a story about time. This was a quick win for the Fed, and this only applies to Morgan Stanley. But when you're talking about other things like the Basel III endgame or any type of GSIB surcharge change that is applied to Bank of America or JP Morgan or Citigroup, that still remains in the idea that proposals have to come out, proposals have to be worked on, and it really isn't going to hit your bottom line until 2027. So if you see more stress capital buffer petitions coming from the industry, think short term if the Fed is okay with it, everything else long term.
All right, this is why you're so popular at Bloomberg Intelligence, because people know you have the answers. Nathan, thanks so much for joining us. Nathan Dean there of Bloomberg Intelligence covers the government policy and all the regulations coming out of it for us out of Washington, D.C. Coming up, electric car sales broke records last quarter, even amidst the supposed backlash. That's because the tax credit is expiring or has expired, and you'll no longer be able to get $7,500 back. We'll talk all about how it's affected Ford and General Motors next. This is Bloomberg Open Interest.
Up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Car makers saw a surge in new electric vehicle sales this past quarter. Sales of purely battery electric vehicles rose 21% from the prior year as the EV tax credit was set to expire and now has. Bloomberg's Gabriella Coppola reported on this. She joins us now from Detroit. So, Gabby, I guess it's just this incentive alone that's driven people, consumers, out to dealership lots or online to buy new cars.
I think, that was a driving force in this quarter. There's obviously, I would caution that EVs are still, they're supposed to hit a record penetration level this quarter, 10% of overall new car sales, and that's a record, just 10%. So people are still buying cars for other reasons too. And I think a lot of it is, you look at this year, and there's been all these kind of weird distorting factors in auto sales. This spring, we saw a huge boom because of people, people worrying about tariffs and the cost of cars was going to up. So that and the car makers totally exploited that, and they said, come get your car now. It's pre-tariff. You get a great deal. So we saw a lot of that in April, May, and March. And then now we're getting another sort of policy-driven bump. And people, including myself, going out there and saying, man, if I want to get a discount on this EV, now's the best time to do it.
So the thing is, I had seen eye-poppingly low numbers for EV sales from the Ford Motor Company. How have they done? And how much of this is going to GM has, a lot of product offering. Tesla, obviously, only in this space. And also, what did you buy?
Oh, okay. So I got a Kia EV6. It was a tough call between the Mustang Mach-E and the Kia EV6, but they're both really sexy cars, and the Kia gave me the better deal. So there you go. But I'll probably get crap for that. But anyway, so on top of that, I would say that there's other, GM has definitely benefited from this. The Chevy Equinox. I've seen those all over Detroit all of a sudden. I'm seeing Mach-E's, Chevy Equinox EV, Kias. I'm seeing a lot more Hyundai Ioniq 5. I'm seeing a lot more of these vehicles around. So you can see that people are taking advantage of these deals. Tesla also, I think, they're predicted to have done quite well this quarter. Sales of the Y and the 3. There's a real pull for people to feel like this is a great deal that's going away. I will say that even though we were all led to believe that September 30th was the last day, it does look like some automakers are going to extend this on their own dime for a little bit, or there may be some sort of financing behind it that I don't understand all the details, but I think, you're still, for cars that are in transit or already on a dealer lot that are an EV, if you're leasing it, I think you could still get the deal. That's what GM has told us. Hyundai came out and said they're going to extend this deal in October for the Ioniq 5, and they're also lowering the price for the 2026 model. So the market has to, you can't just take this subsidy out of the market abruptly, and that's going to create friction in the market. So the automakers are trying to do things to kind of ease it out, But I think going forward, we'll see a lot more hybrids. That's what Hyundai is talking about. They're selling their hybrids, yeah.
Yeah, and I know, Jim Farley is pumped on the E-Revs. Ram is about to come out with their E-Rev truck. So, All right, Gabby, we're going to keep on top of this. Bloomberg's Gabriella Coppola reports on cars for us out of Detroit. I want to point out that happening right now is Bloomberg's Women, Money, and Power event in London. My co-host, Danny Berger, is there moderating a panel on global real estate with executives from PIMCO, Blackstone, and AXA. Check it out if you like on the Bloomberg terminal. Type LIVE GO. This is Bloomberg.
Market, just that notion of income, and from that perspective, where
NYK's sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japanese agency. And also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the power-generating fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance. Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well. Scarlett Fu and Paul Sweeney here with the Bloomberg Intelligence Program. Coming up in just moments, House Speaker Mike Johnson and Senate Majority Leader Jim Thune scheduled to give a press briefing about this shutdown. When they do, we will bring that to you. We're also going to check in with Susan Spence, ISM Chair. We got some ISM data coming out just at the top of the hour here. We'll get to that as well. Wendy Schiller is going to join us, Professor Brown University, to talk to us about this government shutdown. How long will it last? Does any party going to pay a political price here? Lots to talk about there. Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. Gold yet higher again here. We're now close to $3,900.
It's unstoppable.
Unstoppable. So we'll see Mike Malone's got to say about the price of gold out there. So a lot coming up over the next couple of hours. Let's kick it all off. John Tucker and a Bloomberg Business Flash.
All right, we do have data. This is private data. It's not from the government. This Institute for Supply Management, the Manufacturing Index. This is a smaller part of the economy. 49.1 is the index, a little higher than expectations. Remember, anything under the 50, that's the dividing line between expansion and contraction. So a little bit higher, but still in contraction. And then you have treasuries surging in price. The yield's lower right now. 2-year yield down just about 7 basis points. The 10-year yield 6 basis points lower. This comes after the private sector payrolls unexpectedly fell by 32,000 last month. This is from, again, private data, ADP data, which also saw the prior period revised to a loss. Remember, economists had expected a gain of something like 51,000 jobs. You have the S&P 500, 22 points lower right now. That's down 0.3%. We're at 6,665. The Dow Jones Industrial Average, 86 points lower. The NASDAQ 100 right now is down 93 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We did get...
I believe it's the bubble moving through the supply chain.
All right.
So it makes sense to me, and I think it's a blip, unfortunately. Our employment is still in contraction, a little slower. So still not good, and 67% of manufacturing GDP is in contraction, 28% strong contraction.
All right.
Not great
Susan,
signs.
thanks. We got to go to some breaking news here, Susan, but thank you very much. Susan Spence, ISM Chair, giving us the latest on the ISM data. Let's head down to Washington, D.C. House Speaker Mike Johnson and Senate Majority Leader John Thune at a press briefing.
But today, that's not going to be the case. Today, America's boys and girls will walk up to these doors and they'll see something different, a sign that says closed until further notice. And that's because at midnight, the Democrats followed through on their threat to shut down the United States government. As we speak here this morning, there are hundreds of thousands of federal workers who are getting their furlough notices. Nearly half of our civilian workforce is being sent home. These are hardworking Americans who work for our federal government. Our troops and our Border Patrol agents will have to go to work, but they'll be working without pay. Food assistance, veterans benefits, and vital support for women and children are all coming to a halt. Now, thankfully, President Trump is trying to mitigate the damage as much as possible. His administration is working to limit the harm to the American people. But the longer this goes on, the more pain will be inflicted because it is inevitable when the government shuts down. The sad thing about it is that every single bit of this was entirely avoidable. Democrats could have worked with us in a bipartisan manner to avert this unnecessary and very harmful shutdown. But instead, they did something that is rather shocking to us. They prioritized taxpayer-funded benefits for illegal aliens over keeping the government open for American citizens. They themselves positioned that as a binary choice, and it's patently absurd. Listen to what the Democrats are demanding. They demanded, in exchange for our simple, clean, 24-page bipartisan continuing resolution, the same one that Chuck Schumer and the Democrats voted for just a few months back in March. In exchange for that, they rejected it, and they demanded something else. They wanted us to add over $1.5 trillion in new federal spending, paid for, of course, by hardworking American taxpayers, simply for funding the government at current Biden-level spending levels. We are not going to do that. We can't do that. We won't do it. Almost 2 weeks ago, the House did our job. In the House, we passed a common-sense, nonpartisan bill to keep the government open. Republicans did our job. We had one Democrat join us there, so it was bipartisan. But every other Democrat in the House voted to shut the government down. And last night, 44 Democrats in the Senate did the same thing. This is a clean resolution. It would simply buy Congress a few more weeks, 7 weeks, to finish the job. Why do we need that time? So that appropriators in both parties can finish their work. They've been restoring regular order. They've passed 12 separate bills out of committee in the House, and the Senate has done its work as well. 3 bills of the 12 passed in each chamber. They don't line up exactly, so there's a conference committee constituted, the first time in years that that's happened. We just need more time because we ran out of clock at the end of the fiscal year, September 30. this is very important to note. Democrats themselves have voted to pass a clean bipartisan CR just like this 13 times in the last few years. During the 4 years of the Biden administration, 13 times this happened. Republicans did the responsible thing, even when we were in the minority, to keep the government open. And today should be no different. There is nothing new in this legislation. There's no poison pill. There's no partisan tricks. There's no gimmicks whatsoever. The only difference today is the man who is sitting in the Oval Office. Rather than work with President Trump and Republicans to get this job done, as our party has done repeatedly in the same situation over the years, Democrats want to play political games with the lives and the livelihoods of Americans. The simple truth is Democrats in Congress have dragged our country into another reckless shutdown to satisfy their far-left base. That is the truth. Whether or not the government remains open or reopens is entirely up to them. There's still time for Democrats to pass this clean bipartisan bill that's sitting before them, and we encourage our Democrat colleagues to do that. I certainly pray they'll come to their senses soon and do the right and responsible thing. The reason they will have one more opportunity today is because of the sound leadership that is being provided in the U.S. Senate by our colleagues who are standing here with us. This is a joint press conference, as you know, between the leadership, Republican leadership in the House and the Senate. And I'm delighted to yield to my good friend and an extraordinary leader in the Senate, Leader John Thune.
All right. Well, thank you, Mr. Speaker, and our House colleagues for doing the work. You sent us a clean, continuing resolution. Unfortunately, we are here this morning in a government shutdown that the Democrats wanted. Chuck Schumer, at the behest of a bunch of liberal, far-left activist groups, has walked his Democrat colleagues into a boxed canyon. There's no way out, folks. There's no way out. This could have been avoided. It's totally unavoidable. And everybody's now asking the question, how does this end?
All right, that was the speakers down in Washington, D.C., talking about the shutdown of the U.S. government. And the question, I guess, Scarlett, is how long will it last? I mean, I think that's kind of one of the big questions that a lot of people have here, and who will be impacted.
Right. And so far as we know, there are no meetings scheduled between the two parties. So right now, it doesn't look like there's anything to stop this. It's only day one, and the last time there was a government shutdown was during President Trump's first term. Right. And that was the longest one on record.
That was the longest one on record. So we were listening to House Speaker Mike Johnson and Senate Majority Leader John Thune at the press briefing down in Washington, D.C. Let's get a little context around this shutdown and how it might play out from a Washington perspective. Jamie Tarabay joins us. Bloomberg national security reporter joins us here. Jamie, from your perspective, what's the feeling, I guess, with the folks down in D.C. about how this might play out?
Oh, you know, I mean, there are obviously cynics who believe that it will take a little more posturing from some people before they cave. And we're waiting to see who breaks first. There are Democrats who took a very long time with their votes, who are going to be worth watching to see if they do break. Obviously, this is something that, you know, the Senate Democrat leader, Chuck Schumer, has been basically saying that's never going to happen, that the caucus is holding firm. So it's really, you know, there's a bit of a standoff now and nobody wants to blink. So it's going to be interesting to see how much longer this goes for, how much pain everyone has in terms of what they're prepared to stomach politically. And once those costs start to really become apparent, once the absence of federal workers in places like the TSA or museums being closed, or, you know, the places that we expect, so the trains to run on time, when those things really start to impact everyday life, and it really kind of broadens out from just DC to across the country, there's going to be a lot of political pushback.
Yeah, a lot of political pushback, although Americans have gotten pretty familiar with these shutdowns. They usually don't last very long and everyone kind of moves on with their life. Jamie, you cover national security for us. And of course, yesterday we had the president and the defense secretary, Pete Hegseth, addressing hundreds of the U.S. military's top generals. It was a rare in-person meeting in Northern Virginia. What was the big takeaway from that for those who didn't catch it?
There were two sort of hallmark speeches. One was from Pete Hegseth, the Secretary of War, the Defense Secretary. Congress really hasn't made that designation change yet. So on paper, it's still the Defense Department. And of course, President Donald Trump. There's been a real push from Pete Hegseth in particular to focus on what he calls a warrior ethos in the military. So that includes a lot of sort of fitness, an end to diversity policies and choices. And I was listening to some excerpts of the speech this morning, and he was essentially saying that he doesn't want anyone, whether they're men or women, who aren't fit enough to do a lot of the sort of the standard sort of fitness tests to be on missions. If you can't carry ammunition, for example. But he also said that if women can't do what men are doing, then there are going to be missions that don't have women on them. And it was very political, which is not normal for the military. They sort of both President Trump and Pete Hegseth spoke to a room of mostly quiet senior officers who were really pulled in from across the world, which is unprecedented. Took people away from really important work that they're doing in Asia Pacific, in Europe, in Africa, whether they're on nuclear sort of submarine watch or they're, some kind of, surveillance or satellite work. I mean, they're doing very, very skilled work, and to have them brought in for these speeches was unprecedented. And so it's the thing that everyone kind of really took away from President Trump's speech was this mentioning of introducing the military as training domestically against I'm Australian, against American populations and cities, and that also would be unprecedented. So it remains to be seen what that would look like and if that actually would eventuate. I imagine that there are protocols and obviously conventions within the military to not do that, but we'll see what happens.
And Jamie, what I have not really seen today is any reporting on responses from some of those that were in attendance there. It seems to be a pretty tight ship in terms of no real leaks about how some of those officers may have, I guess, taken in these speeches.
Well, I mean, I've had experience embedding with U.S. military, but from some time ago in Iraq and elsewhere, and they generally try to keep their politics to themselves. Our Pentagon colleagues, our colleagues who cover the Pentagon, I'm sure, are hearing much more than you and I are at the moment. But the military really does kind of pride itself on being apolitical. There are conservative and liberal officers who serve, and I'm not surprised that you're not hearing a lot about that right now, and you're probably hearing more from people who had served and are now outside of the military than the people who have to go back to their stations. And then also their leaders, they need to also, sort of lead forward as well. And they have a lot of people that they're responsible for. And so I think that they all really take their responsibility very seriously. And I think that, they've tried really hard to keep politics out of the mission, which is to protect American national interests and keep Americans safe.
Jamie, final question to you. We started with the shutdown, so let's end with the shutdown. How does the government shutdown impact the U.S. military? Do active duty service members get paid, or do they kind of continue serving without pay?
They continue serving without pay, and that's going to be a particular pressure point that the Republicans will use as they continue to blame the Democrats for this impasse and the refusal to agree to pass this continuing resolution. We're going to see a lot of moments and opportunities for both sides to be able to win political points, and that's going to be a particular pressure point that we will see going forward.
All right, Jamie, thank you so much. Jamie Tarabay, of course, covering national security for us here at Bloomberg News in Washington, D.C. on the latest on the government shutdown and how it impacts national security. And Paul, I was just looking, apparently, as far as we understand, veteran benefits still continue to get processed and delivered even with the government shutdown.
Okay, yeah,
so
it's interesting.
One of the essential services.
Yeah, and we spoke to Henrietta Trez earlier this morning at Veda Partners, and she kind of feels like while there is a chance that maybe something can get done over the weekend, she says there is some probability, a reasonable probability, that this could last longer and kind of be longer rather than shorter. So that could be a challenge for everybody, I guess.
Yeah, both sides are dug in pretty hard.
Yep. Yep. All right, coming up, Wendy Schiller, professor at Brown University. She's going to join us to get her thoughts on this shutdown. Mike McGlone as well. He's a Bloomberg Intelligence senior commodity strategist. We'll get his thoughts on gold. Hitting yet another record. It's up $13 today, $3,872 per ounce.
4,000 is next. I mean, it's inevitable.
Yeah,
right?
I know. 4,000 watch, absolutely. Do I own it? I don't think so. Maybe somewhere, but I don't think so. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, and the Bloomberg Newsroom with this Bloomberg Business Flash, brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest. Learn more at ibkr.com/RIA. Well, yeah, bond yields are falling. Let's start there. That's also means stocks are falling. That comes up after the ADP report that showed the U.S. economy shed 32,000 jobs. Right now, you have 8 of the 11 major industry groups in the S&P 500. They are lower. The biggest drag coming from communication services. That's home to Meta, down over 3% right now. Among some of the other standouts, you have shares of Lithium Americas, the ticker symbol LAC, it is soaring as the U.S. takes a stake in the company, right now up 21%. Now, as far as the government shutdown, traders say if the shutdown stretches from days to weeks, it could intensify concerns over an economic slowdown. Danielle Poley at Oaktree Capital Management sees it this way.
In the past, shutdowns have had a limited effect, on bonds and stocks, but with valuations so stretched in equities today, this time potentially could be different.
Right now, the S&P 500, 9 points lower. We're at 66.79 on the index. The Dow is up 28 points right now. The NASDAQ 100 down 28 points. Two-year yield, almost 6 basis points lower, 355 right now. The 10-year down 4 basis points at 410. And I just want to bring you this breaking news across the Bloomberg terminal. This is according to the OMB director, Russell Vaught. He says the U.S. is putting on hold $18 billion in infrastructure funding for New York City. And as soon as we get details on that, we'll bring it to you. I'm not sure if this is something temporary as a result of the shutdown or something else.
Okay.
We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. Scarlett Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan. We're streaming live on YouTube as well. Day one of the U.S. government shutdown. Where do we go from here? Wendy Schiller, professor at Brown University, joins us here. Wendy, we were listening to earlier the Republican leadership from Capitol Hill kind of making their case, perhaps laying some blame at the feet of the Democratic Party here. Early stages here. Any sense of how this might play out here in terms of maybe duration or who blinks first?
It's a really difficult thing for the Democrats, I think, to hold the line, because Democrats tend to care quite a bit about the impact of federal dollars and the impact on job losses and programs shutting down, because they believe in all these programs. And the Republicans want to shrink the size of the federal government. They want to show American voters that we can live with less government. So it's always more pressure on the Democrats, I think, when the government shuts down. They held the line in 2018, 2019, and that was a long, more than 30 days of a shutdown. And eventually Trump blinked. But this time is different because the Republicans own all the branches of government, and they have owned and supported the president's effort to cut government, cut jobs, cut programs. This latest sort of threat to withhold transportation money for New York could be aimed at affecting the mayoral election, but it also could just be a direct aim across the bow at Chuck Schumer, the senator who's the minority leader of the Senate, majority leader for the Democratic Party. And so they're playing hardball, and they have the capacity now because they own all the branches of government, and they're not facing any kind of election for another year. So I think the Democrats will have to continue to justify their holdout position, and I think that's going to get tougher.
Wendy, you mentioned Chuck Schumer, the Senate minority leader, of course, did support a continuing resolution in March of 2025 and caught a lot of flack for it. How much of what they're doing now is because of the fallout from the last time that he, as some people would say, caved into Republican demands?
Well, I think, Scarlett, this is a really important point about the electoral politics around this, which is to motivate the Democratic Party base, which is, in despair, I think you could argue, and did not turn out the way the Democrats hoped clearly in 2024. And so we've got elections in Jersey, elections in Virginia, and they need Democrats to get out the door, and they need some sort of catalyst, and there hasn't been one. So fighting the good fight, even with pressure and losses, can try to motivate the base. And that's why the Democrats are doing what they're doing. And that's why Schumer's doing what he's doing now and holding the line. The timing is tricky on this healthcare issue for Obamacare and the subsidies, which is the biggest thing the Democrats want, an extension of these tax breaks. Those letters about the increase in premiums don't go out for another couple of weeks. So the political impact, the pain that voters might feel isn't going to be felt for another couple of weeks. Can the Democrats hold out long enough to get that reverse pressure on the Republicans once millions of people get letters that say their premiums are going to double because these tax breaks are going to expire? And that's the pressure the Democrats need. I just don't know if it comes soon enough.
What role do you expect President Trump to play if any, I guess, during this whole process here? Do you think he may just kind of stay low and let the folks in Congress fight it out, or will he try to take a higher profile role here?
Paul, this is not a president who shies away from a fight, and he likes to show and demonstrate the exercise of his power. This is power. I mean, just putting grants on hold for New York City or New York State, that's power. Whether the courts say it's legally within the scope of the president's actions and power, we're about to find out. But Trump loves a fight because he sees that he can win it. And he's not, at the moment, running for re-election in 2028. He seems to care about the midterms in 26, but the Republicans think that's a year away, and voters have shorter memories than the Democrats hope for.
We do have a headline here from Speaker Mike Johnson saying the House will be returning next week. Wendy, just put into context for us what the House would be doing if it does return to work next week and there is still a government shutdown. I ask because my understanding is in order for there to be any funding, you need Democratic votes from the Senate side. And that's what we're focused on, not so much what the House does.
Yeah, this is a really interesting scenario, but it's frequently this scenario. Go way back to 2013. Ted Cruz shut the government down. John Boehner was the Republican Speaker of the House. The House did its job. The House is willing to go forward, but the Senate stopped it and forced the shutdown. So I don't think the House is as relevant a player. They're not going to change what they're voting on. That's their position. The only pressure would be if Thune decides, the Senate Majority Leader Republican, to compromise with the Democrats, which we don't see at the moment, then it would force the House to revisit and come back and pass something different. But these signals will come from Donald Trump. If he decides this might be expensive for him in some way, the stock market could have something to do with that, then he'll push both sides to a compromise. And Thune has already said that they'll consider extending these tax subsidies, but not in the next 7 weeks. So I think that's where it makes things quite tricky in terms of the rhetoric for the Democrats.
Wendy, thank you so much. Appreciate that. As always, Wendy Schiller, professor at Brown University. Well, here's some Bloomberg News reporting on that NYC infrastructure funding. The White House is halting $18 billion in New York infrastructure funding due to concerns over, quote, unconstitutional, end quote, diversity and inclusion practices. That's according to a social media post from Russell Vaught, the director of the U.S. Office of Management and Budget. Quote, specifically, the Hudson Tunnel project and the 2nd Avenue subway, unquote, he said in a post on X.
Hudson Tunnel project, that affects you, John Tucker, and
it
you, Paul
affects
Sweeney.
lots of people. Well, the northeast quarter of the United States. So.
Right. So after a decade of kind of wrangling over this, the federal funding under the Biden administration was kind of freed up, and the money's been flowing, and they've been building like crazy out there, making huge progress.
And at least one of these projects is kind of the baby of Chuck Schumer, who is the minority leader from New York.
Exactly. So I don't know.
Yeah, enough said on that.
I'll let you know as I take the train home today whether the workers are still out there doing it, but they are cranking along and making huge progress there. So we'll stay on top of that story. Another story here is this gold. Guess what? It's higher again today.
This is like not even newsworthy anymore. It just keeps going up.
Yeah, but we got Mike McGlone actually in New York. He's usually ensconced down there in West Palm or doing, I don't know what he's doing down there, but he's actually in New York. So we figured we'd get him here in the studio. Mike McGlone, he covers all the commodities for Bloomberg Intelligence. Mike, is this just a momentum trade here at this point, kind of momentum building on momentum?
Absolutely. I like how you always start me out giggling with those comments about Florida. But I like to put two words together with gold now. Gold is getting scary. It literally up 50% this year. It's stretched above so many moving averages, so many things that are typically only happen on their major significant issues in markets. And one thing that's really rare about gold getting this stretch, it's happening at the same time that stock market volatility is on a 60-day basis is the lowest in 5 years. So it's very disconcerting. We all know what happens October, so maybe gold's front running a little bit. It absolutely loves Mr. Trump. It loves things like government shutdowns, but 4,000 is solid resistance.
Okay, solid resistance. We'll look for it there. It's just below that level right now, Mike. In terms of what's driving gold, fundamentally, I keep hearing central bank buying. Which central banks are buying it?
Well, there you go. Well, you know, from the World Gold Council, they mentioned, Poland was one of them. China's obviously number one, but where does Poland sit? You can see why. But the key thing, that's harder to measure, and it's more of a lagging thing. So I depend on their data. The thing we can see on a day-to-day basis is ETF inflows. Significant shift this year. Total ETF inflows this year, and our Bloomberg metric are up almost 20%. That's after 4 years of outflows, and I like to overlay that with the ratio of gold divided by the S&P 500. It's just starting to turn upward. It's the bottom no one wants, the gold to beat beta. And that's what's happening this year. The question is what happens by the end of the year. And I point out volatility is so low in the stock market. I think every hedge fund in the planet gets it. In just a matter of time, their positive gamma, potentially negative delta positions on the S&P 500 kick in.
A lot of Greek letters there, Mike.
There you go. Well, it means basically puts.
We had earlier on Surveillance Day, we had Akash Doshi. He said a gold strategy. Yes, there is a title, gold strategy, because State Street had some of the first ETFs, gold ETFs. And he's saying the money's just flowing in like crazy.
GLD, yep.
Yeah, GLD is it's a benchmark in this space. So I put some numbers at our measure shows the all-time high in total gold holdings was 110 million. The low just recently, and that was 2020, you remember why? The low recently was around 80, and right now we're running around 96, 97. So we're still well below that peak. And
so there's more room to go.
There's a lot of room for those to even get to the all-time high.
Remind us what the relationship is, if any, between gold and Bitcoin.
Well, I love watching that ratio. I started watching it 10 years ago. The gold to Bitcoin ratio right now is about 29 to 30 ounces of gold per one Bitcoin. The high was 40 right after Trump got elected. The significance of where it is now, it's flatlined for 4 years now. So gold, even though it has a much lower volatility, is trading at the same performance as Bitcoin. It's a real bad sign. And so to me, it's signs of peaks in this highly speculative digital asset is what I take from that ratio.
If you're buying gold because you want it as a hedge against all this uncertainty, all this instability, but you're looking at the price and you're thinking this is just kind of crazy, you might look into other precious metals, silver, platinum, palladium. Which of those have the most relative value?
There you go. The best performing commodity this year is platinum. A lot of people use it for jewelry, palladium, silver. They're all going up on the back of gold. It's just gold's pulling it higher, and central banks are not really buying them. They're buying gold. So gold's dragging up all metals. It's just a question of how long it lasts. And I'm just concerned about what this means for the fourth quarter. But also, the key thing to watch right now is 10-year note yields. If we break below that 4% level, that's a shift that we might be getting more of that deflationary bent, and that would tilt away from the gold trade to the bond trade.
All right, Mike, we'll talk pork bellies next time. Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence. GLC Go, the Global Commodity Price Index. It's a great chart or a great set of data there for all things commodities. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, and we're being brought to you by Oracle. Attention, growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Let's start with Treasury yields. They are falling after the ADP data reinforced expectations of a Federal Reserve interest rate cut at the next meeting. Payrolls at U.S. companies, according to ADP, unexpectedly dropped. The economy shed 32,000 jobs. This is according to the private payrolls company. That's why you got the data. It's a private company, not government. Traders jittery as they're kind of fumbling with respect to government data. The jobs report on Friday from the Labor Department, that's on hold because of the shutdown. And I just heard from Amanda Leinen there at BlackRock. She also says, you know, the longer the shutdown goes, the more uncertainty it is going to generate for investors.
The data releases are incredibly important in this environment, given the tension in the Fed's dual mandate. We wanted color on where the labor market is trending. And so if we don't get that payrolls report on Friday, I think it just adds a little bit of uncertainty to an overall challenging environment. S&P 500, 9 points lower right now. The Dow down 31. The NASDAQ 100, 11 points lower. And among the stocks on the move, shares of Nike up over 4%. Sales fell 1% in the most recent quarter. That's actually a smaller drop than what investors had anticipated. A Bloomberg News investigation has found that wholesale power prices as much as 267% more than 5 years ago in areas near, fill the blank in,
data centers.
So the hikes passed on to households and businesses on top of the charges to update overburdened grids. Because those networks cover whole states or regions, consumers who don't even live near data centers, they can also be impacted by that. I saw it in my, I don't know, it was a data center, but First Energy of Ohio is my provider.
Of course, New Jersey.
Yeah, that makes perfectly good sense. And in some cases, the delivery charge was actually more than the power charge. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Scarlett.
I try to avoid looking at that utility bill too closely because
I love that direct withdrawal. I just kind of deal with it.
It gets painful real quickly.
Yeah, exactly right. All right, JT, thank you so much. Appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Brokers studio in New York City. Streaming live on YouTube as well. That would be the internet. Go check us out there. Nike reported some numbers, as John was just reporting. Some better than expected numbers. Stocks up almost 5%, although it's still down about 3% year to date. But maybe a little bit of a turnaround there. Working through the inventory, as some smart folks have told me about the Nike story. One of those is Poonam Goyal. She's a senior U.S. e-commerce and retail analyst for Bloomberg Intelligence. Poonam, is the turnaround at Nike, is it kind of turning? Is it working?
It's working. I think yesterday was the first sign that Nike is able to pick up momentum. Sales on a reported basis were up 1%. Inventories were down 2%. This is exactly what we wanted to see. We wanted to see inventories align with sales. So while the work isn't done and it's not over and it's not a straight line up, we do see momentum building. What they're doing is working. The new products, the innovation, the focus on wholesale, it's all coming together. There are still some pitfalls. China is still sluggish, and we'll need to wait and see what happens there, as well as with its Converse brand.
Okay, so China's definitely an issue. Converse is a work in progress. When I look at the revenue line, the top line, what I see is direct revenue fell 4%, wholesale revenue rose 7%. Just break that down for us in terms of what that means, direct revenue versus wholesale revenue.
Sure. So direct revenue composes of stores, which were actually up 1%. So that shows us that the innovation and the new products which are flowing through their own stores is working. What made the DTC revenue go down 4% was that digital was down 12%. No surprise here. This is where they're clearing all that excess inventory. So this channel will be pressured for a couple of quarters still. Wholesale up 7%, a great number. I mean, it just shows that coming back into partnerships with Foot Locker in a more meaningful way, getting on Amazon.com, all these efforts are paying off, and they're where the customer is. They're gaining their shelf space back, and the customers are responding favorably.
You know, the Nike brand is such a powerful, powerful brand. I think of it like Coca-Cola or Apple. It's so powerful. Yet some of those American brands in China under pressure. And I'm wondering, just with the geopolitics, is Nike a brand where that might be feeling some anti-American sentiment from consumers?
So that has happened in the past. There have been boycotts against, U.S. American brands. We don't think that's the issue yet, from what we're hearing, but we do think that the issue is more product at Nike in China. So they do need to ramp up product, and they do have a lot of excess inventory there, more so than they do in the U.S. today. So that's also a work in progress that they need to get through.
Let's talk about profitability. Margins declined due to higher discounts and then also the higher tariffs in North America. I look at gross margin, 42.2%. Last year at this time, it was more than 45%. Now, the 42.2% was better than estimated. How long is it going to take for Nike to turn that around?
I think we have quite some time to get back up to historical margins. In fact, on the call yesterday, they said that they do still aspire to reach double-digit EBIT margin. EBIT margins in the quarter that they just reported was only at 7.1%. So that's a long runway. We don't think it's anytime soon. And the hit from tariffs is building, not reducing. They had expected $1 billion the last time they spoke to us, and yesterday that went to $1.5 billion in excess costs from tariffs.
How much are they passing along to the retailer versus taking that in their margin? Because, I mean, Nike is probably just a great example of how companies are trying to deal with the tariffs.
Yeah, so I think they're doing this actually very smartly. They're not increasing prices on products that are under $100, but they are taking prices up on sneakers that are above that price point. So if you think about moving prices up, it's very easy to say the price of milk went up from $3 to $3.50. But when you're looking at a pair of sneakers, especially a new launch, you have no comparison. So you can go ahead and price up your new innovation, and the customer may not even recognize that there was a material price increase. And that customer has a little bit more flexibility to stretch their wallets at that price point.
Poonam, if you are heading up On Holdings or Adidas or Skechers or, any of the Hoka, what would you be thinking looking at this set of results?
So Skechers, I think, is in a different league than Nike. It's a little bit different. It's a value play. And I think they don't compete directly like an Adidas or an On or a Hoka would with them. Adidas is doing really well on its franchise lifestyle shoes. And I think Nike, what you heard yesterday, was doing well in performance. So two still very distinct categories. Though for On and Hoka, I think it's a little bit of a different story, because what I heard from that call yesterday was that running was back on. It's doing phenomenally well, and that is where Hoka and On both took share from Nike. So I would be just, a little concerned, and just make sure that I keep my game on when it comes to innovation, because at the end of the day, product is what's going to drive how sales momentum will go moving forward.
Red headline crossing the Bloomberg terminal. Supreme Court refuses to let Trump immediately oust Fed's cook. So that's certainly been something that the Fed watchers have been paying attention to.
Right. The Supreme Court will hear arguments in January in this firing case, but they're not going to let anything happen in the near term. So that does mean Lisa Cook, it sounds like, is in place for the Federal Reserve Open Market Committee meeting this month and in December, at which point the Fed, for now, according to the market, is expected to cut rates twice.
Very good. And we'll have more reporting on that as it comes available. Thank Poonam Goyal talking to us there about Nike earnings. Stocks up 5% today, a little bit better. Maybe that turnaround that they've been waiting for, maybe that's starting to take place here. Poonam Goyal, she's a senior retail and e-commerce analyst at Bloomberg Intelligence. I wear Nikes, but for some reason, Nike doesn't pay me to be like an endorser.
Yeah.
Just because I have little to no
Well, are you wearing
talent.
it for lifestyle reasons or performance reasons, as Poonam was
It's a brand
clearly
loyalty. It's
making
my
clear?
brand. So when I walk into the sneaker store, which I rarely do, I just go right to the Nike.
You go for the swoosh marks.
Yeah.
I have On Holding sneakers, and they're really comfortable.
That's what I hear.
Yeah.
I hear those are good, and I don't know.
You don't have to tie the laces either, elastic laces.
Really? Mm-hmm. Big day in my life. My parents, growing up, we couldn't afford Converse, so we would do the Sears brand.
What was it called? Did it have a name?
Jeepers. Called Jeepers. I'm not kidding. And so, it was big when I actually had a job at 15 years old pumping gas that I could afford to go buy my own sneaks, and that's kind of what I did.
Jeepers for Paul Sweeney. I wore Taiwan knockoff brands. So
Taiwan.
Yeah. My Cabbage Patch doll was a Taiwan knockoff.
All right, very good. Sorry, we're going to have some more reporting here on this Supreme Court case. Again, a little bit of stability to the situation. The Supreme Court refuses to let President Trump immediately oust Fed's Cook. The Supreme Court said it will hear arguments in January in this Cook firing case. So again, as Scarlett was just mentioning, that keeps Ms. Cook in her role through presumably the September meeting the October meeting and then into December.
That's right. And of course, she's been pretty consistent voting with Jay Powell. Of course, President Trump does have one of his own people, Stephen Myron, who most recently joined the FOMC, along with 2 other people that he appointed as well, Bowman and Chris Waller. So he has 3 of the 7 board members on the FOMC. For anyone keeping track.
Yep. Again, presumably, this is a Fed that has historically prided itself on political independence, although it seems to be at risk here a little bit here. But you look at the WIRP function, what's the market telling you? And the market's telling you, a couple of rate cuts this year, probably continuing into next year. Presumably that's what the president wants overall. So maybe nothing really needs to be done. Maybe the market will take care of itself as it tends to do. But again, some political movements on the part of this administration as it relates to the makeup of the Fed.
Yeah, and of course, the latest jobs market data that has come out, and this is from ADP, which is a private sector survey, shows that the labor market is perhaps showing more cracks than people had anticipated. Of course, I put this in context because we're not likely to get the non-farm payrolls report on Friday or even the jobless claims numbers tomorrow because those are government data pieces.
That's right, exactly. So just for those that didn't see it, the ADP did come out with their monthly numbers for the month of September. The expectation, the consensus was for a gain of 51,000 jobs, came in at negative 32,000. And then there's also a revision started last month. They did report 54,000 gain, and that's now been raised to a 3,000 decline in jobs. So again, a downward revision and a weaker than expected number for September. Again, historically, the correlation between the ADP numbers and the non-farm payrolls has not been great at all. It's not been a predictor.
But, we're in a week in which we may not get a lot of the official government data, so there's going to be more weight put on that ADP number. Also, a lot of weight put on the Challenger jobs cuts numbers tomorrow, due out at 7:30 a.m. as well. Right now, that is for an increase for August, it was an increase of 13.3%. I don't have a consensus number for this month, but you can bet there will be a lot of focus on that number as well.
Okay, let's get back to the interesting story that just came out across the Bloomberg tape. The U.S. Supreme Court refused to allow President Donald Trump to immediately oust Federal Reserve Governor Lisa Cook while she sues to keep her job, dealing a setback to his efforts to exert more control over the central bank. Elliot Stein joins us here. He was doing great in his career, Stanford undergrad. Then he made a fateful decision, a mistake. He said, I'm going to go to law school. So he went to law school, and he's been paying for it ever since. But he is our go-to guy about all this litigation stuff here. Ellie, what do you make of this Supreme Court ruling here?
So, I think it's really interesting that they sort of punted on the decision because they want to hear oral argument in January and then decide. But I think what's really notable is that in every other case that's similar to this, where President Trump has fired the heads of an agency, and those cases then went to the Supreme Court. The Supreme Court always has ruled immediately that the president can remove those people pending the litigation. Here, it's very clear that they're treating the Federal Reserve differently.
They're treating the Federal Reserve differently, and I'm looking at the order, the written order, and it's very, very short. It's very terse. I mean, just looking at it, I see a lot of Latin words here as well, which I don't understand. But what does it mean that they're looking for amici curiae and any supplemental briefs responding to amici? What does that mean?
Yeah, so those are what we call amicus briefs. Some people pronounce it amicus briefs.
I like your pronunciation so much better.
I was doing it in Italian, but okay.
Yeah, that was pretty good, but that's not as good as my Latin. Those are just friend of the court briefs. And we spoke about it a few days ago, actually, where non-parties but people who are interested in the case can provide written arguments to the court to give sort of context as to why these issues are important. It doesn't have to necessarily be legal arguments. It can sort of just be, why this is such an important issue for different stakeholders that aren't directly involved in the litigation, but maybe indirectly impacted.
Is there a consensus within the legal community, Ellie, about how the Supreme Court may ultimately rule here? Is this something? Again, you mentioned that President Trump has had some leeway in removing other heads of agencies. What's so different about the Fed and how it might go?
Sure. Well, the issue usually comes down to whether these agencies are part of the executive branch, because under Article 2 of the Constitution, the president has control of the entire executive branch. And so when these other cases have come up, that's what the court looked at, and most of these agencies traditionally do fall under the executive branch. They issue rules, they have enforcement action capabilities, but the Fed historically has been different because monetary policy really is a congressional responsibility that they have delegated. And so even the Trump administration early on made a distinction between the Fed's monetary policy authority and its rulemaking and regulatory authority. And the regulatory side of things may fall under the executive branch, but the monetary policy historically doesn't. And the Supreme Court in May also made that distinction because it said the Federal Reserve is a unique institution. It has a unique structure, and it's almost quasi-private. Those were the words that the Supreme Court said, which suggests that it doesn't really view it as an as an executive agency.
Elliot, we know the president doesn't like to take no for an answer, and he's essentially getting a no for now. Does he have any recourse?
Well, the Justice Department will be in the Supreme Court in January per this order, arguing.
But before then, before the January oral arguments begin?
No, there's not much he can do. He has to live with this, and the government will present its arguments in January.
So is it this individual, is she representing herself, Lisa Cook? Is she representing herself, or is she being represented by the Federal Reserve?
No, she's got lawyers who represent her in her
as an individual,
in her individual capacity. Because, and it's interesting you ask that, because her lawsuit actually names the Federal Reserve Board and the other governors as defendants, and the reason she did that is because we saw it with the lower court orders. The lower court orders forced the Federal Reserve Board not to take any action with respect to the president's termination letter. So that's why they had to name the other Fed governors as defendants as well.
So Lisa Cook's lawyer, her personal lawyer, is Abby Lowell, who is very prominent in Washington. He has defended, it feels like, everyone in Washington, D.C.
Right.
Tell us a little bit about, his background and what he brings to an oral argument before the Supreme Court.
Yeah, well, actually, he may not even be the lawyer arguing in the Supreme Court, because another notable thing that happened when this case reached the Supreme Court is that Lisa Cook's side, on her papers, they retained Paul Clement, who is one of the most notable and probably one of the foremost Supreme Court advocates of our generation. Wow. And traditionally, he has served under Republican administrations and argued for conservative causes. So the fact that he, in this case, is representing Lisa Cook against the Trump administration, I think is really notable, and I would expect him to be the one arguing in January.
God, that would be intimidating. Going up in front of the Supreme Court and then arguing against the U.S. government. That would be intimidating.
Well, he used to be on the government side, right? He used to be, I believe he was the Solicitor General for a while under Republican administration.
Under the George W. Bush administration. Thank you, Wikipedia.
Yes, exactly right.
Tom Keene's encyclopedia.
Yeah, exactly. Elliot Stein, thank you so much. We really appreciate it. It's such a benefit for us at short notice. We say we need a really smart voice on breaking news. And the dude's one floor down from where we are. How lucky are we?
Wait, so how do I pronounce it? Amici or Amici Courier?
I go amicus.
I say amicus or amici.
Amici, okay.
See,
but, potato.
I had 8 years of Catholic school. I think I'm the aficionado in Latin.
I think you are, yeah.
You didn't take Latin, though, did you?
Oh, yeah.
Oh, okay.
Oh,
well,
yeah.
you should know.
I know. Well, the only thing I know about Latin is you just pronounce every single letter as you see it, and then you can speak it just fine. So you walk into any church.
You want to
in Rome,
conjugate some
no
verbs
one says it.
for
No
us?
one speaks it.
Yeah, it's a dead language, but they make it. They made us learn it, and I think we're all the better for it. S&P 500 off 5 points. We'll have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. One more hour of Bloomberg Intelligence coming up. We're going to check in with Michael McKee, Bloomberg International Economics and Policy Correspondent, get his thoughts on what's going on with this U.S. government. Where do we go from here with this shutdown? Nathan Dean, again, the only reasonable person I know in Washington, D.C. that's got a grasp of all the details. He's going to join us as well about how this shutdown may play out and what agencies are really impacted and how that may impact global Wall Street. Shana Sissel, founder and CEO of Banrion Capital Management, should give us her thoughts on these markets as well. So we got a lot coming up in this hour. Let's kick it all off with John Tucker in a Bloomberg Business Flash. John.
All right, guys, let's start with the data, the private data. Private sector payrolls decreasing by 32,000 after a revised 3,000 decline a month earlier. This is from the ADP research data that we got this morning. Now, the odds of a Fed rate cut, they go up. So a rate cut go up, odds go up of a cut. So that's why Treasury yields are lower right now. The 2-year, which is more policy reactive, 355. That is down 5 basis points. The 10-year yield, 4 basis points lower, right now at 410. And the major stock averages, they were down earlier. They have just turned mixed. We have the Dow Jones Industrial Average 20 points higher. The S&P 500 down now just a point, pairing some of the earlier losses. And the Nasdaq Composite Index, that is 8 points higher. That may have more to do with the government shutdown and the delay of data, like Friday's payroll report from the Labor Department. Rianne Mitrione at the Callan family office offered her take on the shutdown and its impact on the markets.
This may not be a traditional type of shutdown. So this one could end up being on the longer side due to the political dynamics at play. And the longer it lasts, the more of an impact we could potentially see.
And a penny for your thoughts. Now it could actually go to a nickel for your thoughts. The U.S.
Inflation.
U.S. retailers are appealing to Congress for a new law allowing them to round purchases to the nearest nickel. That's because the new supplies of pennies drying up.
Wait, so what happens in 1999?
Yeah, so I don't.
Does it become 2004? Or I mean, obviously becomes $20, but then
actually,
what, 2005?
A lot of the Federal Reserve coin distribution locations have already stopped accepting and distributing.
My favorite thing to do is go to the market and then see someone try to count out 50 cents and pennies.
I'm trying to figure out the last time I actually used physical cash or coin. I can't remember. The debit card. Paul carries a wad with
the wad of cash. You gotta have 4 or 500.
Do you round up?
I just, always have a wad of cash. You're never going to walk by a
coinage,
crap
right? No coinage.
No coinage. Haven't had a coin in my pocket in 20 years.
Oh boy, we check the markets for you all day long, right here on Bloomberg Radio. Huh?
I had the Europe when I was in Italy. I put the euro, 2 euro, 5 euro.
Well, they have, they have the coins that are.
The coins are useful there.
They make more sense anyway. Scarlett and Paul.
All right. I wish I had a wad of cash like that. All right, let's take a look at some stocks on the move today. I'm Scarlett Fu here with Paul Sweeney, and we are joined by Tatiana Dare. And Tatiana, we're looking at the U.S. government take stakes in yet another company.
Yes, and that company is Lithium Americas. Your ticker is LAC, up about 22% after the U.S. government agreed to acquire a 5% stake in the company as it develops its lithium project in Nevada. That is the largest lithium deposit in the country. And just a reminder, this is a key component that we use in lithium-ion batteries, widely used in electric vehicles and other things. Well, this also marks the Trump administration's latest effort to speed the development of domestic supply chain to counter China's dominance in these key metals, very critical to defense, automaker, consumer electronics. This comes after the company took a stake in MP Materials earlier in the summer, also the Intel stake. And mind you, this is a Canadian company, not American, even though the Americas is in the name. So it tells you foreign companies are not exempt if their supply is critical to the U.S. government's efforts.
We have some breaking news here. Apparently, there are empanadas on the 6th floor, and the people are going nuts in this building.
There's a really long line to go up the escalator. Tatiana's heading up there soon.
Stuck here online, so I mean on air. So anyway, all right, Tatiana, what else do you have for us here?
Carvana shares up about 1%, was up higher earlier, but that's after Jefferies upgraded the platform for buying used cars to buy from hold. They say the company continues to deliver growth and upside to consensus, and it's primed to benefit from the shift to digital in this massive $800 billion used car market opportunity. It calls the stock's valuation premium as justified by the company's track record of leading growth and upside. Also raised the price target there to $475 from $385. We are at $380 right now. So it hasn't even hit its target, and the analysts are going for higher targets here. Well, shares are higher by 86% this year. So even so, analysts are Jefferies saying that all of this is justified.
Wow, that is some outperformance. All right, let's turn to Nike, which reported earnings.
Yes, Nike up 5% after earnings, your ticker NKE. The retailer's first quarter revenue beat estimates, and analysts now see this as a sign that the company's turnaround is on track. It's a focus on product innovation and specific sports is starting to work out. And curiously, the strong results are offsetting other commentary on the call that they see an annual tariff hit of about $1.5 billion, up from about $1 billion. So it seems like nobody's talking about tariffs anymore.
Well, it just feels like here's a company that's effectively, we talked to Poonam Goyal, who covers the stock for Bloomberg Intelligence, and said, here's a company that's taken most of the tariff hit on their P&L, not passing along to customers, with the exception of some higher end items where people don't care if they're paid an extra 10 or 15%.
Yeah,
I guess.
perhaps not as noticeable. Well, this shows in the stock, right? Because it is down year to date, somewhat about 3% now from 8% previously. So the good results are boosting the stock.
All right, very good. That is Tatiana Derrier giving us the movers there in this market. You can check all that out on the Bloomberg terminal. Bloomberg Market Drivers is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. The government shutdown. What's that going to mean for government services, maybe even for the data that the government provides that is so crucial for financial markets? Mike McKee, he might have an idea here. Mike McKee is international economics and policy correspondent, joining us live here in our Bloomberg Interactive Broker Studio. Mike, from an economic perspective, government shutting down, what have we learned from past shutdowns about the impact on the U.S. economy?
Well, it's generally very small. If it lasts for a little bit, they figure out it's somewhere between 0.1% and a 0.2% impact over a quarter each week. So it does shave a little bit off, but part of it gets repaid. You will have some lower spending because government workers aren't getting paid, so they have to put off spending. But they get paid when the shutdown is over. So if it doesn't last too long, it won't be too noticeable. And it doesn't do a whole lot of damage to the overall economy other than inconveniencing people.
Perhaps inconveniencing investors and traders too, because if you type EcoGo on the Bloomberg terminal, you'll see this bright yellow banner that says U.S. government data releases may be impacted by shutdown. Which data points are we not going to get as a result of this?
Well, it doesn't look at this point like we're going to get the jobs report on Friday, and we're not going to get jobless claims tomorrow. The jobs report on Friday could still come out because the Senate is going to try to vote one more time, and if they should pass the CR and we reopen the government.
How many votes they need to pass it?
They need 60.
And they've got
55.
Okay, so 5 defections.
They'd have to get 5 more Democrats to
Okay.
cross the line. If that happened, then we could see the report come out on Friday. But tomorrow being Yom Kippur, the Senate is not in session, so there won't be another vote tomorrow. So we'll know pretty soon whether or not we get that. And then the next one that people are going to start worrying about is the CPI later in the month, and that could be delayed as well.
When is that scheduled for?
I believe the 15th, but I don't have that right up in front of me.
Okay, so that's a
here.
while from now.
We can look look that up, but it would. The bigger issue is not so much whether we get those reports; it's timing of those reports, and then it is a question of does it last long enough that they can't collect the data for the October reports? Then we wouldn't get those in November. The week of the 12th ends on the 18th this month is the job data collection month. It's a little bit easier with them because most of that's collected electronically. So even if the BLS folks aren't there, the data can come in from companies, but it's the CPI people worry about because they go out and check data prices in many cases. And if they don't have the people on the payroll to go check the prices, that won't happen.
Got it, got it. Now, of course, there's high-frequency data points like jobless claims. That comes out typically every Thursday. Are we going to get tomorrow's report?
We're likely not going to get tomorrow's report, and the thing is that the states put together all of that data. The Labor Department just compiles it into a report. I mean, they also have functions like supporting some of the payments and things like that will continue. But the report itself apparently is not going to come out. But you can call the states, each state individually. And as I understand it, the intrepid folks at Bloomberg Economics are going to attempt to do that.
Of course.
So we may have something for you on that, but no promises yet.
Breaking news, everyone.
Real quickly, ADP came out, negative number. How do you think about that?
I think what you do is just look at the big picture and say it looks like hiring continued to slow. Okay. There are statistical questions about the ADP this time and how they put the numbers together, but it's not always it rarely is an exact number to go on for Friday. So it just tells us that things are not great. And manufacturing ISM showed in the 40s, so still contraction in employment there.
All right, very good. Michael McKee does all the economic stuff for Bloomberg, joining us live here in our Bloomberg Interactive Broker Studio. You know, if you want to get a reasonable sense of what's happening down there in D.C., we go to our next guest, always. Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence, down there in D.C., the only reasonable person I know in Washington, D.C. Nathan, we're here day one. Thank you, John. Let's get an update, first of all, on the empanada issue. John Tucker went to the 6th floor and got Scarlet and empanadas.
Nathan, you see what you're missing here?
Yes.
It's nothing but fun.
Empanada day
We
at
care about
Bloomberg.
the shutdown, Nathan, but it's all about the empanadas first here. So, Nathan, we're day one here. Any consensus on how long this might last, do you think?
So, you know, I think this is going to last probably into mid to late next week. The reason being is that nobody's really talking to each other. You know, the Republicans have a press conference up on Capitol Hill. The Democrats are about to have a press conference up on Capitol Hill, but they're not talking to each other. Tomorrow's Yom Kippur, like Mike was saying, there's not going to be any votes tomorrow, and they're going to have a vote on Friday, and everybody's going to vote the way that they did before. So I don't think you're going to see any type of resolution until this weekend at the earliest, but more likely next week. And the reason being is that shutdowns occur because both parties think that it's politically advantageous to both of them. And right now the Republicans feel like they are on the moral high ground because they have a clean CR, and the Democrats are shoring up their base by being seen as fighting President Trump. So I think the pain, if you will come in the beginning stages of next week. And the catalyst that I'm looking for is whether or not Russ Vought and the director of the OMB and the Office of Management and Budget continues with its threat of canceling contracts. We saw $18 billion geared towards New York City just this morning, and also this idea of reduction in force amongst government employees. If that occurs, then I think the Virginia and Maryland senators, and you know, Mike mentioned you only need 5, those are 4 of them, they eventually come back and say, look, we're going to try and get ahead of the OMB here and protect our constituencies.
I'm so glad that you mentioned what's going on with New York. The White House halting $18 billion in New York infrastructure funding due to concerns over DEI, diversity and inclusion practices. He called them unconstitutional DEI principles. Russell Vought, the director of the OMB. Is DEI part of the Constitution?
You know, this is obviously part of the White House's strategy of trying to influence its own policy on other individuals and entities. This is nothing new. Obviously, you know, I think what will happen here, and President Trump, and I just got this from one of the red headlines that came across the terminal, is that they said that they would conduct a review, and then when that review occurs, then potentially that money could come back to New York City. So I think this is more of just political posturing at the moment in terms of trying to drive this message to Democrats is that, look, we at the White House are going to try and make this extremely difficult and painful for you because, again, the Republicans feel like they have the moral high ground here because they passed this continuing resolution. I think what Senator Schumer has to figure out is what is the endgame strategy here, because two Democratic senators and an independent that caucuses with the Democrats voted to keep the government open, and as a result, you only need 5 more, and if those 4 from the D.C. area region come aboard, then potentially you could see a fracturing of the Democratic Party. They got to figure out what the endgame strategy here is, and they got to do it fairly quickly.
And who is the leader of the Democratic Party today? Is it Schumer? Is it Jeffries? I have no idea.
I got that question from a client just this morning, and the answer that I gave to him was nobody really knows. I mean, historically, it's come from Washington, but then as you get into election cycles, it comes from the states, the governors. You've seen Governor Newsom, Governor Pritzker, you know, try and take up this mantle that we're going to be seen finding President Trump. But then it's also the Washingtonians grab that news cycle. So there's really no leader of the Democratic Party right now. And I think the polling suggests that. You know, the polling approval ratings for the Democrats right now is around 30% compared to President Trump, who's in the mid-40s. And that's one of the reasons why I think the Democrats went forth with this idea of a government shutdown is because, look, if the approval ratings can't get any worse, then let's shut it down. Let's shore up our progressive base. Let's make our folks happy. And we have plenty of time to change the message between now and November 2026 when the midterm elections occur.
There's enough distance, right? And you keep saying how the Republicans feel like they have the moral high ground because they have the continuing resolution that they're ready to pass. This really marks a reversal from what we've seen in years past, especially during the Biden administration, the Obama administration as well. So, Nathan, just talk to us a little bit in terms of operations. Which government entities, which government units will continue to run? Treasury coupon and debt service payments are going to continue as planned, right? They're not at risk?
Yeah, that's correct. I mean, obviously, a lot of the market functions portions that we care about at Bloomberg are deemed essential. For example, I had a client call in yesterday and say, look, talk to me about customs and imports. Are we going to get hit with these tariffs? And the Customs Department, you know, was only furloughing, I want to say 3% of their workforce. Everybody else was deemed essential. So for the most part, the government will continue. And this is one of the challenges that I think that the Democrats are going to have with the OMB, because there is a scenario out here that says if 85% of the government is deemed non-essential and this shutdown lasts a month and we really don't notice a difference, do they really need to come back? But I will say is that, you know, there's a lot of functions that aren't being done. You know, visas for one. I mean, just any type of take your, you know, your individual national park, for example. But, you know, I will say is that government shutdowns are not popular with the American populace. They're okay right now with their parties for the next 3 to 4 or 5 days. But if this shutdown lasts a little bit longer, I would expect the polling data to say the American people is going to pick one side or the other.
And it seems, Nathan, that this, I don't know, the Obamacare subsidies, it just feels like it's a topic that doesn't resonate with people. Am I missing that? Or is this a really big issue?
You know, David Axelrod tweeted out the other day that the Democrats should focus on this, and the response that was going around was that they were. And if David Axelrod didn't know this, then that's not a good message for the rest of the Democratic Party. But I will say is that there has been hints that President Trump and elements of the Republican Party, Senator Tuberville of Alabama, for example, are putting together this idea of potentially extending them either on an income-based level or just on a time frame or anything like that, because there is this recognition that if premiums go up at the tail end of this year, the American populace is not going to like that. Now, the bulk of the Republican Party doesn't want anything to do with the extension of these Obamacare subsidies, but I think there's enough there that something can be done between the Democrats and Republicans. It's just not going to happen during a shutdown. So one of our scenarios where we think this could get resolved is if an unofficial handshake comes between Senator Thune and Senator Schumer, that they will do something to deal with this later in the year. Maybe that gives the Democrats an out to say, look, we've done what we needed to do. Let's end this government shutdown, and then we'll deal with the Obamacare subsidies next month.
Okay. Nathan, thanks very much. Nathan Dean, Senior Policy Analyst for Bloomberg Intelligence. Let's head down to Washington, D.C. right now. We had the Republicans speaking earlier regarding the shutdown. Now it's the Democrats' turn. Speaking is Peter Aguilar. He is representative from the state of California. Oh, no, I'm sorry. We have next to him is Ted Lieu of California as well.
Fighting to lower costs, cancel the cuts, and to save health care. And we're House Republicans. They are on vacation. We are asking Speaker Johnson to bring back House Republicans right now so we can work together to not have this government shutdown. It is now a very bad time to have a government shutdown because we are in a very bad economy. We know that unemployment has now hit near 4-year highs. We know inflation has continued to rise this year. And we just learned today from payroll processor ADP that private sector jobs, which were expected to increase by 50,000 last month, instead decreased by 32,000. Trump's economy is crushing Americans financially. House Republicans need to come back, work with Democrats, and stop this Republican shutdown.
Do you have questions? Nick?
I was wondering if I could get your reaction to Russ' vote announcing this morning that the administration was putting funding on hold for infrastructure projects in New York, the Hudson River Tunnel and the 2nd Avenue subway.
I think this is probably what they meant when Donald Trump said we're going to extract maximum pain. The goal from Donald Trump and his administration has been all along to make this painful. This isn't about policy priorities for them. They want to send a message, and if it means hurting people in the meantime, if it means laying people off, if it means congressionally authorized and designated projects don't continue, it's clear that that's what they mean. This is probably under the headline they said will make Democrats will pay a huge price for this, right? Those are their words. So this might mean what they this might be what they mean. Look, this is shameful and it's tough, and it shows that we don't have true negotiating partners, over there. They just want to make this difficult. They've been, cheering this on for months and planning for this. And it's unfortunate that this is what Russ Vought decides to do.
As Chairman Aguilar said, the Trump administration is inflicting maximum pain on the American people, including the people of New York and New Jersey. The people of New Jersey have a choice this November. They can support someone that is beholden to Donald Trump or not.
Thank you, Mr. Chair. This is for both you and the Vice Chair. You as a defense appropriator and Mr. Lieu as a veteran, what's your response to Pete Hegseth's speech yesterday? I know that there was a lot going on with the shutdown, but obviously that has big implications. Even the president mentioned using American cities as military training grounds. Obviously, when the government opens, you'll have a big role in funding the Pentagon. Again, Mr. Lieu, you're a veteran. I wanted to get your thoughts on Mr. Hegseth's speech yesterday.
I'll keep mine quick because I'm not the one who's worn a uniform to defend the country like the vice chair. But incredibly shameful, chaotic, unhinged, inappropriate, and if Republicans can't speak out against what they heard him say, then what are we doing here? All of those points, using service members, putting them in U.S. cities as training grounds, violating posse comitatus. I passed an amendment in appropriations this year that said funds could not be used in violation of posse comitatus. And every Republican, they accepted the agreement. It passed in voice. Chairman Calvert and our Republican colleagues in the full committee of appropriations, passed it. So that's how they feel. They feel this is a non-issue, or they did 2 months ago. I'm curious if they feel things have changed now, and it's unfortunate that we're in this place. But from women not being able to serve in combat, I mean, there are just so many things, Michael. We can go down the litany of terrible ideas and policy positions that the secretary mentioned. By the way, the most unqualified Secretary of Defense that this country has ever seen. So it's hard to take him serious. It's hard to believe him if his lips are moving either. But that's where we are, and it's unfortunate. And I hope that some of our Republican colleagues start speaking against it. But if past his prologue, then they won't.
Thank you for your question. We are the most amazing military in the world, and the leadership of our amazing military, we're all gathered together, hundreds and hundreds and hundreds of them. And Donald Trump and Pete Hegseth were expecting rousing applause and standing ovations from our nation's generals, and they were met with silence. It was a silence of the generals. And the generals knew that what Trump was saying was wrong. We do not deploy American forces against Americans in our cities. Our military is not to be used for domestic law enforcement. It is not trained to do that. And our generals simply sat there silently. It's also illegal for Donald Trump to order U.S. troops against Americans in American cities. A federal judge has said so. We expect the appellate courts and even the Supreme Court to uphold that ruling.
Thank you. Representative Blue? Our expectation is that generals and members of the service follow the Constitution and the Uniform Code of Military Conduct. Those are their guiding principles, and it's our expectation. I don't want any of those individuals to resign or retire. I want them to hold strong to the Constitution and the oath that they've taken. Questions?
Representative? Representative, sir? I had one quick question.
I'm sorry. Eleanor, did you?
Oh, I didn't have my hand up. Thank you.
I'm sorry. Go ahead.
As I know you're asking for negotiations. That's what you want out of the Republicans. And you made pretty clear what's going to be needed with these Affordable Care Act subsidies as well as the rescissions provisions too. But are you going to give anything up in order to get that out of this?
This is on. Let me back up for those in the cheap seats and for those at home. Republicans control the Senate, the House, and the White House. They must have a plan to solve this, unless they are talking to us. I mean, if they aren't talking to us, then they must have a plan. They need Democratic votes in order to fund government. So it is on them to engage us, talk with us, show up to work, cancel your vacation, come to work, talk with us. We've been having these conversations. We've been pushing to engage since March, by the way, a CR that we didn't support as well. And we have been saying loudly that we have huge concerns from the rescissions that Donald Trump and his administration have executed to not spending resources that Democrats and Republicans have allocated. We have been telling our Republican colleagues for months these are concerns of ours. And we have told them, work with us, talk with us. And all we got were partisan bills because Speaker Johnson is just interested in being the chair of the Republican conference. He isn't interested, apparently, in being the Speaker of the House and passing things with 218 votes that can become law. That's what he could be focused on, but he's not. He is simply focused on doing what his conference wants, trying to keep them together. It's a shame because as a result, this is what we get. The Vice Chair said it. There were day one here, and it could have gone a different way, but that's not what House Republicans want.
Thanks, Mr. Chairman. You guys have over 200 Democrats in the House. You only lost one vote on this continuing resolution when the vote was on it. Yesterday, before the shutdown even started, Senate Democrats lost 3 votes. Are you worried that as this goes on, we could see a repeat of the CR earlier this year and Senate Democrats let it through?
It's a question for the Senate, but I will tell you, each of those senators who voted yes, all of them have said Republicans need to come to the table. Republicans need to negotiate. Republicans need to help avoid the healthcare crisis that they have created. Look, I understand the question, but there is unity in message and what we want that Republicans need to come to the table. Any one of those senators would agree, and many of the senators who voted no on the CR would say the same thing.
Thank you. In the past,
in shutdowns, we've seen both sides come together and pass certain measures that would fund military members so that they don't go without pay. I'm just wondering, is there any discussion yet? I know it's early in the shutdown, but is there any discussion about doing any supplemental pieces of legislation like that? And I guess part two, more broadly, Republicans will be back in the House next week. Is there any discussion yet about at least coming to the table and starting a negotiation?
Well, in order to come to the table, Republicans have to be here. They're not here. They're scattered across the country, across the world, maybe on some trips, on vacation. We're here ready to work, and that part's unfortunate. We want to avert the healthcare crisis that we know is coming. I appreciate you asking about possible legislation. The majority controls the floor. If Republicans want to put pieces of legislation on the floor, they can next week. We are saying, let's avoid this shutdown. Let's end this, and let's have conversations about what's necessary to fix this healthcare crisis that you've created. But we're not going to take pinky promises like Speaker Johnson hands out to his conference, giving them select committees and other things. Like his word doesn't mean much to House Democrats at this point, after backing away from a truly bipartisan CR in December. That's the floor, by the way, of what we need. Democrats and Republicans coming together, agreeing to a continuing resolution. For those of you new to this room, Republicans backed away from that deal, from that bipartisan agreement, when Elon Musk told them to, and then they had a smaller CR in March that we opposed. So that's the stakes of where we are. I don't control the floor. The vice chair and I don't control what comes to the floor. We'll handle that when Republicans notice it. But House Democrats stand ready and willing to engage and negotiate to end this shutdown if Republicans are serious about addressing the healthcare crisis that they've created.
All right, that was Representatives Pete Aguilar and Ted Lieu, representatives from the state of California, giving the Democratic side to the shutdown and their views on getting something done here. We heard from the Republicans earlier this morning, so it just seems like each side kind of casting some blame on the other side.
Digging their heels in.
Digging their heels in, and that suggests that maybe this is not going to be a short-term shutdown. Nathan Dean is still with us. He's senior policy analyst at Bloomberg Intelligence. Nathan, anything there from the Democrats that maybe moves the ball forward at all?
Yeah, so I took two things away from that press conference. The first is that, they're not talking. And I think that's somewhat anticipated. I mean, we're only on day one. And, like Representative Aguilar said, is the House Republicans aren't even in the city at the moment. They come back next week. So I think as they come back and they trickle into town, you're going to see, more discussions about potentially what is the off-ramp here. The other thing I just want to remind folks is that the House really doesn't matter in this debate. It's really the Senate. So it's great for the House Republicans and the House Democrats to say this is what they're going to do, but it comes down to 60 votes in the Senate. That is what is going to drive whatever is the resolution to the shutdown. And because two Democrats and an independent that caucuses with the Democrats have already voted to keep the government open, you're just searching for 5 Democrats to come on board in the Senate. So as we get into negotiations next week, look for Senator John Thune, look for Senator Schumer. And I hate to say this, but Speaker Mike Johnson and Representative Jeffries, they really don't matter as much. It's really comes down to the Senate and the president.
So Senator John Thune, how good of a deal maker is he?
So he's, ironically, he's a little bit earlier in terms of his majority leadership position, and he's taking the approach right now, and look, this is what we would anticipate for him, is just to say, look, the Republicans have done their job, the Democrats need to come to us. You hear the same thing from the Democrats, like in that presser that we just heard, the Democrats said, look, we're here to work, the Republicans need to come to us. They just need to get it out of their system, and they will eventually when the American populace begins to think that, shutdowns are not something that we like. So I think as Senator Thune and Senator Schumer come together next week, they are going to be able to negotiate. I think Senator Thune, even though personally I don't think he wants to extend the Obamacare subsidies, he recognizes that there is a portion of his party that does, and I think the president does as well. So I think there are going to be ways to negotiate. So I think once they get this out of their system, negotiations can begin in earnest. But I'll also just add that if the Office of Management and Budget does something to begin massive reductions in force, layoffs, or additional cancellation of projects, then they could push parties back into their shell and they will just refuse to work with each other.
All right, Nathan, Dean, really appreciate your staying on and giving us your perspective here after we heard from the House Democrats on this ongoing shutdown. It is, after all, day one, but
I like to send Nathan to the Senate.
yes, make some sense. Knock some sense into everyone's head.
Guys,
with empanadas.
With empanadas,
Yeah.
exactly.
Nathan, we just nominated you to kind of
Yes.
be mediator here for the government shutdown. I don't know if he's excited about that assignment, but in any case, let's take a look at the markets right now because the S&P 500 has basically gone nowhere. It's a little changed. I thought maybe, you know, with a little bit of a lift up, it might have made some more progress, but no, not doing a whole lot. And that's kind of the story here across equities. We do have movement in treasuries with yields coming down, treasuries higher across the board after a weaker than expected ADP report on jobs. So let's bring in our next guest. Shanna Sissel is founder and CEO at Barrion Capital Management to give us her take on these markets. And Shanna, how much do you read into the ADP report today that indicated the labor market seems to be weaker than what people had anticipated, and it's certainly kind of playing havoc with at least yields?
Well, we've definitely seen the non-farm payrolls. There's been adjustments month over month, typically adjusted down. And ADP, while it hasn't correlated as much with non-farm as it has in the past, the trends tend to follow each other. So I think this really touches on one of the areas of concern that the Fed had in their comments earlier this month, or earlier last month. It's October, I forgot. And just noting the softness in the labor markets is a key area of concern that the Fed has, and one of the reasons that they used to justify the rate cut that they made.
Shanna, this government shutdown, which we're day one of, this is not, the first time for most investors here. We've been down this road before. What's the conversation you have with your clients about these types of events here?
Well, I feel like it's a little boy who cried wolf. This seems to happen so often now that it doesn't necessarily scare people the way it once did. I do think that the Trump administration is the administration that has the longest government shutdown in recent history. And so that's an area to be concerned. But even in that case, it was only about a month. I think the bigger concern would be if it lasted longer, specifically because we're getting into the holidays and travel season and TSA and a lot of the government services associated with travel are affected by a shutdown. But I think this is more of a wait and see. There's a lot of big talk coming from both sides as they try to speak to their base and put on a tough front. But ultimately, no one wants to be the administration or the Congress that has the longest government shutdown on their resume. So it's really wait and see. I'm not sure people are overly concerned at this point. Talk to me in a week, I might have a different answer.
Yeah, absolutely. We're looking at a stock market that is still near its record highs, although that momentum seems to have slowed down quite a bit. The S&P 500 at 6694. This is a record high, as I mentioned, but we're bumping along that top that we reached in late September. Shana, I've been mispronouncing your name, so I apologize for that. How do you see this moving forward in terms of catalysts for further upside? Because we're pretty toppy right now. Even Jay Powell, the Fed chair, called stock prices fairly highly valued.
Well, first and foremost, don't apologize for mispronouncing my name because everybody does it. So you are not the first.
Still, no excuses.
But second of all, I think it makes sense. There's really no fundamental reason to break through these highs. There is concern for the economy, as we've already pointed out. There's softness in the labor market. Inflation is elevated from where it was a year ago. The Fed is concerned about economic softness and economic weakness. So it's hard to really make a case that the market should be blowing through these highs and maintaining the momentum it did. So at this point, I myself am one of the people who believes that we will see volatility. And I don't know that we will, be reaching significant new highs by year end. I think it's more likely we'll be bouncing around, especially as we have some of this, non-economic impacts of, fiscal policy that do secondarily end up impacting the economy, which is already weakening. And these are the types of things that can kind of set things off in a bad direction if they're not addressed quickly.
Shana, before we let you go, I know you spend a lot of time talking to clients about alternative investments, including commodities. What do you make of this huge run-up in gold?
Yeah, so it's interesting. We've seen kind of the gold and the crypto moves kind of complementing each other, but I think the movement in gold is really a concern about monetary policy. It's a concern about, the unknown. It's a concern about all of the crazy news that tends to come out of the administration, how that impacts broader markets, tariffs, things of that nature. There's just so much uncertainty, and gold is kind of a safe haven when you aren't quite sure what's going to happen and you're really concerned about a black swan type event. You kind of go to these safe places, and gold is one of those places. You also mentioned that we're seeing, yields move lower in treasuries. That would also indicate kind of that same flight to safety. And it's interesting because there's kind of two ends of this market. There's the flight to safety market where you're seeing a lot of this safe assets kind of get a lot of momentum and a rally, but you're also seeing some of the risk assets do it. There's not really anywhere in between, which kind of speaks to how investors are confused and which direction they want to be, and people are kind of on both sides, and there's no clear direction that we're seeing the crowd move.
Yeah, and crypto kind of fulfills the bucket for both, right? For some people it's risk, for other people it's safety, and for
exactly
a small slice of the population it's the only thing.
Exactly.
All right, Shana Sissel, thank you so much for joining us. Shana Sissel is president and CEO of Banrion Capital Management. All right, let's get a market check right now and check in with our John Tucker.
All right, we're actually higher right now, or lower earlier, then turned mixed, and now in the green. This Bloomberg Business Flash, Scarlett, being brought to you by Oracle. Attention, growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. As I say, the major stock averages are higher right now. The S&P 500 up just at 4 points, but still in the green. You have 5 of the 11 major industry groups in the index. They're up right now, and you have healthcare in the lead. And at the bottom of the group, communications services. That's still the worst performer. Among the standouts, Lithium America. Never even heard of this stock. But the government taking a stake in it because they produce lithium, and they do it in Nevada. Right now, the share's up 25%. As Michelle Weaver at Morgan Stanley, meantime, she sees a relatively positive backdrop for U.S. stocks.
You've had a really sharp V-shaped recovery in earnings revisions breadth. So analysts broadly are becoming more constructive on the earnings picture within the market, and we think that that is a pretty good sign that we're now entering that recovery phase.
And private sector payrolls decreasing 32,000 by 32,000 after a revised 3,000 decline a month earlier. This is according to the data that we got out today. That's from the private payrolls company, ADP Research in Roseland, New Jersey. The figure well below all the estimates in a Bloomberg survey of economists. Peloton, Paul, they've overhauled their hardware lineup and also raised their prices. So the new products announced today include updated versions of the Bike and Bike Plus, Tread and Tread Plus, and they're replacing the Row with Row Plus. They're going to replace John Tucker with John Tucker Plus at some point.
Are they a streaming company now? Everything's a plus?
Yeah, exactly. We have the Bike, we have the Tread. We're good.
Okay.
You don't need the plus version? Come on.
No, and we're no longer in the big old house. Now we're in we've downsized.
Okay, well, there you go.
So
There's
no
the poll
thank you
update.
from Paul.
Yeah.
We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Another IPO priced here. Neptune Flood Insurance, NP is the ticker. And joining us from the New York Stock Exchange floors, Trevor Burgess. He's the CEO. Trevor, thanks so much for joining us here. Congratulations on the IPO. It's priced at $20. I'm looking at the Bloomberg terminal now. We got a bid of 22.5 and the ask of 22.75. So maybe they'll finally get this thing opened. If I were running your deal, Trevor, I would have had this open at 10:30, no later. Trevor, talk to us about your business model. Flood insurance, you guys have exposure to Florida. Nobody provides insurance in Florida. What's your business model?
Yeah, so Neptune is an artificial intelligence company that does a really good job at underwriting flood risk for global insurance and reinsurance companies. So we don't actually take the risk. We build technology that does a really good job at analyzing that risk and making sure it's something that the global insurance markets want to take on, which makes us the largest competitor to the National Flood Insurance Program, which is the federal government's program, which was the only way to buy flood insurance for a long time until Neptune came along. Happens to be that the government's closed today, so Neptune is the only game in town right now, which is exciting for us, obviously, because we want to help those 1,300 consumers who are trying to buy their house today and who need flood insurance. We're the solution.
So, Trevor, let me ask you, there's been a lot of complaints about the federal flood insurance program. What is broken with it? Why is it something that people are not on board with or people can't get when they need?
Well, there are a couple of ways to look at the NFIP's problems, but the biggest one is that they've lost nearly $40 billion in their history. They're paying millions of dollars a day in debt payments to the U.S. Treasury. So it's just an unsustainable program. And it doesn't offer a product that consumers want. They only go up to $250,000 of coverage on your house. Neptune offers up to $7 million of coverage. We'll also cover your Airbnb or your hotel if you're flooded out of your room. If you are with the NFIP, you're just out of luck. If you have a flooding, there's no money for that hotel.
So who are your clients, Trevor? Are they the insurance companies and reinsurers themselves?
We get to have two clients. We serve those global insurers and reinsurers who are looking to put money to work in the flood insurance space. And importantly, our customer is the American homeowner and business owner. We provide residential and commercial policies to protect your home. We compete with the NFIP every day that they're open. Today, they happen to be closed.
Fair enough, fair enough. In terms of which states are most affected, Paul mentioned obviously Florida, but is there, I mean, floods seem to happen. Yes, floods seem to happen to every state, including those that are inland. Is there any area in the country that is, more relatively shielded from flood risk?
Not really. If it can rain where you live, then it can flood. And we saw that in the month of July. There were major floods in 23 states in this nation. That means that everyone is really at risk and needs to have flood insurance. But unfortunately, because of the government's program, only 4% of Americans have coverage today. Neptune is trying to change that. We want to get many, many more Americans protected from this most dangerous peril. You've seen these hurricanes when they hit, the tragic flooding that took place in North Carolina and in Texas recently. Neptune is here to make sure all of those homes are protected.
Trevor, is flooding, is that a risk that is going up in frequency and in damage? And if so, why is that happening?
It's happening, the answer is yes, and it's happening because the climate is changing. It's undeniable that the sea level in Key West, Florida is nearly a foot higher than when I was born. The temperature in the Gulf and in the Atlantic is warmer than it was 10 years ago. That added heat is energy, and that leads to more frequent and severe storms.
So what's the growth story for Neptune? Is it more markets? Is it more policies? Is it driving rates higher? How are you guys pulling those levers?
The growth story for Neptune is helping educate the American consumer that their homeowner's policy does not cover the risk of flooding and that they need to buy a separate policy to protect their most valuable asset. If we can just help educate people on that fact, Neptune's going to do a great job at growing.
We should mention that Neptune is going public after a bunch of specialty insurance companies have gone public this year. Accelerant Holdings, Aspen Insurance, American Integrity Insurance, Slide Insurance. What do you think it is about the current environment that makes it so welcoming for insurance companies to tap the public market?
It's nice to have the market open, and it's nice that pricing in insurance makes sense. We want to make sure that consumer is finding value, that the agent is doing well, that Neptune's making money, and it's sustainable for the global insurance and reinsurance community. I think we have some good equilibrium in the industry right now, and that's why you're seeing so many companies come to market.
Trevor, thanks so much for joining us. Really appreciate it. I know it's a busy day for you. Trevor Burgess, he's the CEO of Neptune. Ticker is NP, and as in Nancy, P as in Paul, going public today in the New York Stock Exchange. The company priced their deal at $20 per share. Indications 22.5 to 22.75.
And according to our reporting, it was more than 20 times oversubscribed as well. And this has been a trend lately with the companies that have gone public, the over allocation and the oversubscription, I should say, to all these new issuances. It may be enough to make up for a pretty sluggish first half of the year.
Yeah, absolutely. We've seen a strong IPO market post Labor Day, and I notice how Mr. Burgess is very good in positioning his company. To my first question is, we're an AI company. That happens to be in the insurance industry. So
that means high valuations.
Well coached by their investment bankers there. So we'll see how that trades. We got a little bit of green on the screen here across the board. So a little bit of a turnaround from where we saw it earlier, and plus in the futures market. With the S&P up about 7 points, Dow up 117, and the NASDAQ up 17 points as well. We're going to have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, we talk a lot about AI, and we're going to talk about the powering of AI coming up now. Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Again, we've been talking a lot about AI, so has everybody in the marketplace, really for the last 2 or 3 years, and now you've been looking for derivative plays, and a lot of the derivative plays have focused on who's going to power all these data centers, and that focuses on energy, fossil fuel energy, new energy, and even including nuclear energy. So everything seems to be on the table as these data center providers think about how they're actually going to power this stuff going forward. Scott Levine joins us. He looks at the energy business for Bloomberg Intelligence. He put together a global team and put out a huge report here and a really good report on nuclear power 2026 outlook. He's saying AI-driven power demand is set to spark $350 billion build cycle. Scott, thanks so much for joining us here. I love the big round numbers here. Talk to us about, from an energy perspective, what the industry's doing to kind of prepare for what seems to be this insatiable demand for power.
Yeah, so nuclear really has two very big positives going for it. Number one, it's a emissions-free power source, and the hyperscalers that are really behind the investments care about that deeply, right? And so they've favored more renewable sources heretofore, like wind and solar. But what those lack are, 24/7 baseload characteristics. And for a data center to be up 24/7, that's not going to do it, right? Okay. So nuclear checks both of those boxes, and those are two very big positives, and the reasons that you're seeing folks like Microsoft and Meta come out in favor of nuclear power. And yeah.
So how much does nuclear provide today in the U.S. versus where you think it might be in 25 years?
Yeah, so today it's a little bit below 20% of the grid, okay. Which we're saying will return to about, in our base case scenario, 20% of the grid by 2050. That may not seem like much, 2 percentage points, right? But it will equate to or amount to a $350 billion investment to get there. So those are big numbers. And in addition to that, we're talking about adding 60 some odd gigawatts to the grid. And you can think about each full-size nuke being 1 gigawatt. So that's basically building 60 generating units as our base case. So those are big numbers to get you from 18 to 20% over a 25-year period of time.
I tell you, I went in this report that you and your team put together, Section 5, small modular reactors. That's where I wanted to go to, because we've had some people come into the studio over the last few years and just talk to us about the science and the engineering and the possibilities of these small modular reactors. Tell us what they are and what role they could play going forward.
Yeah, so really these are, and none of these have been built in the U.S. yet, right? So this is very much an emerging technology play. But basically what you're talking about is taking a full-size nuke, you're driving down the highway, you see a big cooling tower, bunch of smoke coming out the top of it. These are much, much smaller, right? And so the idea here would be that these are much more flexible. And so if you have more disparate data centers located throughout the country, you can power these ostensibly with these smaller units, right? And we're talking about, some of these are smaller versions of what's already in operation today, which is a light water reactor. And then some of these types of units are different types of technologies. You have gas-cooled reactors as opposed to water. You have molten salt-cooled reactors as opposed to water. And these use different types of technologies, different types of fuels, still remain to be licensed and proven. So a lot of it's very much on the come. But the technology in each of those areas holds promise. So we'll see, and each of them has pros and cons, right? And so we'll see over the next 5 years the technology shake out and see which ones end up being at the top of the stack for the U.S. But each of them have a lot of money behind them and a lot of support from a lot of deep-pocketed players.
Talk to us about this Trump administration. What is its view on nuclear fuel as an option?
Okay, so firstly, very positive. They came out with a bunch of executive orders in May where they have clear support. They're trying to streamline the licensing process. So these things they basically want to see 10 reactors in construction by 2030.
Okay, wow.
Okay, so yeah, and that's 5 years from now. It seems like a long time, but in nuclear world where it takes 10, even 15 years to build a reactor, which is what it took to build the only reactor that's been built in the U.S. in the last 30 years, took 15 years to build. That is not that long a period of time.
Yep. All right, folks, listen, I don't know what your politics are or how you think about it, but as I talk to these experts here, it just feels like from an energy sourcing perspective, everything's got to be on the table. If you listen to some of the experts talk to us about the need for energy going forward, it just feels like everything needs to be on the table for discussion, including nuclear power. And that's why this report from Bloomberg Intelligence is really, really prescient and really detailed, and provides, I think, a really good understanding of what the opportunity is from an investment perspective. So check it out on the Bloomberg terminal, BIGO, and that's where you find all this great research. Scott Levine driving the team there at Bloomberg Intelligence. We appreciate that. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. And stay with us. Your top stories and global business headlines are coming up in just a moment. Got a little bit of green on the screen here. S&P 500 up 7 points, the Dow up 82 points, and the NASDAQ up about 30 points. All of that's about 1/10 of 1%. We did get that ADP data weaker than expected this morning. That's causing yields to come in a little bit here, particularly on the short end. The 2 years down 5 basis points, 3.55%. You look at the 10-year, which is kind of where the mortgage watchers are always paying attention. That's off about 3 basis points, 4.11%. And gold higher yet again. For Scarlett Fu, I'm Paul Sweeney. This is the Bloomberg Intelligence Program. More coming up. This is Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. The federal government is shut down, and Maryland's Democratic Governor Wes Moore blames President Trump.
The chief executive of this country has a simple responsibility: to run a functioning government, not to shut it down.
Senate Republican leader John Thune.
This could have been avoided. It's totally unavoidable. And everybody's now asking the question, how does this end? Well, it ends when the Senate Democrats pick this bill up, passed by the House of Representatives, and vote for it.
Hundreds of thousands of federal workers have been furloughed or will be in the days ahead.
This Army vet lives near Robins Air Force Base in Georgia and says the shutdown is attached to politics, but lawmakers need to remember.
It's hard to take serious one side fighting against the next side. These are real things in the lives of people.
In New Orleans, Terrence Johns works for the USDA, where some 42,000 workers are now on furlough, and says it's hard.
Make ends meet while having to expend the cost of driving to work every day.
Allison Keyes, CBS News.
Some workers are on the job and won't be paid. The TSA and air traffic controllers are examples of that. Mail deliveries will continue. The nation's highest court says Lisa Cook can keep her job as a Federal Reserve governor, at least for now.
The Supreme Court says it won't act now on the Trump administration's efforts to fire her immediately, and instead will wait until January to hear arguments. Then it will decide if there's legal cause to take her off the job. The president claims she committed mortgage fraud. Cook denies any wrongdoing.
That's CBS's Stacey Lynn in Washington. Now to New York City, where an incinerator shaft in a 20-story high-rise apartment building in the Bronx collapsed.
We just heard a boom. It sounded like a bomb. And then we just ran out the building. I'm like, I can't believe this.
There are reports a gas explosion may be to blame. Officials say there is no immediate word on any injuries. Correspondent Jim Krasula has details now on a product recall.
More than 320,000 even-flow car seats are being recalled after the Boston-based company discovered material from the headrests could result in a choking hazard. Federal officials found that pieces of foam in the headrest of certain even-flow Gold Revolve 360 Slim and Revolve 360 Slim can be accessible to a child and can increase the risk of injury.
Walmart says it plans to remove synthetic dyes and 30 other food additives from its store brands sold in this country by January 2027. It could affect about 1,000 products, from snacks to baked goods, power drinks, salad dressings, and frosting. The Dow is up 72 points. This is CBS News. Inflation may be taking a toll on the dating world.
A survey by the Kinsey Institute finds prices are so high, Gen Z and millennial singles are giving up on romance because it's too expensive. 43% say they're going on fewer dates. 37% say they're cutting back. With bar and restaurant prices soaring, drinks setting you back $15 or more these days, more than a third of young people blame the economy. Those who are coupled up aren't wasting time. Almost 1 in 4 say they're rushing their relationships and moving in together to save money, splitting the rent, groceries, and utilities. Deborah Rodriguez, CBS News.
Georgia police say Tyrese Gibson failed to turn himself in late last week after an arrest warrant was issued for cruelty to animals. The warrant was issued to the Fast and Furious actor after his 4 dogs mauled and killed a neighbor's dog. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The fourth quarter begins with a shutdown. Welcome to the Wednesday edition as federal funding lapses after a series of failed attempts to pass a short-term fix last night. And yes, here we are. Washington is now asking, how long will this last? Coming up, we're going to get the latest live from Capitol Hill and an update from Jonathan Tamari, who covers Congress at Bloomberg Government, with analysis ahead from our political panel, Bloomberg Politics contributor and Republican strategist Rick Davis here alongside Democratic strategist Megan Hayes. And later, we'll focus on the shutdown's impact, specifically on the Pentagon, when we spend time with retired Marine Corps General Arnold Punaro. It's all after a look at Wall Street. Let's see if the market cares about the shutdown. Day one, and Alexis Christoforous has Wall Street live from World Headquarters in New York.
Joe, thanks very much. The market right now shrugging off the first government shutdown in nearly 7 years. Most investors betting that this shutdown is going to be short-lived. The Dow Jones Industrial Average up 72 points. Broader market higher as well, with the S&P gaining 7, the NASDAQ Composite up 36. Yields are down. The 10-year yield 4.11%, 2-year at 3.5%. New day, new record for gold at $38.62 the ounce. Stuart Kaiser is head of U.S. equity trading strategy at Citigroup Global Markets. He was a guest on Bloomberg Open Interest.
From our perspective, for this to be really impactful for equity markets, you're going to need to see it last for a while. You're going to see, pretty large layoffs, or you're going to need to see something happen in the bond market to kind of spill over into the equity market. None of those are base case, but I think those are the required type of things you'll need to do to really impact equities.
Citigroup's Stuart Kaiser. The government shutdown threatens a blackout in crucial economic reports, including this Friday's monthly jobs report, data the Federal Reserve needs to make its decisions. And that's putting extra attention on today's ADP payrolls report, which shows private companies unexpectedly shed 32,000 jobs last month, reinforcing expectations for 2 more rate cuts from the Fed this year. Packaged food company ConAgra reporting quarterly profits that beat estimates, also reaffirming its guidance for the fiscal year. But the maker of Slim Jim jerky and Bird's Eye frozen foods warning inflation and tariffs are pushing up costs slightly higher than expected. Right now, shares of ConAgra up 3.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash. Back over to Joe Matthew now and Balance of Power.
All right, Alexis, thanks for that. We'll get back to Alexis Christoforous for more on the markets in about 15 minutes' time as we connect the dots here between Washington and Wall Street. And there isn't too much of a connection today, as we've heard repeatedly from economists and from political strategists on this program, those who are sensitive to matters involving the economy. This isn't really a market story. It could become one. Just depends how long this goes on. The lack of a jobs report, I'll give you that one. That is a strange moment that the markets might have trouble dealing with as we all zero in on the ADP today. But hey, this is it. Welcome to Wednesday, shutdown day, the Wednesday edition of Balance of Power on Bloomberg Radio. We're always on satellite radio, channel 121 if you have Sirius XM, and you can watch us on YouTube by searching Bloomberg Business News Live. We see you as well on Bloomberg Originals. Over the course of the next 2 hours, we're going to try to make sense of what the heck happened last night. We were up there live in the Senate. If you were with us on the late edition of Balance of Power, we spoke with Democrats and Republicans, including some senior members of both parties in the Senate, and the anger was palpable as things prepared to shut down. We got, of course, through the Democratic vote. It failed. Republican vote. It failed. And now there are great questions about off-ramps And what's going to happen next? This could be another record setter. I feel like my old job in the local radio news business would do holiday coverage. You got to tell everybody what's closed and what's open. It's kind of like that here because a lot of people, 750,000 federal workers are being furloughed right now. That includes, by the way, the majority of the 16,000 employees of the National Park Service. But the national parks are going to stay open, they tell us, at least with a skeleton crew. And the Smithsonian museums will be open, well, at least until Monday. It's going to be up to the administration. We don't know a lot more than that. It'll be up to the administration and Russ Vought as more time goes on to decide exactly what is funded and what is not. We did hear from the speaker today. Mike Johnson was watching all of this unfold in the Senate last night. He says his members are coming back just next week. Here's Speaker Mike Johnson.
The House will be returning next week. Here's the simple fact. There isn't anything we can do to make this bill any better for them. We literally did not put one single partisan provision in the bill. There's no policy writers, there's no gimmicks and no tricks.
Jonathan Tamari has covered a couple of these. Bloomberg Government's senior Congress reporter joins us now from Capitol Hill. Jonathan, it's great to see you. What's happening today? We're going to get a couple more votes on the same bills that will fail again?
Yep, they're unfolding right now as we speak, in fact, and we don't expect any change in the outcome. They're both going to fail. They failed a couple weeks ago. They failed yesterday. They're going to fail again today. I think one of the questions might be, do they fail a little better? Is there one or two more Democrats who cross over and support the Republican bill? There were 3 last night, and so that is the question, is how long do some of the more moderate Democrats hold out? Do they still, embrace this shutdown, or do they cross over and maybe undercut some of their party's leverage in doing so?
John Fetterman was the first, right? And he did so on the CR vote a couple of weeks ago. But you mentioned the 3. Angus King got on board, independent, who caucuses with the Democrats, and then Senator Catherine Cortez Masto. Who are you watching? I keep hearing Jeanne Shaheen, who is apparently in the midst, by the way, of working out a deal on Obamacare tax credits. What's going on in the background here, Jonathan?
Yeah, she's definitely a person to watch. She seems very uncomfortable with this idea of a shutdown. She's on the Appropriations Committee. That, she tends to be a little bit more of a traditionalist, wants to respect the appropriations process that Congress usually goes through. And so she is someone to watch as far as another Democrat who might cross over, who might try to cut a deal. The issue is Republicans are telling us, we're not talking about a deal, we're not working out a deal until the government is back open. They're saying that has to come first, and then they'll work on a deal about these ACA subsidies. So we'll have to see if any deal is possible until enough Democrats do support this bill and reopen the government.
Why is the House even coming back next week if this remains a Senate matter? They're not going to redo this in the House, are they?
Not necessarily, but I do think there's maybe some optics here where Democrats are saying, hey, look, we're here, we're ready to negotiate. Hakeem Jeffries accuses Republicans of being on vacation, in his words. So I think there's maybe a bit of an image thing here that all these federal workers are getting furloughed and Republicans are off in their districts, not here in Washington doing the work or negotiating. Not that there's probably going to be a lot of negotiating happening immediately.
Well, that's right. And so the burden remains on the Senate, and maybe more specifically, Chuck Schumer. Here's the Democratic leader from early today after those bills failed last night.
He is using the American people as pawns, threatening pain on the country as blackmail. Well, that's not going to work. The American people, it's so easy to see through those tactics. They know this is the Trump shutdown. They know Republicans control the presidency, the Senate, and the House. And what is done during a shutdown will fall squarely on the Republicans' back.
Well, let's talk about what's going to be done during the shutdown. Mike Johnson just now on CNN, Jonathan Tamari says OMB, this is the administration, management and budget, has to decide on essential government services. So we're going to get some paper, I presume, from Russ Vought and from the White House on what is essential, what is not, and who is, in fact, going to be laid off here. We've got the furloughs I mentioned, 750,000 workers today. President Trump said yesterday some of this could be permanent, irreversible. What do lawmakers expect?
Yeah, I mean, they expect Trump to, as he has throughout his term, grab as much power as he possibly can within the limits of the law and possibly pushing the boundaries of the law. And in a shutdown, the White House does have, extraordinary authority to decide what is essential, what is not essential. There's not a lot of strict guidelines around that. So there is a world where they say, well, you know what, the programs that Democrats like, those things are not essential. They're going to go away. The things Republicans like, those are essential. They're going to continue in operation and really apply a lot of pressure to Democrats. Republicans are expecting that. They expect that to be a pressure point on Chuck Schumer, on Senate Democrats. We don't have a lot of detail yet, but I think as it comes out, we've seen this White House play every lever to its advantage, and I don't think there's any reason to think they wouldn't do that this time around.
Boy, so what's your gut check? Jonathan, you know these guys as well as anybody, and you know the dynamics here with a promise of mass layoffs from an administration that some think wants to see this shutdown go on a while, and of course, a number of Democrats who say they won't be fooled again. Are we going to set a new record here, or will this feel different in 3 or 4 days?
I don't think it's going to be a record. That the record is around 35 days, and that was in a situation where part of the government was funded, so it wasn't an entire shutdown, and it happened over a holiday, and it was even during a period where the members of Congress changed during that time because one term ended and another term began. So I don't think we're going to get there, but I also don't think this is going to be resolved today, tomorrow, Friday. I think we're at least going into this weekend, possibly into next week. Democrats are really, despite all this other pressure we just talked about from the one side of the White House, laying people off and cutting programs, Democrats have a lot of pressure from their base to show that they have some backbone, some fight, that there's some point to them here in Washington. And, there was a poll out yesterday about approval of congressional leaders, and the Democratic disapproval was the highest that had ever been measured by the Pew Research Institute, who did this poll. And so that kind of shows you that they have a lot to do to win back their own voters. And so I think they do have to put up a fight, and that it's going to be a little bit of a time before Democrats, even if they do cave, feel politically comfortable doing that.
Yeah. Well, you framed that perfectly, Jonathan. In our remaining moment, what does caving look like? If Democrats get a promise from leadership, if there's a deal or a handshake or whatever between Chuck Schumer and John Thune to say, okay, you vote yes, you give me your 5 or 6 votes that we need, and we promise you that we will have a debate on legislation to extend the Obamacare tax credits. Is that enough to get the government back open?
So Chuck Schumer has been very careful not to, lay out a specific demand, a specific line that would get him there. I don't know that's going to satisfy people because a debate in the Senate doesn't tell you anything about what's going to happen in the House or even in the Senate for that sake. I think Democrats might feel like they can still win even with a loss if they can bring this issue to the forefront, use this shutdown to talk about health care and talk about premium increases, and then if those premium increases happen, they could say, hey, remember that shutdown? We were the ones who were fighting to try to block that. Look what happened. So I don't think they're going to get what they want, but they might get a political message out of it.
Fascinating. We'll meet you at the midterms. Jonathan, great to have you back. It's been too long. It takes a shutdown to get Tamari back on the air. He's the senior Congress reporter at Bloomberg Government. Great to have Jonathan Tamari back with us. We're going to zero in specifically on the Department of Defense, what the president calls the Department of War, coming up next. Because a shutdown, in the eyes of many, will affect military readiness. General Arnold Panaro up next.
It's 12:21 on Wall Street. I'm Alexis Christoforous. Stocks squeezing out some modest gains after the U.S. government entered its first shutdown in 7 years, putting hundreds of thousands of jobs and billions of dollars in output at risk. The Dow is up 23 points. The S&P 500 adding 4. The NASDAQ Composite up 29. Yields are lower right now. The 10-year yield is at 4.12%. The yield on the 2-year at 3.5%. And gold at yet another record high. Key ADP jobs data showing private payrolls declined in September, widely missing estimates and increasing the odds for 2 more rate cuts from the Fed. In stock news, strong egg sales at Cal-Maine, not enough to impress investors. Quarterly profits missed estimates at the food company. Cal-Maine now doubling down on prepared foods, investing nearly $15 million in a high-speed pancake production line. Shares of Cal-Maine down 3.5%. U.S. Energy Secretary Chris Wright telling Bloomberg News the U.S. government will take a 5% stake in both Canada's Lithium America and its Nevada mining project. Shares of Lithium Americas up 28%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's a Bloomberg Business Flash.
Alexis, thank you. I'm Joe Matthew in Washington, and welcome to the Wednesday edition. If you're just joining us, of Balance of Power. Yeah, it's only Wednesday. Seemed like yesterday was a couple of days in one. But it is the first day of the shutdown. Here we are. We saw it coming literally months ago. In fact, started talking about this back in March, the last time Chuck Schumer, quote unquote, caved and was shamed by many progressives. The seeds were planted for this moment many months ago. The question is, how do we get out of it? Where are the off-ramps, if they exist? Remembering, of course, and we just talked about this with Jonathan Tamari, the first Trump administration saw a record shutdown. That was 35 days, but that was a so-called partial shutdown, and there were some other outside factors that led that to happen. Terry Haynes at Pangea Policy, who we follow very closely here in Washington, in his latest note to clients, unpacks the whole thing. 5 reasons why this shutdown very likely won't last long. Leave it to Terry to find the silver linings here. Number 1, Schumer's Senate group already is not unified and is fraying. Remember, we got 3 last night that voted along with this. 2, pressure will continue to build on Senate Democrats as the fate of public employees rapidly concentrates their minds, thanks to Trump's threats to terminate many of them. Remember, 750,000 furloughs today could become layoffs. 3, Ds are susceptible to pressure on government data. Oh, that's right, the BLS. Not kicking out the jobs report on Friday. Markets nervous. 4, once the Democrats' resistance political point is made the next days for the party's respective voter bases, major donors, pressure points today signal a resolution to allow negotiations on Obamacare premiums. And 5, remember, continuing government funding at current levels is in itself a Democratic win. We'll see about that, because they're counting the days right now at the Pentagon. And if you think that we're going to be able to pay our troops indefinitely here, you might be disappointed with what we're about to hear from Arnold Pinaro. The retired Marine Corps general is with us now, former staff director of the Senate Armed Services Committee, with his view on what's happening here in a world of perpetual CRs and now a shutdown. General, it's great to have you back. I saw the statement that you kicked out earlier this week, and you're concerned with readiness. We've had a lot of politicians on last couple of days, and everybody's playing a blame game right now, but I want to get to the matter at hand with you, because you're talking about troops deployed in harm's way do not receive their pay. Civilians performing critical defense functions are furloughed or required, again, to work without compensation. And importantly, we never think about this or talk about it, at least the small businesses that sustain our defense industrial base face immediate financial strain. How long can this go on, General, before it does impact our readiness?
Well, Joe, it's impacting our readiness right now today. There's nothing positive about a government shutdown, particularly as it relates to national security, especially when there's no clear path to a resolution, as Jonathan clearly outlined, and it was totally avoidable. The troops in harm's way, many of them in very dangerous places. We live in a world more dangerous and uncertain than the peak of the Cold War. They're not being paid, and their families, just like average Americans, they need their paychecks. We've already sent home over 300,000 defense civilians on furlough as part of that larger number. A number of tens of thousands are having to remain on the job for safety and security, but they aren't being paid either. Cutting edge equipment that's coming off our production lines that need to go to the hands of our warfighters are being parked in the parking lots because the defense civilians that have to be there to accept them on behalf of the government aren't working. And again, the more important thing, small businesses that are the backbone of our supply chain. They're the backbone of the supply chain if you're building a manned fighter or a submarine or just about any other thing. They are being sent home and shuttered, and they will never get back pay, unlike the troops and the civilians if the government ever reopens. But the small businesses, many of them will be put out of business. Necessary training. The fathers and mothers give us their sons and daughters to serve in the military, expecting them to be well-led, well-equipped, and well-trained. But we're not doing the training right now, and you have to do constant and realistic training in the world that we live in. And frankly, the sad thing about this, it was totally unavoidable. We've started the last 25 years with a continuing resolution in the first quarter to give the Congress more time to work out compromises. I really feel like the Democratic leadership has picked the wrong fight. They're shooting on the wrong target, and their bullets are hurting real people just to send a message to their base. Very unfortunate. It is hurting military readiness today.
I was in the Senate last evening, General. I was talking with Senator Eric Schmidt about the fact that troops in harm's way, men and women in uniform, would not be getting paid. And he stopped me in my tracks and said, we're working on something here to tap the $150 billion, I think it was, that was in the president's big, beautiful bill to try to cover their paychecks in the meantime. You're pointing out that that money has a very different and very important purpose.
Look, I'm for the troops getting paid, and as a commanding general of a Marine division, when my troops weren't being paid, I raised unshirted cane. But that reconciliation bill is for modernization and investment. If you start spending it on payroll, you're going to blow a lot of money. Our defense payrolls for our military and our civilians are quite large, and that is not the purpose of what was put in the reconciliation. God bless him, Navy SEAL, and his thinking, but that is not the purpose of that money, and it should not be used for that. Furthermore, it takes all the pressure off of the Democratic leadership if all of a sudden there's no harm being done. I hate to say it that way, but that's just the cold, hard facts of life. We need the Golden Dome. We need to, modernize our Navy. We need to modernize. The Air Force has the oldest fighters and fewer fighters than we've ever had. The Army is 50% smaller than the peak of the Cold War. That money is designed for modernization investment, not for payrolls.
What happens to procurement in a time like this? Is that a longer-term process with monies allocated so it's not impacted by a shutdown, or is this at risk as well?
Well, it's up to the individual contracts. Typically, the Department of Defense does not like to shut down the big production lines because it would be so expensive and so hard to start them back up again. And many of them are funded. And so if there's a contract that's funded, if OMB allows it, they have the discretion to continue that. So typically, they have not shut down the big production lines. But unfortunately, like I mentioned, they shut down the small businesses that are the heart and soul. The small businesses that do forgings and castings. You can't build a fighter without forgings and castings. So even though maybe the big production line of one of the large primes can continue, it's not necessarily true that the small business supply chain is going to be there when they need the part.
Well, that gets back to what you said about these small businesses that sustain the defense industrial base. People are familiar with the Lockheeds and the RTXs and the Northrop Grummans, General. How small are some of these businesses, and what services do they provide?
Well, there are two kinds. They provide a lot of the equipment in specialty technical equipment, microelectronics, things that go into our large production platforms at the big primes. The big primes can manage cash flow. Small businesses don't have spare cash. They can't keep people on the payroll when they're not being paid. And so they either have to send them home on administrative leave. But tens of thousands of small businesses, both in terms of services to the Department of Defense, running the call centers, running the health business, running the IT services, doing the kind of equipment, building the equipment that we need in our supply chain. If you look at some of the major backlogs that we have on our large items of equipment, it's basically because the small businesses in the supply chain have not been able to keep up with demand. This is just going to make it a lot worse. And again, these companies never get repaid. So this is not an issue where, okay, we're going to open the government back up and we're going to send them all that back pay. There is no back pay when they don't do the work. The government worker and the military, sooner or later, those that are allowed to come back on the civilian side, like you said, many could be laid off under this circumstance because they want to reduce the size of government. But the small businesses never get paid.
Well, that's right. And boy, that goes for a lot of them around here related to the defense industry and otherwise. General, if you live in Washington, D.C., this is a big-time local economic story for a lot of small business owners. I want to ask you, General, because I don't always get a chance to talk with you about what happened yesterday at Quantico, and I suspect that you were watching pretty closely at a very important point of geography for the Marine Corps, Officer Training School. And Pete Hegseth,
yeah, well, I spent,
in what almost looked like a TED Talk,
when
General.
I got back from Vietnam, was stationed at Quantico training second lieutenants going to Vietnam.
Sure that's right.
I call what happened yesterday a fairly traditional thing we call commander's intent. When I took over the commanding general of 4th Marine Division, I called in all my regimental commanders, battalion commanders, senior enlisted, got them all in one room at one time and said, okay, this is what we need to do in the 4th Division. We need to increase the warfighting readiness of the division. That's going to be our mission. Here's how you're going to do it. So it's called commander's intent. So it didn't bother me that the top civilian leader in the Pentagon would call them in to make sure they basically get everybody on the same sheet of music. And I'll be honest,
What'd you think of his tone
I had the same
and his
reaction
message?
as Senator Dan Sullivan, a fellow Marine. The standards of rigorous physical training, appearance, proficiency in your military skills, realistic and tough training, these are in the DNA of the United States Marine Corps. So I didn't find anything, to be concerned about in that area.
I think it was the tone, the idea of the young man walking in and telling the elders with more experience how to do their jobs. Did you appreciate the way the message was delivered?
I'm not an expert on that, but look, we have civilian control of the military. We have elections in this country. The two top civilians in the chain of command to the warfighting commands is a legislation that I helped write in 1986 when we reformed Goldwater-Nichols laws. And so basically, if it's a legal order, our military understands that they're going to follow the legal orders of the chain of command. And so, we've had a lot of different people serve as Secretary of Defense over the years. We've had a lot of people serve in the White House over the years. And so our military gets used to different personalities. I'm not going to comment on the tone. I think we need to focus on the 10 directives. And frankly, I didn't have a lot that I was concerned about in any of the things that he rolled out. We should make promotions strictly on the merits. We need people to basically be able to be proficient in their military occupational skills. All of those things have been fundamental to the department, now the Department of the War, they call it, for all the years that I served in uniform. So to me, I think it was very appropriate to make sure get everybody on the same sheet.
Well, as I said yesterday, General, I need to start doing my sit-ups or I'm not going to make it. It's great to have you back. Arnold Pinaro, retired 2-star Marine Corps Major General, with us here on Balance of Power. We drive on the Wednesday edition and our panel ahead on Blue.
It's 12:40 on Wall Street. I'm Alexis Christoforous. The U.S. government shutdown is underway, and it's raising questions about how long it will last and what it all means for the markets. Lorena Urici is chief U.S. economist at T. Rowe Price. She was a guest this morning on Bloomberg Surveillance.
We're hearing the government will use this exercise of who is an essential worker and who is not to deliver more federal workforce layoffs and reductions. And if that's the case, I think the economic implications and the effect on growth can be bigger than it's been historically.
Lorena Urici of T. Rowe Price interviewed on Bloomberg Surveillance. Taking a look at stocks, mixed right now. We have the Dow off about 8 points, but the S&P 500 holding on with a gain of 6. The NASDAQ Composite is up 42. Yields are lower with the 10-year at 4.12%, the 2-year at 3.5%, and gold at another record high, sitting at $38.71 the ounce. The industrial technology company Acuity posting better than expected quarterly earnings fueled by a surge in sales in the company's intelligent spaces division. And the AES Corporation rallying today after reports indicating BlackRock's global infrastructure partners is nearing an acquisition of the company. Shares of AES up now about 16%. Tesla is hiking lease prices for all of its vehicles in the U.S. after that federal tax credit that helped boost EV sales expired. And for the first time this year, Tesla's monthly sales rose in France and in Denmark. We've got shares of Tesla slightly higher right now. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's a Bloomberg Business Flash.
Alexis live in New York. We'll have more on the markets coming up at the top of the hour. Thank you, Alexis. I'm Joe Matthew in Washington. Thanks for being with us here on Balance of Power, the Wednesday edition, the shutdown edition. I shouldn't say that because, well, we'll probably still be shut down tomorrow. You know, they're leaving for Yom Kippur, and this is nowhere near being settled. That will be brought to the fore in our second hour when we spend time with two members of Congress. When I say that, I mean Democrat Glenn Ivey, Congressman Ivey from Maryland, and Senator Ted Budd, the Republican from North Carolina, is going to be with us. And I think it'll be pretty easy to delineate the two sides when we have that conversation. Jack Fitzpatrick will also update things from Capitol Hill. It's so bad right now in Washington and on the Hill that Senator Susan Collins is suggesting bringing out the talking stick once again. She was swinging this around the other day, the talking stick that was employed to end a shutdown in 2018. This apparently is an African tribal stick that you must hold in your hand to have the floor. So when you get 20 people in a room and everyone's talking over each other, only the person with the talking stick can make a point. It is then handed around the room, and eventually we find common ground. But we are clearly not there yet. Was in the Senate last evening and spoke with Democrats and Republicans who clearly had no trust for one another. Senator Roger Marshall, Republican from Kansas, making the point that this is Chuck Schumer's shutdown. Here's what he said.
I think this is a political question for Chuck Schumer, that his base, his far left base, crucified him when he kept the government open in the spring, and he's afraid to do that again. He's afraid that AOC is going to primary him. All those things going on. So to him, it's a political decision.
AOC. What would she have to do with this? That, of course, right, everyone remembers the outrage that many progressives expressed back in March when Chuck Schumer, quote unquote, caved to the far right and allowed members to clear the CR. Never again, they said. AOC was on TV this morning being asked about this, throwing back on MSNBC the idea that this is about AOC and her potential to primary Chuck Schumer if he doesn't please the base. Do we have that sound? Here's Alexandria Ocasio-Cortez.
This is so not about me in this moment. This is about people being able to insure their children. And I will say, because I saw some senators speculating about this, and I saw some Republican members of Congress saying, oh, well, if we have this shutdown, it's because of AOC. Well, if that's the case, my office is open, and you are free to walk in and negotiate with me directly. So she's running. No. This is going to be a great panel.
Rick Davis is here, Bloomberg Politics contributor, Republican strategist and partner at Stone Court Capital as well. This is great. Megan Hayes in her early edition debut. Former special assistant to President Biden, Democratic strategist. Wonderful to see you both. Thank you for being here. Megan, I'll start with you as the Democrat in the room here. Is that what's motivating Chuck Schumer? He thinks he gets primaried if he does this wrong?
No, I think that he genuinely wants people to be able to have health care. I think that the polling suggests from Trump's own pollster that the American people overwhelmingly want to be able to afford health insurance and want to have as many people insured as possible. So I think where we've talked about this a lot, where if you don't have a reason, if you can't open the government back up, you shouldn't let it shut down. But here we are, and they are going to stand firm on this. So I think, Schumer did face a lot of agita in March, but I don't think that is his driving force here. He needs to keep people insured, and he needs to make sure that the American people not on health insurance is really bad for the economy, and I think Chuck Schumer knows that.
Well, the agita is going around. Rick, I wonder what you make of the administration's attempt to get ahead of the blame game, to try to do this in the Trump style. If you go to the front page of any government agency today, in part of the administration, you will see a message that's been plastered in front of the normal website front page that blames Democrats and the radical left for shutting down the government, urging you to call the Democrats to have them fix this. If you walked into the White House briefing room last evening, they were playing a loop tape of Democrats decrying shutdowns from years back. They put a little montage together, even though there was nobody in the room, Rick. Is the administration doing a good job keeping the party message together?
Yeah, they're trying, and they're doing a better job than they did on selling the reconciliation bill, because they kind of let that lay flat. And there's a reason why when you pull it now, it's pretty unpopular. So they don't want to fall in that same trap, right? Lessons learned. But, we're in the talking point session, right? I mean,
that's right.
Senator Collins is exactly right. When everybody gets worn out saying the talking points, which are Schumer's protecting health care and Republicans just want a clean CR and get on with the business of government, then once you get past that, because we're going to hear that all day today, is like, okay, what's the deal look like? And there's an easy makings to the deal here. This is not a hard thing. Republicans right now, I think falsely so, think this inures to their benefit. At some point that turns against them. So far, from what I can tell in past polling, there's never been a shutdown that hasn't paid a price for Republicans, right? I mean, regardless of who's president, we, for whatever reason, get blamed for shutdowns. And my guess is this isn't going to break that string. And so out of the 8 shutdowns we've had since 1990, 4 of them right now are with Donald Trump as president, and the previous 3 cost him votes. So at the end of the day, there's going to be pressure politically that's going to solve this. There will not be a policy dimension to this that gets everybody out of the shutdown.
Well, you hear Rick talk and you think maybe Democrats ought to hang on for a minute.
Well, I agree with Rick, but I also think the American people send their members of Congress here to work on their behalf, and with the government shutdown, they are not doing that.
That's true.
So they need to find a solution to get the government back open. And I do agree with him that there is a really easy fix here to get the government back open. And once they all get tired, like he said, they will do it. But there is a political cost, and I do think it's going to come in 26. Like, the longer this goes on, the polling, their own pollster is saying they will pay a political price for this. Their voters in swing districts that are favored Republican, they fall from a 2% deficit to a 15% deficit. That is a major deficit for a member to come back from.
That's a big deal. What's the fix, though? Do Republicans offer a limited extension, or do they do an unlimited extension with an income cap? But how does this actually come to form?
I think they need to get out there, all 4 of these leaders together, and say, we're going to open the government and we're going right into negotiations, and this is what we're doing. I think that the Democrats are very concerned that if they just go on good faith that they're going to negotiate, they will not negotiate, just like with the rescission package. But Democrats need to hold strong on what their one demand is, and if that is to keep the ACA tax extensions, that needs to be the one thing. They can't have all these other things piled on. I understand it's not a policy conversation, but I do think that they need to have some good faith action from the Republicans, because I don't think they're seeing that yet.
Interesting. Jeanne Shaheen, who everyone's watching very closely right now, the Democratic senator from New Hampshire, told Jack Fitzpatrick at Bloomberg earlier today she's already working on something here, and that's partly why everyone is looking at Shaheen as a potential deal maker. She says she's more concerned, though, with Obamacare subsidies than clawbacks, than rescissions, because there was the idea that a promise of no rescissions might help to unlock a deal as well. Rick, John Thune is just going to keep on voting. They're going to do this again today. They're maybe not tomorrow because of Yom Kippur, but they're going to come back and keep voting on these 2 CRs, I guess, until everyone's exhausted. What's the point of that?
Well, they picked up some votes yesterday. 3 Democratic senators voted with Republicans to clear the bill. And you know, it gives everybody an opportunity to look like they're trying to solve a problem, right? I mean, there is a method to the madness that even though there aren't direct negotiations happening today, they want to get the impression that the Senate, specifically here, not the House, is working to try and find a solution to this. And the best demonstration of that is us reporting, oh, you know, they picked up an extra Democrat. Oh, my God, they're getting close to a deal. You know, those are the kinds of things they're trying to manage the media around. And so I think that it's a smart strategy. Just keep the wheels moving. Sooner or later, you'll have enough people on board to get it across the finish line.
Could John Thune peel off enough Democrats just by voting over and over again? You've got Fetterman now. That wasn't a surprise, but Cortez Masto, King, we're getting closer. Do you get a Shaheen, a Peters in there, and we're done?
You very well could. You have a lot of people. Those are some people that are in toss-up districts right now.
Yeah.
But I think it's also an optics thing, and Rick is right. It's a media play. Mm-hmm. They can go and say, Democrats voted to shut it down or keep the government shut down. They're not working for you. And I just think until they actually have real conversations and real negotiations here and come to the table, this is all for the media and all optics.
And then you can
way to raise money.
You can make an ad that
right.
says Megan Hayes voted 7 times
That's right.
to close the government,
That's right?
And so I guess we'll just keep doing this. Megan suggests this is about leadership getting in a room. Rick, is it as simple as that?
Yeah, it really probably is. I mean, look at the math formula, right? I mean, right now they're going to score the extensions on ACA, which is the primary demand by the Democrats, as Megan says. They're going to say, okay, that's $1 trillion expense. We're not going to do $1 trillion. We'll do $500 billion. It's bad enough we've got this deficit the way it is. The Democrats will say, we can't cut a deal for $500 billion. That's like, 10 million people are going to lose their insurance. I mean, like, that's how it's going to go. It's going to be based on how much money are the Republicans willing to put into a fixed bill on the ACA extensions. And that'll be a very precise discussion once they get to the point where they're going to have that conversation. So there'll be a win-win, right? Democrats will be able to go out and say, hey, we saved ACA, and Republicans will say, hey, we cut it in half and saved taxpayer money. And then boom, you got the government back open.
He just made that sound so easy.
It is that easy.
We knew this was coming for months. How come we can't do this?
If we didn't, we need adults in Congress. I don't understand the problem here.
Well, I'll tell you, I don't know if it will end up seeming that easy in the end, because you've also got the Rust vote factor, and I'm wondering how you see the administration playing into that. President Trump said yesterday, irreversible things can happen during a shutdown. He also said sometimes shutdowns can be used for good. Are we going to see these mass layoffs, and how would that impact the chance for a deal?
Look, I mean, Donald Trump doesn't want to abide by laws and rules, but it's against the law. Democracy Forward filed a lawsuit on behalf of federal workers yesterday in court in San Francisco. It is illegal to fire mass layoffs during a shutdown. It's just not what we do. So I think whether he threatens, I think that was a tactic to get Democrats to not shut down the government. Clearly that didn't work. But Donald Trump is going to do whatever Donald Trump wants to do. But the fact of the matter is he is not the one that is involved in these negotiations. Congress needs to start working for the American people, get the government back open, and get health care funded. It's very easy.
It's been suggested more than once recently, Rick, that Donald Trump wants to see those Obamacare subsidies extended as much as anybody else because of the impact on the midterms. We've only got a minute left. Do you agree?
Yeah, I think Republicans are very clear-eyed about this, and you'll notice, Senator Thune has not thrown them under the bus and said there's absolutely no way. They did get voted down in the House, but that was a party line vote.
That's right. In fact, what he did say was, we have to reopen the government to start negotiations. Is that something that Democrats can tolerate?
I think that they're going to need more than that. I don't think they think Republicans are acting in good faith.
So you need a promise.
I think you need them to publicly say they're doing this you need some skin in the game from the Republicans. I don't think Democrats think they're acting in good faith.
Really interesting. We've got, as I mentioned, a great panel today. Megan Hayes and Rick Davis will be back in our second hour as we welcome our global television audience to the conversation. Tyler Kendall will be along as well. And we've got a couple of lawmakers to hear from. The gentleman from Maryland, Democrat Glenn Ivey, Congressman, will be here. And we'll also be joined by Senator Ted Budd, the Republican from North Carolina. You're going to hear the differences and maybe some of the acrimony in this debate coming up just a couple of moments from now. Stay with us here on the fastest show in politics. It's shutdown day one. Unclear how many there will be. This is Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Shut down, but for how long? Welcome to the Wednesday edition as federal funding lapses after a series of failed attempts to pass a short-term fix in the Senate. But the Republican-led Senate is not done voting yet. I'm Joe Matthew alongside Tyler Kendall here in Washington, where there's a bit of a hangover today, Tyler. We're not done, though. There will be votes today on the same two CRs that failed last night. And John Thune says he's just going to keep bringing it to the floor.
Right, exactly. And we did hear from congressional leaders on both sides of the aisle earlier today, Joe, and it really seems like they're both dug in. In fact, we heard from the House Speaker Mike Johnson saying that more pain will be inflicted the longer this goes on. We're waiting for some reporting to come out of a potential call between the OMB director, Russ Vought, and House Republicans later today.
I'd be deeply curious to hear about this. And over the course of the next hour, we'll bring you the latest. Jack Fitzpatrick at Bloomberg Government is standing by on Capitol Hill to talk about where we stand here in day one. If anybody's talking, knowing, of course, that everyone leaves again tomorrow for Yom Kippur. There will not be an opportunity on Thursday, but they'll get back to it presumably on Friday. The House will come back next week. And we're going to hear from two lawmakers this hour, Tyler. Fascinating. Senator Ted Budd, the Republican from North Carolina, will be giving us his view on things, along with Congressman Glenn Ivey, the Democrat from Maryland. So we're going to have both sides delineated quite clearly in the next couple of minutes.
Right, and I'm particularly interested to hear from the Democratic congressman because he represents a district that butts up right to Washington, D.C., and we know that we're watching really closely the impacts on the labor market, whether or not there will be permanent firings when it comes to federal employees, because as of now, we're estimating that 750,000 employees are currently furloughed as part of this process, and we're going to have to see if there's any longer-term impacts.
Questions if those furloughs will become layoffs, and that's where we begin our conversation this hour. We'll have more from Capitol Hill after we take a look at Wall Street. Let's get the baseline in the markets. Alexis Christoforous standing by for Charlie Pellet today at World Headquarters in New York. Alexis?
Thanks, Joe. And stocks seem to be taking news of this government shutdown in stride. A mixed market at the moment with the Dow down 39 points. The S&P is up 5 and the NASDAQ rallying 55 points. Gold setting another high, touching $3,900 an ounce before pulling back a bit. Treasury yields and the dollar slipping. Today's ADP employment report showed private employers shed about 32,000 jobs last month. That was worse than expected, and investors say it makes it more likely the Fed will stay on track for that October interest rate cut. Bank stocks coming under pressure over concerns about a slowing economy in the face of the government shutdown. Shares of Citigroup and Wells Fargo each down about 2 1/3%. JP Morgan Chase off more than 1%. And packaged food company ConAgra Brands rallying nearly 4% after reporting quarterly profits that beat estimates. The maker of Slim Jim Jerky and Bird's Eye frozen foods also reaffirming its fiscal year guidance, but warning that inflation and tariffs are pushing up costs more than expected. Quick check of Nike, up now about 5% after the sneaker giant posted a surprise sales increase for last quarter. Turnaround efforts appear to be taking off as the company realigns its business around sports, such as running and basketball. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash. Back over to Balance of Power now with Tyler Kendall and Joe Matthew.
I appreciate that, Alexis. Great to have you aboard today, and we'll have more on the markets about 20 minutes when we check back in with Alexis Christoforous in New York. Clearly, this is not a market that's too concerned about a government shutdown, at least not yet. It's not an economic event unless it goes on for a bit longer, although the missing jobs report on Friday will leave a huge question mark hanging over the Friday trade as we make our way forward here. It's day one. They're voting again, as we mentioned, on the 2 CRs today in the Senate, with everybody asking the same question. Why don't we let the Republican leader in the Senate take it from here?
Everybody's now asking the question, how does this end? Well, it ends when the Senate Democrats pick this bill up, passed by the House of Representatives, and vote for it. It's on the floor of the Senate. We're going to vote later this morning on this, 24 pages.
This is where we start our conversation on Capitol Hill. Bloomberg Government's Jack Fitzpatrick is standing by, our appropriations expert. Jack, what is the answer to that question? How long could this go?
This will be a test of members' patience with their leadership and how long rank and file members, especially in the Senate, just want to leave all the power in the hands of John Thune, of the Speaker of the House, of the President of the United States. Right now, there are not significant back channels. There's not a gang forming of centrist members who want to take the reins and say, put me in charge, I'm going to find an alternate path forward. But that is one of the significant X factors here. I spoke to Jeanne Shaheen, a more moderate Democrat Democrat from New Hampshire who said there are member-to-member conversations on the Affordable Care Act subsidies. There are conversations happening, but right now, largely, this is all being left to the principals, the big four congressional leaders and the president, and there's enough patience from senators to see if one side breaks, to allow their leaders to try to negotiate and use pressure tactics, so that right now there's not a lot of movement. There's not an alternate path coming forward. It's the Republicans seeing if the Democrats will break and the Democrats seeing if the Republicans will break.
Jack, can you just set up the rest of today for us? What is on the docket when it comes to procedure in the upper chamber?
Right now, not much is left. They just did their 2 votes that we saw coming. This is the third failed vote on both the Democratic proposal to fund the government and the Republican proposal to fund the government. The Democratic one failed along party lines. The Republican proposal was the same as last night. It was 55 to 45, short of the 60 votes necessary. You got 3 Democrats who signed on. So we're still watching those 3 Democrats, Fetterman, Cortez Masto, and King, the independent who caucuses with the Democrats. That shows there's no movement. And so it is going to be a test of patience and a test of willpower because nobody broke. And we've now had 3 votes on the same exact proposals that haven't gotten to that 60-vote threshold. After that, they're set to leave town for Yom Kippur. They could announce emergency votes if necessary, but there's not a lot going on, and there's not even real negotiating happening today.
All right, Bloomberg Government's Jack Fitzpatrick, we thank you as always for your reporting and insight live for us from Capitol Hill. And we mentioned this at the top of the show. We are hearing from both sides of the aisle, congressional leadership on the messaging around the shutdown. We did hear from Senate Minority Leader Chuck Schumer earlier today, giving this message to his members.
He is using the American people as pawns, threatening pain on the country as blackmail. Well, that's not going to work. The American people, it's so easy to see through those tactics. They know this is the Trump shutdown. They know Republicans control the presidency, the Senate, and the House. And what is done during a shutdown will fall squarely on the Republicans' back.
To dive into the politics and the policy, we're joined now by Republican Senator Ted Budd of North Carolina. Senator, thanks so much for joining Bloomberg. Let's just start with the latest. What are you hearing behind closed doors about where this shutdown is heading? Is there any sort of development that you can give us when it comes to the negotiations?
There's really no clear over-under on this. Is it going to be short? Is it going to be long? It's really up to Chuck Schumer. He's the one that needs to negotiate with himself, maybe negotiate with AOC, because it really seems that it's New York City and New York State politics that are playing out on a national stage right now. Chuck Schumer isn't concerned about America. He's not concerned about government employees. He's not really concerned about the rest of our country. He's only concerned about having a primary for U.S. Senator from AOC. So he has to show his radical base that he's actually fighting. What he really wants to do is spend $1.5 trillion more. He wants to give health care to illegals. He wants to undo the working families tax cut. And he wants to hurt rural hospitals, and he wants to continue these COVID handouts. That's what he's trying to do, and it's really just about appeasing his radical base.
I just want to understand, if you can explain to us the idea of giving health care to illegals. Isn't it impossible for an undocumented citizen to be eligible for health care?
The way they were, thank you for asking. The way they were enrolled, it actually would lead to them through other avenues being into these entitlement programs. So would we send a check directly? No, but were they enrolled through other measures? Absolutely. And those that were here legally, of course, and those that were citizens, sometimes it was couples making up to $500,000 were getting these subsidies. So do we need to fix these reforms or have some reforms in regards to these subsidies? Yes, there are some people that actually need them. There's some contractors, some blue-collar folks that were on 1099s, and they need to have them. But we need to reform them. We don't want to throw them out. We want to say, let's have the discussion. But this is completely nonsensical what Chuck Schumer's doing. He's saying you have to do this right now or we're going to shut the government down. And matter of fact, he did it at midnight last night. This is a December discussion. This is not a late September or an early October discussion. This is something we can keep working on. You can shut the government down and have a discussion, which he did, which is very expensive, and he's been opposed to it up till now. Or you can keep it open and have discussions.
Saying about that. I was in the Senate in that same spot you're standing in, talking with a number of your colleagues, Schmidt, Marshall, and others last evening. Tom Cole joined us. And the idea here about where we're going has just raised a whole bunch of questions. Chuck Schumer was talking about this earlier today on the Senate floor, Senator. I'd love for you to hear what he said and have you respond. Let's listen. I guess we don't have that right now. We'll get back to that in a moment. When we start
I've heard lots of comments from him.
Well, I was just ask you this question, Senator. Yeah. We'll put Chuck Schumer aside for a moment. You're saying that extending the Obamacare subsidies is a matter for the end of the year. But a number of Democrats who've joined us, Chris Coons last evening said, notices are going out and open enrollment is about to begin, that healthcare premiums actually start rising today. Are they wrong?
I think they're wrong in their timing. This is something we need to discuss, but you don't do it in an emergency fashion like this. The reason that you do a stopgap continuing resolution or CR is so that you can have these conversations and let the Appropriations Committee, with people that are elected to do so and are put on these committees to do so, can work out the budgets in a reasonable means. That's the regular order that we talk about here, and that's what we need to do. This is right now, this argument, this shutdown, it's very expensive. It doesn't make any sense. It backs Chuck Schumer further into a corner. I think it only gets worse for him, not better. We're the reasonable ones here. Donald Trump is reasonable. But it's completely just trying to appease Chuck Schumer's radical base is all he's doing, and showing that he's having to fight so he doesn't have a primary from AOC.
Well, Senator, you're saying that shutdowns are expensive, so I'd love your take on the White House's threat when it comes to permanent layoffs. It's our understanding that the OMB Director, Russ Vought, will be speaking to your colleagues on the House side today about that potential. We should say at this point it doesn't appear that agencies have laid out that plan, but do you agree with this as a negotiating tactic?
I don't think it's about a negotiating tactic, but if Chuck Schumer is going to hand this card to the White House, which wants to be fiscally responsible, I mean, that's one of the reasons that President Trump was elected, is to get the fiscal house of America back in order. And there are a lot of people that are needed in the private sector. There's a lot of talent that work for the U.S. government that may be better serving our economy working in the private sector and not at the behest of American taxpayers. And if it's chance for Russ Vought to right the ship on that, then so be it. Yeah, I mean, it's not about being mean. It's about being fiscally responsible for American taxpayers.
Well, what do you think he can do here? If the government shut down, he's got the keys to the kingdom, Senator. How many workers do you think Russ Vought can cut?
Look, I don't know. He's going to look at this, and you have to keep the funk. I think people want the American government to work. They want it to open. They want it to be responsible. They don't want it to be front and center. I mean, people want to go home. They want to talk about their lives. They want to live their lives. And you just need the American government to work. And Chuck Schumer has thrown it into dysfunction. He's overspending. He's trying to add $1.5 trillion, much of that for illegals. And I think Americans think that's ridiculous. Look, if somebody is not essential right now, then they don't need to be working for the American government. And I think that's what Russ Vought's going to look at. He's going to do the right thing.
Senator, I do want to ask you about another policy that has really come to the forefront this week, and that's President Trump's policies regarding tariffs. We saw him renew tariffs when it comes to the furniture industry. In particular, in his post announcing it on Truth Social, he highlighted your state of North Carolina. Now, we've seen some mixed reviews from domestic industry. I'm wondering where you stand on this policy and what you're hearing from domestic furniture makers about this more protectionist view.
Well, President Trump and I have the same goal, and that is to reindustrialize the United States. So I think that is what he's for. He wants more manufacturing to be done here. You know, we've seen some post-NAFTA revitalization of the North Carolina furniture industry, but it's still not where it was pre-NAFTA. So we want more industry to come back here. I'm not traditionally a fan of tariffs, but I am a fan of what Donald Trump's trying to do, and that is level the playing field against countries that have cheated us and have taken our workforce away and have hurt American employment and have hurt our industries over the last 20 or 30 years. So I think he's trying to right the ship and attract these countries to reinvest, in these companies to reinvest in North Carolina and the other great states in our country. And it's starting to happen. I wish it would have happened yesterday. I wish it would have happened years ago. I wish we would have never had the disjointed economic effect that NAFTA did on North Carolina. But those decisions are behind us. Now let's get America back on track, especially our economy.
Really glad you could join us, Senator. And what's happening in North Carolina is important to us, so we'd love to have you back. Senator Ted Budd, the Republican from North Carolina, making his debut on Bloomberg TV and radio in the throes of a government shutdown. Thank you for joining us here on the Wednesday edition. We're not even 24 hours into this shutdown, and we have a lot of questions still about what took place last evening. Already again today, we've seen the two continuing resolutions, Republican and Democratic versions, fail, and there is no one talking, and there appear to be no off-ramps at the moment. You just heard the Republican take on this. Let's hear from a Democrat. In Glenn Ivey, the congressman from Maryland, is with us in studio here in Washington. Welcoming you back, sir. It's good to see you.
Thanks for having me.
You've been through a couple of these, but I have to admit, I know everyone says this time is different, and it kind of feels a little different this time with Russ Vought circling over the Capitol.
Well, I think the big differences are sort of twofold. One is the threat that the president made to punitively terminate government employees, which is illegal, as you just heard in the previous segment, and there's a lawsuit about that. The second, though, is I think the widespread pushback. So the Trump shutdown in 2018 was about building the wall. Most Americans really didn't care one way or the other about that. When they get these notices in their mailbox that their premium's about to double for their health care insurance, they're going to care about that. And they won't care what the spin is from Washington. They won't care what the process was. They won't care what Chuck Schumer said or whoever. They'll want to find out how to get their premiums back down, and I mean yesterday. And that's when this is going to move. That'll light a fire under the Republicans to get something done on that front.
Just on the first point about potential layoffs, you represent a district that has a lot of federal workers.
Absolutely.
Are you hearing concerns from constituents leading up to this and now that the shutdown has actually started?
Well, I started hearing concerns from my constituents from January 20th, because that's as soon as Donald Trump hit the door, he started firing government employees, and he couldn't do it fast enough for his taste. And we filed multiple lawsuits, Democracy Forward and the unions, to show that, to slow that down and address it, make sure people were getting fair treatment. But now they've hit the saturation point for sure. They're actually starting to bring some people back that they'd forced out previously because they need enough people to do the services. And there's some services that are like clinical trials for Alzheimer's research that I just thought it was crazy that they shut that down. It's indefensible, frankly. So I think they're going to turn the corner on that, hopefully, based on the pushback they're getting from within their own party and from the American people. And I think that's going to make it hard for them to follow up on this threat that they made. But you never know with those guys. You really can't tell.
Republicans remind us that these are COVID-era Obamacare subsidies, and many ask why they should still be around since the pandemic is not. What's the real answer on this? Should there be a permanent extension? Does it imply that Obamacare is not working as designed? Or should there be new rules, new guardrails about how this works?
I think there should be a permanent extension. They didn't have any trouble doing a permanent extension for their 27 tax cuts for the people that the billionaires and the really wealthy people that benefit from it. Why can't they do a permanent extension that helps regular Americans maintain health care? Donald Trump and many of these Republicans have been out to get Obamacare for 15 years now. And they found that they couldn't do it after the first 2 years because once people got it and realized how valuable it was and critical to their health care coverage, it became bulletproof. This is a kind of a Trojan horse approach to taking it down. You could have millions of people that lose their coverage based on what they're doing here, and they really aren't giving any good explanation for why they won't do it.
Just for clarity, would you support a commitment to negotiations down the road, or do you want to see pen put to paper before the government is reopened when it comes to this?
Two problems with down the road. One is we've been negotiating this for months now. For example, the $1 trillion in Medicaid tax cuts, that was an H.R. 1. Democrats fought against that. Almost all of us voted against it in the House. They passed it anyway on a party line vote. On the subsidy extensions, I'm on the Appropriations Committee. We tried multiple times to put in amendments on the appropriations bills that would have given the extension at that point. They voted them down every time by unanimous party line vote by the Republicans. So they can't say we need 7 more weeks to figure this out because we've had 7 months to be working on this and have been. So my sense of this is they've been voting to kill it over and over again. Why should we assume that they're changing their minds now? Why should we credit that statement? And of course, Donald Trump has been totally erratic and unreliable on commitments that have been made one way or the other. So, yeah, I'd like to see it in writing. Matter of fact, I'd like to see it get done now as part of reopening the government. We can do both at once. They really haven't given a good explanation as to like, oh, it's part regular order and all this. Regular order didn't work. So now we're trying this now to make sure the American people, I think there's 15, 16 million of them that could lose their coverage. We want to make sure they get their coverage.
Well, we all remember, of course, the shutdown in 2013 that was surrounding Obamacare. We've been going around the block on this for a while here. I'm curious to hear from you. What happens in a congressional office when the government closes? You had to probably meet with your staff, at least last time you were all in a room, to let them know they were not going to be getting paid starting today. Does the office close? What happens?
No, we keep going. In fact, we've got a call tonight. It's a town hall webinar where people who are, facing these issues, the layoffs and the like, and have questions can call in, ivy.house.gov, or not call in, but tune in. It's a webinar streaming to try and get information. Other congressional officers are doing similar types of things. Obviously, we're going to keep working in the community to try and help with people trying to figure out how to get through this.
Is that a motivator when lawmakers see that the staff isn't buying lunch or coming to work or getting a second job? I mean, that's real, isn't it?
Yeah, I'm a former staffer, so I know, how hard it can be on them. I'm also a former federal government employee of the Department of Justice, for example. So I know the impacts can be really tough on folks. Most folks need their pay, they need their income to stay steady. They're living paycheck to paycheck, so it's tough on them. But at least in my district so far, people seem to understand the importance of this moment, the need to make sure that health care gets extended. Because many of them, yes, they're government employees, but they, grandma's in a nursing home based on them getting the payments through Medicaid. They understand the fallout of what could happen here.
We are talking about the fiscal impacts, and I'm wondering what you make of Republicans' recent argument that the Democratic-backed plan could add $1.5 trillion to the national debt over the next decade. That's according to an estimate from the Committee for a Responsible Federal Budget.
It's kind of laughable because the tax cuts that they put in place in H.R. 1 is like between $4 and $5 trillion. So, I hear them start complaining about the deficit again, and I'm like, where were you when you passed this thing unanimously, essentially? So here's the issue. They're trying to do a lot for the billionaire buddies. Can they do something for the American people, regular folks in the working class? They're not trying to ask for a whole lot of handouts or anything, but they do want to just give them the chance to extend their health care coverage with the subsidies that they've been given and come to rely on. Give them a chance to continue to get the Medicaid funding that they need for elderly and the disabled and children who are poor and the like. Why are we cutting that stuff to give tax cuts for people who really don't need the money? And many of them aren't even asking for it. So it's inexplicable to me and indefensible, frankly.
I don't know how much time you spent on Truth Social, but you might have seen the videos the president's been posting about your leader in the House, Hakeem Jeffries. There was one a couple of days ago. He's standing side by side Chuck Schumer. It's an AI-generated deep fake where Chuck Schumer is saying offensive things about undocumented immigrants. And the Democratic leader in the House is put in some sort of mariachi outfit in what was deemed a sure-to-offend racial depiction of Jeffries. And he did it again last night.
Yeah, I mean...
what does that tell you about the willingness to compromise?
I mean, it tells me more than that. I mean, you start kind of wondering if the guy's really stable or not. I mean, it just doesn't make a lot of sense. The performance in front of the generals and admirals yesterday was unsettling too, to say the least. And there's been a whole string of that with this guy since he got back into the White House. I mean, if Joe Biden had been doing stuff like this, you'd have to peel people off the walls. Oh, he's lost it. Let's, measure Trump by the same yardstick.
It's good to have you back.
Good to be back.
Maybe when things reopen, we'll talk again. Unless this goes on for a while. Congressman Glenn Ivey, the Democrat from Maryland.
Apparently, I'll have some free time.
It sounds like it. Thank you for being here.
All right.
For all the wrong reasons, but we'll keep in touch on this one. I'm Joe Matthew alongside Tyler Kendall. Yeah, it's day one. It's not even over yet. We have a lot more to talk about. Our panel will be in next. After we take a look at Wall Street, Alexis Christoforous has her eyes on the markets for us on Balance of Power. She's live in New York. Alexis?
Thanks, Joe. And markets appear unfazed by this government shutdown, the first in 7 years. Markets modestly higher. The Dow is up 8 points. The S&P 500 adding 14. The NASDAQ, though, doing nicely as those tech stocks continue their rally, up 75 points right now. Treasury yields and the dollar are down, but gold, another record there, briefly touching $3,900 an ounce before pulling back just a bit. In stock news, packaged food company ConAgra Brands reporting quarterly profits that beat estimates and reaffirmed its guidance for the fiscal year. But the maker of Slim Jim Jerky and Bird's Eye Frozen Foods is warning that inflation and tariffs are pushing up costs slightly higher than expected. We've got ConAgra shares up 4.25% right now. Semiconductor maker ARM Holdings getting a nice bump, climbing 4.5% on a report that Qualcomm adopted ARM's newer computing architecture for its flagship chips. And Occidental Petroleum higher for a second day, up now 0.6% on a report that Warren Buffett's Berkshire Hathaway is in talks to buy Occidental petrochemical business for about $10 billion. This would be Berkshire's largest deal since 2022. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash.
All right, Alexis, thanks so much. As Alexis mentioned, I'm Tyler Kendall here in Washington alongside Joe Matthew. And like most days, it's a busy day here in the nation's capital. And we got some breaking news this morning. The U.S. Supreme Court saying that Fed Governor Lisa Cook can retain her seat while the broader question of her firing plays out in court. To get all of the analysis and insight into this decision, we're joined now by Bloomberg's chief economic policy correspondent, Michael McKee. He joins us from World Headquarters in New York. Mike, just break down this decision for us. How consequential was it that the Supreme Court ultimately ruled in Lisa Cook's favor?
Well, it is a bit consequential in that in the previous cases where Donald Trump has tried to fire agency heads, the court has ruled fairly quickly that they could be fired. In this case, they've deferred a judgment on it until January, a fairly long period of time for a case like this. It originally began when the president tried to fire Lisa Cook for unsubstantiated allegations of mortgage fraud back in August. She sued. Two lower courts agreed with her and said that she could not be fired. The administration then appealed to the Supreme Court, arguing that he has the right to fire her because the Federal Reserve Act says that they serve 14-year terms unless fired for cause by the president. So the question before the court now, do unproven allegations meet the for-cause clause? And was Cook entitled to a due process hearing before the president fired her? In other words, did she get a chance to defend herself on these unproven allegations?
Well, we know she didn't, right? That the idea was that she didn't refute them. Therefore, there was an implication of guilt, at least when we spoke with members of the administration. I know the courts don't work that way, Michael. Do we know when this DOJ investigation is going to wrap up?
We don't, and that could be an important factor for the Supreme Court once it does wrap up, because if they do, one would imagine that they would find a reason, as they have in the Comey case and others, to indict somebody that the president wants indicted. But if it were to go to trial and she were to be found innocent of anything, or if they don't indict her, then that's going to weigh on the whole issue of whether the president can fire her, because there wouldn't be cause. The cause issue would be moot in that case. The other thing that's going on is that, of course, the court is going to consider in December the firing of the last Democratic member of the Federal Trade Commission. And the Supreme Court may want to think about both cases at the same time, because when they fired Gwen Wilcox from earlier in the year from the Merit Systems Protection Board, they said that the Federal Reserve is a slightly different agency. So if the FTC decision and the Fed decision are intertwined, that may be why they put it off so long.
Great to have you, Michael McKee. with us from World Headquarters in New York. We want to bring you to the White House. J.D. Vance, the vice president, just walked into the briefing room and is taking questions from reporters on this first day of the shutdown. Let's listen for a moment. Live.
They don't want to give health care to illegal aliens. Can you address both of those lies from the Democrat Party?
Yeah, so on the point that it's a Republican shutdown, look, it's obviously a Democratic shutdown. Just look at the vote totals in the House, look at the vote totals in the Senate, and look at the President of the United States' own action and conduct throughout this crisis. Nearly every single House Republican voted to open the government, Matt. Nearly every single Senate Republican voted to open the government last night, and even to their credit, a few moderate Democrats voted to open the government. That's not a Republican shutdown when nearly every single Senate Democrat votes to shut it down and every Republican voted to open it up. It's just obviously not true. Now, you can disagree about a number of things, but you can't disagree about the obvious fact that Republicans voted to open the government. The president stands ready to sign that opening of the government. We just need a few more Democrats to join us in that effort to open the government. Your final question about illegal alien benefits. Look, the text is very clear, and I even saw, I think it was George Stephanopoulos in an interview with Mike Johnson, did a fact check that was totally rooted in baseless claims. It was basically Democrat propaganda. If you look at the legislative text that they gave us, they tried to turn on two separate provisions that would give health care benefits to illegal aliens. Number one, if you're an American citizen, you've been to a hospital in the last few years, you probably noticed that wait times are especially large, and very often somebody who's there in the emergency room waiting is an illegal alien, very often a person who can't even speak English. Why do those people get health care benefits at hospitals paid for by American citizens? The answer is a decision made by the Biden administration that the Trump administration, working with congressional Republicans, undid. We turned off that money spigot to health care funding for illegal aliens. The Democrats, in their legislative text, want to turn it back on. That's one thing. The second thing, Matt, is we all know that there are various ways in which the Biden administration waved away illegal immigration status. They gave parolees, they gave asylum claims to people who weren't really claiming asylum. And when they waved the magic wand of amnesty, giving millions of people legal status, even though they were in the country illegally, they also gave those people access to health care benefits. So what the Democrats are engaging in is a sleight of hand. They're saying, no, no, no. Those weren't illegal aliens who were getting health care benefits, even though everybody, knows they were in the country illegally. It's a lie told by the Democrats that they're not trying to give health care benefits to illegal aliens. It's a lie that is obviously untrue if you just look at the text that they gave us. And all you have to do is understand that this is about who benefits. We think the American people's government ought to benefit American citizens. The Democrats are willing to shut it down to benefit illegal aliens. The contrast couldn't be more clear. Peter.
Thank you, Vice President Vance. The big holdup is, of course, that you guys say illegal immigrants are getting taxpayer-funded health care. Democrats say you're lying. That makes it feel like it could be a really long shutdown. Is this going to be a long shutdown?
You know, I don't know. I can't predict what congressional Democrats are going to do, Peter, but I actually don't think it's going to be that long of a shutdown. This is a pure guess from the Vice President of the United States because I think you already saw some evidence that moderate Democrats are cracking a little bit. They understand the fundamental illogic of this. Look, for years, every single one of us, we can remember Barack Obama on the White House lawn. We can remember Chuck Schumer. We can remember, Nancy Pelosi. For years, in Chuck Schumer's case for literally decades, we've heard them say, you don't shut the government down over policy disagreement. Okay, Republicans think this thing about health care, that thing about health care. Democrats think this thing about immigration. Republicans disagree. Whatever those disagreements are, you don't shut down the government over it. For the first time since the Democrats have been in politics, they're now saying that unless we get every policy item that we demand, we're going to shut down the people's government. They're trying to take a hostage, and we're not going to let them.
And the administration announced today that $18 billion bound for New York transportation projects is going to be frozen so it can't go to DEI programs there. But the timing of this, does announcing that today mean that you guys are going to squeeze Chuck Schumer's home state until he blinks?
Look, I haven't talked to Russ about this morning, but look, I'm sure that Russ is heartbroken about the fact that he's unable to give certain things to certain constituencies. We want to do everything that we can to help the American people, but when the Democrats shut down the government, we have to actually do a little triage to make sure the most critical and most essential services are provided. The government does a lot of things. Of course, Republicans think that the federal government probably does too much, but there are a lot of critical things the federal government does that absolutely all of us would agree need to do. Our troops need to get paid. Our air traffic controllers need to make sure that people are flying safely and on time. We need low-income people to be able to access the food services that are provided by the federal government. There are critical things that need to be saved. We're going to do everything that we can over the coming weeks, if the shutdown lasts that long, to ensure that people get the essential services that they need, despite the fact that Chuck Schumer has shut down the federal government. It's not going to be perfect because we are in a government shutdown. We are going to have to lay some people off if the shutdown continues. We don't like that. We don't necessarily want to do it, but we're going to do what we have to keep the American people's essential services continuing to run.
Thank you.
Yeah.
Thank you, Mr. Vice President, and thank you for being here. Yesterday, President Trump said, as a result of the shutdown, we'll be laying off a lot of people that are going to be very affected, and the Democrats, they are going to be Democrats. Has the administration asked agencies to target federal workers who they believe to be Democrats in these reductions of forces?
We're not targeting federal agencies based on politics. We're targeting the people's government so that as much as possible of the essential services can continue to function. That is the question the president has asked the entire government, is fundamentally, okay, we're in a shutdown. That causes some problems. The troops aren't getting paid. There's nothing that we can do about that while the government is shut down. But there are essential services that we want to make sure as much as possible they still continue to function. That is the principle that's driving us forward during this shutdown. It's going to continue to be the principle that drives us forward. But let's be honest. If this thing drags on for another few days or, God forbid, another few weeks, we are going to have to lay people off. We're going to have to save money in some places so the essential services don't get turned off in other places. That is the reality of the government shutdown that Chuck Schumer and the Democrats have foisted upon the administration.
So what did he mean by they're going to be Democrats? He said they're going to be Democrats.
You've laid out a lot of the pain and problems that would come with a Democratic shutdown, and yet in the Oval Office yesterday, the president said that a lot of good could come from a shutdown. So square that circle. Which is it, a Democratic-caused crisis or a Republican opportunity for reform?
Well, I think all the president is saying, Phil, is that he wants to make sure the American people's government functions as well as it can, despite the fact that we're in a shutdown. We're going to have to make things work. And that means that we're going to have to triage some certain things. That means certain people are going to have to get laid off. And we're going to try to make sure that the American people suffer as little as possible from this shutdown. That's what the president is saying, is that, yes, this is a bad thing. Obviously, the president is trying to reopen the government, but we're going to make things work as well as we possibly can, given the constraints that we have.
And then on those policy differences for the discussion and the negotiations to come later, during the Biden administration, Democrats twice voted to expand these Affordable Care Act tax credits, but those were supposed to be temporary and they were slated to expire at the end of the year. As you sort of crack the door open to negotiation at a later date, would the party that ran on defunding Obamacare really negotiate about potentially expanding Obamacare?
Well, Phil, what we've said to the Democrats is that we're willing to have a conversation about how to ensure that Americans continue to have access to health care. And frankly, they should have access to better health care at a lower cost. We inherited a mess of a health care system from the Biden administration. It's why the president has worked so hard on the most favored nation status for prescription drugs. It's why we care so much about lowering the cost of prescriptions and why we're doing everything else. We're willing to have that conversation. But I think it's important to bracket the health care policy conversation because it's separate from the government shutdown. We think that we can open the government and then have the conversation about what best healthcare policy to fit the needs of the American people. That's all we're trying to do. That's all we're trying to accomplish. We've got to reopen the government first. Now, Caroline, I don't know how you do this, how you actually choose people, because I don't know 90% of the names in here. Is it just who's the best dressed? Okay, I really like your shirt. Go ahead.
Thank you, Mr. Vice President. You are president of the Senate. Can you talk about what you're doing, what the administration is doing to try to get other Senate Democrats to vote to open the government?
Yeah, we're talking to a number of our colleagues, Democratic and Republican in the Senate. I talked to a number of them last night. The president, of course, is talking to them as well. I think there really are two categories of demands that I've seen privately from congressional Democrats. I think on the one hand, those who are negotiating in good faith are saying, look, We just want to make sure that we're able to have a conversation with the administration about some of the critical needs that we see that need to get fixed over the next few months. We recognize it's kind of absurd, and a lot of them will admit in private that it's kind of absurd to shut down the people's government over these disagreements, but just agree to negotiate with us in good faith on these issues, and of course we're having that conversation with them. Then there's another category, people who say, give us everything we want or we're going to keep the government shut down. We just write those people off because they're not negotiating in good faith, and frankly, we don't need them. We've already got 3 more Democrats last night than I thought we would get, and I think it's because they recognize the illogic of the position of taking the entire American economy hostage because they don't get their policy priorities. So 3 moderate Democrats joined 52 Republicans last night. We need 5 more in order to reopen the government, and that's really where we're going to focus, is how to get those 5 additional Democrats.
Thanks, Mr. Vice President. First 2 questions. Are there plans to meet Democratic leaders again in the coming days, or are you planning on plucking off senators one by one?
So that's the whole question?
No, I got a second question.
Okay, go ahead and ask the second question.
So the president's been posting some images of Leader Jeffries and Senator Schumer.
I saw.
Recently. You've said that you're interested in good faith negotiations with these leaders, but what message does that send? Is it helpful to post pictures of Leader Jeffries in a sombrero if you're trying to have good faith talks with him?
Oh, I think it's funny. The president's joking, and we're having a good time. You can negotiate in good faith while also poking a little bit of fun at some of the absurdities of the Democrats' positions, and even, poking some fun at the absurdity of the Democrats themselves. I mean, I'll tell Hakeem Jeffries right now, I make this solemn promise to you that if you help us reopen the government, the sombrero memes will stop. And I've talked to the President of the United States about that. Now, to your first question, are we negotiating one-on-one? Are we negotiating in groups? Look, I will go to the U.S. Capitol right now and meet with Chuck Schumer or any Senate Democrat if it helps us reopen the government. Most of the conversations, in my experience at least, have been one-off. We're also, of course, relying on some of our Senate Republican colleagues who have good relationships across the aisle. We're going to do whatever we have to do is the answer, and I think it's tough to predict what shape this negotiation is going to take over the next few months, but I feel good about the fact that Democrats already realize privately the fundamental irrationality of their position. I hope that they're going to publicly acknowledge it and reopen the government. The guy in the back, yeah.
Thank you, Mr. Vice President. You responded to a post on X of Chuck Schumer on the House floor back in 1996, railing against illegal immigrants receiving taxpayer-funded benefits. You said Chuck Schumer once recognized that it was disastrous to give illegal aliens rewards for breaking the law. Now he wants to shut down the government unless we reward illegal aliens for breaking the law. Why has Chuck Schumer changed his stance?
That's a good question. Actually, it's a very tough question. Asking me to get in the head of Chuck Schumer is not a place I particularly want to be, but my basic read on it is that the entire Democratic Party, the political leadership, not every Democrat nationwide, but the political leadership of their party has got it into their heads that the only way to be compassionate is to be compassionate to illegal aliens rather than American citizens. If you go back to what Bill Clinton was saying, even Barack Obama in some cases, what he was saying about illegal immigration 10, 15, 20 years ago, you would put them on the MAGA right based purely on their rhetoric around illegal immigration. So I don't know why they've gone so far to the left. I think it's bad for the country. I think it's bad for them politically. But our principle, all I can do is speak for the president that I serve and the country, the administration that I serve right now. We believe that the American people's government exists for the American people. That means the people who have the legal right to be here, and that's why we're fighting to reopen the government. And unfortunately, the Democrats are fighting to shut it down for the benefit of illegal aliens. And I'll take a couple more, and then I'll let Caroline, I'll go back to my day job so Caroline can go back to hers. All right, yes.
Thank you, Mr. Vice President. Just going back to the sombrero, you said that the president's joking, but Hakeem Jeffries says that these memes were racist. What's your response to that? And just if I may briefly go off topic, Secretary Hegseth yesterday made an edict about no more beardos in the military. Just wondered what...
Sorry, what did he say?
No more beardos.
Beards.
Oh, sorry, that's my accent. Just wondered your response to that.
I didn't see that particular comment. I thought Pete gave a hell of a speech, and a speech that really is just oriented around returning the American military to the very high standards that it has had for virtually its entire history until Joe Biden came along and decided to lower standards. I think it was bad for our military and it was bad for our troops. When I was a young United States Marine, I did not have a beard. I am now the vice president, so I get to do what I want to do. But I think Pete's trying to re-implement high standards, and that's a very good thing. On the sombrero thing, I mean, Hakeem Jeffries said it was racist, and I know that he said that, and I honestly don't even know what that means. Like, is he a Mexican American that is offended by having a sombrero meme? I mean, I saw one of the major TV stations put the meme up and then say, this is AI generated. And he had like the curly animated mustache too. It's like, do you really not realize the American people recognize that he did not actually come to the White House wearing a sombrero and a black curly animation mustache? Like, give the country a little bit of credit. We're all trying to do a very important job for the American people. The President of the United States likes to have a little bit of fun when he's doing it, and I think that's okay. I'll take one more question.
Mr. Vice President.
All right, that's Vice President J.D. Vance in questions in the White House briefing room. Reporters, of course, have a lot of questions about this government shutdown, how long it might last, and what might come of it as well, speaking to the imagery and the videos, the AI deepfakes that President Trump has posted depicting Democratic leader Hakeem Jeffries in some sort of faux Mexican garb with the sombreros and the mustache. There was another video like that this morning, the president playing in a mariachi band. If you're just tuning into all of this, that's the political reality today in Washington, and we're glad you joined us here on the Wednesday edition. I'm Joe Matthew, alongside Tyler Kendall in Washington. We're going to have a conversation straight ahead with Congresswoman Lisa McClain, important as she is chair of the House Republican Conference, and will bring us inside the negotiations, or a lack thereof, at the moment. We spoke as well today with Larry Summers, my colleague David Weston at Bloomberg World Headquarters in New York, speaking with the former Treasury Secretary about this government shutdown. Here's what Summers said.
This is about whether we should be scaling back the availability of health insurance for millions of Americans who in the old system used to not have eligibility for coverage, and in the new system do have eligibility for coverage. And people should make their choice about what they think. And I suspect that that will become clearer in the days, perhaps the weeks ahead, and we will see how it all plays out. But people shouldn't be distracted by the budget resolutions and the supermajorities and the 60 votes in the Senate and the appropriations process or any of that. This is a stark question. The government can reopen tomorrow if the President of the United States is prepared to accept the maintenance of Medicaid benefits, is prepared to accept the continuing functioning of the exchanges that have brought health insurance to millions of Americans, most of whom are employed by small businesses who can't really manage to provide health insurance to all their workers.
That's the take from Larry Summers earlier today on Bloomberg, and it's a pleasure to welcome back Congresswoman Lisa McClain. She is live on Capitol Hill, chair of the House Republican Conference, representing the 9th District of Michigan. Congresswoman, it's good to see you. Welcome back. And I guess I should say happy shutdown day, or there's probably not much happy about it considering what's going on here. I know that this is a Senate matter right now, and they're going to keep voting on the continuing resolutions that we have seen. But I guess the big question today is how long this might last. What are you hearing behind the scenes?
You know, I can share with you from the Republican standpoint, we hope it doesn't last very long because we don't want the American people to feel the pain from the Democratic shutdown. So I really don't have a sense of that because it's not in our hands. It's in the Democrats' hands right now.
Congresswoman, our understanding is the OMB director, Russ Vought, was set to speak to your conference today. Can you confirm, has that call already happened, and what was discussed, including the future of potential permanent layoffs?
Yeah, I left the call early to come to the interview, so we did have the call, and he was explaining kind of the process on how things work if this government shutdown continues. He's stressed again that he hopes that it doesn't continue, that the president and the administration don't have to make the tough calls. But at the end of the day, there's only so much money to go around, and it is, you know, Mr. Vought's job, as well as the administration's job, to figure out who is essential and how to continue the programs that are essential. But he wanted to stress again that this can all be avoided if the Democrats come to the table like they have under Chuck Schumer 13 times before and vote for the exact same CR that they voted for in March.
We spoke earlier this hour, Congresswoman, with Senator Ted Budd, the Republican from North Carolina, who made the point that if employees, federal employees, are deemed non-essential at this time, then maybe they shouldn't be working for the government to begin with. Should those 750,000 furloughs today be layoffs?
You know, I think it's a really hard question really to answer. And I say that because I think if that happens, and again, I hope it doesn't happen as a Republican, I hope it doesn't happen. But we know that the government is bloated, right? I think if this does happen, it's going to uncover a lot of what's going on in terms of who is essential and who really isn't essential. If I'm a furloughed employee right now, I don't know that I'd really want to have the government shut down right now.
And Congresswoman, I do want to keep with the labor market, pull on your expertise, your perch on House Fin Services, because our understanding is the BLS isn't going to release the jobs report this Friday, of course, considered to be one of the leading indicators of the health of the labor market. Are there any discussions when you are hearing from the OMB about what is essential and what is not, that data collection could actually fall into that bucket if this shutdown continues?
Yeah, you're right. Everything is on the table, and it's a really tough job to be in with that Russ has to do, is how do we make good decisions, right? Data is always important in making decisions. So again, I don't really understand why the Democrats want this shutdown to put more and more power in the administration's hands. Right? They've railed against the administration, in my opinion, unrightly so, for doing what the American people elected them to do, and that is be fiscally responsible. They right now are ceding all of the power to the administration. I don't understand it. It doesn't make sense to me. But, you know, as Republicans, we want to open the government. We want to get back to business, to doing our business. I would add this. As Republicans, we've passed all 12 appropriation bills out of committee. We are getting back to how business is supposed to be done in D.C., right? That's what the people want. They want something different. They don't want this big omnibus, right? They want us to go through the appropriations process. That's what we're doing right now, but it's really tough to do that when the government's shut down.
Congresswoman, would you be willing to promise your Democratic colleagues to have an actual negotiation and debate over the extension of Obamacare subsidies if the government is reopened, or has that overture already been made?
No, we have to have that discussion. We have to have that negotiation. We have to have that debate, right? And that's what we're willing to do. But the issue is we have a funding issue right now. This isn't a health care issue. It's not an agriculture issue. It's not a transportation and infrastructure issue. It is a funding issue. The ACA credits don't expire till the end of the year. We have plenty of time to debate and talk about that, which is exactly what we should do, not attach it and cram it down the throats of the American people.
But Congresswoman, just for clarity, do you support any extension to the expiring ACA premium tax credits?
What I support is going through regular order and having debates and discussions. That is how government is supposed to work. We are supposed to work for the American people, and that's what Republicans are doing right now by continuing to want to keep the government open.
Well, there are a lot of questions about how that's going to take place. Democrats tell us that notifications start going out today to those folks, and that premiums are in fact already rising. What are you hearing about the cost of health care in Michigan?
Yeah, listen, the cost of healthcare is extremely important, and that's why I applaud President Trump. He told you on the campaign trail that he was going to bring drug prices down, and what did he do yesterday? He brought drug prices down. So I applaud President Trump for doing that. He's actually not talking about it and not using it as leverage. He's actually delivering for the American people. What the people in my district are also telling me is they are tired of the waste, the fraud, the abuse that is happening in this healthcare situation right now, and that has got to be eliminated. That's exactly what Republicans did through the working families tax cuts, and that's what we are going to continue to do. Let's get rid of the waste, the fraud, the abuse, to make sure that the healthcare programs that we do have actually work for the American people.
In the final minute we have you, Congresswoman, we did hear Democratic leaders repeatedly say that the ultimate decider here is going to be President Trump. Is that the right assessment? Is the White House fully leading these negotiations?
Well, right now, President Trump is our commander-in-chief, right? And the Republicans, we have been in constant contact as House Republicans with the White House, with President Trump, on keeping the government open. The president wants to keep the government open. We want to keep the government open. The only people right now that are standing in the way are the Democrats. So we've been in constant communication and constant contact. We're ready to go.
All right. Republican Congresswoman Lisa McClain, she's the chairwoman of the House Republican Conference and represents Michigan's 9th District. Thank you so much for joining us here on Bloomberg Television and Radio. And Joe, at this point, I mean, we're speaking with members on both sides of the aisle, and it seems like everyone's really dug in. Just to reiterate one of the headlines from Vice President J.D. Vance in that impromptu press conference, saying healthcare policy that needs to happen separate from these shutdown negotiations.
That's exactly what John Thune has said as well. You need to reopen the government for negotiations to commence, and that's something that we'll be talking about with a number of lawmakers this evening. I'm going to head back up to the Senate. We're going to do what we did last evening. We've got some very important voices for you to hear from both sides of the aisle. That starts at 5 p.m. Eastern. You'll be here with our panel.
Yep, it's going to be a jam-packed show. Tina Smith, one of the senators Joe will be speaking with, alongside Dan Sullivan. Stick with us. This is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Welcome to the fourth quarter, everybody. Yes, indeed. This is Bloomberg Business Week Daily on this first trading day of the fourth quarter, the first trading day of October. And Tim, we've got stocks higher and U.S. Treasury yields a little bit lower.
You might have remembered yesterday I asked the question in our simulcast, do we still have to come into work if the government shuts down?
Yes.
Well, I answered my own question. We are here, even though the government is shut down.
Yeah, it's not so for a lot of federal workers. Hey, listen, we're going to get into all of this also in the next 60 minutes. Speaking of the markets, what investors are watching, they're certainly thinking about what the Fed does later on this month. Investors seem to be banking on another Fed rate cut later on this month. Speaking of the Fed Governor Lisa Cook keeping her job for now. We'll get into that. We've also got the latest reads on the U.S. labor market. And so we kind of have a Fed/eco/jobs data/government shutdown roundup. That's what I'm calling it.
Okay, that works. We also got a roundup on the latest consumer tech because as we do get into the fourth quarter, all these companies are thinking about what are they putting on sale for the holiday season. Amazon's overhaul to take on Apple, Peloton's price hike, and the aura of the latest Aura Ring.
A lot going on in the consumer tech space. Hey, also a lot going on in the Middle East as they try to pivot in terms of their economy and what it is for the next 100 years. So we're going to talk about that with the CEO of the Bahrain Economic Development Board, what they are doing to attract investment in. And yes, technology, AI, we're going to guess that's got a component to it.
All that and more coming up over the next hour right here on Bloomberg Business Week Daily. First up, though, a check on the day's trade and top business stories. Here's Alexis Christoforous in for Charlie Pellet. Hey, Alexis.
Hey, guys, thanks. Shutdown? What shutdown? That's what Wall Street's saying right now. We have stocks higher across the board. The Dow Jones Industrial Average is up 33 points. The S&P 500 adding 19. NASDAQ Composite is rallying 89. Treasuries are a bit lower here. The yield on the 10-year at 4.11%. The 2-year yield 3.5%. Commodities have been paying attention to the government shutdown, though. Earlier, gold touched $3,900 an ounce, a new all-time high before pulling back. It is now down slightly at $38.58 an ounce. Meanwhile, key ADP jobs data showed private payrolls declined in September widely, missing estimates and increasing the odds for 2 more rate cuts from the Fed. Remember, because of the government shutdown, we may not get the government's monthly jobs report due out on Friday. In stock news, strong egg sales at Cal-Maine, not enough to impress investors. Quarterly profits missed estimates at the food company, and Cal-Maine is now doubling down on prepared foods, investing nearly $15 million in a high-speed pancake production line. Shares of Cal-Maine down 2%. And U.S. Energy Secretary Chris Wright tells Bloomberg News the U.S. government is taking a 5% stake in both Canada's Lithium Americas and its Nevada mining project. Shares of Lithium Americas, nice day for those investors, up about 25%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash. Back over to Carol and Tim.
All right, Alexis, thank you so much for that. Well, when it comes to kind of eco-Fed news, here's what we got for you. Payrolls at U.S. companies unexpectedly dropped in the month of September, due at least in part to issues with some data analysis. You've got Fed Governor Lisa Cook keeping her job, at least for now, following a U.S. Supreme Court order. And then, Tim, you've got the White House pulling their nomination to lead the Bureau of Labor Statistics, so throwing the leadership of the agency into further disarray.
Well, we've got our economics, our Fed, our BLS roundtable here in the studio. Michael McKee is a Bloomberg TV and radio international economics and policy correspondent. Also, Molly Smith, she's a Bloomberg News economics editor. They both join us here in the Bloomberg studio. Mike, I want to start with you and about Lisa Cook keeping her job for now. Obviously, it's people who are supportive of the structure or the independence of the Fed are cheering this, but I'm wondering from a legal perspective, it's the idea that she keeps her job for now. What does the for now mean here?
Well, it means until the court rules, which they said wouldn't be until sometime after January because they're going to hear oral arguments in the case in January. It's a rather long postponement of the decision by the court, although anything's possible these days. One reason may be that they are taking up the case of the FTC commissioner that the president is trying to fire, whom the court allowed to be fired. But they're going to hear arguments in that case in December. And because some of these previous cases have involved the Federal Reserve, and the court has suggested there may be some slack given to the Fed that isn't given to these other agencies, it may be that they want to consider the cases more or less sort of together at the same time to think about how one affects the other. That is one reason that they may have punted on this for the time being.
So for those who are in favor of her staying on the Fed board, they shouldn't open up the champagne or anything and celebrate yet, because there's still some hurdles to go.
There's still some hurdles to go. They will have a hearing in January, and we don't know if that means that it would be something that gets delayed in terms of a decision in the same way that a normal case would be, because they're not taking the case itself. They're taking the emergency application that the administration put forward to just let her be fired. The case itself would go through the lower courts first and maybe eventually make its way back up.
Having said that, the Supreme Court could have said, yes, President Trump, okay?
Yes, and some legal analysts are suggesting that means that they do have some thought that she might be in the right, and that she might be able, the president might not be able to fire her directly.
All right. Speaking of personnel in the federal government, Molly, I want to bring you in. You and the team writing a great story about the White House pulling the nomination to lead the Bureau of Labor Statistics. What happened? Because it feels like a little bit of an unusual move by a White House that's rather deliberate in its actions and kind of doesn't take it unless it knows things are going to stick.
So we had been wondering if there was something going on with this nomination, because we knew that the Senate committee that would have heard the nomination proceedings for this candidate, whose name is E.J. Antoni, that they had already received the paperwork and were going to hold a hearing for this nomination several weeks ago. So we're wondering what the holdup is. Already had an indication that there was one Republican senator who said that she had, quote, extreme reservations about the nominee, and that her vote alone could have blocked this nomination from proceeding, because the Republicans in this particular Senate committee only have a one-seat majority. So that really could have throttled the whole thing. And we just heard from the White House press secretary, Caroline Leavitt, say in the briefing that it looked like they weren't going to have the votes to get this through. So they withdrew the nomination last night. They said they look forward to putting forth a new candidate soon. Either way, though, we still have the acting commissioner in place. So that's who had been the deputy commissioner before, Bill Wyatrowski. He's been at BLS for 50 years or so. So he's a pretty experienced guy. He knows what's going on.
Sounds like it.
Is it possible he'd be the White House's pick?
I doubt it, just given that they seem to want somebody who's probably a bit more overtly aligned with the administration's views. And Wyatrowski is considered to be more of a career BLS technocrat, which is not something that the White House would seem keen to want to go forward with.
Well, as we continue to watch the government shutdown, Mike, I guess we're not going to get date on Friday, right? We know that's a given.
They're going to vote one more time in the Senate on trying to get the CR passed. It doesn't look like it's going to succeed. If it did succeed, they could put the report out, because the data are all finished. It's just a matter of giving it to the commissioner, Mr. Wyatrowski, and then having him transmit it to the White House ahead of time. But if we don't get that today, we will not have the jobs report on Friday. We won't have jobless claims tomorrow. Tomorrow being Yom Kippur, there is no Senate meeting, so they can't vote again.
All right, a very different jobs week in that case. Since we just brought up the shutdown, we do want to go to Washington, the House briefing room. House Minority Leader Hakeem Jeffries making some comments. Let's listen in.
Republicans have consistently shut the government down as part of their efforts to try to extract and jam their extreme right-wing agenda down the throats of the American people. Democrats have repeatedly made clear we are ready to sit down with anyone at any time and at any place in order now to reopen the government, to enact a spending agreement that meets the needs of the American people, and to address the devastating Republican health care crisis that has caused extraordinary harm on people all across the country, in rural America, working class America, urban America, small town America, the heartland of America, and black and brown communities throughout America. The Republican healthcare crisis is devastating, the likes of which no one has ever seen. Largest cut to Medicaid in American history. A possible $536 billion cut to Medicare because of the one big ugly bill, if Congress doesn't act by the end of the year. Tens of millions of Americans are about to experience dramatically increased premium, co-pays, and deductibles because of the Republican unwillingness to extend the Affordable Care Act tax credits. Hospitals, nursing homes, and community-based health clinics are closing all across the country, including in rural America, because of what Republicans have done and the healthcare crisis they have triggered through their cruel actions throughout this year. Republicans have even canceled medical research in the United States of America, even as it relates to children who are battling cancer. The Republican healthcare crisis is immoral in nature, and Democrats are fighting hard to reverse it. Cancel the cuts, lower the costs, save health care on behalf of the American people. It's now my honor to yield to the whip, Catherine Clark.
Thank you, Mr. Leader. We are so grateful for all that you have done and putting the American people's voice into this debate. And I've had one question from my Republican House colleagues this week. Where the heck are you? Where the heck are you? You've cut people's health care. You're giving their hard-earned tax dollars to billionaires in the form of tax breaks. And then you don't even show up to defend your own policies, your own bills. Mike Johnson and Steve Scalise are both from Louisiana. Most children in Louisiana are on Medicaid. 64% of all births in Louisiana are paid for by Medicaid. 74% of nursing home residents in Louisiana are on Medicaid. Yet Republicans are willing to shut down government, refusing to even show up for work this week because they want to cut Medicaid by $1 trillion, because they want to defund health care for children and seniors and pregnant women, because they want to pay for billionaire tax cuts. Well, Mike Johnson and Steve Scalise can fight for the billionaires. They can double down, if they so choose, on their lie about who we're fighting for. But we know who we're fighting for, and so do the American people. Democrats are fighting for families, families in Louisiana, families in Massachusetts. We're fighting for American families in every corner of this country. We're fighting for a child's right to go to the doctor, fighting for a new mom's right to have a safe delivery. We're fighting to keep millions of people from losing their insurance and keeping health premiums affordable for everybody. We're here to do our job. It is long past time that Republicans join us and end this Republican shutdown. It's now my great pleasure to yield the microphone to our chairman, Pete Aguilar.
Thank you, Whip Clark. And as we're fighting, Republicans are nowhere to be seen. Our message has been very clear. Cancel your vacation, cancel the cuts, lower the cost, fix health care. That's why we're here. Donald Trump and House Republicans have shown their true colors this week. Instead of protecting health care, they're ripping it away. 15 million people at risk of losing their health care coverage. And while we're here trying to keep the government open, the guidance from our colleagues on the other side, Lisa McClain, my counterpart, the chair of the Republican conference, instructs their members, don't talk about health care. That is their message. So while we're fighting for health care, we're fighting to keep this government open. The guidance from the GOP has been very clear. Don't talk about these issues because they know the American people are with us. Democrats have been at the negotiating table for months, and we want to work in a bipartisan way. We've always wanted to work in a bipartisan way to solve these issues. Republicans control the House, the Senate, and the White House. They own this crisis. They own this shutdown. And instead, they want to use people as political pawns. Russ Vought wants to lay people off. He wants to fire people. He wants to use this shutdown to carry out the agenda that he has wanted all along. It's shameful and it's wrong. Republicans will do everything in our power to fix this Republican mess, to provide health care to people and to ensure that the American people aren't left out in the cold, because it's the right thing to do. Leader Jeffries.
Thank you, Pete.
All right, folks, you have been listening to the Democratic leadership. You did hear from House Minority Leader Hakeem Jeffries going back to the podium. We'll monitor to bring you any headlines. He was followed by Democratic Whip Catherine Clark from the state of Massachusetts. And then we did also hear from House Democratic Caucus Chair Representative Pete Aguilar from the state of California, making some comments about the government shutdown and some of the issues at play. We should point out our most read story on the Bloomberg at this hour: White House Budget Director Russell Vought planning to swiftly dismiss federal workers with layoffs expected to happen within 2 days, imminent very soon. And that was something, Tim, specifically, we did hear the minority leadership talking about specifically. Keep in mind, a group of moderate Republicans and Democrats are searching for a way out of the shutdown, discussing options such as a short stopgap bill while an extension of expiring Obamacare subsidies is negotiated. Healthcare in particular is certainly a sticking point between the two parties.
Oh, it absolutely is. I mean, that's what comes up, whether you're talking or we're hearing from Democrats or Republicans. Carol, on the firing comments, we did hear from White House Press Secretary Caroline Leavitt, who said that layoffs would happen within 2 days, imminent very soon, but declined to give any details about what agencies or positions would be targeted. President Trump and his team have moved quickly to capitalize on the shutdown to shrink the size of the federal government. The administration earlier on Wednesday halted $18 billion in federal funding for infrastructure projects here in New York, including for the 2nd Avenue subway project and the Hudson Tunnel project as well.
Meantime, I do want to mention something that the president has put out on social media addressing the Federal Reserve, something we just talked about with Molly and Mike, and that is the president saying, I really believe that Fed Chair Jay Powell, too late. Powell is an obstructionist, so continuing certainly to target the chair of the Federal Reserve. Back to the House briefing room we go, and to House Minority Leader Hakeem Jeffries.
Driven by the demands of hardball politics, driven by left-wing groups to make a show of opposition to President Trump. That's a pretty harsh statement from one of your own members. You refute that?
House Democrats have consistently made clear that we will sit down with anyone at any time and any place to enter into a bipartisan agreement that makes life better for the American people. We will not support a partisan Republican spending bill that continues to gut the health care of everyday Americans. Health care is not a partisan issue. It's not a partisan issue. It's an American issue. And when you strip away health care from everyday Americans, that impacts Democrats, independents, and Republicans alike. When you strip away health care from the American people, as Republicans have done and want to continue to do, you're impacting people in rural America, in urban America, in the heartland of America, from coast to coast, and all points in between. This is not a partisan issue. Defending access to health care that's affordable, standing up for hospitals and nursing homes and community-based health clinics, that's not partisan. That's as American as baseball, motherhood, and apple pie.
But you must disagree with Mr. Golden here.
Question?
Right? Mr. Leader, so Russ Vought just spoke to House Republicans on a call, says that these firings are likely to start within the next 48 hours. Also said that WIC is going to run out of money within the next week. And he just posted that $8 billion of green energy will actually be cut immediately, and it's going to affect 16 states, all of them which have either Democratic leaders or Democratic majorities in their state houses or Senate. What's your response to that?
These are all
Feeling
things
the
that-
pressure?
These are all things that the Trump administration has been doing since January 20th. The mass firings of federal workers, Trump administration has been engaging in this since January 20th. Targeting the clean energy economy, Republicans have been doing that since January 20th and assaulted the clean energy economy and the creation of good-paying American jobs in their one big ugly bill. Trump administration has been killing jobs. This is a job-killing administration. Job creation is down, but you know what's up? Costs. They promised to lower costs on day one. Costs aren't going down, costs are going up. Inflation is going up under the Trump administration. And one of the reasons why Democrats are fighting hard at this moment is because unless we extend the Affordable Care Act tax credits, more than 20 million Americans in a matter of days are about to experience the reality of dramatically increased premiums, copays, and deductibles. Many of them will experience medical bankruptcy as a result. That's why Democrats are fighting hard on behalf of everyday Americans. I'll yield to Catherine to talk about the WIC issue. But in every other shutdown that Republicans have caused, including in the 35-day shutdown that Donald Trump presided over in 2018 and 2019, funding for women, infants, and children, their health, their nutrition, and their well-being was maintained. It was maintained. In every other shutdown, the reason why the Trump administration is threatening now to cut funding for women, infants, and children is because they can't stand that program. They're on the side of their billionaire buddies. They've been running the largest pay-to-play scheme in American history. And Exhibit A of that was their one big ugly bill, which is now law. Largest cut to Medicaid in American history. And they stole food from the mouths of hungry children, women, veterans, and seniors, and all of this was done to provide massive tax breaks to their billionaire donors. We're fighting for the health care of the American people. They're fighting for their billionaire donors, their friends and family plan, which has been all about enriching the lifestyles of the rich and shameless from the very beginning of the Trump administration. So all this talk that we see right now, as if it has anything to do with the shutdown that Republicans have caused, no, it's their ideology. Cruelty is the point when it comes to the Republican Party.
All right, you are listening to House Minority Leader Hakeem Jeffries there in the House briefing room as members of the Democratic Party, the leadership of the Democratic Party responding to the government shutdown. We did hear earlier from the Republican leadership, most notably J.D. Vance, Vice President of the United States, talking about the Republican view and perspective on this, something that we continue certainly to monitor. It is among our most read stories on the Bloomberg. For the latest, you can head there. We're going to be covering it over the next 3 hours.
I'm curious what Ali McCartney has to say about this. She's certainly watching this closely. She's here in our studio. She was listening to those comments by Democratic leaders. She's Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners at UBS, managing just over $1 billion. Ali joins us here in the Bloomberg Business Week studio. Let's start with the shutdown. You are listening to Democratic leaders right now. It doesn't seem like investors really care about this. We've seen this playbook before. We know that the government will reopen. Is that the right way to look at this?
Look, I think what you have to do in situations like this, which is hard as a journalist or an economist to do, quite frankly, is to put sort of the human impact, which is real for many people in many different ways, in context, but understand the macroeconomic and the market context. So historically, shutdowns have not really impacted markets. If there is an effect, and it usually is a negative effect, it is usually very short-lived from a market perspective. This one is a little bit interesting because of two reasons. The first is because we are so much on the Fed and the BLS data and what the unemployment or labor market looks like. And so the fact that we might not have access to the data. Now, remember, the largest conversation going through Wall Street has been, should we even be looking at that data? What is the integrity of it and what does it mean? So I think the question that people might be asking themselves, which I don't think is it is going to happen, is could the delay in data, whether it's 2 days or 2 months, change the directionality of the Fed? Which I think, to your point, when you said, Trump is now tweeting, about Powell, I don't think that was coincidental.
Why? What do you, because it's interesting. I was thinking about, how we wanted to come at you in a good way, but meaning all the things that are coming at investors, Ali. Like, you've got this government shutdown, as you kind of said, we can probably dismiss it, but a tariff environment that is still a little bit fluid.
For sure.
An earnings season just around the corner, and then you've got a Fed that's in a tricky place, and then you have the president coming out. Why do you think the president did that?
I think that the president is trying to remind the Fed, Powell and all, especially with the other announcement today in terms of the Supreme Court's ruling that you were talking about.
Lisa Cook, yeah.
That he's in charge and he knows, and he is, and it's too late. He wants this directionality. He wants interest rates to go lower. And he talked about some not so subtle things that he's going to do in the short to medium term to get his way. Now, I think the thing that we have to be really careful of is when we talk about history with this administration, this is a different kind of administration that does things quickly, that may not appear as anticipated or thought out. And so although we are saying historically markets are muted in terms of their reaction, historically macroeconomic consequences are very short and quick to reverse, there is the possibility, like there was in April, like there could be in anything, any day, that this could go a different direction, whether it be furloughed workers, whether it be green policy, whether it, so there is an aspect, especially as we're 38% up in the U.S. markets from the April low, that, we've had, ending last week, we have 15 straight days of just up in momentum. We are priced to perfection. There are a lot of things in the equity and fixed income market that investors may ultimately be right about, but are relatively complacent about. So this is another risk on top of sort of a salad of risks that are out there now.
Well, let's talk about the labor market risk, because we did get some data earlier today, ADP data, which we're talking about because we probably will not get the BLS data on Friday. That wasn't pretty if you... believe in this economy. 51,000 was what economists surveyed by Bloomberg expected. 32,000 is what a negative 32,000. The economy shed, private payrolls shed 32,000. That on top of potential furloughs or mass firings.
Right, that's a complication.
It is a complication. What is the economic impact of that?
So I think it all goes to the same point, which is that ultimately, when we look at the average age of a U.S. worker, in terms of this being, our average age being about at retirement, when we think about things like the tariffs that much more largely affect low-income people, we need people to have jobs, and we need people to have great paying jobs, and we need, at the same time, to be retooling the labor force because of AI and what is happening in both the manufacturing but the services industry. And to the extent that we are not doing any of those, I was recently at a dinner over last week when everybody was in town for foundations and the UN and Climate Week. And really the focus economically of that dinner was, are we investing in our labor force? Are we educating people? Because, I know I look at my kids and how they're getting through high school. I don't think they're learning anything. I don't know what college does for them. I don't know if trade school and student loans for trade school is the way to go. I don't know if I should tell my sons to be HVAC repairman or plumbers, or certainly shouldn't tell them to be coders. So I say all that to say, not only do we have an aging workforce, we have a completely changing human capital perspective. And most companies right now, most states and our federal government, in a sense, are on pause, waiting to see what happens.
I love that you went there. Same thing, having discussions with, a lot of companies' senior leadership that was in town last week, and talking about the potential for like a 5 to 7 year labor market dislocation. which if you are coming out of college at that point or just starting your career, that's kind of a big bummer because that's a long time.
It's
to
a really
be
long
in a
time.
market that's that fluid.
I think
or figuring its way forward.
And I think there are two parts to that. There's, first of all, how do those people begin to create what we all thought was the American dream, right? Building equity, buying a home, savings. But the second part of that is, if you don't ever have entry-level employees or analysts or associates at investment banks or real estate firms or tech companies, who then becomes the next generation to create ingenuity and push economic expansion?
So you're asking a lot of existential questions.
I am.
But you also do asset allocation and manage money.
I'm bullish on the market.
So given your concerns, given what you just told us, the questions that you have about the broader economy and life here in the United States, where do you put your money?
Okay, I'm glad you asked that. So we're coming out of a month, September, where almost everything worked, right? Against history, against sort of correlation. Crazy sort of month. And then we have the narrative that we are going into the fourth quarter, which usually is also expansive.
Right.
So what am I doing now? I continue to buy gold. Weak US dollar, central bank buying. There are some risks, many of which we've been talking about today. 2, long-term munis. Finally widened a little. We think that we're setting up for them to get a little bit cheaper. That's a place to look when you're a New York or California high-income taxpayer, and you can get, 4% coupons that really are closer to 8% for your experience. Private investments. The private investment market, the venture capital market now, is about 60% of every dollar is going to AI. That's never been seen before. Let me give you a sort of a corollary. FinTech was about 15%, so 15 cents on every dollar. So I think there has to be a lot of diversification. I think there has to be, you have to own broadly, right? We're at a point where for the S&P 500, at least 185 stocks are outperforming the benchmark. That means we're getting some breath. There could be another couple, maybe third to go. But I think you can't get too comfortable here. This is a precarious environment. Your balance sheets right now look really good, but there are a number of issues out there, whether they be political, whether they be sociological, whether they be from the threats or the benefits of productivity and AI on the labor market. And so you really have to be like spreading all your bets.
Yeah, and it's interesting to have a VIX that's at 16. I mean, there feels like a lot of complacency in the market. Allie, thank you so much.
My pleasure.
Good to check in with you again. Allie McCartney, she's Managing Director, Wealth Management and Private Wealth Advisor with Alignment Partners over at UBS. They've got just over $1 billion in assets under management. Allie, thanks.
Well, I said we'd talk tech. Let's do that because Alphabet's Google introduced a range of new Nest-branded hardware today, just a day after Amazon held its own product showcase as both companies vie to more deeply integrate AI throughout the smart home. As for Amazon, the company overhauling its devices to take on Apple in the AI era. Also, Peloton shares swinging wildly today. The company hiked prices in a sweeping product revamp. And then, Carol, there are the wearables. Aura launching a $500 ceramic smart ring with a new blood work tracking tool.
Where shall I spend my money? That's what I'm thinking. Or where will my husband spend his money? It's a lot. We knew we needed to know what's going on.
He's a gadget guy, so.
He is a gadget guy.
Listen up.
I'm like, what's this new box? What's this new device? Bloomberg News managing editor for Global Consumer Tech. I'm assuming he has lots of boxes and devices always in his orbit. We're talking about Mark Gurman. He's out there in our Bloomberg News LA bureau. Mark, a lot here to unpack. What's the biggest news? What do you think we should first pay attention to?
So I'm just going to ignore everything you guys said. I listened well, don't worry. But I actually just got something a few minutes ago. These are the Meta Ray-Ban displays. These are Meta's first display glasses. I haven't set them up yet. They just came into the office. These are the first mainstream smart glasses with a screen and the lens. We've talked about them significantly. And then it has what's called the neural wristband. You put this around your wrist, and that allows you to track your finger movements and your motion in order to navigate the user interface of the glasses. So I'm actually really excited to diving into these a little bit later today, really using them and eventually publishing my review. They're $800. They went on sale yesterday at some Ray-Ban and LensCrafters stores, Best Buy stores. So excited to dive into these.
What's the learning curve using this, Mark? How do you have to be trained to use it? Do you have to do a demo to use it? Can you just use it out of the box? Is it going to be easy for consumers?
They think that you need this crazy demo, and so they're not letting anyone buy it who doesn't get the demo. I got the demo at Meta's headquarters a few weeks ago, so they were pretty comfortable with me just getting one out of the box. There's probably going to be some sort of, they tell me, a video that plays on the glasses that, when you first do the first boot, tells you how to use the thing. There's a little bit of a learning curve, 15, 20 minutes or so on the learning curve as well. And so it's going to take a little bit of time to get used to it if you're new to it, to get it up and running. But I think people will eventually like this technology. My hope is eventually it moves to a hand and eye tracking like setup, so you don't need the neural wristband, something similar to how the Vision Pro is operated. But definitely, I think this is a category that's going to take off.
Unbelievable. I know when you talked about this last time, I mean, I think both of us were blown away and looking at your video that was on the Bloomberg about how to use it. Learning curves, there's these videos to kind of have, we figure out how to use things. But when I think about learning curves, Peloton, I feel like is still on a learning curve. And the stock has swung. I think it's like a 10 to 12% swing, Mark, from high to low today. They're upping prices. Explain this to us, and is this the way forward for this company?
So it's a mixed bag, right? The stock is down probably because of the changes in pricing. They hiked prices between a couple $100 and $700 on the high end, depending on which bikes or treadmills you're looking to purchase. They hiked subscriptions between a couple bucks and $5, depending on which subscription you're getting. So Wall Street doesn't like that because that's going to lead to regression, even more regression in terms of user numbers. It's going to lead to people leaving their subscriptions. It's going to lead to people maybe not wanting to buy the devices themselves because of the higher price points. And so, Wall Street usually likes a price hike, but in terms of Peloton, they really seem to despise it. On the other side of the coin, I think the hardware that they rolled out today is extraordinarily impressive. This new CEO has been in the building for a little bit less than 10 months. Actually, I think maybe 10 months to the day today. And they've got 5 or 6 new hardware devices. Under the prior CEO who was there 2.5 years or so, they did basically nothing in terms of new product launches or innovation. So I think they deserve a lot of credit for working overtime and really fast to get this new equipment out. And so we'll see what really happens with these user numbers based on these price increases, but clearly Wall Street is terrified.
Okay, let's move on to another wearable in the Oura Ring, a $500 version of its smart ring. This one's ceramic. We should remind everyone, a lot of this stuff coming out right now because this is the holiday season. This is when people do holiday shopping. We traditionally get a lot of new devices and gadgets out during this time, Mark. This new Oura Ring, I was surprised that Oura has such a high valuation now. It raised money. Bloomberg News reported on this in recent weeks. What can you tell us about this ring and what it does for the business or could do for the business?
I think it's going to do nothing for the business. This is absolutely the same ring that they launched, I think it was last October. It's the Oura Ring 4. It's just coming out in a new finish. That's $100 more expensive, so it's the ceramic finish. I have the ceramic blue one arriving at the office tomorrow, so looking forward to taking that for a spin as well to see if there is anything more meaningful about it. But this is just probably a marketing lever and maybe raise ASP slightly.
Okay.
$500 for a smart ring, interesting price point. Let's see what happens. But Aura's a really fantastic business. But the problem is that they're $10 billion in terms of the valuation right now, so they're too expensive to get acquired, right? And they're not worth enough to be like some major hardware company, but they're getting there. They need more types of devices. They need to expand beyond rings into other types of hardware.
Yeah, I was going to say, when it comes to things like this, technology devices, consumer tech, Mark, I mean, are we that easy? You just put a different finish on and we're like, yeah, I'm going to spend the money. We're not that easy, are we?
Depends.
Sometimes.
Maybe. I don't know. We'll see. I don't think people are going to buy the ceramic version. I think it's going to be super niche. I think people are more into the couple $100 version. The reason these are doing so well is because of like FSA, HSA, whatever accounts. People are using that to buy these devices. And then a lot of people, maybe not a lot of people, but some people have the Amex Platinum.
Yes.
And the Amex Platinum, they just did their big price increase. And as part of that, there's like a $200 annual Oura Ring credit on there now. Unfortunately, and they should change this, that doesn't work with the subscription. You have to pay like $6 or $7 a month to use an Oura or $70 a year. But the $200 a year you get from Amex is kind of a scam because you need to buy the new hardware, and Aura doesn't come out with new hardware every year. That's neither here nor there, but that might be driving some purchases too.
Is Aura? I mean, and you wrote the story, just a couple of weeks ago about the multi-billion-dollar valuation. Is this a hardware company or is it a software company? Software as a service?
Well, it's both. They would be fine if they didn't have this subscription, but it's really the subscription and the annual subscription in particular that I think is driving things. You know, they always say hardware is hard. Hardware is very bad margin-wise. It's not a good business. But when you're able to put a software product on top of it that has a 90% margin, you're in pretty good shape. This is why Apple shifted to services almost a decade ago now, because they knew that hardware sales were flatlining. They knew margins could potentially go down. They knew they would have to adjust prices, and the way to create recurring revenue is putting something on top that's necessary. And Aura and Whoop and some others Peloton, of course, is the poster child of this, have figured out this hardware plus software business model.
All right, speaking of hardware, let's go to your story that's out about Amazon overhauling its devices to take on Apple in the AI era. What do we need to know, and what kind of stood out for you?
They look really cool, I think. I think Panos, he's the SVP of hardware now at Amazon, and Alexa and services, has done a really nice job on redesigning the hardware of the Echoes and the Echo Shows. 3 new Kindle Scribes. These are Kindles that you can read on, but you can also write on and draw on. It's sort of like a scratch pad. I think they look terrific, and these are going to do pretty well. The new Color Scribe, $630, is the most expensive Kindle device ever. I think actually the most expensive device from Amazon since the failed Fire Phone from a decade ago. I think it's going to do really well. For me, I actually like this new mid-tier Kindle Scribe. It has a backlight. It looks like really nice, bright white paper, but obviously digital. So I might get one of those to do some reading. I need to go back to reading, and maybe I'll get one of those for the holidays.
Don't we all?
I'll send you some books, Mark. In the meantime, just very briefly, we didn't get a chance to talk about the Nest branded hardware. Again, I said it would be sort of round the world with Mark Gurman in terms of tech devices. What do we need to know about Alphabet's lineup?
It's kind of whatever. The most interesting thing to me is they announced this $100 speaker. They announced it today, but it doesn't come out until the spring, which I guess is anywhere between March and the end of May. Why they released it so early or announced it so early before the release, only, I don't know, God knows. I guess they wanted to just tell a more cohesive story and try to get out in front of some of the Apple announcements coming up in the next several months. Moving to 2K video quality, I think that's good. Ring at Amazon the other day or yesterday, they announced 4K video. So it's kind of interesting that Amazon and Google are completely 2 different spectrums of video quality in the same week.
Hey, really quickly, 20, 30 seconds. What do you think is going to be the big, hot consumer tech item this holiday shopping season?
Ooh, smart glasses. I think the Ray-Ban Meta glasses are going to do pretty well. And of course, the iPhone 17 Pro has just been blockbuster for Apple. They can't make them fast enough. So this is really big stuff for Apple this year.
All right, well, go play with your toys, and then we'll look forward to reading your next story. Mark Gurman, always fun to check in with him. He is Bloomberg News Managing Editor for Global Consumer Tech. Highly recommend you check out his writings and reporting on the Bloomberg Terminal and at Bloomberg.com.
Hey, we are just shy of an hour and 20 minutes from the close of equity trading on to this Wednesday afternoon. Let's send things on over to Alexis Christoforous in for Charlie Pellet. Hey, Alexis.
Thanks, guys. 242 on Wall Street. Stocks shrugging off the first government shutdown in 7 years. Get a load of these numbers. The Dow now at its best level of the day, up about 95 points. The S&P 500 is up 28. We've got the NASDAQ now climbing 115 points. Even the Russell 2000 along for the ride, up now about 5. Treasuries are lower with the 10-year yield at 4.10%, the 2-year yield at 3.5%. Gold pulling back after a big rally earlier that saw it touch $3,900 an ounce, a fresh record high. Now, this government shutdown means we may not get the government's monthly jobs report due out on Friday, so special attention being given to the September ADP report, which showed private companies slashed 32,000 jobs last month. That's more than expected, and it may increase the odds of 2 more rate cuts from the Fed. The Supreme Court is allowing Federal Reserve Governor Lisa Cook to keep her job for now and scheduled arguments in January to weigh President Trump's bid to fire her. In stock news, Tesla hiking lease list prices for all its vehicles in the U.S. after that tax credit expired. And for the first time this year, Tesla's monthly sales rose in France and Denmark. Shares of Tesla now up better than 3%. And we've got Nike shares jumping 6% after the sneaker giant posted a surprise sales increase for last quarter, but raised its tariff cost forecast to $1.5 billion. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's your Bloomberg Business Flash.
Hey, thanks so much for that update, Alexis. Do appreciate it. Alexis is giving us an update on the public markets, rather. A story getting our attention on the private side of things is something that just came out from Allison McNeely and Sri Natarajan, who write about what's happening with private equity funds as more and more of them are being established. An amazing headline: more PE funds than McDonald's signals pressure. Private market gains are pinning hopes that the next surge of growth will separate the best from the rest in an industry saturated by too many firms.
Listen, great headline. And here's the point. KKR partner Alisa Wood saying today at Bloomberg's Women, Money and Power event in London, which has been underway, says there are 19,000 private equity funds in the United States. There are 14,000 McDonald's in the U.S. How are there more private equity funds than McDonald's? That's actually crazy, right? She says capital coming back is really important. The mark-to-market paper gains only take you so far. And listen, we've talked about this. Private equity, man, it has been on a tear. There has been the last few years where, investors have been kind of waiting for their returns because companies have not been going public. There hasn't been much M&A activity. So it's just really fascinating. Those higher interest rates have really made it a struggle for buyout firms to offload their investments. So this has been very tricky for the PE market.
Enter AI, though, because private equity firms are now raising and deploying billions of dollars into AI businesses, particularly data centers, with hopes that the emerging asset class will deliver the industry a next surge of growth. They're acquiring AI companies and data center providers through their equity and real estate businesses, as well as lending against those assets. To your point, Carol, though, about numbers here, in terms of exits, because of the last few years, there haven't been many IPOs, save for the last few months. A lot of the companies that were acquired by private equity companies had been sold to other private equity companies. Yeah. So there's a lot of business happening between private equity companies, and those are the exits of late.
Yeah, moving it along, right? Kind of getting it off, the initial private equity firm's balance sheet to some extent so that they actually have new capital to deploy. And in an environment, this story, again, going back to what's going on in London today, we are talking about $7 trillion of investment needed to finance the rapid growth of AI. This is according to Hadley Pierre Marshall. She's Chief Financial Officer at Brookfield Asset Management, her firm among a number of big private capital players seeking a central role in the technologies build-up. Listen, what is the one theme, one of the major themes that we talk about all the time and really have for the last 2.5 years? And initially, it was about NVIDIA and chips and the demand and the ongoing demand and the AI build-out. And we've all kind of learned a lot over the last 2.5 years. Then it moved to the build out for data centers. Then it moved out to, all the power that we need to fuel those data centers. And, the frenzy, the activity, the investment, it continues. Although, and Tim and I, we've talked about this as of late, there are some questions about whether or not the revenues are going to be there for all of this investment. So there are some questions. And we've also talked about the circular financing going on, companies investing in other AI companies. And it feels like, wait, is this just kind of keeping all the momentum going, or is it a real investment that leads to financial payoffs?
You didn't say bubble.
I did not say bubble.
And Kathleen McCarthy Baldwin over at Blackstone does not think it's a bubble. She's global co-head of real estate. She said the firm doesn't see a bubble in the sector. Here's what she said: data centers are a great place to be positioned because you're not picking which specific application within AI is going to be the winner. You win when you see the digitization of our world playing out as we are all demanding more information, more compute, more content as well.
Yeah, it's interesting. And we talked about, AI so much, but you mentioned McCarthy Baldwin. She also pointed to another promising sign for the industry, the prospect of retail investors rushing into alternatives markets. And she says, looser regulations making it easier for Blackstone and its peers to expand beyond their traditional investor base to find new sources of capital that fuel investments. It's kind of interesting. We have seen this again, another trend, and I'm not going to say it's just 2 years, but the private markets, not just private equity, but private credit in particular. And there has been pressure, moves, actions to make those private markets more accessible to the retail investors. And so that, in doing so, can and will provide a whole other pool of capital for private credit firms and private credit investors. But, there's some questions about the lack of transparency and just, whether or not we need to be kind of cautious as we go because of that lack of transparency and just, some concerns.
I just want to bring everyone an update on the government shutdown. It's still shut down. That's the update. But
Yes.
the fact is the most read story, second most read story in the last 8 hours on the Bloomberg terminal has to do with what could happen to some federal workers this week. White House Budget Director Russell Vought is planning to swiftly dismiss federal workers. It's a sign that Republicans will lean into hardball tactics to pressure Democrats to cave to end a government shutdown. We did just hear from Democratic leaders at the top of the hour. Last hour, we heard from Vice President J.D. Vance, who spoke to reporters. I anticipate the back and forth will continue. We will always bring you the latest from Washington, D.C. when it comes to the back and forth.
In the meantime, while we keep one eye on what's going on in the nation's capital, we certainly keep one eye on Wall Street, and we've got a rally underway. So investors seem to be shrugging any concerns about maybe a prolonged shutdown. You've got the S&P 500, folks. It is up about 0.4%, 67.17, and the NASDAQ 100 a gain of about 0.5 percentage point, 126 points to the upside. Kind of an even split in the S&P, about 226 names to the upside, 275 to the downside. That's a look at the markets. Coming up, some stocks on the move when Bloomberg Business Week Daily continues.